Oh, hi guys. Welcome to the CA Inter Corporate Law Marathon. So I just want to give a brief idea about what we are going to cover. And by the way, next 15 minutes is going to be my introduction. Please watch that entire introduction without a failure. Getting it? By the way, we are discussing about paper 2, a revision of paper 2. Paper 2 consists of two parts. One is A, another one is B. So company law and paper B is other laws. Paper B other laws, we are uploading a separate video which is handled by our Sreshta faculty Vikita Madam. Okay, I will upload a separate video. And company law is handled by me and Subramaniam sir. So we have another faculty, DV Subramaniam sir, me and him. We both are handling. Now, straight away, without any other discussion. So first, what chapters we are going to cover? First of all, what are the chapters that we are having? We are having totally 10 chapters. Now, this 10th chapter, audit and auditors. Please watch my audit marathon. Please watch my audit marathon. You can type caramharsha audit marathon. You will find a video with 4 lakh plus views. In that audit and auditors, company audit topic is covered. You can watch that. Or after September 3rd week or 4th week, I will upload some marathon. In that, company audit will be once again covered. Next, what we are not covering in the corporate law marathon. In the corporate law marathon, what we are not covering? We are not covering M&A chapter. We are not covering prospectus chapter in the marathon. We are covering rest of the chapters. Now, what are handled by me? The following marathons, these chapters are handled by me. So I am handling these two chapters. Whereas preliminary, incorporation, share capital, deposits and charges. All these 5 chapters, DV Subramaniam sir, who is our company law faculty, he will handle. That's it. Now, believe me, after watching this entire 11 hours of the video, this company law, purely company law, we are actually covering company law weightage is what, how much in exams. Actually, paper 2 will be, weightage will be 120. You need to attempt for 100. So, paper B, other law will be having approximately 50 marks weightage and company law will be having approximately 70 marks weightage. And out of 70 marks, what we are not covering in the revision, what we are not covering is management and administration and prospectus. Both together, maximum weightage. I'm not talking minimum weightage. Maximum weightage in exam is 20. So which means effectively 50 marks weightage of company law we are covering, and other laws, entire 40 marks worth of 100% syllabus is already covered in another video. So through this, we are giving you 90% syllabus under revision for law. Whereas this video is only about company law revision. Now this video, if you observe, we have given below timestamps. So first, whatever the order in which we have given the video, like 11 hours, please watch in the same order to get the best benefits out of it. So first you need to watch preliminary. Continuation in this video, entire marathon is there. Incorporation, then you need to watch dividends, then accounts of companies. Then you need to watch share capital, then deposits and then charges. Whatever the video, we have structured the video in this order only. So if you watch the video in this order, I'm telling you, you get a very beautiful insight about company law, and you will definitely see once again Sreshta standard how the kind of clarity we have, the kind of clarity we give to the student in the revision class itself. And remember, what you're watching is a revision class, not a full-fledged class. That's it. So just this preface I want to tell. And by the way, for your information, the material we are using in this marathon is this material. This is completely an updated material. You can download this material in Sreshta for CA and CMA application. You see above me, there is a white color logo, Sreshta for CA and CMA. You just type that word in Play Store. You will get an application inside that you can download. Anyhow, next another 11 minutes, 12 minutes, my video is only there about marathons, materials, instructions to be followed, everything. Please follow those instructions strictly. Don't skip the video. Please follow. And please watch this entire video marathon only at standard speed. This instruction I give for everybody. When you're watching at standard speed, you get understand very, very good. So just watch the next 10 minutes without missing it. Then you can start the actual subject, preliminary, which will be started by DV Subramaniam sir. Then incorporation, then dividend I will discuss, accounts I will discuss, then again rest of the chapters again Subramaniam sir will discuss. Now you may have, sir, what about other laws? You will have another video, separate video will be there, and all this I gave a clarification in the next 10 minutes, where and all you can find other subjects, all that I gave clarification in the next 10 minutes. That's it. So proceed further. All the best. So hi guys, welcome to the marathon lectures from Sreshta for CA and CMA by Sreshta faculties. Okay, So right now you may be watching the accounting or auditing or law, whatever the subject. Out of 8 subjects, you may be watching any subject. I don't know. This is just an introduction video from me. Now, what important thing that you need to do right now is don't directly skip to the subject. Don't directly fast forward the video. Please watch this video without any interruption. Even when you're watching the marathon, we have given below the description timestamps. If you click on a particular timestamp, you will go to that particular chapter. But what I sincerely advise you, please watch this entire marathon in the same order. Suppose we uploaded 12th hour, don't directly go to the 5th hour and start watching. Watch in the same order, because there is a structure that we follow so that you get the best understanding. Getting it? And further, after this 1 or 2 minutes, getting it, there is my another video which is merged, which is already merged. Please watch that also, because that is an instruction to be followed while watching the marathon, what material to be used, all that also I covered. So the initial 5-7 minutes of my content, please do not skip. Please do not skip. So you're going to get some guidance on how to watch this marathon. Then you can directly start with the subject. That's it. Getting it? So take care, continue watching. And please do not watch at higher playback speed. Some students think watching at higher speed, 1.5 times, 2 times the speed, dangerous approach. See, your objective of listening to the marathon class is not to listen, but to learn something. Learning, you should not make it fast. If at all we can cover the video in 5 hours, we would have covered in 5 hours, no? See, suppose I uploaded 10 hours marathon. If at all we can cover it in 5 hours, we would have taken it in 5 hours, right? Why the hell we take 10 hours? Why the hell we take 20 hours? So if at all you're watching at 2 times the speed, 1.5 times speed, you are not actually learning. You're only listening to the words. You are not learning. You're not analyzing. Analysis will not transmit. Understanding, you'll not get the emotion exactly. Whatever the emotion, with whatever the emotion or intensity the faculty is teaching, if at all you're watching at higher speed, higher playback speed, you will never get that intensity. You will never get that connection. You just listen and leave. See, this is the reason why students, in spite repeat many a times, they still do not recollect. They still do not understand the content. Some students say, sir, some students may be faster in learning. If at all you are very fast in learning, try to listen the song at 1.5 times speed. Take any one particular song, try to listen at a higher speed. See whether you are connecting or not to it. You are listening, no? Music is audible, song words are audible, vocals and music, everything is audible. But why you are unable to connect? Connection is required with the subject. In order to establish that connection, please listen to the subject at standard speed. Even though you may be very smart, you may be very intelligent, just try that intelligence while listening to the songs also. Listen to a song at 2 times the speed. Emotion is important. In anything, any work you do, emotional connection is required. So please watch the entire content at standard speed. And I'm telling you, if at all you want to try 1 hour, if 1 hour you watch at standard speed, another 1 hour you watch at higher speed, you check back yourself where you are learning better. I think that is the best judge, that is the best decision. Just try that and then do. Because many people in YouTube are misguiding students saying, listen at higher speed, revise more number. No, that's not. Listen at standard speed. Your revision, number of times revision will naturally reduce. That's it. So continue watching the video. Thank you. Have a nice time. Bye-bye. So, hi guys. First of all, thank you very much for, encouraging our institute's rest of us CA and CMA to this level. Anyhow, so here is a good news for all of you. From Srestha, again in respect of November 2022 exams, we are going to upload again all updated marathon classes, revision classes. Okay, we are once again uploading the videos or revision videos for November 2022 exams. And we are doing it for all 8 subjects. So who are the faculties that first of all taking all these marathon revision classes? And myself, I will take audit, and I will take some 2 or 3 important chapters of company law. And so nothing but P5, mainly I'll focus on, paper 6. And Satyaraju sir will focus on paper 1 and paper 5. So you will be getting approximately 20 plus 20, 40 hours of marathon for accounts and advanced accounts put together. Then Subramaniam sir will be taking paper 2 part A, company law main chapters. And Harish Krishnan sir will be taking paper 7, which is EAS and SM marathon. And Vikita madam is taking paper 2B, other loss marathon. And Samba sir is going to take paper 4, income tax, separate marathon for 12 hours. GST, some 10 hours, separate marathon. And Srinivas Reddy sir, paper 3, costing marathon, approximately we are going to upload for 15 hours. And coming to our another faculty, paper 8 part B, Naga sir is going to take economics marathon. And same Samba sir is going to take paper 8 part A, financial management marathon class. So from the entire Shrestha team, we are going to give you all 8 subjects revision marathon classes on YouTube. Now, first thing that you might get a doubt. So what are the things or what are the materials that you are going to use for these marathons? So before that, where you will find this marathon on the YouTube? Very simple. You just open CA Harsha. Okay, there is a YouTube channel. So go to that home videos and there is a playlist. Here you will find a playlist separately for November 2022 marathons, revisions, CA Inter. So in this playlist, you will find all 8 subjects. Now immediately you might get a doubt. Are all 8 subjects uploaded right now? No. By 10th of the September, you may be watching this video. On the date on which it was uploaded, or even maybe later. I don't know. Getting it? By 10th of September, all subjects except auditing, we will upload. Audit subject new marathon, we will upload after September 20. After September 20, audit related subject marathon will be uploaded. And you know what? The all revision classes, entire revision marathons are absolutely in English. Because Shrestha is having 1500 plus students across 20 states in India. Not 20, I can say 26 states I think we have covered. Some 2 or 3 northeast states only we have not covered, but 26 states we are having admissions. So obviously, for us, the students across India, we can't use any particular regional language. So we have to stick to English. So entire explanation will be in English. Now, coming to a few questions which you need to understand. Okay. One. We have uploaded in May 2022 exams some video classes, marathon classes. And I'm telling you, the same revision classes with slight modifications we are uploading. Some for few chapters we re-recorded like 1 or 2 chapters wherever there were amendments. But actually speaking, for May attempt and November attempt, the subject, the material, everything is exactly same. Because right now you are in September month 2022, right? If at all you go and check ICI website, what is the latest material available? November 2021 edition, October 2021 edition. So typically for May attempt, whatever material we are using, the same material we are going to use for November. I hope you are getting it. And now so we are using a particular material, right, for marathon, where you can download this marathon, where you can download this particular material which is used in the marathon classes. So there is an app in Shrestha for SHRE, Shrestha for CA and CMA. There is an application called Shrestha for CA and CMA. You will find right side, above me, there are 2 logos. First logo is there no white color logo? That logo. If you type this name in the Play Store, you will get that logo. Getting it? Only from Android you can download the material. Suppose if you do not have an Android phone, please use somebody's Android phone and download the material. Okay, so in this application, you just download and log in. We have given in the main menu. If you go to the application, there is something called main menu. Just after opening the app, left side top, you will find main menu. Click on that, you will find study material. Inside that, November 2022 and May 2023, there are materials. Please download the materials. PDF copies, please download and keep it with you, so that it will be useful when you're watching the revision class, so that whatever faculty is actually using the material, so it is with you in hand. That's it. If at all you want to have a hard copy, you can buy that hard copy on the same application. But I don't think you require a hard copy, because it's a revision class. So whatever you already have gone through, whatever material you already learned from, please stick to that material. Take our revision classes as a additional guidance. And I'm telling you, you're going to enjoy the subject like anything from, see, generally in YouTube, you'll find many subject related marathon, but for all 8 subjects at a single place with a particular standard, uniform standard you'll rarely find. So here our institute's rest of a CA and CMA is giving you that option. Getting it? So I hope you understood what we are going to deliver. Now, what are the topics that we are going to cover approximately, if at all you ask me? So if you look at paper 1, accounting, we are going to upload 2 videos. Approximately both the videos put together will be 20 plus hours. So these are the chapters: fundamentals, incorporation, introduction to accounting standard frameworks, AS2 and AS12, financial statements of company, bonus, investment accounts, redemption of debentures. That's it. We are not covering anything else from accounts subject. And paper 2A, company law, if you look at, me and Subramani sir, both of us are taking in this case the classes. Like if you look at accounts of companies and dividend, audit and auditors, these 3 chapters related revision I will take. Rest of the chapters, basic, incorporation, share capital, deposits, charges, these chapters revision will be handled by Subramaniam sir. Then other laws, all these topics are being covered by Vikita madam. And paper 3 costing, all these topics, 100% of all the chapters are being covered by Srinivas Reddy sir. Okay. Then part 2, see, costing video will be uploaded in 2 parts. Both together will be 15 to 16 hours. Then paper 4A, income tax. We are going to cover 5 heads of income, clubbing provision, set off and carry forward, chapter 6A, return of income, TDS and TCS. And GST, we are going to cover almost all the chapters. Then advanced accounts, introduction, few accounting standards, amalgamation, reconstruction, liquidation, partnership, consolidation. All these topics we are going to cover as part of revision. And accounting, advanced accounting is also being uploaded in 2 parts. Accounts you will have 2 parts videos, advanced accounts you will have 2 parts videos. Sorry, company you will have 2 parts. Sorry, costing you will have 2 parts videos. Then coming to auditing, ignore auditing right now because I have not yet uploaded the marathon. Then paper 8A, financial management, these chapters. Paper 8B, these chapters. Even paper 7A, paper 7B also we are going to upload all the subjects. I told you where you will find all these videos. You will find that in the Play Store. Open caramharsha, open playlist. Inside that you will find November 1st playlist, November 2022 marathon. So in that playlist you will find all the 8 subjects video. By the way, you will find all these videos by 10th September maximum. Getting it? So actually I'm recording this video on 4th September. So right now after this video I'll be uploading the marathon videos. And this video will be a common video in all in all marathon videos, whatever I'm going to upload, 12 hours videos. In all the videos, this video right now whatever I'm recording will be a common video, so that every time whoever is watching a new revision class will not miss all this. Now one more important thing. Now who should not watch this marathon class? If at all you are a first time learner. Now many people will ask me, sir, is it useful for a first time learner? No. This is not for first time learners at all. This is for those who are going to write exam. Okay. Those who are just about to go and write the exam. No, for them only this is. See, a subject is completely covered in 20 hours. 100 marks paper is hardly being covered in 20-24 hours. A regular course will be 120-150 hours. Imagine we are reducing 1/5 time. It's a revision. First of all, understand. Revision is useful. Revision class will be useful only for those who already prepared the subject once. You may have prepared in self-preparation method or you may have taken coaching. That doesn't matter. That doesn't matter. But those who already prepared once, only for them this is useful. For others, strictly I'm saying not at all useful. Because don't waste your time. But I'm telling you, those who already have gone through books, who already wrote 1 or 2 attempts, getting it, or who are a first timers. Maybe you are first time you are writing in November. But you already gone through the coaching. For you, these marathons are going to be a best, thing, in your preparation. Definitely, after watching this marathon, you will definitely get a new look on the subject, new idea, new perspective on the subject, so that within next 1.5 months, you can plan your preparation perfectly. That's it. Okay. Take care. Have a nice time. So continue the classes. Getting it? So this is an intro video. First, I'll upload this normally. Then again, I'll upload this as part of the revision videos. Getting it? So continue. Thank you. Have a nice time. Bye-bye.
Hello students. Let's begin the marathon of corporate laws. As you all know, total Companies Act 2013 is divided into 29 chapters, 470 sections. But at CA inter level, you had only 10 chapters. And from sections point of view, section 1 to 148 are applicable to you. So the first topic of our Companies Act is preliminary. In this chapter, you'll find only two sections, section 1 to section 2. So only two sections are there. And from exam point of view, you can expect some 5 to 6 marks from this chapter. So very small chapter and important from exam point of view. So Companies Act 2013, it received consent from the Honorable President of India on 29th August 2013 and it was notified in the official gazette on 30th August 2013. So it had total 470 sections and 7 schedules. And you are very familiar with schedule 3, financial statements of companies, right? So the first one is write a short note on definition of a company and applicability of Companies Act. This is what section number 1. So section 1, for the time being, take any act for the time being. You'll find, section 1 is all about scope, extent and applicability of the act. You'll find only 3 points in section 1. What is the scope of the act? Extent of the Companies Act and applicability of the Companies Act. So here, in section 1, this Companies Act 2013 is applicable only to the companies. So then what is a company, sir? A company means, company means a company which is incorporated under Companies Act 2013 or any previous law. So what is a company, ma? Company means a company which is incorporated under Companies Act 2013 or any other previous law. So incorporation is must. So company is nothing but association of person, but every association is not treated as company. Listen carefully. Every company is an association, but every association is not a company. The association which is getting incorporated under Companies Act, then only you can call such association as a company. And if you see, the Companies Act 2013 is not our first Companies Act. Our first Companies Act is Companies Act 1866. Later, it was repealed and we got one more act, Companies Act 1882. And in the year 1913, we had third Companies Act. And after independence, in the year 1956, we had one more act, Companies Act 1956. And recently in 2013, we had one more act, repealing all previous company laws, and we introduced one more act, Companies Act 2013. Now the point is, we are changing act, but we are not changing companies. If you take ITC, it was incorporated in the year 1910 under 1882 Act. If you take Asian Paints, it was incorporated in the year 1945 under Companies Act 1913. If you take Infosys, it was incorporated in the year 1981 under the Companies Act 1956. Now, these three old companies, they are in a dilemma whether we need to follow new act or is old act applicable. Old act already deleted, already repealed. Now, which act they should follow? They should follow new act. Who told us? The definition is telling. The definition is telling. Company means company incorporated under Companies Act 2013 or any other previous law. Any other previous law means, previous 4 company laws. Companies Act 1866, Companies Act 1882, Companies Act 1913, Companies Act 1956. So if you are incorporated under any of these 4 previous company law, you are still treated as a company and you need to follow our act, Companies Act 2013. Understood? So this is what, definition. So firstly, the scope is very simple. The scope is Companies Act 2013 is applicable to all the companies. Sir, Act shall extend to the whole of India. This Companies Act is applicable to whole of India. That means whether the company is incorporated in Jammu and Kashmir or Kerala or Maharashtra, Madhya Pradesh, it is irrelevant where it was incorporated in India, sir. Then Companies Act 2013 is applicable. Next one, the provisions of this act shall apply to the following companies. First one is, as we already discussed, if you are a company incorporated under Companies Act 2013 or previous company law, then you need to follow Companies Act 2013. Second, third one and fourth one, if you see these 3 points, B, C, D points, you will find some companies, insurance companies, banking companies and generation or supply of electricity companies. Banking companies, insurance companies and electricity companies. So here banking companies, if you take SBI, Axis Bank, they are already companies and they need to follow the respective act, Banking Regulation Act 1949. Best example, preparation of financial statements. Actually, our Indian companies will follow Schedule 3 for presentation of financial statements. But coming to the banking companies, they had a different financial statements concept, different schedules were prescribed. Now whenever there is a conflict between the respective acts and Companies Act 2013, which one they should follow, sir? Respective acts are applicable. Respective acts are applicable. If there is no inconsistency, or if Banking Regulation Act is silent with respect to some topics, then our Companies Act 2013 is applicable. So to all these three special companies, banking, insurance, and generation or supply of electricity, they will follow our Companies Act. But if Companies Act provisions are inconsistent with the provisions of their regulatory acts, then they can follow their regulatory acts. And next one, any other company governed by any special act for the time being, except insofar as the said provisions are inconsistent with the provisions of such act. So if you take LIC, Life Insurance Corporation, it was governed by LIC Act. So if LIC Act is silent, then our Companies Act 2013 is applicable. But LIC Act is very clear that provisions of Companies Act is not applicable to them. They clearly specified that Companies Act provisions are not applicable to LIC. Now LIC is not required to comply the provisions of Companies Act 2013. And such other body corporate incorporated by any act for the time being in force. So any other body corporate. Now you'll get a doubt, sir, what is a body corporate? What is a company? Are they both same or different? Are they both same or different? Obviously they are different. And you already know this statement, all companies are body corporates, but all body corporates are not company. Did you remember the point? So what is a body corporate, sir? Body corporate is an association which is incorporated under any act for the time being. An incorporated association is called body corporate. But if you take company, it is also an incorporated association, but such incorporation happened under Companies Act. So if you are an incorporated association, you'll be treated as body corporate. If such incorporation happened under Companies Act, then you'll be treated as company. Suppose, sir, I was incorporated under LLP Act, sir. I'm a body corporate. I'm limited liability partner. I'm LLP. Whereas I'm an incorporated association, but my incorporation happened under Companies Act, sir. Now I'm a company. So body corporate is a wider term, company is a narrow term. So every company is a body corporate, but every body corporate need not be a company. So if any of the provisions with respect to LLP is silent in LLP Act, now you can take advantage of such concepts in Companies Act. For the time being, I'm telling you. And if you take foreign company, another example, foreign company is also a body corporate because it is incorporated under an act which is outside India. It is incorporated under an act. It is not incorporated under Companies Act. So foreign company is also a body corporate. Some provisions of our Companies Act 2013 are applicable to the foreign company. So what are those provisions? I will let you know in our upcoming points. Understood? So very simple, scope of the Companies Act, it is applicable to companies, extent, whole of India. Applicability, companies, banking company, insurance company, electricity, generation or supply of electricity companies, and then any body corporate governed under some other acts, provided that such other acts should be silent. Or if there is any contradictory points, then follow your respective acts. Next, we had, features of a company or a characteristics of a company. You can see here, company is an artificial person. It's just a piece of paper, ma. So if someone asks you what is a company, instead of telling a definition, just tell them that company is simply a piece of paper, right? Whatever you heard is correct. So ROC is having authority to issue certificate of incorporation once you file documents for getting incorporation of a company. So an association, when they file documents with ROC, upon verification, ROC will issue a certificate called Certificate of Incorporation. The moment you get Certificate of Incorporation, yes, that is the result, that is the proof that company came into existence. And the same authority, ROC, under the power of, central government or, the help of NCLT, they can cancel that paper. That is nothing but, liquidation of the company. Understood? So company is simply a piece of paper, or it is an artificial person whose existence, birth and death of the company is decided by operation of law. And you can observe that, you can know that members liability is always limited and separate legal entity. So here company is separate, owners are separate. We call owners as members of the company. Owners, who are the owners of the company? Members of the company. So separate legal entity comes into the picture. So company being an artificial person, it can't do its activities on its own. That's why company require human agency. That human agency we call them as board of directors. So if you observe, there is a relation between company and board of directors. What is the relationship, sir? Principal and agent. Principal and agent. For the acts of company, owners are not liable because separate legal entity. This fiction separates owner and company. Now for the acts of owners are responsible. For the act of company only responsible. Now, on behalf of company, board of directors will do certain activities. If all these activities are within the scope of memorandum of association, articles of association, then board of directors are not liable, only company is liable. Only company is liable. So company is always having unlimited liability, but the owner's liability is limited. So what this limited liability indicates, sir? The risk is limited. Risk means what? Whatever amount they invested. So if company is doing business very well, they will get profits, they will get share in the profits. We call them as dividends. But if company performance is not good and company is continuously suffering losses, then who will bear such losses, sir? Company. Members will bear the loss to the extent of their invested capital. Any loss beyond their invested capital, owners won't pay any single rupee extra. So this is one of the differential characteristic between company and partnership type of organization. And in partnership type of organization, act of one partner, all other partners are liable. But here, act of directors, company only liable. It is not at all related to owners of the company. Understood? So as long as directors act within the authority, yes, company is liable. If directors act beyond the authority, you all know, as long as agent works within the principal authority, principal is liable. If agent exceeds authority, principal is not liable, agent is personally liable. Here also, as long as board of directors are doing activities within the powers of MOA, AOA, company is having unlimited liability. Or else board of directors are personally liable and their liability is unlimited. Here we are talking about limited liability. This limited liability is applicable only to the owners, but not to the company, but not to the board of directors. And the next one is perpetual succession. Perpetual succession means independent existence simply. So here the incoming of the members, outgoing of the members won't affect the association. This won't affect the company survive. Yes, company is independent body, so its existence as well as death is decided by operation of law. So the incoming of the members or outgoing members won't affect the life of the company. And since it is an artificial person, it will express consent through common seal. It is official signature of the company. So that's it. This is all about section 1 of the Companies Act. Now let's begin section 2 of the Companies Act. So section 2 of the Companies Act 2013, here you can find different types of companies. So very important, different types of companies, very important. You can expect 5 marks from this small topic. So why I'm talking very important? Because small topic and you can easily score 5 marks from this topic. That's why you need to concentrate. So listen carefully. By the end of this lecture, this preliminary topic, you'll be in a position to answer any kind of question that you are going to get in the exam. So listen carefully. On the basis of certain categories, companies were divided into many types. On the basis of certain prescribed categories. For example, on the basis of number of members, The companies are classified into two types: private limited, public limited. And later we had one more concept called OPC, one person company. This is also part of a private limited company only. Next one, on the basis of ownership, if government is having majority of ownership, then it is a government company. Other one, non-government company. Next, on the basis of control relationship, you can observe holding company, subsidiary company, associate company. And on the basis of listing, you can see listed company, unlisted company. On the basis of liability of members, you can see three companies: limited by shares, limited by guarantee, unlimited companies. So let's begin the topic of types of companies. First one, on the basis of number of members. So we categorize companies into three types: private limited, public limited, one person company. So how can we differentiate a company, whether is it a private company or whether is it a public company? Very simple. Download the AOA, Articles of Association of the company. In Articles of Association of a company, if you find conditions, sir, conditions with respect to what, sir? Restricts the transfer of shares, limits the number of members to 200, prohibits the invitation to the public to subscribe any securities of the company. If you are able to find these three conditions in the Articles of Association of a company, then it is a private limited company. Sir, I am unable to find these three conditions, sir, then it is a public limited company. Many people will tell that if you find private limited in its name clause, then it is a private company. If there is no word called private, then it is a public company. It is 100% wrong. Why? Because a government company, irrespective of these private limited or public limited, it should use word called limited. Yes, it should use word called limited. So if you are a government company, it is irrelevant for me, private or public. The name of a government company shall always ends with limited. Now, how can you categorize whether is it a private company or public company? Understood? So how can we categorize company as a private or public? Simply take AOA. In Articles of Association, if you are able to find three conditions, so what are those three conditions? Restricts the transfer of shares. Once again, I am telling you here, the transfer is not prohibited, restricted. Sir, in what manner the transfer is restricted, sir? Very simple, very simple. No, I'm a member of private company. First of all, why to place restriction on the transfer, sir? Reason, my name itself is telling private, privacy, confidentiality. To protect confidentiality, there should be restriction on the incoming and outgoing members. So if there is a free transfers are available, just imagine free transfers are available, incoming members, outgoing members, you can't control. Ultimately, outsiders will easily come into the company by purchasing shares in secondary market, and they will come to know all our trade secrets. This should not happen. So simply to protect the confidentiality, here we are restricting the transfer. How? So I'm a member of a private company. I want money. I want to transfer shares. Now I'll write a letter to the directors. About my intention of selling these shares. Directors, first they will offer these shares to the existing members. If existing members are ready to purchase, then I will sell to them. If existing members are not ready, they are not having funds, then I need to sell shares to any person to whom board of directors gave approval. So to whom board of directors gave approval, to those persons only I can transfer these shares. At what price, sir? The price is determined by the management and certified by the company auditor. So here transfer is allowed, but the transfer is restricted. So don't write that transfer is prohibited. It is absolutely wrong. So restricts the right to transfer its shares. Next one, here the number of members is limited to 200. How many, ma? 200. In case of OPC, maximum only 1. So we are talking about private company. Here the maximum number of members is 200. But while counting 200, care to be taken to exclude certain people. Who are they, sir? First one, employees. So my company employees who became members during their employment period. I repeat, during their employment period, they are not counted for the purpose of this 200. Sir, my company employees, they retired. Now because of 60 years of age they retired. After 5 years they came to us and they acquired some shares, sir. So we allotted some shares to them. Now are they included or excluded? Included, not excluded, included. Why? Because they became members not during the employment but after employment. So once again I'm asking you, when they become members? During the employment, excluded. After the employment, sir, included. Okay, sir, my company employees, they became members during employment only. Due to age factor they got retired, sir. Now, are they included or excluded, sir? Excluded. Because when they become members, no, they were employees. So, simple rule, simple rule. Employee becoming member or any person becoming member during the employment period shall be excluded, whether he is in service at present or whether he is not in service at present. Are you all getting my point? That means, present employees are excluded. Past employees who became member during the employment period also excluded. Now, one more point. If you see this D point, sir, at the time of incorporation, I am the promoter of the company and I am the member of the company, sir. So we incorporated a company. After few years, when company offered job, I applied for the job and I got selected. Now I'm employee of the company, sir. I'm employee of the company. Sir, am I included in this 200 count or excluded? Obviously included. Why? When you became member, during the employment period or before the employment period? Sir, before the employment period, sir. So then you'll be included. You'll be counted. Understood, ma? Everyone. So simply who will be excluded, ma? Only the persons who became members during their employment shall not be counted. So this is with respect to employees. And we had one more category, that is joint shareholding. First of all, what is meant by joint shareholding? Two or more persons holding two or more shares under a single share certificate jointly. So for example, me and my mother holding one share certificate. In that certificate there might be 2000 shares, 5000 shares. Okay, no problem. So one share certificate held by me and my mother. Now for the purpose of this 200, we are counted not as two but as one, only one. So in case of joint shareholding, all the number of members, all the members will be excluded and only count one shall be included. So this is with respect to limitation on number of members. Is it clear? And next one, prohibits any invitation to public to subscribe for any securities of the company. So that means a private company is strictly prohibited from offering its securities to the public. So they can't make public offer. Name itself is telling, private company. They can offer securities only to the closely held people, private people. They can't offer shares to public. Sir, how can you categorize whether a private people or public people? See, any person, an unknown, unidentified person becoming member of the company, that means public only. Identified person, very known person to whom we are giving offer and from whom we are getting money and to whom we are allotting securities is a known person, private. Are you getting my point? So in a public company, you can't identify the persons who are becoming members of the company. Any person from general public, they can come and they can purchase share, they can become member of the company. But in private company, it is not like that. So you can see the restrictions, you can see the limitation, and you can see the prohibition. So these three conditions are very important to categorize whether a company is a private or a public. And other conditions, it should have minimum 2 persons and its minimum paid up share capital. It should have minimum paid up share capital as may be prescribed. These 2 points you're already aware of it. That's why I'm not making stress on those 2 points. Whereas the 3 points are very important. Restricts transfer, limits number, prohibits public offer. Understood? Next one, that minimum paid up capital, how much, sir? Previously it is 1 lakh rupee, but Companies Act 2013, in Companies Act 2013, Companies Amendment Act 2015, they deleted the word 1 lakh and they wrote the amount prescribed. So they may prescribe in future under rules. So far they were not prescribed, but I'm telling you. Next one, This minimum paid up share capital requirement is not applicable to Section 8 company. However, that Section 8 company should be in regular in filing financial statements with ROC, in filing annual returns with ROC. If you are a regular filer, then this exemption is available to you. Next one, public company. So what is a public company? Very simple. Any company which is not a private company, it is a public company. Any company which is not a private company, we call it as public company. And it should have minimum paid up share capital as may be prescribed. Okay, so far this is good. But if you read this third point, you'll get more and more clarity or more and more confusion. So what is this third point? Sometimes a private company is also treated as public company. When, sir, if a private company is a subsidiary to public company. So what is this subsidiary, sir? I'll tell you after a few minutes, but for the time being, listen. Majority of control in this private company, if more than 50% of voting power is held by public company, then this private becomes subsidiary to public company. Subsidiary to public company. If a private company is a subsidiary to public company, then this private limited is deemed to be public company. Deemed to be public company. I repeat, deemed to be public company. By its articles, it might be a private company. Through articles, it might be a private company, but in fact, this is a deemed to be public company. That means the privileges, the status which was given to the private company, those privileges status is not available to this company. Understood? Sir, can it enjoy the benefits of public company? No. Why? Because it had restrictions, it had limitation, it had prohibition. So simple, nutshell point. A private company which is subsidiary of public company, it will have only the disadvantages of public company as well as disadvantages of private company. It won't have any advantage of private, it won't have any advantage of public company. So this is like a control point. To eliminate this situation, then simply name any private company. If you are a subsidiary to public, then you are deemed to be a public company. So with this, private company, public company, we completed. Next one person company. One person company. So here, minimum and maximum number of members is 1. How many? Minimum and maximum 1. And here, who can become member of the company, sir? An Indian resident. So how can we get residential status? Very simple, under income tax rules, or if you take FEMA rules, you can see that a person who stay in India for a period of 182 days or more, he will be treated as Indian resident, and that person is capable of incorporating one person company. But latest amendment act, the time limit of 182 days with respect to Companies Act, I'm telling with respect to Companies Act, they gave one more alternative that if your period of stay in India is 120 days, then also you can incorporate a one person company. So the key highlights of one person company is number of members, minimum 1, maximum 1. Coming to the directors, it can have only single director, one director. Of course, it can have up to 15 directors, but minimum 1 director is sufficient. And it will be treated as a private company, so all the privileges available to private company are equally given to the one person company. And it will have a nominee who cannot act as a nominee for more than one OPC. So there are restrictions on the member and there are restrictions on the nominee. What are those restrictions on the nominee, on the one person, as well as on the company? You will get to know in the next topic, that is incorporation of companies. So for the time being, one person company means a single person. Now how many members will present in OPC? Minimum 1, maximum 1. And it will have one more extra person called nominee. And for the time being, these limits are not applicable. Recent amendments, these limits are not applicable. Next, on the basis of size, companies are classified into two types: small company, other than small company. Okay, so this is not a separate category, this is just based on the paid up share capital and turnover limits. This is not a separate company like private, public, like that. Small company is not a separate company. It is not a separate company. It is not a separate company, but based on the paid up share capital turnover limits, you can find this small company. So small company means, any company satisfying three conditions to be satisfied in order to call a small company. So what are those three companies, sir? One is, it should be a company other than public company. That means, private company. And its paid up share capital should not exceed 2 crores. 2 crores. Limits have been revised. You can see revised limits here. So three conditions to be satisfied in order to call a company a small company. One is other than public company. A second one is paid up share capital should not exceed 2 crores. And third one, turnover should not exceed 20 crores. If these three conditions are satisfied, then you will be treated as small company. In addition to the privileges of private company, you will be given extra privileges. You no need to comply some provisions of the Companies Act. The logic is very simple of introducing this concept is to encourage all mid-size partnership firms, mid-size associations to come into the company type of organization. Today, for doing business, we had multiple options. As a sole proprietor, you can do the business. For this, they provided an alternative called one-person company. So for attracting you under one-person company, they made members liability limited. Understood? They made simply members liability got limited, and they can do more and more operations. They will get an identity in this India. They can do operations from any place in the India. And then next one, mid-size entities, like second type of organization is the partnership firm, association of persons. Are you getting my point? Cooperative societies. So to attract these kind of entities, they provided a privilege called private company, and in private company also they gave extra privileges, so like under small companies. Okay, so if you get incorporated as a private company, and if your turnover is below 20, or if your paid up share capital is 2 crores or below 2 crores, then you will be called as small company. You no need to comply all the provisions of Companies Act. For complying few provisions is sufficient. Understood, ma? So what is the need of attracting them into the company? The reason Companies Act is asking company to file n number of forms with ROC. Like, for financial statements, AOC 4, my annual returns, MGT 7. So all these forms, with respect to liabilities, DPT 3 deposit forms. So when a company is filing all these forms with ROC, it indicates, transparency. Now, any person from the public can download this information from a public domain, that is mca.gov.in. They can go through the affairs of the company. They can go through the activities done by the company, everything. So this information general public is getting only because it is filing documents with an authority called ROC. But can you find a sole proprietor, a partnership, cooperative society filing forms with government? No. Then how a general public know about this type of organizations? So transparency point of view, for getting, for better transparency, each and every business organization should be incorporated under company. For attracting them, we are providing these privileges. Nothing more than that, nothing more than that. So next one, so you can expect a question on the small company, you can definitely expect a question from small company, regarding these exceptions. If you fall under these five categories, even though your turnover is less than or equal to 20 crores, even though your paid up share capital is less than or equal to 2 crores, but if you fall under these five categories, you will not be treated as a small company. So what are those five companies, sir? Holding company, subsidiary, section 8 company, and then body corporate governed by special act, and then public company. There is a possibility that there is a company called PQR Private Limited. Its turnover is 19 crores. Its paid up share capital is 1.9 crore. And this PQR Private Limited, in this PQR Private Limited, in this 1.9 crore paid up share capital, some 1 crore share capital was held by ABC Limited. ABC Limited. Now, directors of PQR Private Limited contend that PQR Private Limited is a small company because of turnover and paid up share capital requirements. So, since they met the requirements of turnover and paid up share capital, they want to take status of small company. Do you agree with the directors of PQR Private Limited? So, this is one question. You can expect for 5 marks. Now, answer to this question, my dear students. Is PQR Private Limited a small company? The answer is no. Why? Out of 1.9 crore, 1 crore, that means more than 50% was held by ABC Limited. That means this PQR Private Limited is a subsidiary to ABC Limited. This PQR Private Limited is subsidiary to another company. So, subsidiary company is already excluded. A subsidiary company is already excluded. So, accordingly, PQR Private Limited is not a small company. The contention of directors of PQR Private Limited is invalid. Understood, ma? So, in this manner, you can expect question for 5 marks. Next one, benefits of small company, just academic interest point of view. Some benefits. They are not required to prepare cash flow statement in the financial statements, ma. You can see D point. So, this single point, on this point there is a question for 6 marks in the latest attempt. I think 1 year back there is a question on the small company with respect to this point, and that question is for 6 marks. So that's why we are telling you concept clarity is very important. So don't mug up entire things. Understanding is very important. Then only you can analyze the questions in the question paper. You can attempt each and every question with 100% perfect knowledge. Okay. So, small company had many privileges. Some of the privileges were given here. This is not that much important from exam point of view. But this C point, you can cover C point under management and administration chapter, and D point in accounts of companies, and B point under auditors chapter, and A, E, F, G. These points you can find in the some other topics. So, there we were going to cover these points. Next, only private limited companies can be regarded as small companies subject to satisfaction of the above provisions. So with this small company, we completed. Next one, on the basis of relationship, you can find, the companies are classified into 3 types: holding company, subsidiary company, associate company. Holding, subsidiary, associate. See, these are different companies. They are different companies, but based on the relationship, we are categorizing some companies as holding, some companies as subsidiary. So if you see the definition of holding company, there is a point that we had 2 companies, Tata Sons, TCS. With respect to TCS, this Tata Sons will be treated as holding company if TCS is subsidiary to Tata Sons. If you read the definition, that is the point. One company will be treated as holding company if it had subsidiaries. So any company having subsidiary, that company we will treat as holding company. And this word is very important. Here the expression company includes body corporate. Company includes body corporate. For example, LIC. If you take LIC, this is not a company. This is not incorporated under Companies Act 1956. This is not incorporated under 2013 Act. This was governed by separate law called LIC Act 1956. So this is a body corporate. Now LIC is having some 60% of holding, 60% of paid up share capital in some PQR Limited. Now LIC is treated as holding company and PQR Limited is treated as subsidiary company. So holding company category is not only given to the companies, this category is also given to body corporates. Understood? So holding company, nothing to learn more and more. So it is very important to remember subsidiary company. And you can expect 6 marks question from this subsidiary company. So what is a subsidiary company, sir? On the basis of control, I'm categorizing companies into 2 types: controlling company, controlled company. Controlling controlled. Controlling means a company which control other entity. Controlling company means a company which control other entity. Controlled company means a company which was controlled by another entity. Suppose here two companies are there, company A, company B. You can call company A as controlling if it control another company. Company B is controlled by company A, so company B is called controlled company. Understood? So here subsidiary company is a company controlled by holding company. Now here this control is of two types. This control is of two types. Yes, holding company can get control over another company in two ways. One is acquiring more than half of the voting power. Sir, how can we get voting power, sir? Simply, acquire paid up, acquire shares of the company. If you had more than 50% of capital of another company, then that entity becomes subsidiary. Then the entity becomes subsidiary. If you take TCS for example, in TCS 73% of paid up share capital was held by Tata Sons. Now Tata Sons is the public company, TCS is the holding company. Tata Sons is the holding company. Sorry, Tata Sons is the holding company. Repeat, Tata Sons is the holding company, TCS is the subsidiary company. So here to become a subsidiary, two types of controls are there. If you had any one control, you will be treated as holding, and in which entity you are having control, that entity is treated as subsidiary. First type of control is having more than 50% of voting power. And second type of control is control over directors. Control over directors. If you had a control on the composition of the directors, then your entity will be treated as holding company, and in which entity you are having control, that entity is treated as subsidiary company. Are you getting my point, students? So any type you had, you'll be treated, any type of control you exercise, you'll be treated as holding. The other entity is treated as subsidiary. So what are the two types of control, ma? One is control over directors. So here control means what, sir? In a company, say for suppose there are total 15 directors are there. As per our Companies Act also, maximum number of directors in a company is 15. Of course, subject to AOA, you can increase. But out of 15 directors, if one entity is having power to appoint or remove majority of the directors in that 15, majority means how many? 15 by 2, 7.5, round of 8. So if one entity is having control over appointment and removal of 8 directors out of 15, then that entity is said to have control. So entity having control, holding company, and the control where it was exercised, we call it as subsidiary company. Understood, my dear students? But this control you can exercise, control of voting power you can exercise on your own or through another subsidiary companies. Sir, example, sir, Tata Sons, TCS. This is direct holding subsidiary relationship. One more case we'll see. Suppose Tata Sons along with TCS. So TCS is already under the control of Tata Sons. Imagine they had control in another company called ABC Limited. In this ABC Limited, TCS is having some 26% control. Tata Sons is having some 25% control in ABC. TCS is already a subsidiary company. Now in this case, ABC Limited automatically becomes subsidiary to Tata Sons. How, sir? They had 25 plus 26. How much? 51% control. So for becoming a subsidiary, more than 50 is sufficient. Here, you can find 51% control. Are you getting my point, students? So that means together with one or more of its subsidiary. There is completely indirect subsidiary concept is there. Totally indirect. How, sir? Suppose there is a company A Limited. To this A Limited, we had two subsidiaries, B Limited and C Limited. So B and C are the subsidiaries to A. So in our resulting company, in D Limited, B Limited is having 26% control, C Limited is having 27% control. 27% control. Now D automatically becomes a subsidiary to A Limited. How, sir? A Limited is already controlling D. In what manner? Through its subsidiaries B and C. B and C. So if you put the voting power put together, 26 plus 27, almost 53% is there. So now D is a subsidiary to A Limited. So this is totally indirect control. Indirect control. So to make one entity as a subsidiary, either you can exercise voting power directly, or you along with another subsidiary can exercise voting power, or you no your holding is zero but your subsidiary is having more than half of the control, then also that company will become subsidiary to you. Understood. Next, deemed subsidiary. A company shall be deemed to be a subsidiary company of holding even if the control referred as above is of another subsidiary company of holding company. That's what my last example. If you take last example, A Limited holding in D Limited is 0, but D Limited is still holding. D Limited is still subsidiary of A. How? Through its subsidiaries. Through its subsidiaries. And you can see example here also. C is a subsidiary of B. B is subsidiary of A. Then automatically C becomes subsidiary of A. You just analyze practically, in the ultimate in our company, who is getting control? The above, holding companies. That's it. That's it. Who controls our entity? For that control, how much voting power they should have? More than half. More than half. So how you get voting power? Through acquiring shares of the company. Acquisition of shares, you will get the voting power. Understood? Next one, ma. Very, very difficult point. Many students won't understand this point. Held in fiduciary capacity. Held in fiduciary capacity. Shares held by a company or power exercisable by it in another company in a fiduciary capacity shall not be considered for the determining the holding subsidiary relationship. That means what? Take an example. We had two companies, A Limited, B Limited. So B Limited paid up share capital is 1 lakh. 1 lakh. Out of 1 lakh, A Limited is holding some 46,000. 46,000. That means 46% control is there. Can you tell me, with this 46% control, do you think A Limited controls B Limited? No. From holding subsidiary point of view. Can you call A Limited as a holding, B Limited as a subsidiary? No. Not at all. Understood? Next one, continuing this example. Continuing the same example. Member M. One member is there, member M. For the benefit of society, or for the benefit of employees of A Limited, for the benefit of society, he made a donation. Mr. M is holding 10,000 rupees shares. Let me take in one note, you'll get a clarity. So company A Limited and B Limited. B Limited paid up share capital is 1 lakh rupee. Out of 1 lakh, A Limited is holding 46,000. And another person, independent person, Mr. M is holding some 10,000 shares. 10,000 rupees shares. So paid up share capital 1 lakh. Paid up share capital 1 lakh. Out of 1 lakh, 46% was held by A Limited. With this 46%, you can't call A Limited as a holding company, B Limited as a subsidiary company. And Mr. M is holding some 10,000 rupees paid up share capital. For one purpose, I repeat, one purpose, M contributed all his shares to that trust. To a trust. This trust is for the benefit of employees of A Limited. Employees of A Limited, or general public, whoever it might be. So there is a trust, and this trust was headed by A Limited. A Limited is the trustee of trust. I repeat, A Limited is trustee, in charge. That means in charge will hold all the assets, and all the assets are on behalf of trust. Now Mr. M donated 10,000 rupees shares to the trust. So he registered all the shares in the name of trustee. Who is the trustee? A Limited. Now here A Limited is a trustee holding these shares not for itself but holding on behalf of employees. Now 10,000 shares they are holding as a trustee. That means all these 10,000 rupees, who is the beneficial holders? Employees of A Limited. Employees of A Limited are the beneficial holders. It's not A Limited. Now if you observe, A Limited in its own capacity it is holding 46,000 rupees capital, and as a trustee, that means in the fiduciary capacity, it is holding 10,000 rupees paid up share capital. Now for the purpose of determining holding and subsidiary relationship, you should not add this 10,000. So many people will do that. Many people think that 46,000 plus 10,000 total 56,000. 56,000 out of 1 lakh, that means 56%. So A Limited is having 56% paid up share capital of B Limited. 56% control is there. So B Limited is a subsidiary, A Limited is holding company. It is wrong. So if you held any shares in a fiduciary capacity, that means you are holding shares on behalf of someone, for the benefit of someone, then you should not add those shares for determining the holding subsidiary relationship. Not only here but also in associate company also we are going to cover that point. So I hope everyone understood my point. One is, if you are holding shares in a fiduciary capacity, that means you are holding shares on behalf of some other person. In that case, those shares will not be added to your existing holding for the purpose of determining holding subsidiary relation. Next one, note. A company cannot have more than 2 layers of subsidiary company. Further, immediate wholly owned subsidiary company will not be counted as a layer. So this is also one more difficult point to understood. Note, it creates one dilemma. Just listen carefully. Our entity is C Limited. It is having a subsidiary S1 Limited. S1 Limited is having a subsidiary S2 Limited. That's it. 2 layers permitted. 2 layers. Up to this only allowed. So S2 Limited having one more subsidiary not allowed. Only 2 layers are permitted. Say for suppose C Limited is having wholly owned subsidiary. Limited, one subsidiary. It is having A Limited as a subsidiary. A Limited is having a subsidiary of B Limited. Permitted. This is permitted because here the count is 0, 1 and 2. 1 and 2. But whereas here if you take count 1, 2. 2 layers completed. Maximum it can have 2 layers, subsidiaries of 2 layers. So down the line, that is nothing but layer, you need to check down the line. Horizontal, it can have many. Suppose, C Limited can have 100 subsidiaries. C Limited can have 100 subsidiaries in a horizontal manner. That means, direct subsidiaries, it can have, there is no limit on it. But, sub-subsidiaries concept, I'm telling you. If you take S2 Limited, this is sub-subsidiary to C Limited. In vertical manner, there is a prohibition, there is a restriction. Maximum 2 layers are permitted. While counting 2 layers, if you had wholly owned subsidiary, then that count, that layer is not counted. So simply if you observe the chart, S1 Limited, S2 Limited, yes, end the line. Now S2 can't have one more subsidiary. Layer is permitted, the layer is restricted. But if you take that left side one, wholly owned subsidiary can have A Limited can have B Limited. So there you can find 3 companies, but count is 2 only. Wholly owned subsidiary, count is 0, right? Are you getting my point? B Limited should not have subsidiary because this company won't permit. From this company point of view, you should think, this company point of view, 2 layers are allowed. 1, 2, completed. 1 and 2 already completed. So now B Limited can't have one more subsidiary. So this point they won't test you practically in the exam. They may ask you in multiple choice type of question. So but for the time being, how many layers are permitted? 2 layers are permitted. Horizontally you can have n number of companies. Vertically 2 layers are permitted. While counting these 2 layers, if you had wholly owned subsidiary immediately, then that count will be treated as 0. Understood ma? Next one, associate company. Associate company. So an associate company in relation to another company means a company in which that other company has significant influence, but which is not a subsidiary company. Suppose we had two companies, A Limited and B Limited. So B Limited becomes associate to A Limited only if A Limited is having significant influence in B Limited. Sir, how can I get that significant influence? Is there any definition to significant influence? Yes. What is the definition, sir? Having 20% or more of voting power, but it should not exceed 50% of voting power. Because once if you exceed 50% of voting power, then there arises holding subsidiary concept. So having 20% of more and less than or equal to 50% of voting power, then then you can call that second company is associate to first company. And many will get a doubt, sir, a single company, can it become both associate and subsidiary to another company? No. A company can become either associate or subsidiary. It can't become both subsidiary and associate. Extending this example, in B Limited, total there are 10 directors are there. 9 out of 10 directors appointed by A Limited only. Either appointment or removal can be done by A Limited only. And A Limited is having 26% control in B Limited, 26% of paid up share capital in B Limited. Now, my dear students, listen carefully. Is B Limited associate company or subsidiary company? The answer is subsidiary company. How, sir? 26% means it is within the range of 20 to 50, right, sir? So it should become associate, no, sir. I clearly told you, associate company excludes subsidiary company. Here, if you observe this case, B Limited 9 out of 10 directors were headed by, governed by A Limited. That means, composition of directors, A Limited is having control over the B Limited composition of directors. So B Limited automatically becomes subsidiary. Once B Limited becomes subsidiary, you can't call B Limited as an associate company. And extending this point, the main purpose of classifying holding subsidiary associate is to verify the group as a whole. Reason, Sima, owners, members, they invested some 10 crores in company A Limited. A Limited, it diverted certain funds to a B Limited. A Limited acquired some 60% of voting power from B Limited. For that, they paid some funds to B Limited. Now, A Limited standalone financial statements, I repeat, A Limited standalone financial statements are not correct picture of A Limited. It's not a correct picture of A Limited because what about the performance of these funds? What about the performance of these funds? Are you getting my point, students? See, they diverted some 2 crores to B Limited. That means A Limited is doing business with 8 crores only, 8 crores paid up share capital, 2 crores, investment in subsidiary, 2 crores. Sorry, paid up share capital is 10 crores, but they did business only for 8 crores, remaining 2 crores they invested in subsidiary. Now, the performance you need to show for entire 10 crores. For entire 10 crores, the performance you can show only through consolidated financial statements. So in consolidated financial statements, holding company, in addition to its figures, it will add the figures of subsidiaries and associate companies. So now the owners of holding company will get a clear picture, correct picture of the position of holding company, performance of the holding company, as a group as a whole. Understood, my dear students? So let's see the point one more time. So associate, how a company becomes associate to another? Very simple. If one company is having significant influence in another company, that significant influence they can get through voting power or through any agreements. Through agreements also they can get voting control. So memorandum of understanding, whatever the agreements they write, they had between themselves. Through those agreements also they will get a significant influence. And associate company includes a joint venture. So that means, joint venture is an associate company. And again, the point is repeated one more time. The point is repeated, that is shares held in fiduciary capacity. You should not consider them while considering whether a company is a holding or subsidiary. Next one. We're almost at the end of the topic, listen carefully. Foreign company, government company. Foreign company. What is a foreign company? So foreign company means a company incorporated outside India and having place of business in India. They can do business through agent in India, either physical mode or electronic mode. Electronic mode, for example, if you take a online e-commerce transactions. Electronic mode means online e-commerce transactions. Physical mode means having branches. For example, HSBC Bank. It is a company incorporated outside India but having business in India physically through branch operation, through branch. It's a foreign company. Electronic mode, say for suppose Alibaba, if you take, they were incorporated in China and having business in India through electronic mode. Understood? But if the same entity come to India and if they incorporate company in India, then that company will be Indian company only. That company will be treated as Indian company only. If you take best example, Facebook, Amazon, and then Kia Motors, Kia car company. So their their parent companies were incorporated outside India. They came to India and they started one more company in India as per Indian Companies Act. Now, whatever company incorporated in India, they are treated as Indian companies. See here, one more point I need to tell you. The nationality of a company depends upon the place of incorporation, but not the nationality of members. Suppose today, 5 Korean people came to India and incorporated company in India. Now, the company in India, we call it as Indian company, domestic company. It's not foreign company. So, and conducts any business activity in any other manner. Understood? Of course, foreign companies also very important to learn, and they are required to comply provisions of our Companies Act 2013. Not all provisions, but very few, like complying CSR activities. CSR. If they get profit from India 5 crores or more, they need to spend 2% of the profits in India under CSR section 135, and they need to file some financial statements with ROC. Those financial statements should be prepared according to section 381. So they need to comply some provisions. Next, government company. See, once again I'm telling you, private company is different, private sector undertaking is different. Private company different, private sector different. Public company different, public sector undertakings are different. PSU, we popularly call them as public sector undertakings, right? So public sector undertakings are different, public companies are different. So what is the difference, sir? Through articles of association, you can categorize a company as a private or a public. You can categorize a company as a private or public. In a private company, you can find restricts, limits, prohibits, where you can't find these 3 words in a public company. Now, what is a public sector? What is a private sector? If government ownership is there in any organization, then you can call it as PSU, public sector undertaking, like SBI, BPCL, Indian Oil Corporation, BSNL. So government stake, government is having majority of ownership, then it is called as public sector undertaking. If such public sector undertaking is incorporated under Companies Act, we call it as government company. Understood? If public sector undertaking is incorporated under Companies Act, then we call it as government company. Then what is a private sector undertaking, sir? Government ownership is zero or negligible. Government ownership in this entity is zero or negligible. Then it is a private sector undertaking. If the private sector undertaking is incorporated under Companies Act, it is nothing but non-government company. It may be categorized as private or public depending on AOA of company, articles of association of the company. Are you all getting my point, students? Everyone. So don't treat that, private sector undertakings are private companies, public sector undertakings are public company. It is wrong. It is wrong. Public sector undertaking means government owned entities. Understood? So now you can categorize government company as a public sector undertaking. Government company comes under public sector undertaking. Government company means a company in which not less than 51% of paid up share capital held by, central government, state government, one or more state governments, or, combination of central and state governments. And finally, subsidiary to government company is also a government company. Subsidiary to a government company is also government company. And this note point you will get to know when I teach share capital chapter. Until share capital, you won't get this point. Differential voting rights. For the time being, I'll tell you. Differential voting rights means a share giving vote either more than one or less than one. More than one or less than one. So it won't carry equal voting rights. The voting rights are differential in nature. In that case, you should not take paid up share capital. You should consider the vote called voting power. See, of course, at the end, voting power comes from share capital only. If share capital, if there is no classes, if there is no different class in the share capital, obviously paid up share capital or total voting power, both will have same effect. Both will have same effect. But in the share capital of a company, if they had differential voting right shares, that means giving more than one vote. For example, a company had 1 lakh shares, 1 lakh shares. All 1 lakh shares belonging to only one class. Then each share can give you one vote. Total number of votes, 1 lakh votes. Total number of votes, how many? 1 lakh. So I'm holding 46,000 shares. That means 46% of share capital or 46% of voting power, both same. Both are one and the same. Say for suppose, out of this 1 lakh shares, 80,000 shares will give you one vote per share. And 20,000 shares, listen carefully, 20,000 shares, each share can give you 5 votes. How many votes? 5 votes. Now I'm holding 46,000 of 80,000 shares. 46,000 of 80,000 shares. Can I tell that, I'm having 46% voting power? No. Why? Here the voting power, if you calculate voting power, 80,000 shares into one vote, 80,000 votes. 20,000 shares into 5 votes. Each share will have 5 votes, right? 20,000 shares into 5 votes, 1 lakh votes. Total 1,80,000 votes are there. Now I'm holding 46,000 ordinary shares. I repeat, I'm holding 46,000 ordinary shares. My voting is 46,000 votes only. 46,000 out of how many, sir? 1,80,000. Now how can I call it as 46% voting power? No, my voting power is 46,000 out of 1,80,000 votes. So there arises a difference. Only in that situation, if company had differential voting rights, then don't go with paid up share capital word. Replace paid up share capital word with voting power. That means here 51% of 1,80,000, not 1 lakh paid up share capital. Not 1 lakh paid up share capital. 51% of 1,80,000 votes you need to consider. Are you all getting my point, students? Are you all with me? Everyone. So listen carefully. If company is having equal voting rights, then paid up share capital, voting power, both are same. But if company issued, company is having differential voting rights, in that case only paid up share capital word is replaced with voting power. So for the time being, a few examples you can see: BPCL, Indian Oil Corporation, Hindustan Petroleum Oil Corporation, and then BHEL, ITCL, BDL, and NLCL. So all these are government companies. All these are government companies. Say for suppose central government, that means government of India holding 80% paid up share capital in IRCTC. Now IRCTC becomes a government company. Suppose government of India is holding 25% in A Limited. AP state government is holding 25%, and then next Tamil Nadu state government is holding some 20%. Now all put together total how much more? 70%. Now A Limited is also a government company. One more point. Subsidiary to government company is also treated as government company. Understood everyone? Subsidiary to government company is also treated as government company. Next one, write about types of companies based on the liability. Just academic sake. I'll just revise it quickly. So we had three types of companies. One is limited by shares. Here the members' liability is limited to the extent of unpaid value per share into number of shares held by them. Now their liability arises in two situations. One is whenever board of directors make calls on shares. The other one is in the event of liquidation. If assets are not in a position to meet the liabilities, then liquidator may call that amount. Liquidator may call unpaid value amount. We call it as contribution amount. So member liability arises in two cases. One is during going concern, board of director making calls on shares, and during liquidation, liquidator calling contribution money. But their liability is limited to the extent of unpaid value. Next one, limited by guarantee. Here members liability is limited to the extent of guarantee they provided in the memorandum of association. And here members liability arises only in the event of liquidation. During going concern, their liability is zero. But in the event of liquidation, if assets are not in a position to meet liability, then only their liability arises. Next one, unlimited company. Here there is no limit on the members liability. Only in India in practice private companies were incorporated under unlimited liability companies. Few private companies can incorporate as a unlimited liability. Here there is no limit on liability of the members. The members liability is joint and several. It is unlimited. Understood? So with this, my dear students, we completed preliminary topic completed. And next we'll start with incorporation of the company. So the next topic is incorporation of company and matters incidental thereto. So total 20 sections are there, section 3 to section 22. You can expect easily some 8 marks from this chapter. So in this part 1, incorporation process. So the first question is, write about the concept of promoter. So who is a promoter? So we had two meanings. One is one who take initiative in forming the company. That means drafting memorandum of association and articles of association. So filing all these documents with ROC, entering into preliminary contracts on behalf of future company. So whoever do all these kind of activities, we call them as promoter. But our Companies Act 2013 gave definition to the word promoter. So you can see here definition of the promoter. So promoter is a person who has been named as such in a prospectus or annual returns. So if someone is named as a promoter in prospectus or annual return, then he will be treated as promoter. If you open a Reliance Industry Limited prospectus, there you'll find, so late Shri Dhirubhai Ambani is our promoter. So now who is the promoter of Reliance Industry Limited, sir? Dhirubhai Ambani, sir. Next point, one who has control over affairs of the company. So this control you can get either as a shareholder or as a director or otherwise. That means through agreements sometimes you can get majority control in one entity. So sometimes, creditor can take control over the entity. For example, one company took finance from multiple banks and it failed to pay the loan amount. Now banks, consortium, groups of banks, they come together and then appointed one person to control over the affairs of company. Now that person will be treated as promoter. So simply named promoter, that means who is named as promoter in the prospectus or annual return, he is the promoter. Next thing, who had control over affairs of the company. So simply with respect to voting power, you can take shareholder. With respect to directors, yes, you can take managing director example. And sometimes, creditor who get authority or who get control over affairs of the company. So these people are also termed as promoter. Now, if you see Reliance Industry Limited, so Sri Dhirubhai Ambani already deceased some 15 years back, 15-20 years back, he deceased. Now, who is controlling the affairs of Reliance Industry Limited, sir? So, Mukesh Dhirubhai Ambani. So, now Mukesh Dhirubhai Ambani, sir, is the promoter of Reliance Industry Limited. And next one, in whose advice, in accordance with whose advice, directions or instructions, the board of directors of the company is accustomed to act. That means he is neither a shareholder nor a director, but still his word, his advices, his directions, board of directors are accustomed to act. Then in that case, that person is also treated as promoter. For example, if you take Ratan Tata, sir, TCS company, Tata Group of companies. So Ratan Tata, sir, he already resigned from the position of chairman. He already resigned from the position of director, but still board of directors are used to listen to Mr. Ratan Tata, sir, words. Are you getting my point? So in that case, so whose advices, directions, instructions, the board of directors are accustomed to act. Now that person is also treated as a promoter. And care to be taken, from the C point, one person is excluded. That person is professional. For example, to draft MOA and AOA, definitely a CA or CMA or CS services are required, because MOA had several restrictions. While drafting MOA, we need to comply many rules. And who will assist you in framing those clauses of MOA, AOA? Definitely, sir, a chartered accountant. Now, every year company has to prepare financial statements. They need to conduct general meeting, and in that general meeting, they need to lay down the financial statements, and on those financial statements, they need to get members' approval. All these directions, provided by chartered accountant in practice. Now CA is providing all these advices to the board. Now board of directors are following those advices. Now can we call that CA, the chartered accountant, as a promoter of the company? No, because he is rendering those services merely in a professional capacity. Suppose if that CA provide any service in addition to the professional services, suppose he is giving business ideas, he is helping board of directors in framing a new business strategies. Now that CA is also treated as promoter of the company. So my dear students, so who is a promoter? If you get the question in the exam, who is a promoter? One who was named as a promoter in the prospectus or annual return as a promoter. Next, one who has control over affairs of the company, either as a member, simply shareholder or director or otherwise, or in accordance with whose directions, advices, instructions, the board of directors are accustomed to act. But from the C point, a professional rendering services in professional capacity, that professional is excluded. Next one, sir, how many members are required for forming a company? Suppose if you take sole proprietorship, one person is sufficient. If you take partnership firm, two partners, minimum two partners are required. Similarly, for starting, for forming a company, how many members are required, sir? Here companies are again classified into three types: one person company, private company, public company. As we already discussed, in one person company, minimum one natural person is required. Maximum also one natural person. Listen to my word, natural person, Indian citizen is required for forming one person company. Whereas for private company, two or more persons are required. Here I am using word person. That means, person includes artificial person. So yes, a company can start a private company. A company along with a natural person, or two companies can start a private company. The point is, for forming a private company, minimum two persons are required. And then for public company, coming to the public company, minimum 7 persons are required, and we can form this company only for one purpose, that is only for lawful purpose. If you form company for any unlawful purpose, then tribunal is having power to lift the corporate will. So lifting of corporate will, they can identify the real persons behind the will, and they can punish those persons. So simply, one person company, one member, private limited company 2 persons, and then public limited company 7 persons are required. Next, once you select the company, you will be given 3 more options. That is, do you want company limited by shares? Do you want company limited by guarantee? Or do you want a unlimited company? So this is nothing but members liability. In case of limited by shares, members liability is limited to the extent of unpaid value. In case of guarantee company, member liability is limited to guarantee which was provided in the MOA. And in case of unlimited company, members liability is unlimited. And section 3A, this is an additional point. This is not part of original act, but in latest amendments, 2019 amendment act or 2017 companies amendment act 2017, they introduced this concept, if I'm not wrong. Okay, fine. So here section 3A, what it tells us, very simple. So we doing business in a private in a public company. Public company is our style of organization. We had 7 members, sir, but unfortunately one day 2 members got deceased. 2 members died, so now we are total 5 members, sir. Okay, is there any obligation on us to increase the number of members? Yes, you need to increase this 5 to 7. At any point of time, the number of members in a private company should not fall below 2. In case of public company, should not fall below 7. Suppose in any situation, if the number falls below 7 in case of public company, now the lawmaker is giving you time period of 6 months to increase that number. How many months they are providing? 6 months. Within 6 months, if you increase the number, by allotting shares to a new person, or by registering shares in the name of legal heirs of deceased person, yes, you need to increase that 5 to 7. If you do it, then no problem. Members liability, it is limited forever. Members liability is limited forever. Suppose you fail to increase number of members. 6 months completed. Now what happened? From this point of time, whatever debts incurred by the company, it is not company liable. Members of the company who are aware of the fact that company is doing business with reduced number of members. I repeat, so the members who are aware of the fact that company is doing business with a reduced number of members, only those people are liable for the additional debts, for the debts contracted after expiry of 6 months, and their liability is joint and several. Company liability already ceased at this point of time. So the debts which company incur after expiry of 6 months from the date of reduction of number of members. Are you getting my point? All those debts, company is not liable, only members are liable. Which members, sir? Member who is aware of the fact that, company is doing business with a reduced number of members. Sir, how ROC will know this matter, sir? Every year company has to file annual returns with ROC. There they need to provide the details of members. Active members, they need to provide the details of members. In that case, definitely ROC can know how many members are alive. Is company having full-fledged, is company having 7 members or not? ROC can verify it. Understood? So in that manner, ROC will issue notice. Accordingly, members liability, it will be converted from limited to unlimited. Next one. So section 3 is all about minimum number of members. Section 3A is all about members liability. In what case members liability will be converted from limited to unlimited. That is one case, reduction of number of members. Next one, incorporation procedure. Procedure for incorporation of a company. Very simple to remember. First thing, fundamental documents of the company, MOA, AOA. So first you need to finalize memorandum of association and articles of association. Next, this should be signed by subscribers. Who will sign MOA, AOA? Subscribers. Now, once these documents are signed, next, prepare two declarations. One declaration is about compliance declaration. Yes, so whatever the association we are registering or we are incorporating under Company Act 2013, so this association had complied with all applicable rules and regulations. So we have complied all applicable provisions, rules and regulations. Like that, we need to furnish a declaration. This is like a self declaration, and this should be signed by a director or secretary or company secretary or manager who was involved in the incorporation process, and a professional. So who comes under professional, sir? Company secretary, chartered accountant, cost accountant, advocate in practice. Any person from this four, I told you four: CA in practice, CMA in practice, CS in practice, advocate in practice. Any one person should sign this declaration. And there is one more declaration. This declaration is all about no defaults. So certificate about defaults. It's a certificate. Simply, yes, the subscribers of the company and proposed directors of the company, they need to sign this declaration stating that last 5 years we didn't commit any offense in the promotion or management or incorporation of the company, and we are not guilty of fraud. We didn't commit any offense under this Companies Act in the promotion or incorporation or management of the company. So these people will file a declaration. It will cover 3 points. It will cover 3 points. 2 points is with respect to past 5 years. 1 point is with respect to present company. So what information they are declaring, sir? Very simple. Last 5 years. Remember this time period. Last 5 years, we have not committed any offense in the promotion or management or incorporation of company. And we are not guilty of fraud, or we didn't commit any misfeasance. So during the last 5 years in the management of any other company, that means only a people without defaults. Even if they commit defaults, 5 years they should wait. 5 years they should wait. For example, I'm a director of ABC Limited. I failed to file annual returns of ABC Limited. Actually, I'm having a duty to file annual returns of the company, but I failed to file annual returns of this company consecutively 3 years. Now 5 years ban will be imposed on me. Next 5 years, I can't incorporate one more company. I was prohibited. Are you getting my point? So here the point is, whenever I'm incorporating new company, I need to declare myself that I didn't commit any offense during the last 5 years. So this is with respect to past. Future point of view, so whatever documents we are filing with ROC, all those documents are complete and correct to the best of my knowledge. Like that, they will certify. And these two declarations, you need to file it with ROC. In addition to this, MOA, AOA, two declarations, you need to provide address for temporary correspondence, details of address for temporary correspondence. Once you get certificate of incorporation, once company comes into existence, it will have a registered office, and that registered office address will be filed with ROC within 30 days of incorporation. And then next one, we need to give particulars of whom, sir? Particulars of subscribers as well as directors. Simply KYC documents. Are you getting my point? So proof of nationality, proof of residence, all those points. And then directors should give should disclose interest in other body corporates. They need to mention, they need to disclose their interest in other body corporates. This is for identifying related parties. That's it. Understood? So you need to file all these documents with ROC, then only ROC will issue certificate of incorporation. So is there any obligation on us to incorporate, to file all these documents for with ROC for getting certificate of incorporation? Yes. Why? If you read the definition of company, it starts like this. Company means a company incorporated under Companies Act 2013. That means without incorporation, no company comes into existence. All companies will come into existence only through incorporation. For incorporation, you need to file all these documents. Along with this, you need to pay prescribed fees. That fees, it depends upon state to state. Recently, I incorporated one company in Chennai, Tamil Nadu, having registered office, having Tamil Nadu. The premises is located in Chennai, Tamil Nadu. I kept authorized share capital 10 lakhs. It asked me to pay stamp duty of just 520 rupees. Whereas 1 month back I incorporated company in Telangana. I kept 10 lakh rupees stamp duty, 10 lakhs rupees authorized share capital. It asked me to pay 2020 rupees stamp duty. So stamp duty depends upon state laws. So no need to remember that amounts, how much amount, what is the form we need to file, because it changes very frequently. It changes very frequently. Understood? So pay fees or amount of the stamp duty electronically, obtain certificate of incorporation, and file declaration about address of the registered office. So if you go through this question, I have already completed everything. So you can see there: signing, declaration of complaints, declaration of subscription to shares, declaration of non guilty. So I haven't committed offenses. I was not found guilty of fraud, and all the documents filed with ROC for registration is complete and correct. And then address for temporary correspondence. Next one, subscriber details, director details. That's what I told you, particulars of subscribers and directors. So once you file all these documents, ROC will issue certificate of incorporation, and that certificate of incorporation will have a number called corporate identity number. Individuals, we will have Aadhaar number. Companies will have simply identity number. Again, company need to file an application for getting PAN. So income tax SSC, that number is again different. SIN is different, PAN is different. So don't think that both are one and the same. And then whatever documents we prepared and filed with ROC, those for incorporation, those documents you need to preserve till the liquidation of the company. So where to preserve, sir? At one place, that is none other than a registered office. So preserve all the papers, all the documents which you use for getting incorporation certificate, where at registered office. How long, sir? Period of maintenance period, sir, till the liquidation of the company. Next one, sir. Everything is fine, sir, but after 1 month after incorporating a company, yes, we came to know that we got certificate of incorporation by furnishing false information, which is not true. For example, all the subscribers are minors, all the subscribers of the company are minor. However, the person, one of the person, he morphed all the Aadhaar card date of birth, PAN card date of birth. He morphed somehow. He used softwares and he morphed all the documents, and he projected that all the subscribers are having contractual capacity, so to enter into a contract. So this matter we came to know after 1 month of incorporation. Now what we can do, sir? Very simple. Go and file an application with NCLT. Now NCLT is having power to do anything. So here the point is, I furnished false information. ROC came to know that the whatever information I furnished is false. During incorporation phase only, ROC came to know that I filed false information. Now what ROC will do? ROC will impose section 447 punishment on the persons who signed that declaration. I told you, right? We need to furnish 2 declarations. One is about compliance, one is about self declaration with respect to no offense we committed. Next one, no breach of trust, no guilty of fraud, and then whatever information we furnished is complete and correct. That declaration, whoever signed, those people are going to get punishment under section 447. So if ROC identify, yes, company is getting incorporated by false information, he will stop incorporation and he will levy punishment on the persons who signed the declaration. But already company got incorporated, sir. ROC, upon ROC verification, ROC thought that information is true and he issued certificate of incorporation. Later, these minor children, children are there, no? Their parents came to ROC and told that, sir, how can you give certificate of incorporation to an association who are having only minor persons, sir? Please cancel it. Please cancel it. Now, my point, can ROC cancel that certificate of incorporation? No. ROC had power only to issue certificate. Cancellation of that certificate vests with NCLT. Now any person, any aggrieved party can file application with NCLT. Here what NCLT is going to do, sir? NCLT is going to levy section 447 punishment on the persons who signed the declaration. So that punishment is common, and NCLT is also going to punish company. How, sir? How they are going to punish company? So you can see here 5 points, ma. This question in one attempt it came for 5 marks. I'm not sure, but in November 2019, I guess November 2019, these 5 points were asked for 5 marks. So state the powers of tribunal if company was incorporated by furnishing false information. If company is incorporated by false information, then NCLT will impose punishment on the persons who ever signed the declaration under section 447. And company, how they are going to punish company. They can modify MOA, AOA. Simply, NCLT may ask the promoter, come on, change all the names of the subscribers. Change the details of the subscribers. So modify MOA, AOA. Or NCLT may declare members liability as unlimited liability. Actually, in company type of organization, members liability is limited. But they will simply lift the corporate will. Now members liability, it get converted from limited to unlimited. Or else NCLT may ask ROC, this association not yet started business. So what is the need of liquidation? Simply you remove the name from the register. Simply strike off the name. You just remove the name from the register. Suppose that company already did some business. Now NCLT will order winding up of the company. Will order for winding up of the company. In that case, liquidator will come. He will take assets of the company. He will consider the liabilities and he will settle all those issues. So he will make affairs zero. Next one, or he may pass, NCLT may pass such other order it may deem fit. It may deem fit. Are you getting my point, students? Removal of name is different, winding up is different. Removal of name, it is not a liquidation, it is not a winding up. It is simply, just remove the name from register. That means no one can think that yes, company came into picture, company got dissolved. It is not like that. Company didn't came into picture. Simply company didn't came into the picture. Whereas under winding up, the world will know that company came into existence, it did some operations, later it got liquidated. So in winding up, you can see the birth of the company as well as death of the company. Whereas under removal of name, you won't find company existence. Next one, tribunal before passing any order, it will give one opportunity of being heard. It will ask the association why you committed this fraud. It will ask you. After collecting response from you only, they will pass final order. And before passing any order, they will also consider the transactions which you entered during the company incorporation date and company order date. Simply NCLT order date. So right from incorporation till NCLT order, whatever transactions company entered into, they will consider all the transaction and they will give final judgment. So my dear students, with this incorporation procedure completed, so first we studied who is a promoter and what are the documents to be filed with ROC for getting certificate of incorporation, and what happen if I furnish false information for getting certificate of incorporation. So we covered these 3 areas so far. Next one, moving on to one person company. So what is one person company? As we already discussed, in one person company, only one person can act as a member. See, it is also one type of private limited company, whereas number of members is restricted to one. And who can act as a one person, sir? Indian resident. Previously, it is Indian resident. Period of 182 days stay is very important. But now it is not 180 to 120 is also sufficient. If your period of stay in preceding financial year is 120 days, then you can incorporate one person company in this year. Not only that condition, second one, you must be a natural person and you must be Indian citizen. Indian citizen. If you are able to satisfy these three conditions, then you can incorporate one OPC. You can become member maximum in only in one OPC. If you want to become member in another OPC, you just liquidate this company. You just liquidate this company and become member in another OPC. So at a time you can hold membership only in one OPC. So students, let me ask you one more time. What are the three conditions to be satisfied to incorporate one person company? So first one, Indian citizen. Next one, natural person. Third one, residential status. Period of stay should be 120 days or more. I repeat, 120 days or more. Understood, ma? Everyone? Okay, fine. Next one, sir, when I should satisfy these conditions, sir? You should satisfy these three conditions at the time of incorporation of company as well as as a member after incorporation of the company. That means you should satisfy these three conditions not only at the time of incorporation but also subsequent years, but also subsequent, whatever tenure you're acting as a member, you should satisfy these conditions. Suppose 1 year I left India, almost 365 days, one complete year I'm in Australia. Now disqualification gets attracted, automatically there arises vacancy in the position of member. Vacancy in the position of member. Now the nominee will become member of the company, and the nominee so became member. And the nominee so became member will appoint another person as nominee to this company. Listen carefully. This point was tested 2 times in last 4 attempts. Same point. One person started a one person company with a nominee N, and N want to leave India. N want to go to Australia for higher studies. So that N is going to cancel Indian citizenship, and N is planning to get citizenship of some America. Now, is there any is there any vacancy in the nomination clause? Yes, there is a vacancy in nomination clause, because the three conditions of residential status, citizenship, natural person, you should satisfy not only at the time of incorporation but also subsequently while acting as a nominee, while acting as a member in the company. Are you all getting my point, students? Now these three qualifications, these three conditions, so along with member, nominee should also satisfy. Both nominee and member should satisfy these three conditions. And I already told you, at a time you can become member in only one OPC, you can become nominee in only one OPC. But there is an issue. Suppose in a OPC, Mr. A is the member and Mr. B is the nominee. Mr. B is the nominee. In BOPC, reverse. B is the member, A is the nominee. Allowed, sir. Allowed. Why? Because A at a time he is a member in one OPC, he is nominee in another OPC. So there is no breach of number. So it is within the permissible limit only, right? Now one day A got deceased. As a result, B became member in AOPC. B became member in AOPC. Now here if you observe, member B is holding membership in two one-person companies. One is AOPC, the other one is BOPC. Are you all getting my point, students? In this case, 180 days period is given to Mr. B, either to continue with A, liquidate B, or continue with B, liquidate AOPC. So 180 days election period is given to such member. Now within 180 days, he should take a decision whether to continue with his OPC or with another OPC. Understood, ma? Next one, prohibition on minor. Prohibition on minors. Minor cannot become member of the OPC, and minor cannot become nominee of OPC. Simply, minor can't hold even single beneficial interest in the company. Minor is not allowed to hold beneficial interest also. So member position as well as nominee position, minor is strictly prohibited. Minor is strictly prohibited. And this OPC, on member you found some restrictions. Similarly, on company also you can find restrictions. So what are those restrictions? It can do any lawful business except 3 activities. One is charitable activities. The main objective of OPC is to promote commercial establishments. So charity won't come under commercial purpose. So OPC is prohibited from charitable activities. OPC is prohibited from carrying NBFC activities. OPC is prohibited from investment activities. So OPC can't do these 3 activities. One is investment, the other one is NBFC, the other one is section 8 activities. Are you all getting my point, students? So next one, this nomination clause, there arises vacancy in nomination clause because of 3 reasons. There may be a vacancy in nomination clause. One is resignation by nominee. Second one is removal of nominee by member. Third one is disqualification, either death or revocation of citizenship, or residential status. His period of stay came to below 120 days. It fall below to 120 days. So that is nothing but disqualification. So because of these reasons, there arises vacancy in the nomination clause. I repeat, what are those cases, ma? First one is resignation by nominee. Second one is removal of nominee by member. Third one, disqualifications. In these cases, within 15 days of vacancy, a sole member should appoint another person as a nominee, and within 30 days, sole member has to communicate the same with the ROC. Simply that company has to file forms with the ROC with respect to change of nominee. That's it. So if you see MOA in a OPC company, you will find 7 clauses, not 6. That 7th clause is all about nomination clause. Next concept is section 8 company. One more important concept, alternative items. This question is coming. In section 8 company, just listen. There are 3 conditions. If you want to incorporate, or if you want to convert your company into section 8 company, or if you want to start section 8 company, 3 conditions are must and should. One is objects should be commerce, art, science, sport, education, research, etc. Simply charitable activities or religious activities. And second one, this company is prohibited from declaration and payment of dividend. Then whatever surplus is there, that surplus should be invested in promoting the objects of company. So that is the third condition. So total 3 conditions, my dear students. One is object should be charitable or religious. Second one, so prohibition on declaration and payment of dividend. Third one, invest the surplus in promoting other objects of the company. If you are able to satisfy these 3 conditions, file an application with ROC. So simply central government, but power delegated to ROC. Okay, file an application with CG. CG, upon verification, CG may grant license subject to some other conditions. So you need to give priority to these areas. You need to give priority to this state. Like that, they may levy additional conditions. So once you get license, register that license with ROC. From that point onwards, you will be treated as company with charitable objects, simply section 8 company. And these section 8 companies are allowed to take CSR license. In accounts of company, you are going to get that point. CS or corporate social responsibility. And these section 8 companies are allowed to claim section 12AA certificate, section 80G certificate, section 80GG certificate from 80G from income tax department. Commissioner of income tax will give these licenses to section 8 company. In that case, these companies are not at all required to pay any tax to the government. subject to the conditions. Okay, that is entirely tax subject ma, but come to our subject. So here, once you get license, register that license with ROC and you will be treated as licensed company or section 8 company. You will get all the privileges like statutory, all the privileges like section other company. But the point is, here you had additional privileges, here you had additional disadvantages. Being a section 8 company, you are given some privileges and you are given some uh, restrictions. So privileges, coming to the privileges, even a partnership firm can become member of section 8 company. They can acquire shares of the section 8 company. In other companies, firm is not allowed to become member because firm has no legal identity. Partnership firm is just a relation, right? So firms can become member under section 8 company. And then no need to constitute several committees like nomination and remuneration committee, shareholder relationship committee. Those committees are not applicable to section 8 companies. And then one more advantage, for calling general meeting, normal cases 21 days notice is required, but here 14 days notice is sufficient. This is one more privilege. But the biggest demerit is, if company want to change its object clause, simply if company wants to change MOA or AOA, they need to take permission, prior approval of central government. Without approval of central government, they can't modify MOA, AOA. And sir, is there any possibility that can I convert section 8 company to other companies? Yes. After taking members approval, file an application with central government. If central government allows you, then you can convert into other kind of companies. Simply from non-profit companies, not for profit companies to profit companies. So not for profit making companies to profit making companies. But the point is, at the time of such conversion, whatever surplus you are having, whatever assets you are having on the date of application, those will be transferred to similar section 8 company. Understood? So CG approval is must and should. Next one, question number 7 is very important. Revocation of license. Revocation of license. So when revocation of license will take place? 3 cases. One is, you violated section 8 conditions. You distributed surplus in the form of dividends, and you changed objects without permission of CG. So section 8 you violated, or you violated the conditions of central government, or you are doing some fraudulent activities, or your affairs are fraudulently managed. That means you are taking lump sum amount in through bank account and paying cash amount to the donors. Simply you are involved in converting white money into black money, or you are involved in converting black money into white money. So simply if you are doing such kind of activities, fraudulent activities, then CG will give you one opportunity of being heard. Simply it will give you notice. Later they are going to cancel your license. Then what is the consequence of revocation of license, sir? Consequence of revocation of license, here you will be amalgamated with similar section 8 company, or you may be liquidated. In the event of liquidation, whatever surplus you are having, whatever amount having in your bank account, all those amounts shall be transferred to either insolvency and bankruptcy fund, or to the similar section 8 company. So similar section 8 company means what? A section 8 company which was engaged in similar activities. Similar activities means, suppose I started a company with objective of sports, and there are two section 8 companies. One is engaged in rural development, the other one is engaged in sports. Now whatever surplus there in my company, it will be transferred to a section 8 company which is having sports objective. That means in which activity I was incorporated, showing which activity I was incorporated. In that activity, in the company which is having similar activity, we are going to transfer the funds. Are you getting my point, students? So either liquidate or amalgamate with similar section 8 company. In case of liquidation, surplus arising from such liquidation transfer to insolvency and bankruptcy fund, or transfer to similar Section 8 company. But if you violate NCLT order or if you violate Section 8 conditions, this is the maximum punishment. To company, it is 10 lakhs to 1 crore, and to the directors and officers in default, the punishment, it ranges from 25,000 to 25 lakhs. So punishment you need to remember. How, sir? Revision. Multiple times revision you need to perform. Next, write about effect of registration. This is similar to features of company, or this is similar to characteristics of company. Once we get certificate of incorporation, then what is the effect? Very simple. Separate legal entity, body corporate, contractual capacity. It can acquire properties, it can incur liabilities, it can enter into the contracts. So simply you can write the features of the company. Not that much important. You can skip this one, but give one time reading, so that any practical question you comes into the exam, you can attempt it easily. Next one, part 2, MOA definition. So part 2, MOA and AOA. Write about definition of memorandum and its significance. So if you read the entire definition of MOA, you will find this. Memorandum of association means memorandum of association. So memorandum means memorandum of the company, which was originally framed at the time of incorporation. You will find original MOA at the time of incorporation, and you will find altered MOA or altered from time to time in pursuance of any previous company law or of this act. So memorandum covers not only original MOA but also altered MOA. There is a significance in framing definition like this. The provisions which are applicable to memorandum, you should comply not only at the time of drafting original MOA, you should also comply same provisions at the time of altering such MOA. That means both original MOA and altered MOA should be in accordance of the provisions of Companies Act 2013. That is the only significance of this definition, nothing more than that. But MOA is a chartered document. MOA is a constitutional document, right? We natural persons, we had our own constitution, Indian Constitution. Indian Constitution 1950, right? So in that constitution, things were defined in a negative manner. We can do anything except few things which were notified in the constitution. You can do anything. You can read, you can stand, you can walk, you can talk, you can sing, anything. But you can't kill another person. You can't kick another person, right? Similarly, to a natural person, you can find Indian Constitution, and to the artificial person like company, you can find MOA. But the significance of MOA is a company can do anything which is there in MOA, and a company is prohibited from doing anything which is not there in MOA. Are you getting my point, students? So company can do any activity specified in MOA, and company is prohibited from doing any activity which is not specified in MOA. It helps two group of people. One is investors, the other one is outsiders. So investors can assess the risk of their investment by reading MOA. So yes, what a company can do, what a company can't do, you can find in object clause of memorandum of association, right? So because of that activity, what risk is involved, how long company can do business, how much profit company can earn, so you can easily assess reading that document. So investor point of view, risk assessment. Outsider point of view, contract validity. Outsider point of view, it is all about validity of the contract. If an outsider enter into a contract, enter into an agreement with company which is clearly outside the object clause purview, then we call it as ultra virus transactions, ultra virus acts. In such a cases, company is not liable to outsider. That means who is going to bear that loss? Who is going to suffer? Outsider. Of course, outsider will recover that thing from directors of the company. Keep it aside. But company is not liable to the outsiders. Are you all getting my point, students? So here, MOA serves two group of people. One is investors about their risk assessment, and the other one is outsiders about the contract validity. Next one. So MOA will have some 6 clauses, sometimes 5 clauses, sometimes 7 clauses. If you're a company with share capital, you can see 6 clauses. If you are a one person company, you can find 7 clauses. But if you are a company without share capital and if you are not a one person company, then you can't see capital clause. There you can see only 5 clauses. Understood? So it depends upon nature of the company. But for the time being, 6 clauses: name, registered office, simply situation clause, object clause, and then capital clause, association clause. Are you getting my point, students? Liability clause. So the 6 points you can see in memorandum of association, starting with name clause. So MOA, definitely MOA first clause is name clause. Based on that name clause only, certificate of incorporation will be given. In certificate of incorporation, you are going to have a name of the company. So it is nothing but the name which you furnished in MOA. Now the point is, while selecting the name, you need to comply the conditions which was specified under Companies Act as well as Company Incorporation Rules 2014. So what are those restrictions, sir? Your name should not be identical or resemble to the name of existing company, because companies today, they had identity only through its name. So company is not a natural person. If you see natural person, you can identify them, you can differentiate one natural person from another. So 2 or 3 persons won't have same appearance, right? Exceptional cases, avoid them, twins, avoid them. But I'm telling you, so we can differentiate natural persons, but company, we can make differentiation only through name. That's why a unique name will be given. You need to select unique name. Your name should not be identical with or resemble to the name of existing companies, and it should not be undesirable in the opinion of central government. So what is meant by undesirable? Very simple. It should not be similar to the name of existing registered trademarks. Existing registered trademarks. And it should not give any impression that company is some way connected with government or local authority or any corporation which was connected to government. So using such a phrases, it creates some kind of impression, some kind of impression in the mind of the people, the readers. They may think that this company is somewhere connected with the government. For example, if I incorporate a company like this, Andhra Pradesh State Capital Developers Limited, Andhra Pradesh State Capital Developers Limited. Now, the reader or an outsider who is going through this company details, they may think that this is linked with AP government. Are you all getting my point? So you should not use some words like which create impression that company is connected with the government, and then specific words not to use. For example, commission, authority, undertaking, board, federal, republic, president. So all these names are strictly restricted. If you want to use these undesirable names, file an application with CG. If CG allows you, if CG gives you permission, you can use them, or else strictly prohibited. Strictly prohibited. So now the point is, every year millions of companies getting incorporated, or lakhs of companies getting incorporated. Now whatever name you are proposing, is it available or not? If available, reserve the name. Now prepare MOA, AOA. Now file all these documents with ROC. Now ROC will issue certificate of incorporation. So for preserving the name, simply for reserving the name, we are going to file an application. So here the promoters of the company shall make an application, may make an application to ROC for reservation of the name set out in the application as the name of the proposed company or name to which company proposes to change its name. That means existing company, it wants to change the name. Example, Satyam Computers. Initially the name of the company is Satyam Limited. Later they changed the name to Mahendra Satyam. Mahendra Satyam. So existing company wants to change its name, whether new name is available or not. Or sir, myself, an association not yet incorporated, we want to incorporate under company, sir. In that case, yes, file an application for name of proposed company. So this form, who will use? New company as well as existing company. So previously it is formed RUN, reserve unique name, but now practically it is a SPICE form, simplified procedure for incorporating company electronically plus. So SPICE plus is there. So practically different, book is different. So for reserving the name, file RUN. Sir, reservation of name means what, sir? During this period, so say for suppose, that name is reserved to you for 20 days. You are a new association, you want a company, you want to register a company. In that case, the name will be reserved for 20 days. Sir, no, sir, I'm existing company, I want to change my name. So I'm filing this form for whether proposed name is available or not. If it is available, it will be reserved for a period of 60 days. Now this 20 or 60, what it indicates, sir? During these 20 days or 60 days, if some other association is filing an application for same name, for similar name, for identical name, they are not going to get that name because it was already reserved to you. So within 20 days or within 60 days, you need to file remaining documents. Then only this name is allotted to you, or else the reserved name shall be cancelled and it will be made available to the rest of the public. Next one, cancelling name. So when they will cancel the name, sir? No, whatever information you furnished, if it is false, if it is not correct, so after giving one opportunity of being heard, they are going to cancel the name. Are you getting my point? So if company has not yet incorporated, then reserved name shall be cancelled. Now that name is available to the rest of public. Already incorporated, sir. Now ROC will ask the company to change its name. Change the name. We are giving you time limit of 3 months. Change the name. Sir, one example, sir. My name is similar to the existing company. In that case, I need to furnish declaration or NOC, no objection certificate, from the existing company. If you see Reliance group of companies, you can find word Reliance, similarly to some 60 or 70 companies. You can find Reliance word is used by some 70 companies. How? Because all those 70 companies are in a group. So now I want to use the name Reliance. So for that, I need to get no objection certificate from Mukesh Ambani. So but what I did, I forged the documents, I morphed the documents, I created documents, and I signed as if Mukesh Ambani, sir. Now the point is forged documents I furnished and somehow the name got reserved. Company not yet incorporated. I repeat, company not yet incorporated. Now ROC came to know that yes, this document is forged document. Now ROC will cancel the name, cancel the reserved name. Or suppose ROC came to know that after incorporation of company, after giving certificate, ROC came to know that now ROC will give me time period of 3 months to change the name, or else it will verify the affairs of the company. If no business was started, then it will remove the name, simply striking the name of company. Sir, business did, sir, some transactions company entered into, sir. Now an ROC will file application with NCLT. NCLT will order winding up of the company. So that's what I told you previously. ROC had no power to liquidate the company. ROC can issue certificate of incorporation, but liquidation power lies with NCLT. And your name should satisfy this Emblems and Names Act also. So with this name clause completed, next one is domicile clause. So this is nothing but state. You need to furnish the name of the state, name of the federal state. Federal state means India as a whole. We have a central government of India, and each and every state will have their own governments. So that's what federalism means. So the name of federal state is mentioned where the registered office is to be situated. So here we are not going to give complete address of the company. Here we are giving only the name of state. Here we are going to give only the name of state. Once we get certificate of incorporation, we will file electronic form INC 22. There we will mention complete address of the company. That's what registered office address. Next one, object clause. So there is no restriction on object clause, but two things you need to keep in mind. Your object clause should not be in violation of Companies Act 2013. Your object clause should not be in violation of Companies Act 2013, and your object clause should not carry fraudulent activities. Fraudulent activities. Simply, Companies Act made some prohibition. Companies Act prohibited OPC from doing investment activities, NBFC activities, charitable activities. Now, OPC MOA should not contain those clauses. OPC MOA should not contain those clauses, even though they are legal. You should eliminate those clauses. Are you getting my point? So it should be in accordance with Companies Act 2013, and it should not contain any fraudulent activities or any kind of affairs which are opposite to public policy. It should not contain any object which is opposite to public policy. If you include them and if you get certificate of incorporation, then also you are not allowed to do such activities. You are not allowed to do such activities, right? So next one, anything, if company is entering into any transaction which is beyond the powers of object clause, simply we call it as ultra virus, beyond the powers. So ultra virus, effect of ultra virus is void ab initio. Repeat the word void ab initio. That means void from beginning. If something is void from beginning, you can't ratify it. You can't ratify the activities which are void ab initio. So ultra virus acts are simply void ab initio, and you can't ratify them. Understood, ma? But if any activity which is beyond the powers of directors, I repeat, beyond the powers of directors, but within the powers of company, then company can ratify it. Here, ultra virus is of three types: beyond the powers of Companies Act, beyond the powers of let me write. So ultra virus is beyond Companies Act, 1 point, beyond MOA, beyond AOA, but within MOA. This ultra virus as to Companies Act is illegal, void, as well as punishable. Ultra virus as to MOA is simply void. Ultra virus as to AOA valid if ratified by members in the general meeting. The main objective of ultra virus is to protect the stakeholder funds. See, today our members contributed money to the company thinking that company will do only one business, only one activity which is specified in MOA. Directors, without their permission, if they do second business with these funds, if they do other business with these funds, so company is not liable, company is protected. Those directors who entered beyond MOA of the company are punishable. So they need to return funds to the company. In that manner, investors' funds will be protected. Stakeholder funds will be protected. Are you getting my point, students? And case studies you can refer, just read it. You can easily get that information. Next one, liability and capital clause. So this clause decides the liability of the members, not company. Company liability is always unlimited. This liability clause decides the liability of members. If it is limited by shares, then limited to the extent of unpaid value. Simply, unpaid value multiplied by number of shares held by the person. Here there is no concept of joint and several liability. That means Mr. A held some 1000 shares, unpaid value 2 rupees, and Mr. B held 10,000 shares, unpaid value simply 2 rupees. Now here A is liable to the extent of 2000, B is liable to the extent of 20,000. Suppose if B fails to pay, A is not liable to B's share. A is liable only with respect to his share of 1000 shares only. So no joint and several liability. Here only individual liability limited to the extent of unpaid value. And company limited by guarantee, here also members liability is limited. Now, in case 1 limited by shares or case 2 limited by guarantee, the members liability is subject to three amounts. So here 2 people are liable for 3 amounts. Who are the 2 people? Present members. And if present members fail to pay, then list B contributories. That means the persons who transferred shares within 1 year before commencement of liquidation list to be contributories, and they are liable for three amounts. One is deficit portion, so excess of debts over assets, that deficit portion. Second, liquidation expenses. Third one, adjustment among members. Adjustment among members. Suppose few members they are holding fully paid shares. Some members they are holding 80% paid up, and remaining persons they're holding 40% paid up. They're holding three types of shares. One is fully paid up, second one is partly paid up, third one is 10% paid up. Imagine now, yes, this person, last person, should bring money so that it will be adjusted among the contributories. So these people are liable for three amounts. One is deficit portion, liquidation expenses, and adjustment among the contributories. Next one, share capital clause. In capital clause, you need to give three details. One is authorized capital or nominal capital divided into number of shares, face value. Divided into number of shares, face value. You need to furnish all these three details in the capital clause. Must. Simply disclosing, authorized share capital 40 lakhs is not sufficient. 40 lakhs divided into 4 lakh shares, each share 10 rupees. You need to give that information also. Are you all getting my point, students? Next one, subscription clause. Here you'll find the details of subscribers, the persons who subscribed MOA, you will find the details of those persons. And then these are the tables. We had 5 companies. Just write the companies in a list. Like first one, limited by shares. Next one, limited by guarantee without share capital. Next one, limited by guarantee with share capital. Unlimited company without share capital. Unlimited company with share capital. So remember this order. Now with respect to MOA, just write the order like this. So in schedule 1, we had 10 tables. In first session only I told you, we had total 7 schedules. In that, schedule 3 is financial statements, schedule 1 is MOA, AOA. So write the order. So A, B, C, D, E, and then F, G, H, I, J. Simply, original order is F, G, H, I, J. Simply interchange these two. Interchange. You'll get the list. You can easily remember. Limited by shares, limited by guarantee without share capital, limited by guarantee with share capital, unlimited company without share capital, unlimited company with the share capital. So MOA tables A, B, C, D, E, AOA tables F, H, G, J, I. In this manner, you can remember this. Next one, so with this MOA we completed. AOA, Articles of Association. So AOA is for internal governance. I repeat, AOA is for internal governance. MOA, it speaks about what a company can do, what a company can't do. But coming to AOA, how the things can be done. Because company being an artificial person, it can't do things on its own. It definitely requires some human agency. Now the powers of human agency you will find in AOA. The powers of directors, simply speaking, what a director can do on behalf of company who is going to sign the contracts. So in simple statement, what is meant by AOA? So AOA is for internal governance. And if you ask me the definition of AOA, similar to the MOA. Articles means articles as originally framed or as altered from time to time in pursuance of any previous company law or of this act. That means simply, if you put it in equation format, articles of association equal to original articles plus altered articles. That means both original as well as altered articles, they both should comply the provisions of Companies Act 2013. Next one, ma. So here the point is, you can have own articles or you can have model articles. That means you can copy the articles of table F, table simply table F, you can copy it, or you can have both own and model articles. But MOA, everything is own. So a company should have own MOA, whereas company can have model articles. Next one, entrenchment of AOA. So entrenchment, simply for certain clauses alteration in AOA, we need special resolution. But if you are making, however, if you are making, sir, not special resolution, I need 90% approval, I need 100% approval for altering some clauses. That means you want to make entrench certain provisions. We call it as entrenchment. In simple word, entrenchment means something very simple, you want to make it complicated. Making something complicated is nothing but entrenchment. If you ask me, getting special resolution is easy or getting 90% approval easy? So special resolution is easy, because here, 3 times votes in favor. Simply here, votes in favor, if it is greater than or equal to 3 times of votes against, a special resolution is said to be passed. If votes in favor is exceeding 3 times, is exceeding or equal to 3 times of votes against, then special resolution is said to be passed. Are you getting my point? But you want 90% approval. That means, almost 90%. 90% approval only. Yes, 90% approval required means it is more than 75%. So this is nothing but entrenchment. So entrenchment means making something more protective. Next one, you can have these entrenchment provisions at the time of incorporation or subsequent to incorporation. If you are a new company, you want to incorporate under 2013 Act, then you can have entrenchment provisions right at the time of incorporation only. Or sir, I forgot to entrench my AOA, sir. Now you can entrench it. How, sir? Simply take members' approval. Sir, I am a private limited company, sir. How much approval is required, sir? In case of private company, all the members' consent is required. Sir, myself public company, sir. Just special resolution is required. Now, after taking this approval, entrench your AOA, file these documents with the ROC. ROC shall register the same. So it is irrelevant when you have entrenchment provisions is irrelevant, but whenever you are introducing entrenchment provisions, you need to communicate with ROC, or else that entrenchment provision is not enforceable. Are you getting my point, students? Entrenchment provisions are enforceable only when you give notice to ROC. And you had examples, you can go through it. Forms of articles, just now I told you, table F to J, how to remember? I gave you note point. Next one, doctrine of indoor management. So just now we studied, doctrine of ultra-vires. Company is protected, company is not liable to the outsiders. Extension of doctrine of constructive notice, extension of doctrine of ultra-vires. If you see, we had 3 doctrines: doctrine of ultra-vires, continuation to ultra-vires is doctrine of constructive notice. And to this doctrine of constructive notice, we had an exception, that is nothing but doctrine of indoor management. What this doctrine of ultra-vires is telling, activities beyond the powers of MOA, company is not liable to the outsiders. Company is not liable to the outsiders. Now outsiders are asking, sir, is there any obligation to read the objects of MOA? Yes, there is an obligation. That was, dealt by doctrine of constructive notice. Constructive, deemed, notice, information. The moment I file a piece of paper with ROC, it becomes public information. It is available to all the persons in public. Simply by paying a prescribed fees, nominal fees of some 100 rupees, they can download those documents. The main intention of filing information with ROC is to make it public. Now, every member should read those documents. So, doctrine of constructive notice makes an assumption that any person dealing with company is having knowledge of MOA and AOA. And further, it is making a presumption that these people already understood those affairs of the company. So similarly, that means, under ultra-vires, company is protected. Similarly, under constructive notice also, company is protected. Outsiders are not protected. To the outsiders, company is not liable. But this doctrine of indoor management is entirely exceptional case. Here, what House of Lords, what judge is telling, what House of Lords, in this case study of Royal British Bank versus Turken. So the judgment was came like this. The judgment was given like this. As an outsiders, he can make presumption with respect to internal proceedings. Sir, internal proceedings means what? Resolutions, members approval, board resolutions, everything, internal affairs. An outsider can make an assumption with respect to internal affairs. They have been conducted according to MOA and AOA only. So now, if any internal proceeding went wrong, outsiders, company's liability with respect to outsiders is not at all prohibited. Company is strictly liable. So that means outsiders are protected, company was made liable. So under doctrine of indoor management, the objective of the doctrine of indoor management is an outsider dealing with company can make presumption with respect to internal matters. But this doctrine is available only if two conditions are satisfied. Condition number 1, he should have knowledge of MOA and AOA. Condition number 2, he should not have knowledge of irregularities. Knowledge of MOA, AOA is should. Knowledge of internal irregularity, he should not have. So if these two conditions are satisfied, then he can take advantage of indoor management. Accordingly, he will be protected. Company is liable to that person. But to this indoor management, we had exceptions. My dear students, I didn't remember the attempt. I think it is May 2019. They asked a question like this. Define doctrine of indoor management and list down the circumstances where constructive notice is applicable. State the circumstances where constructive notice is applicable. So the constructive notice is applicable to the situation where indoor management is not applicable. See, either indoor management will apply. If indoor management is not applicable, that means constructive notice is applicable. So exceptions to indoor management is nothing but circumstances under constructive notice. So here we had 3 exceptions. That is, if you had knowledge of irregularity, indoor management is not available. How can you make a presumption that internal proceedings happened correctly? Because you know irregularity. Once you know fact, you can't make assumption. Next, negligent. You are negligent. You didn't inquire company documents. And forgery. Forgery is entirely nullity. As per Indian Penal Code, the effect of forgery is null and void. Nullity. So in forgery cases also, indoor management is not applicable. Understood, my dear students? So 3 doctrines, once again I am repeating. Ultra virus, extension to ultra virus is constructive notice, exception to constructive notice is indoor management. Exception to indoor management is nothing but constructive notice. Getting it? Next one, question number 13. MOA, AOA cannot override the act. In section 4 and section 5, I clearly told you memorandum articles we need to prepare according to the act only. Act means Companies Act. If there is any point which is not allowed under Companies Act, for example, in OPC, I wrote a point that company can invest surplus funds in another body corporate. Actually, Companies Act is not allowing, but you still wrote it, you still added it, and you somehow managed and you got certificate of incorporation. Now, sir, can I invest in other body corporate? No, you can't invest in other body corporates. Sir, that means if there is any inconsistency between Companies Act and MOA, AOA, any board resolution, any members resolution, or any agreement executed by company. So if there is any inconsistency between Companies Act and these 5 things, always Companies Act will prevail. Companies Act is supreme. Only Companies Act is applicable. Understood? And to the extent of such inconsistency, it becomes void. Suppose in MOA I had in AOA I had 100 points, only one point is conflicting in nature. Now only that one point is void, all remaining 99 points are valid only. 99 points are valid only. Are you all getting my point, students? Next one. Write about effect of MOA and AOA. So effect of MOA and AOA. The moment company gets incorporated, this MOA AOA becomes contractual documents between company and members. It is irrelevant whether you signed MOA, whether you signed AOA, it is irrelevant. The moment you become member of the company, the moment company gets incorporated, this MOA and AOA becomes contractual document between these two persons. That means company is bound by these provisions to members. Members are bound by these provisions to company. That means if company make calls on shares, suppose company make calls on shares, member should pay that amount, or else company can forfeit the shares of member, because member violated provisions of MOA AOA. Members breached the provisions of MOA AOA. Now company will take action. Similarly, company should spend all these monies only on the object specified in object clause of MOA. Only object specified in MOA. Suppose if company is deviating, company diverts these funds to some other purpose. Now member can bring injunction order against company. Member can stop company from entering into those activities. So that means, company is also bound to the members. Company should spend money only with respect to objects specified in MOA. Or else, members can take action against company, because members will stand in aggrieved position. Company stands in default position. So because of MOA AOA, company is bound to members. Members are bound to the company. But, company is not bound to outsiders. Outsiders are not bound to company, because MOA AOA, these are the two contractual documents between company and members. Are you all getting my point, students? So company liable to members, members liable to company, and members not liable to each other. Directly they are not liable, but with the help of company they can make liable each other. Students, is it clear, ma? So with this, basic provisions of MOA AOA completed. Now the next topic is alteration of MOA and AOA. Alteration of MOA and AOA. So what is meant by alteration? Simply amendment. That means modification. Something we are adding, something we are deleting, or something we are replacing it. So this is nothing but alteration. Now coming to alteration of MOA. Original MOA, if you observe original MOA, it was signed by the members of the company. Technically speaking, subscribers. So subscribers of the company, they signed original MOA. And yes, this original MOA was filed with ROC. Upon issue of certificate of incorporation, this MOA will act as a contractual document between members and company, right? Now something, if you want to modify a contract, any term in the contract, it requires mutual consent of the parties, right? Mutual consent of parties is required for modifying the contract. Here also, MOA is a contractual document between members and company. For making alteration, members' approval is required. What kind of approval, sir? It depends upon case to case. Suppose, voluntary modification like change in name clause, change in object clause, change in liability clause, or change in object registered office clause. So for this, members' special resolution is required. Whereas change in capital clause and compulsory change of name, simply rectification of name, in those cases ordinary resolution is sufficient. So depending upon the case, members approval is required for making alteration to MOA. Then once you get approval, you need to amend MOA, so alter MOA. This altered MOA will get effect only if you file it with ROC, because when you read the definition of MOA, MOA means original MOA as well as altered MOA, right? So altered MOA will get effect only when it is registered with ROC. So that's it. The procedure of alteration of MOA is completed. But in detail, we'll discuss now. So first one, MOA, the reasons for alteration of MOA you can observe. So there may be change in name of the company. So name might be changed because of two reasons. One is, change in ownership or management of the company. Next one, change in constitution of the company. For example, private company to public company, conversion of private to public, conversion of public to private. There you need to add word private in one case, you need to delete private in another case, right? So name gets altered. Next one, there may be a reason of rectification of name. Rectification of name. So when you copy the name of other company, when your name is similar to the name of existing company, now ROC may issue 3 months notice to you. Within 3 months, you need to change the name. So that is nothing but rectification of name. And second reason for alteration of MOA is alteration of object clause. Yes, I want to do new business, or I want to change my existing business. I want to upgrade my technology. So by purchasing latest machines. So if my object clause permits, then I'll do it. If my object clause restrict me, prohibit me, then I'll make amendment to the object clause. Next one, alteration to registered office clause. Registered office clause. Next one, alteration to capital clause. Alteration to capital clause. There is an alteration to liability clause also, but that is not in our syllabus. And then association clause we can't alter unless there is an order from central government, because association clause, it shows the persons who subscribed MOA. Even after 100 years or even after 200 years, that means till the liquidation of company, the association clause is not going to get changed. Even the people may die, but the persons who subscribed MOA originally, you can see only those people names. So let's start the discussion of alteration of name clause. So yes, change in ownership or management. This is one of the reason why they change name of the company. Like Satyam Computers, if you take, originally Satyam Limited. Next, it got changed to Mahindra Satyam. Later, they removed word Satyam and they kept it as Mahindra. Of course, it got merged with Tech Mahindra. Now you can see only Tech Mahindra company. Fine. So alteration of name clause. What is the procedure, sir? What is the procedure? Central government approval is required. Prior approval of central government is required. Why? Because whether the proposed name is available or not, you need to file an application with central government. Of course, power delegated to ROC. So you need to file an application with ROC. If the proposed name is available, it will be reserved for a period of 60 days. So within 60 days, what we need to do, sir? Simply call for general meeting, extraordinary general meeting. Take members' consent by way of special resolution. Now alter MOA and file this altered MOA along with special resolution with ROC. Now ROC will change the old name and he will issue fresh certificate of incorporation with a new name, and he will modify the same in his registers also. But whenever there is a change in constitution of the company, like private limited to public limited to private limited, in those cases central government prior approval is not required because that name is already available. Understood? Suppose Reliance Industry Limited. Reliance Industry is available. If they want to convert into Reliance Industry Private Limited, they can easily convert. For that, no need of central government approval is required. Of course, for conversion of public to private company, I'm not speaking about name change. I'm speaking about constitution. Public to private, CG approval is required. Whereas private to public, CG approval is not at all required. Next one, in case of rectification, listen carefully. Rectification, yes, here CG will issue an order to change the name. Of course, ROC will issue an order to change the name because of two reasons. One is infringement of trademark, that means unauthorized copy of trademark. The other reason is other cases, simply others, that means your name is similar to the name of existing company. Previously we had no centralized software like mca.gov.in, so maybe possibility that one ROC without knowledge of availability of names, without knowledge of name of existing companies, he might have issued certificate of incorporation, but later he came to know that this company was already available with this name, so the name is already reserved by some other entity. Now ROC will issue us notice to the company to change the name of the company. Of course, while reading you will get central government, but in rules it was already delegated to ROC. Fine. So in these two cases, in trademark case, particularly speaking about trademark case, the owner of registered trademark, repeat, owner of registered trademark shall file an application with central government within 3 years of incorporation of that company. So owner of registered trademark has to file application within 3 years with central government. That's stating that, sir, my trademark got infringed. Some people without my permission, they're using my name. Now central government will issue notice to that company. Come on, change your name. So we are giving you time of 3 months. We are giving you time of 3 months. Originally it was 6 months, but in amendment, it got reduced to 3 months. Now company has to change the name within 3 months, or else they will issue an order for a removal of name from the register, or they may order for winding up of the company. So within 3 months, company, by passing ordinary resolution, what kind of resolution? Ordinary resolution, company has to change its name. Even in other cases also, central government will issue order to company, 3 months order. 3 months, what is meant by 3 months order? Within 3 months company has to change its name. By passing what kind of resolution, sir? Ordinary resolution is sufficient. Ordinary resolution is sufficient. Fine. So in this name, rectification of name will be done. But the point is, involuntary change of name, the company should be regular in filing its annual returns, should be regular in filing financial statements with ROC, and then it should be it should make payments to the debenture holders, deposit holders on timely basis. Simply speaking, any company which has committed default in payment of principal as well as principal or interest to debenture holders or deposits, and not filing the returns, annual returns, financial statements with ROC, then that company is prohibited from changing its name. Of course, if company rectify its defects, then very next minute it can change the name by passing a special resolution. So my dear students, here the name will be changed because of two reasons. One is voluntary change, the other one is rectification of name. So rectification of name appears in two situations. One is infringement of trademark, the other one is other cases. Remember, my dear students, in one attempt there was a question that owner of registered trademark filed an application with CG after 5 years of incorporation of the company. 5 years of incorporation of the company. Now, is there any obligation on company to change its name? No. Why? Registered owner trademark, registered trademark owner should file an application, should file a petition with central government within 3 years of incorporation of the entity with the name, with the same name. So since 3 years completed, now owner can't take action against the company which copied the name of trademark. Are you all getting my point, students? So here it is not 6 months, it is 3 months. Next, involuntary change of name, you should remember the defects. So if company is defaulted with respect to filing returns with ROC and with respect to payment of amounts to the debenture holders or deposit holders, then that company is prohibited from changing the name. Of course, if defects get rectified, then company is allowed to change its name. And in case of delay, so company fine 1000 rupees for every day, and every officer who is in default fine minimum 5000 and maximum 1 lakh rupees. Understood, my dear students? So let me remind you one more point. In case of change of name, the company should use old name wherever it print a new name in brackets, the former name. So old name should appear for next 2 years. Simply speaking, last 2 years, whenever company change the name, so it should be displayed along with new name. So old name should be displayed along with the new name. So that is all about alteration of name clause. Next one, alteration of registered office. Alteration of registered office. So here a registered office alteration is possible because of it is possible in 4 ways. One is change of registered office within city. Next one, change in city. change in city, no change in ROC. No change in ROC jurisdiction. Next one, change in city, change in ROC jurisdiction, but no change in state. No change in state. And finally, last one, change in state. That means, shifting within the same city, shifting between two cities, shifting from one city to another city, but no change in ROC. Shifting from one city to another city, change in ROC, but no change in state. And shifting from one state to another state. Understood? So, if for the time being, if you take Jubilee Hills to Banjara Hills, first case. Second one, change in city, no change in ROC. Take an example, Bangalore to wait a moment. So change in city, no change in ROC. For example, Hyderabad to Warangal. Next one, change in city, change in ROC, but no change in state. So this is possible only with respect to two states, that is Tamil Nadu and Maharashtra. In case of Tamil Nadu, Chennai to Coimbatore, and in case of Maharashtra, Mumbai to Pune, as well as vice versa, Pune to Mumbai, Coimbatore to Chennai. Change in state, Maharashtra to Karnataka. Example, Maharashtra to Karnataka. So these are the cases. Now let's begin the discussion. In case 1, board approval is sufficient. So for shifting of register office from one place to another place within the same city, board resolution is sufficient. And with this, along with that, you need to intimate the same with ROC. So ROC filing within 30 days. In form number INC 22. So case 1 completed. Board resolution plus ROC filing. So that's it. Shifting from one place to another place within the city completed. Next one, change in city but no change in ROC. Change in city but no change in ROC. So in this case, you need to take approval from board of directors, not for the purpose of shifting, but to call for general meeting. In that general meeting, members should give a special resolution. That means you need to obtain special resolution from the members. Now you need to file the same with ROC. Here two forms you need to file it with ROC. One is INC 22 with respect to change in registered office. The other one is MGT 14 with respect to copy of special resolution. So same, these two forms should be filed within 30 days of the event. So what is the procedure for shifting register office from one city to another city? So take approval from board of directors for calling general meeting. In general meeting, take members approval. What kind of approval we need? Special resolution, and then file all these forms with the ROC. So case 1 and case 2 very simple. Now there comes case 3. That is shifting from one ROC jurisdiction to another ROC jurisdiction, but there is no change in state. So here, before shifting we had one ROC, after shifting we had another ROC. So we had two ROCs, two registrar of companies are involved. So now, you need to take permission from a higher authority, a person, behind, a person above ROC. So none other than regional director. So listen carefully, my dear students, listen carefully. So with this, you will get a clarity on case 3 and case 4. Company can shift from one ROC to another ROC. So old ROC, new ROC. Old ROC, new ROC. It can shift from one ROC to another ROC only if it get approval from regional director. For that, company is required to file an application with the regional director. So application should be filed with regional director. Along with application, some 5 documents company has to file. So that is copy of board resolution, copy of special resolution, and then declarations. Declaration is with respect to no change in jurisdiction with respect to pending prosecutions. No change in jurisdiction. So with respect to pending prosecutions, whatever the cases were filed against the company, so with respect to previous, old pending cases, there will be no change in jurisdiction. Old ROC jurisdiction is applicable. So at the time of hearing, we will attend. And another declaration is with respect to no pending dues. So with respect to workman, we paid all the amounts. There is no pending dues. And one more certificate from chief secretary of the state acknowledgement. So because of shifting from one ROC to another ROC, there would be no impact on workman. Are you all getting my point, students? So no impact on workman. So these 5 documents, company has to file it with regional director. Of course, this declaration should be signed by KMP. Key managerial person should sign this declaration, or two directors, KMP or 2 directors should sign this declaration. So regional director, after receiving application within 30 days, of application, regional director will dispose that application, either approving the shifting or reject the shifting, either approve or reject. Now company has to file regional director order with the old ROC within 60 days of regional director order. Now the old ROC will issue certificate within 30 days of filing. So certificate within 30 days of filing regional director order. Now the company, it will go to the new premises, which was located in new ROC jurisdiction. The moment it go to new ROC jurisdiction, it has to file INC 22 within 30 days of shifting. Company has to file INC 22 within 30 days of shifting with new ROC. This is all about case 3, shifting from one ROC to another ROC, and there is no change in state. Very simple procedure. Now for this, students used to read for 1 hour, 1.5 hour, but the case is very, very simple. Understood? Next one, case 4, my dear students, case 4. So here, company is shifting from one state to another state, right? That means maybe out of regional director purview. At present, we had 7 regional directors, north, east, west, south, and then northeast. So northwest, like that, we had 7 regional directors. So here, company for shifting from one state to another state, here the application will be filed with central government. Of course, in rules, that power got delegated to regional director, but in act, it is central government. So company has to file application with central government. Along with the application, the aforesaid 5 documents are common. But in addition, you can see some more documents. Company has to file additional documents with CG, that is altered MOA. So why, sir? Why? In case 1, case 2, case 3, there is no alteration of MOA, because MOA contains only name of the state in which it got incorporated. In case 1, case 2, case 3, there is no change in state. Therefore, there is no matter of alteration to MOA. But coming to case 4, there is change in state. That means MOA will be altered. So, altered MOA plus minutes where special resolution was passed. Minutes of the meeting where special resolution was passed. Along with that, creditors details. And then copy of advertisement with respect to shifting, copy of advertisement. All these documents company has to file with central government. Once central government get these documents, it will pass an order within 60 days. 60 days of applications, regional director will pass an order, but subject to creditors' consent, whether creditors are adequately discharged or not. If not discharged, whether they were properly secured, finally whether they are properly consented. That means, they gave 100% consent. If they're not giving consent, come on, repay those debts. Repay those debts. So creditors' consent is very much important in case 4. Once central government issues order, no, of course, power delegated to regional director. So once order was received by the company, now company has to file the order with old ROC as well as new ROC within 30 days. Within 30 days of CG or RD. I'll write CG. As per act, it is CG. As per rules, power delegated to RD. So within 30 days, company has to file central government order with ROC, registrar of companies, and old ROC will give certificate within 30 days of filing. Within 30 days of filing, and company, once it go to new premises in the new state, so it has to file INC 22 with a new ROC. Same time limit within 30 days. And ROC, new ROC will issue fresh certificate of incorporation because there is a change in name of the state. Understood? So very, very simple procedure. So here also, special resolution is required, board resolution is required, central government approval required. In addition, creditors approval is also required. Understood? So this is the simplest form for remembering case 3 and case 4. Once again, I'm reminding you, this is not full length lecture. This is just a revision. So that's what I'm focusing only on important points. Are you all getting my point, students? I'm just focusing on important points. So finally, in case 1, board resolution is sufficient and ROC filing. So this is within state, within city, and within same ROC. Within city. In case 2, along with director's approval, you need to take members approval, special resolution, and ROC filing. In case 3, that means change in ROC, board resolution, special resolution, regional director approval, and then ROC filing. And in case 4, board resolution, special resolution, CG approval. CG will give approval only subject to creditors consent, and finally ROC filing. So very, very simple. So with this, alteration of registered office clause completed. Next, moving on to alteration of object clause, change in object clause. So here also the picture remains same. Where you find object clause? In MOA. What is an MOA? It is a contractual document between company and members. So whenever you want to modify a contractual document, it requires mutual consent of the parties. So here company want to change its object clause. Company will request members to give the approval. What kind of approval? Special resolution. Once you get special resolution, amend the object clause. File the altered MOA with ROC within 30 days. ROC will issue a certificate within 30 days of filing. Now you can start new business. But extra point is dissenting shareholders. Sir, who are these dissenting shareholders? The shareholders who are opposing the alteration. We don't want the alteration. So in that case, the promoters or controlling shareholders, both are same. Controlling shareholders will come under the promoters. If you remember the promoters definition, promoter is a person who has control over affairs of the company, right? As a member, shareholder, or as a director or otherwise. So okay, promoters or controlling shareholders will give exit offer to the dissenting shareholders according to the SEBI norms. So once dissenting shareholders become 0, now you can start new business. But this point, the second point, this is with respect to prospectus. If you want to change the object stated in the prospectus, how you issued prospectus? You issued prospectus to the public at a large. You advertise the prospectus. Similarly, alteration of object also requires advertisement in 2 newspapers. So this point you can find in prospectus topic. So once again I'm telling you, alteration is valid only if it get registered with ROC. So the effect of original MOA, you'll find same effect in altered MOA only when it is registered with ROC. Are you all getting my point, students? Next one, any alteration to MOA, in case of company without share capital, and if you want to alter MOA so that profits of a company can be distributed among non-members, such alteration is void. So company without share capital, if members are interested in changing MOA so that non-members will get share in the profit, share in the divisible profits of the company, so such alteration shall be treated as void. And next one, alteration noted in every copy. See, you got one schedule from ICI, exam schedule. So they want to commence exam from November 1st onwards. And within 1 hour, you got one more schedule. So exams will be from November 2nd. One schedule it is telling November 1st, another schedule it is telling November 2nd. Now, if you had names like, revised schedule, now easily you can identify the revised schedule. You can study according to the revised schedule. Are you getting my point? On the revised timetable or on the revised schedule, if you find word revised, then you'll get a clarity. Okay, original ignore, revised, so we'll stick on to the revised. But imagine the two schedules, they didn't have any word like original as well as revised, for example. So you can't find the word revised on the revised schedule. Now there arises a dilemma. Which schedule we need to go? Is it which one is the original, which one is revised? Actually, we should follow revised schedule, but we can't find the word revised on the schedule. Then which one we need to follow? You're getting my point, students? So simply, if you ignore the word altered MOA in a altered MOA, if you don't disclose this is altered MOA, then there arises a confusion among readers of the memorandum of association. They may think that this might be the latest one or this might be the original one. So that's the reason. So whenever you alter MOA, whenever you alter AOA, you need to disclose that this is an altered MOA. You need to disclose that this is an altered AOA. Without disclosure of word alteration, if you circulate any MOA, any AOA, then there is a punishment. Penalty 1,000 rupees for every copy of circulated. So 1,000 rupees of every circulated copy. Understood, my dear students? Next one, so simply alteration to be noted. Next one, alteration of AOA. Again, the story remains same. AOA is a contractual document between whom and whom? Company and members. Now, if you want to modify AOA, definitely mutual consent of the parties is required. So, company is requesting members. So, the company requesting members means on behalf of company, board of directors are requesting members. So we want to change AOA because of these reasons. Originally, underwriting commission, we kept it as 1%, but we want to pay 2%. Then only underwriters are very interested in our issue, or else underwriters are not taking any kind of initiation. So we want to increase underwriting commission, or we want to issue sweaty equity shares. For that, AOA approval is required, but AOA is silent with respect to such matters. So because of many reasons, board of directors on behalf of company will request members. So we want to alter AOA. So members should give their consent in the form of special resolution. So members should give consent in the form of special resolution. Once company gets special resolution, within 15 days, they need to file altered AOA with ROC. And ROC shall register the same and they will issue certificate. Understood, ma? So within 15 days of alteration of AOA, company has to file altered AOA with ROC. So that's what, procedure of alteration of articles. You need special resolution and, alteration to include conversion of companies. Alteration of AOA includes conversion of companies. What is this, sir? See, ma, in my in the previous video or some 1.5 hour back video, I clearly told you that how can we differentiate a private company and a public company. I told you clearly. So simply open articles of association. In AOA, if you find the word restricts transfer of shares, limits number of members to 200, prohibits invitation to public to subscribe the securities of a company. If you find these three words, it is a private company. Sir, these three words I can't find, sir. Then it is a public company. If not available, then it is a public company. Understood, ma? So, sir, myself private company, I want to convert into public company, sir. Now, simply eliminate these three words. Erase these three words. So, eliminate these three words is nothing but alteration. Alteration to AOA. Alteration to AOA requires consent of members, special resolution. So, this is nothing but alteration to AOA. Sir, myself public company, I want to convert into private, sir. Then add these three words, restricts, limits, prohibits. The moment you add these three words to your AOA, you'll become private company. So addition, deletion comes under alteration. Alteration requires two things. One is members approval. Second one is ROC registration. Understood, ma? So alteration shall be valid only if it get registered with ROC. Next one, alteration to be noted in every copy, or else fine of 1000 rupees, 1000 rupees per copy you circulated without disclosure of what altered. Next one, coming to the distribution of MOA and AOA to the members. So at present, we had MCA website on payment of 100 rupees. You can download these documents, but previously, we didn't have that website. So if members want any of these documents, MOA, AOA, copy of board resolution, copy of special resolution, or agreement executed by the company. Agreement executed by company. Any of these documents, if member want to study, then such member can file an application with company. So he may request company in writing along with prescribed fees. He need to pay fees also. Simply request is not sufficient. He need to pay fees. So once company receive request in writing and fees, then company should provide these documents within 7 days, or else company is going to get punishment. Within 7 days of request plus payment of fees. I'm writing both the words. Fees also important. Suppose simply member requested for the documents, company didn't receive any amount. Now there is no obligation on company to provide these documents to the requested members. Understood? So if you make any default, for the delay period, the fine is 1000 rupees. Maximum 1 lakh rupees. Max 1 lakh rupees. 1000 per day. During the delay period, it is subject to the maximum punishment of 1 lakh rupee. Understood? So, resolutions required in section 117. That's what, board resolution and special resolution I wrote. Don't worry. So, in general meetings, you'll get this point, section 117. Clear? Next one, write about registered office of the company. I told you. So, the importance of registered office is just three words, ma. Communication, inspection, and jurisdiction. All the matters, all the legal departments or members or any person, if they want to communicate with company, they will write letters to the address. Which address? Registered office address. If anyone want to inspect the company records, statutory records or members records, then they will come to registered office and they can carry inspection activities. If anyone had a dispute with company, they can file a petition on company in a jurisdiction where registered office is situated. So this is the importance of registered office. So the address which you file with ROC in INC 22, I used to call it as registered office address. So every company after getting incorporated, within 30 days they should have registered office, and within same 30 days company should file the address with ROC, and this condition is applicable even when you change your registered office also. Suppose you want to shift from one premises to another premises. After shifting, within 30 days you need to communicate same with the registrar of companies. Understood? And labeling of company, you can go through these points, not that much important, just go through it. Once again I'm reminding you, this is a revision lecture. You won't get 100% explanation, but you'll get only revision of important points. So this revision lecture is helpful only if the student had completed at least 2 times of study. So if you had read this company law, corporate law at least 2 times, then this revision lecture would be 100% helpful. So without reading any concept, don't drag to the revision. If you are a first time listener and first time reader, when you go through the revision, many doubts will come. So don't do that. At least complete 2 times reading a concept and then watch the revision lecture. You'll feel comfortable. Next, shifting of register office also completed. So with this alteration completed, and we are left with miscellaneous topics and practical questions. So only miscellaneous topics I'm going to cover, that is commencement of business. First one, commencement of business. So this is applicable only to the companies which are registered with paid up share capital, which are having a share capital. And this section is applicable with effect from 2nd November 2018. So company which is getting registered from 2nd November 2018 plus having share capital. So any company satisfying these 2 conditions can start business, can exercise borrowing powers. Listen carefully, a company can exercise borrowing powers, a company can start business only subject to 2 conditions, 2 filings. What are those 2 filings, sir? 2 filings with ROC. One is with respect to INC 20A, the other one is with respect to registered office, that is INC 22. This INC 20A should be filed by board of directors. They should declare that the subscribers of memorandum of association, have deposited the promised amount. So at the time of incorporation, at the time of subscribing MOA, they promised that they are going to take these many shares and they are going to pay this much amount for these many shares. So the promised amount was deposited, and the proof is bank statement. You need to attach bank statement and you need to file INC 20A with ROC. The time limit is 180 days from incorporation. 180 days from incorporation. Within 180 days you need to file these documents, or else ROC may conduct physical inspection, physical inquiry. Upon physical inspection, if they come to know that company is not doing business, then they will remove the name from register. Or if company is doing business, now ROC will ask them to file the returns. If they file returns, delayed, for the delay period they need to pay fine. How much? Company 50,000 rupees, and company 50,000 rupees. Officer in default 1,000 per day, maximum 1 lakh rupee. And this INC 20A should be certified by, should be signed by 2 people. One is director on behalf of board. The other one is professional, practicing professional, CA or CMA or CS. So once again I'm telling you, the crux of this concept lies here only. The crux of the concept you can see here only. Company, if it is incorporated with effect from, if it is incorporated on or after 2nd November 2018 with the share capital. So that means, old companies no need to follow this step, and company without share capital no need to follow this step. They can start business, they can exercise borrowing powers only when INC 20A and INC 22 got filed with the ROC. So what is the time limit for INC 22? As you all know, within 30 days of incorporation, they need to file INC 22, verification of registered office. Next one, in case of special entities, the company engaged in insurance, stock exchange, banking sector, then they need to produce NOs, objection certificate from the regulatory sectors. IRDA in case of insurance, SEBI in case of stock exchange, and then RBI, sorry, banks in case of Banking Regulation Act. According to the Banking Regulation Act, they need to produce the NOC from Reserve Bank of India. Understood? Next, conversion of companies already registered. Just now we had discussion. We discussed this point. So private to public, public to private, private to public, public to private. The procedure is same. Alteration of AOA. It begins with alteration of AOA. For this, special resolution is required, and you need to file these documents with ROC. The procedure is same. But when you're converting public company to private company, additional approval, central government approval is required. You need to file central government approval with ROC. That is the only extra step. The rest of the procedure is same. So board resolution for calling general meeting. General meeting, members need to give approval by special resolution. Then alter AOA, file all these documents with ROC. ROC, upon verification, it will issue fresh certificate of incorporation. So the moment you get certificate of incorporation, your constitution gets changed. But remember, my dear students, because of change in constitution, there is no change in existing obligations. So before conversion, whatever debts you had, whatever obligations you had, the same debts, same obligations will be carried next also. After change in constitution also, the same obligations, the same liabilities will applicable. Same obligations continued. Next one, subsidiary company is prohibited to hold shares in holding company. Yes. The moment one company becomes subsidiary to another company, it is prohibited from acquiring shares of holding company. So simply speaking, subsidiary cannot become member of holding company. Any allotment of shares to subsidiary company is void ab initio. Void ab initio. Any allotment of shares to the subsidiary company, by holding company is void ab initio. So S Limited should not acquire any shares of H Limited, and H Limited should not allot shares to S Limited. But we had 3 exceptions. You need to remember these 3 exceptions. In past, 2 to 3 times questions were asked from this concept. Questions came on this concept. S Limited can hold the shares of H Limited in 3 cases. One is as a legal representative. The other one is as a trustee. And third one, subsidiary company acquired shares before becoming subsidiary. So carefully listen. So subsidiary cannot acquire shares of holding company, and holding company should not allot shares in the name of subsidiary company. But subsidiary company can continue to hold these shares if it is holding shares as a legal representative on behalf of deceased person, or as a trustee, or suppose before becoming subsidiary, subsidiary acquired shares of holding company. For example, subsidiary took 10% of H Limited shares on 1st January 2022. Later, H Limited acquired 65% of share capital of H Limited. This happened on 31st March 2022. That means holding subsidiary relation came into the picture, after S Limited got shares of H Limited. In that case, it can continue to hold such shares. There is no problem. But the only point is, with respect to this third point, they had no voting power. With respect to 1 and 2 cases, subsidiaries continue to vote in the holding company general meetings. Understood? And in recent exams, there is a question that can S Limited acquire 10% of share capital of H Limited before it becomes subsidiary? After 1 year, H Limited got 65% share capital of S Limited and S Limited became subsidiary to H Limited. Is there any obligation on S Limited to surrender 10% shares to the company? No, there is no obligation. It can continue to hold such shares. And H Limited allotted bonus shares. H Limited allotted bonus shares to all its members. As a result, S Limited also got some extra shares. Is that issue of bonus shares valid or not valid? The answer is valid because of bonus issue, there is no change in percentage of holding. Additional share is given at free of cost based on your previous holdings, right? So because of getting bonus shares, there is no change in percentage of holding by S Limited in H Limited. You all getting my point, students? You can go through that question. It was somewhere. It was asked in 2020. 2020, if I'm not wrong, the same question came in the exam in 2020 exam, 2020 only. So go through that paper, you will get a clarity. So only 3 points you need to remember. General rule: subsidiary should not hold shares of holding company. Exception: in 3 cases, it can continue to hold the shares as a legal representative, as a trustee, and acquired shares before becoming subsidiary. Out of 3 cases, in first 2 cases, voting is allowed. Last case, voting is not allowed. And allotment of bonus shares in the name of subsidiary company is not prohibited. So that's it, ma. And then serving of documents, you can go through it. If company want to serve documents to the members, or if anyone want to write a letter to the company, then preferable modes: registered post, speed post, courier, and then leaving it at registered office, or electronic mode. You just go through the question, not that much important. Next one: authentication of documents. Authentication of documents. As you all know, company and artificial person, how it can sign the contractual deeds, how it can sign contractual documents, it is not possible. So on behalf of company, either KMP, key managerial personnel, or officer or employee authorized by board will sign, so that company stands as a party in the contract. So listen carefully. There is a contract between company and supplier. Now supplier will sign the document. Now on behalf of company, who can sign this document, sir? KMP, or any officer or employee of the company, but he should be authorized by board. Sir, how such authorization will come, sir? That thing you can read in question number 24. But who comes under KMP, sir? CEO, managing director, manager, company secretary, whole-time director, CFO, and any officer. Remember carefully, any officer below the board of directors, level below the board of directors, immediately next level, and he should be in full-time employment. Full-time employee. If these 2 conditions are satisfied, now board may give KMP designation to such officer. Immediate level next to the directors, and he should be in full-time employment, and such other officer as may be prescribed. But an employee or officer of the company, he will get authority only through a paper signed under common seal. If company is having common seal, yes, that authority, power of attorney document should have common seal, and it should be signed by the persons in whose presence the common seal was affixed. The people will sign it. If there is no common seal, then 2 people should sign the authority letter. One is director, 2 directors. If company is having a secretary, then 1 director and 1 secretary should sign the letter of authorization letter or power of attorney document, whatever you may call. But the point is, company can give power to a single officer or employee to execute documents, to execute negotiable instruments, only if such officer or employee gets that power through a power of attorney document. It should have common seal. If common seal is there, if there is no common seal, then 2 directors should sign this letter. If company is having secretary, then 1 director plus 1 secretary signing this letter is sufficient. Now this employee or officer will get power to execute any document on behalf of company. Accordingly, company is liable to the other party. So with this total incorporation of company and matters incidental thereto chapter we completed revision. Understood?
So one more pending topic, that is dividends. So with respect to dividends, many students will have so many doubts. So I'm going to clarify I'm going to explain this topic in such a way that you will never get any further doubt with respect to the topic dividend. First, we'll discuss the notes which I am using here, and then we will do a line by line reading in the material, ICA study material related to dividends topic. So first of all, the provisions that are dealing with dividend under company law are from 123 to 127. 123 section talks about declaration of final and interim dividend. It has totally 6 subsections. Not 6, 7 subsections including penalty provision. 7 subsections. Then 124 unpaid dividend account concept. 125 investor education protection fund concept. 126 share transfer not registered, like transfer of instrument of transfer of share is received by the company, okay, but company have not registered. In such a case, what dividend on such shares the company has to do? So that one. 127, what if the company declared dividend but failed to repay, failed to pay within 30 days? Fine, all that we are going to discuss. Before that, by the way, one more thing, for this particular topic, until we finish this video, please, if possible, try to maintain running notes. Please try to maintain running notes. Whatever the point I'm going to explain, please maintain running notes if possible. Of course, we are going to discuss it from the study material. Typically speaking, you need not have a running notes, but have it. Because no, I'm using notes. I'm going to explain you directly from the notes first in this lecture. In the next lecture, I'm going to do from the study material. ICS study material. Fine. So there are some key points which we need to understand as an overall outline relating to dividend. Some outlines that we need to understand. I'm not discussing 123, 124, 125, like sections have not yet started. I'm just talking about few certain outlines. So what is the first outline? Dividend declared. Dividend declared shall be paid within 30 days of declaration. Once a company declared dividend, within next 30 days, the company shall pay the dividend to the shareholder. Shall pay it. Otherwise, 18% per annum interest shall be paid by the company to the shareholder. 18% simple interest shall be paid per annum. Like suppose within 30 days the company has to pay, right? From 31st day onwards, interest we have to add. Suppose if the company paid dividend on 60th day to the shareholder from date of declaration, for 30 days, 18% per annum interest, nothing but 1.5% per month on the dividend amount the company has to pay. Suppose, sir, within 30 days the company did not pay, sir. The company did not pay within 30 days. 31st day onwards, 18% per annum interest will apply. Yes, I agree. In addition to that, since the company declared dividend and within 30 days it is not paid, within 7 days from 30th day after, within 7 days from the end of 30th day, whatever dividend which the company did not pay, that is called as unpaid dividend. Unpaid dividend, it shall be transferred within 7 days from expiry of 30 days. The company, whatever unpaid dividend is there, within 7 days from the end of 30 days time limit, okay, the unpaid dividend if at all there, as on 31st day, if any unpaid dividend is there, within 37th day or nothing but 7 days from the end of 30 days, the company shall transfer that unpaid dividend to another bank account. That bank account shall be called as so and so company unpaid dividend account. company ABC Private Limited unpaid dividend account, BCED Private Limited unpaid dividend account. Like that, there will be a bank account will be opened with a scheduled bank. Okay, so unpaid dividend account. So in that account, the company shall deposit unpaid dividend. First of all, the company will declare a dividend, right? Company, where the dividend amount will be with the company. Once dividend is declared, please transfer that entire amount of dividend declared to a separate bank account, declared dividend account. Generally, it is called as declared dividend account or dividend bank account within 5 days. Within 5 days. Now, you see here, suppose let us assume 1st September 2021, company declared a dividend of, let us assume, 50,000 rupees. 50,000 rupees. What is the due date? 30th September 2021, the company shall pay. Suppose as on 1st October 2021, the company still has 30,000 rupees which is not paid. By 7th October 2021, this 30,000 rupees shall be paid to unpaid dividend account. It shall be transferred to unpaid dividend account. Before all this, by 5th September 2021 itself, whatever 50,000 rupees dividend declared, it should be kept in separate bank account. By 30th September, from that bank account, transfer it to shareholder bank account. Okay, if at all you couldn't transfer, as on 1st October, how much is unpaid? 30,000. Transfer it to unpaid dividend account within 7 days. Sir, what will happen if I did not transfer within 7 days? Within 7 days, I did not transfer to unpaid dividend account also. In such a case, from 8th October onwards, on 30,000 rupees, what is the unpaid dividend? 30,000. On 30,000 rupees, 12% per annum interest will be there. Sir, just now you said 18%. Remember, here, see, there are two interest. One is 18% interest is there, another one is 12% interest is there. A company, once dividend is declared, within 30 days, company shall pay to shareholder, right? Yes. Suppose if the company did not pay within 30 days, company later somewhere 70th day, 90th day, 100th day, they are paying to the shareholder. What is the amount of dividend declared? Plus 18% on the amount. From 31st day you have to calculate. Okay, till the date of actual payment to the shareholder. 18% per annum rate of interest you have to, and pay that entire amount to the shareholder at the time of payment. Here 12% interest I am talking about late delay in transferring to unpaid dividend. See, there is a delay in payment to shareholder. 2. Delay in transferring unpaid dividend to unpaid dividend account. So 12% per annum is the rate of interest applicable for delay of unpaid dividend to be transferred to unpaid dividend account, separate bank account in a scheduled bank. So 12% is rate of interest. So let us assume, so 30,000 company have not paid, no? This has to be transferred to unpaid dividend account by 7th October, but company did not transfer. Originally company declared 50,000, no, it is kept in one bank account rate within 5 days. In the same bank account, 30,000 still lying. After 7th October also it is still lying. Later after 10-15 days company realized, arre, we forgot to transfer to unpaid account. Now the company is paying to unpaid dividend. 10 days there is a delay. For that 10 days, 12% per annum interest, please calculate that amount. That amount plus unpaid dividend together transfer to unpaid dividend account. Sir, okay sir, this 12% for 10 days, let us assume some 1,000 rupees came, sir, unpaid interest on delayed transfer to unpaid dividend account. That interest, what the company has to do, sir? Should it be paid to register of companies as a penalty? No, that interest also, that 12% interest also shall be paid to shareholders only. Shall be paid to shareholders only, which means a shareholder is receiving two types of interest. Let us assume whatever dividend declared, 30,000 rupees, whatever dividend declared is one interest. 30,000. I will show you a calculation, a simple calculation I will show you. 30,000 rupees, 30,000 rupees. So it has to be paid by 30th September 2021. But let us assume company paid to shareholder on 2021 30th November ultimately. So 30,000 is principal amount of dividend, yes or no? What is the interest under section 127 for late payment? 18% per annum for 2 months. 18% per annum for 2 months. Let us assume 1500 rupees, 1500 rupees per month. Let us assume, for the sake of convenience, let us assume 1500, 1500. 1 month 1500, another one 1500. Total 33,000 until now. Now actually as on 30th September it has to be paid, but company did not pay. 7th October or before, the company shall transfer to unpaid dividend account. That is also not done. On this 30,000, let us assume company transferred to unpaid dividend account on 30th October 2021. Almost some 24 days delay. For these 24 days, 12% per annum interest is calculated. Let us assume some 700 rupees came. So company has to transfer 30,000 rupees plus 700, totally 30,700 rupees to unpaid dividend account. Okay, the company 700 rupees interest incurred, which is calculated at 12%. Okay, for late transfer to unpaid dividend bank account, for late transfer, total 30,700. In addition to 30,700, interest on late payment some 3,300. Total shareholder will get, sorry, 3,000. Total shareholder will get 33,700 finally. Finally, the shareholder will get how much? 33,700. Sir, originally shareholder is liable to receive only 30,000. No. Yes, correct. For late received, for late receiving 3,000 interest, which is calculated at 18%. Further, company did a small delay for transferring to unpaid dividend account. For that delay also, company is liable to add interest at 12%, 700. Total amount company shall distribute to shareholder for whom the dividend is not paid. So that's how it is calculated, 18% and 12% both. Sir, it is duplication, no? Of course, let it be. 12% is for late transfer to unpaid dividend account. 18% is for late settlement to the shareholder. That's it. Please be clear. For late payment to shareholder, 18%. For late transfer, a smaller offense, just a transfer. My bank account only. That is my bank account. This is my bank account. Just for late transfer, 12% rate of interest. Further, just a minute. Further, so delay in transfer to unpaid dividend account. What is the rate of interest? 12%. Don't worry, I will connect it. I will connect each and everything when I'm once again when I'm explaining the provision. Further, sir, I transfer to unpaid dividend account, sir. Finally, the amount is lying in unpaid dividend account, sir. You know, 7 years over. It has transferred in 2021, sir. Somewhere in the 15th October we transferred. October 2028 also crossed. October 2028, 7 consecutive years, that amount is still lying there only. Shareholder did not came back and ask me within these 7 years. What the company has to do? Please transfer that amount. Whatever amount lying in unpaid dividend account, the so much of amount lying for past 7 years shall be transferred to a special account called Investor Education Protection Fund, which is constituted by SEBI. So that money, whatever is there in Investor Education Protection Fund, no, what SEBI will do, if shareholder comes after 7 years to SEBI and put an application, dear SEBI, I want money now, I forgot to claim all these years, I was in coma, SEBI will refund. Or SEBI will use it for investor awareness, advertisement, campaigns, all that. Further, unpaid dividend, whatever unpaid dividend is there, no, which is transferred to unpaid dividend account, no, within 7 days or after 7 days along with 12% interest, whatever is there in unpaid dividend, no, within 90 days from the date of transfer to unpaid dividend account, within 90 days from the date of transfer to unpaid dividend account, shareholder wise, what is the amount of dividend, how much amount is liable, okay, shareholder name, his address, Okay, it shall be published on the website of the company or such other website which MCA prescribes. These are the broad overview about each and every point whatever we covered in this. I will once again cover in depth in the provisions. Okay, so first, I hope right now you understood as a whole. What is that you understood? Once company declare dividend, within 5 days, first keep the dividend in separate bank account. Okay, from that bank account, within 30 days from original declaration date, pay to the shareholder. Happy, over. Suppose if it is not paid, 31st day onwards, shareholder will have a interest. Shareholder will get a right to receive interest 18% per annum until he actually received. Okay, company within 30 days not paid, now it is called as unpaid dividend. As on 31st day, it is called as unpaid dividend. On unpaid dividend, shareholder will get 18% interest. That's okay, fine. What company has to do this unpaid dividend? Transfer it to separate bank account called unpaid dividend bank account. Unpaid dividend account. Okay, within what time? 7 days only. Within 7 days after 30 days, you have to transfer to unpaid dividend. What if I didn't transfer? Again, you have to pay interest at 12% per annum on the amount which is not transferred, on the amount which is not transferred to unpaid dividend. And whatever the interest that is being added at 12%, that is also to be credited to unpaid dividend account, which will be given to shareholder proportionately. Okay, it is there in unpaid dividend account. It is there for 7 years. Like that, shareholder did not came and ask the money. We are also unable to trace his bank details, all that. It is there like that 7 years. Transfer it to investor education protection fund. First you transfer to unpaid dividend, right? Do one thing. Within 90 days, publish all the details in the company website and such other website. First publish all the shareholders details within 90 days. Okay, published. Wait for 7 years. Okay, waited. Still nobody came. Nobody came. Transfer to IEPF. That's the overall outline of days, dates, interest, all that. And now we'll discuss the provisions related to dividend. Provisions related to dividend. The main provision is section 123, declaration of dividend. The main provision is section 123. Just a minute. 123. Okay, it has only 6 subsections. So what are they? First one, sources for dividend. See, there are two types of dividend. First of all, understand. Subsection 1 talks about final dividend. Just a minute. Subsection 1 talks about final dividend. Subsection 3 talks about interim dividend, whereas subsection 1 talks about final dividend. There are two dividends. One is final dividend, another one is interim dividend. Whether it is interim dividend or final dividend, it is who will decide this dividend amount? Board of directors. If board of directors declared a dividend, it will be approved by shareholders in the company. AGM. So once it is approved in the AGM, or if any dividend is specifically declared in AGM, if any dividend, board recommends the dividend and shareholders will declare the dividend in AGM, approve it in the AGM. Generally dividend is declared in AGM only. Board will approve it. Board will recommend it. Generally it is declared in AGM. Generally by default every dividend is a final dividend. Suppose if the board of directors only declared dividend before AGM, the AGM has not yet come. Before AGM, during the financial year, board of directors only declared the dividend. Okay, it is subject to approval from shareholders in the general meeting. Later ratification will be there. Board of directors not on the AGM. They only recommended, they only declared. Then the dividend is called as interim dividend. Very simple. Most simple definition for interim dividend is any dividend declared by the board of directors between two AGM dates. It's an interim dividend. Very simple. Fine. So what are the provisions relating to declaration of dividend? If at all a company want to declare dividend, first of all, it should have money for declaration, right? So what is the sources for dividend? There are two sources. One is Profits of the company calculated after providing depreciation. Profits of the company after providing depreciation. Which profits, sir? Is it current year profit or previous year's profit? Previous year's profit is called as accumulated profits. Previous year's profit is called as accumulated profits. A company can declare dividend out of current year profits happily. Sir, I don't have current year profits. Don't worry, you have accumulated profits. Declare it. Or that is one source. Don't worry, still we have so much discussion on profits of the company. Or second source, any funds provided by central government or state government in pursuance of, due to a guarantee given by them. This company was given a guarantee by central government, state government. The shareholders were given guarantee by the central and state government. So because of the guarantee, government now released funds to the company. Now the company can pay dividend out of these funds given by central and state, which is a very exceptional scenario. So there is no much discussion about funds given by central. Now the discussion is all about profits of the company. This is most important discussion. Now, by the way, company can declare dividend out of profits of the financial year or the previous years, or funds given by central government or state government. Okay, government simply. Sir, company want to declare dividend out of profits of the company. Proviso 1. There is a proviso to 123 subsection 1. What it says? Unrealized profits, revaluation reserves, any other type of reserves except free reserve shall be ignored. Only free reserve is considered. Accumulated profits means only free reserves, not every reserves and surplus, only free reserves. Free reserves are that reserves which is available for distribution of dividend. Capital reserve, revaluation reserve, statutory reserve, these are all not available for declaration of dividend. Securities premium account, these are all not, these cannot be considered as an amount available for dividend. This shall not be considered. Only free reserves. Current year profit you have, okay, declare from that. You don't have current year profit, previous year profit you have, okay, declare from that. Provided, please, any depreciation, if it is there, calculate depreciation as per schedule 2. Calculate depreciation as per schedule 2 rates. Eliminate that, reduce that from the profits. Reduce even tax also. Profit after tax. Okay, profit before depreciation minus depreciation, profit before tax minus tax, then you will find a picture, no number called profit after tax. If that is positive, declare from that. Sir, I don't have profit after tax, sir. Current year is losses. Can I declare it from previous year accumulated losses? Yes, you can declare accumulated losses. Yes, you can declare out of accumulated losses, provided one proviso says dividend shall be declared only after set off of previous year losses and depreciation. Dividend, what it says is simply calculate current year profit. Suppose if it is negative, okay, what is the previous year profit? Suppose if it is positive, total it, then you'll get some picture. If it is positive, you can declare. If it is positive, you can declare. Sir, accumulated profits also not there, negative. Sir, do you have any free reserves additionally? Yes, sir, I have a free reserve, positive. Yes, sir, I have a free reserve, positive. Okay, if the ultimate figure is positive after adjusting with the free reserve, then declare. Sir, I don't have accumulated profit. I don't have current year profit. No current year profit, no accumulated profit, zero. Reserves are zero. Reserves are negative in fact. Can I pay dividend? Impossible. You can't pay dividend. You cannot pay the dividend. If you have a negative reserves and surplus, ultimately you cannot pay dividend. If I don't have current year profit, okay, I can pay out of last year profit. Last year also I don't have profit losses. Okay, see balance sheet free reserves. Do you have any other free reserve? No, I don't have. Ultimately negative picture, you can't declare dividend. Logically speaking, you can't declare a dividend. Further, why I said you can't declare dividend, I'll come to that. Proviso 2, this is the most important thing. Proviso 2, dividend in case of insufficient profits in current year. What is the procedure to be followed? What is the procedure to be followed if at all in the current year the profits are insufficient? Just a minute. is proviso to 123 subsection 1. What this proviso says, in case of inadequate profit or no profits at all, the company want to declare some amount, some 10 lakhs, but the profits are less than 10 lakhs or there are no profits, losses, then dividend can be declared out of accumulated profits, nothing but previous year profits, and any free reserve if available, general reserve like that. 4 conditions the company has to satisfy. The company has to satisfy 4 conditions. What are they? Suppose if the company do not have profits. See, if the company has previous year profits are there, current year also profits, excellent. Whatever the profits are there, declare that much. There is no limit on rate of dividend. You can declare whatever you want. Suppose I don't have profits, inadequate profits. I want to declare dividend, but my profits are not sufficient. Suppose my current year profit is 10 lakh, but in current year, I want to declare dividend of 20 lakhs. This is profit after tax. I want to declare dividend, but my profits are not adequate. In such a case, you can declare the additional amount of 10 lakhs, out of last year profits plus free reserves. You can use last year profits and free reserves subject to 4 conditions. If you do not have current year profits or your profits are not enough to pay dividend, see, suppose you are having 5 lakhs profit, you want to pay 5 lakhs dividend, no problem. You have 5 lakhs profit, but you want to pay dividend more than 5 lakhs. Then this proviso will apply. Then these 4 conditions will apply. Condition number 1. You want to declare rate of dividend. You want to declare some at some rate, some percentage, as a percentage of face value, some amount. See, 5 lakhs or 10 lakhs, whatever the amount of dividend, it is arrived by calculating rate of dividend on the face value. That rate of dividend shall be less than or equal to 3 years average rate of dividend declared. 3 years average rate of dividend declared preceding previous years. Preceding financial years. Ignore current year. Last 3 years. Sir, third year, third year, second year, first year. Last year, just last year, I declared 12%, sir. That before year I declared 14%, sir. That before I declared 16%, sir. What is the average rate? 30 plus 42. 16 plus 14. 30 plus 42. 42 by 3. 14% is the average. Now in current year, you can't declare beyond 14%. Why? In current year, you don't have profits, or you're having profit, but you want to declare more than that. In such a case, take last 3 years rate of dividend by 3, average it. That much only maximum you can declare. That is one condition. Condition number 2, calculate the amount of dividend. Accumulated profits were there, no? You are drawing, no, from the accumulated profits. Calculate the amount of dividend drawing from accumulated profits. How much amount of dividend? Total 20 lakhs dividend, sir. Current year is 10 lakhs, sir. So additional 10 lakhs I should draw from last year accumulated profits and reserves, sir. How much is the additional amount? 10 lakhs. That 10 lakhs amount, should be less than or equal to 1/10 of the paid up capital plus free reserves. That additional 10 lakhs shall be less than 1/10 of the paid up capital plus free reserves. And whatever amount you drawn from the accumulated profits, and how much? 10 lakhs. First utilize for set off of losses and then declare dividend on equity shares. 10 lakhs I drawn. If I have any accumulated losses, first I should set off. If I have current year loss, I should set off. If I have previous year pending losses, I should set off. Okay, logically speaking, this condition 3 is not a big deal. Because accumulated profits means where is the question of losses? Next, balance of reserves. I withdrawn from reserves and accumulated profits at 10 lakhs, right? Current year profit 10 lakhs. I declared 20 lakhs dividend. 10 lakhs set off against current year. 10 lakhs I drawn from last year profits, no? I drawn from accumulated profits. After drawing the 10 lakhs, still I have some reserves, free reserves and accumulated profits. That shall not fall below 15% of the paid up capital. It shall not fall below 15% of the paid up capital. 4 conditions. Very simple. Current year, I have a profit after tax 10 lakhs. I want to declare a dividend of 20 lakhs. Amount is 20 lakhs. Rate is 15%, 20%, 30%, some rate I decided. But amount I want to declare is 20 lakhs. I want to declare 20 lakhs, but my current year profits are 10 lakhs. Inadequate profit. Now what should I do? Previous year accumulated profits are approximately 1 crore I have. Due to Corona, this time the profit was low. But last year I have accumulated free reserves 1 crore. Now out of 20, 10 lakhs I will use current year profit. Additional 10 lakh I will pay out of last year my 1 crore. Okay, pay. 4 conditions. Condition 1. How you calculated 20 lakhs profit, 20 lakhs dividend? By using 18% rate. By using 18% rate of dividend. Let us assume by using 20% rate of dividend, I calculated 20 lakhs as a dividend. First, let's do one thing. What is the last 3 years average rate? 14%. Hey, you are thinking of 20%. You can't declare more than 14%. Okay, which means now I can declare maximum 14% only. Earlier I thought what originally 20 lakhs I want to declare, but I can't declare 20 lakhs because I can only declare 14%. 14 lakhs only I can declare, out of which 10 lakhs I set off, 4 lakhs now. That 4 lakhs I will set off because of the condition 1. My dividend, board of directors originally thought 20 lakhs dividend, now that is reduced to 14 lakhs because 14 lakhs is 14% average rate. 20 lakhs originally board thought 20%, but because of the condition 1, inadequate profits in the current year, I can only declare maximum 14%. So my imaginary dividend, or my dividend, my thought, my expectation 20 to 14 reduced. Fine. Condition 2. Now what is the total amount of dividend drawing from accumulated profits? Totally 14. Current year profits 10 lakhs I set off. So 4 lakhs only I am drawing from accumulated profits. How much is this 4 lakhs? It should be, what is 4 lakhs? It should be less than or equal to 1/10 of the paid up capital. Suppose paid up capital is 20 lakhs and 25 lakhs free reserves. Free reserves, or let us assume 20 lakhs I have. 25 lakhs 1/10 means 2.5 lakh plus free reserves 20 lakhs, 1/10 of the paid up capital and free reserves. So 2.5 plus 2, total 4.5. 4 is less than 4.5. That's fine. Amount to drawn, first I must utilize it for any losses, any set off of losses pending. If any losses pending, generally that loss picture won't be there. Otherwise, where will be the free reserve? Already losses would have been set off against free reserves. Balance reserves shall not fall below 15%. 20 lakhs, no, out of which 4 lakhs I have drawn, 16 lakhs. Balance reserve 16 lakhs shall not be less than 15% of the paid up capital. Paid up capital 25 lakhs, 15% means some 3.7. Yeah, it is there. All 4 conditions satisfied. Now you can declare that additional 4 lakhs, totally 14 lakhs you can declare. See how much process is there. Originally board of directors were thinking 20 lakhs to declare, but they understood 14 lakhs only possible. Whether that 14 lakhs is possible or not, condition 2, 3, 4 also need to be checked. Totally 4 conditions. Condition 1. In case of inadequate profits in the current year or no profits in the current year, dividend can be declared out of accumulated profits and free reserves also. Condition 1. The rate of dividend shall not exceed 3 years average rate of dividend in the preceding 3 financial years. Condition 2. Amount drawn from accumulated profits shall not exceed 1/10 of the paid up capital and free reserves. Condition 3. Any losses pending shall be first set off against the amount drawn. Then condition 4. After withdrawing from the accumulated profits, the balance reserves and accumulated profits shall not be less than, okay, 15% of the paid up capital only. That's it. These are the 4 conditions when there are inadequate profits or no profits in the current year. Suppose you're having current year 10 lakhs profit. I want to pay dividend up to 10 lakhs. No problem. No need to check all this. You can happily pay. This is what practically happens. Companies generally don't declare dividend out of accumulated profits. They don't. They generally stick to current year. Otherwise, see hell of conditions. Now, so that's about the proviso 2. This is actually proviso 2. Proviso 2 to section 123 subsection 1. Fine. So like what I understood finally is a company can declare out of current year profits happily or accumulated profits. If accumulated profits have to be used because of inadequate profits or no profits in the current year, proviso 2 has to be satisfied. Okay, fine. Further, provision 3 says dividend shall be declared only after set off of previous year losses and depreciation. Before you declare dividend, you are having current year profit, last year losses are there, first set off, depreciation set off, still you are having profit, from that profit only declare, from that profit only you declare. That's it. Further, sir, dividend can be declared only out of profits after providing depreciation, right? Yes. How that, at what rate depreciation shall be calculated? Schedule 2 is there. Rates of depreciation, useful life, all that, residual values, all that. So as per schedule 2, calculate depreciation, eliminate it from the profit, eliminate previous year accumulated losses, all that, find out the balance current year profit, then declare. Sir, interim dividend. Can a company declare interim dividend? Yes, happily. Interim dividend provisions are different from direct dividend, final dividend. 123 subsection 3 is the only section talks about interim dividend. So as per so a company board of directors can declare and pay interim dividend within 30 days only, time limit as usual. Unpaid dividend concept, unpaid dividend account, everything is applicable for interim dividend. All provisions of dividend applicable to interim. And there is a proviso, 123 subsection 3 has a separate proviso. What it says, suppose in case of losses. Sir, in current year, I want to declare dividend. Let us assume I want to declare dividend somewhere on 25th October 2021. This is financial year 21-22. Preceding this, there are 2 quarters, quarter 1, quarter 2. Both together, is it profit or not? Check. Quarter 1 plus quarter 2 result together is loss. Cumulatively loss. In case of loss, directors can declare interim dividend. Maximum rate of interim dividend is how much? 3 years average profits. Not average profits, 3 years average dividend. 3 years average dividend. Last 3 years average dividend. Same only. Like final dividend, what 3 years average? No, same concept only applicable. Same concept only applicable. Further, once dividend is declared, 123 subsection 4 says within 5 days please deposit the dividend declared in a separate bank account. 123 subsection 5 says dividend shall be paid only to the registered shareholder, which means if any shares are on dispute, you need not pay the dividend to them. What you have to do, 126 section speaks about that, I will discuss there. And it shall be paid on cash basis, means dividend cannot be paid on credit. Dividend cannot be paid other than money, only in monetary form you have to pay, either by check or by dividend warrant or by electronic mode. Warrant is a very old concept, now it is not there. Either by check, private companies generally pay by check, and listed companies generally pay by electronic mode. And further 123 subsection 6 talks about prohibition. When a company is prohibited to declare a dividend, sir, if the company defaulted with respect to repayment of deposits under section 73 and 74, 73, 74 provisions are relating to deposits. If there is a default and the default is not yet rectified, still continuing, today also the default we are still suffering, in such a case prohibited to declare dividend on equity shares. Only on equity shares you are prohibited. Sir, what about preference dividend? That you can pay. Equity shares dividend are prohibited. That is 123. So first I spoke about overview. So sources of dividend, current year profit or previous year profits or funds provided by central or state government. Provision 1, notional profits, unrealized profits, revaluation reserves, all sorts of reserves, please exclude. Provision 2, in case in current year I don't have sufficient profit or I am having losses, what to do? 4 conditions. Okay, that we have covered. Provision 3, and whatever profit I have in current year, previous year losses, depreciation, current year depreciation, if any, first remove that. Still if you have profit, then only declare out of that profit. So that is provision 3. And depreciation, at what rate you have to calculate? As per schedule 2 rate. Interim dividend, understood. Amount of dividend shall be deposited within 5 days. Only to registered shareholders you have to pay. Prohibited to declare if there is a non-compliances with 73 and 74 sections. Then coming to 124 section, unpaid dividend account. What is this unpaid dividend account is about? Suppose you declare dividend, but you did not pay it. It is not paid. Dividend not paid. or dividend not claimed by the shareholder also within 30 days from date of declaration. Within 30 days, company did not either pay to the shareholder. See, originally once declared, within 5 days transfer to bank account. So from transferring to bank account within 25 days, company has to pay. Totally within 30 days, shareholder account should be credited, but not credited. In such a case, within next 7 days, that is from 31st day to 37th day, transfer that amount from that bank account to unpaid dividend bank account, which is opened with a scheduled bank in the name of this company. And please, whatever amount to transfer to unpaid dividend, no, whatever the details, name, address, amount of unpaid dividend, within 90 days from the date of transfer to unpaid dividend, publish on the website of the company. Further, sir, company defaulted with 124 subsection 1, sir. What is 124.1? Within 7 days, you have to transfer to unpaid dividend account, right? You didn't. In such a case, 12% interest shall be charged from the date of default. From the date of default, that is after 7th day, 8th day onwards, 12% interest is charged until you actually transfer, and that interest shall accrue to the shareholder only. Now, once the amount is lying in unpaid dividend account, what? The claimant, the shareholder, can apply for the company, whatever the amount. The company will have to pay that amount, 18% interest and 12%, any delay related to unpaid dividend account, that interest, everything shall be paid to the shareholder. Suppose 7 years from the date of transfer to unpaid dividend account, from the date of transfer to unpaid dividend account, 7 years it is still in the amount only, no shareholder claimed, it is remained unpaid, then company shall transfer to investor education protection fund. Not only the dividend, shares shall also be transferred, shares in respect of which dividend is transferred to investor education protection fund. I transferred dividend to investor education protection fund. Why? That dividend is lying in unpaid dividend account for 7 years in respect of one shareholder. So that dividend I transferred. Are dividend itself it didn't claim. Obviously shares also he is not claiming. He is having ownership, but no one is claiming. That shares also shall be transferred to IEPF. So the dividend provision itself says dividend which is unpaid for 7 years transfer to IEPF. Not only dividend, shares on that dividend shall also be transferred to IEPF. Sir, I failed to comply with this provision. This is a new amendment applicable from December 2021 exams onwards. Applicable from December exams onwards. What is the penalty for contravention? Company, if at all failure to comply with unpaid dividend rules, sections, all this 90 days website details, all this 1 lakh rupee penalty plus 500 rupees per day additional penalty. Maximum penalty can be 10 lakhs. Every officer who is in default, he is also liable to pay 25,000 penalty plus 100 rupees per day for continuing penalty, maximum 2 lakhs. This is the latest amendment. But generally what I recommend to students is don't try to remember penalty provisions. That doesn't mean no question will come. Question will come. Penalty questions can be asked, but instead of you memorizing that penalty questions, put your time on the actual concept. You can fetch more marks. Penalty questions in entire examination, worst scenario, 4 to 6 marks only will come from penalty provisions on entire subject. So for that 4 to 6 marks, I don't want you to stress so much and remember. Even in spite of you try put so much efforts, you don't remember at the end of the day. By the way, I hope 124 section also you understood. 123 over, 124 over. Then coming to 125. What is Investor Education Protection Fund? We will directly cover this from study material. Then 126. Sir, the company was received an instrument for transfer of shares. One shareholder transferred shares to another shareholder. Okay, sold. Now shares have to be registered to another shareholder, right? So for which the transferor send an instrument of transfer to the company. Now the company, what happened? No, company did not register because of some pending details or because of some issues, unpaid capital like that. In such case, whatever dividend on those shares where registration is kept pending, that shall also be transferred to unpaid dividend account. Whatever dividend declared on the shares where registration, transfer deed is pending, transfer is pending, that shall also be transferred to unpaid dividend account unless the company is authorized to pay dividend to the transferee. Suppose no, the seller told the company, hey, please pay dividend to the transferee directly. If at all he told me, I'll pay to him directly. as on as on the date of declaration of dividend, as on 30th day from the date of declaration of dividend, as on 30th day from the date of declaration of dividend, transfer deed I received, registration is still pending, company will keep the dividend amount in unpaid dividend account. From there it will pay to the transferee later once transfer instrument is done. Suppose if the transferor gave an instruction to the company, irrespective of registration, pay dividend to him, then I will pay. Generally this point will come in private companies, not in listed companies. And further, since the registration is pending, keep in abeyance right shares, bonus shares. On those shares where registration is still pending, don't distribute or allot right shares, don't allot bonus shares. Dividend, don't pay, transfer to unpaid dividend account. Right shares, bonus shares, don't pay, keep abeyed. That's it. That's about 126 section. Very simple, not that relevant. 127, it talks about original 30 days time limit. Once dividend is declared, the company has to pay to the shareholder within 30 days. Okay, suppose if the company fails to distribute dividend within 30 days, dividend declared but not paid to shareholder within 30 days, every director, whoever is a party to default, he is liable for imprisonment, and you see it is compulsory, and 1000 rupees fine per day, and the company shall pay the dividend along with 18% interest for the defaulted period. That's it. Provision 2 to 123 subsection we already understood. With this dividend provisions we understood. More clearly, all this overview I already gave here. Once a dividend declared, pay within 30 days. Otherwise, 18% per annum interest a company has to pay because of section 127. Suppose if the dividend is not paid within 30 days, within next 7 days, transfer to unpaid dividend account after expiry of 30 days from date of declaration. And once dividend is declared, transfer to separate bank account within 5 days. Within next 25 days, pay to the shareholder. Not paid within next 7 days, transfer to unpaid dividend account. Not transferred, 12% interest. Delay in transfer unpaid, 12% interest. In unpaid dividend account, amount is lying for 7 years, transfer to IEPF. Unpaid dividend details, shareholder wise, within 90 days from the date of transfer into unpaid dividend shall be published on the company website. That's it. I hope you understood the dividend provision thoroughly as a whole. As a whole, you understood. I hope. Uh, that's it. That's it. So now after this lecture, what we will do is we will do read from the material directly. So you'll get a better idea. In material, this much in depth also not discussed. Even in the study material, this much in depth also it was not discussed. You will feel very easy now when we are discussing from the study material. Okay. So almost I hope you have gone through the past 1 hour 1 minute approximately the video, 1 hour 2 minutes. I hope you didn't skip any of the content. So let's continue from the material. Whatever we understood in the overview session, whatever we understood in the previous 1 hour 2 minutes, whatever we understood in the past 1 hour. Okay, let's do a brief reading of what are all covered within the dividends chapter material. Fine. So first question, so we splitted all the concepts, whatever we discussed in the previous past 1 hour, we splitted them into multiple questions here. There we spoke as sections, now we are discussing as multiple questions. So write about definition, meaning and concept of dividend under companies. So first of all, the most important definition is the term dividend includes interim dividend as well. Section 2 clause 35, it says that dividend includes interim dividend as well. So what is interim dividend? What is final dividend? I already told you previously. Once again, I'm repeating. If the dividend is declared in the annual general meeting, that's a final dividend. If the dividend is declared by board of directors on any occasion other than annual general meeting, between AGMs, before AGM, whatever board of directors are declaring. See, there is a difference between recommendation of dividend and declaration of dividend. With respect to final dividend, board of directors will recommend in the annual general meeting. Once the shareholders approved, dividend will be declared. Whereas interim dividend, board of directors only declare it. Later, shareholders at annual general meeting ratify that. So that's a basic difference between a final dividend and interim dividend. So, and the term dividend includes interim dividend. Whatever provisions that are applicable for final dividend with respect to payment process, Like you remember, once dividend is declared, we have to transfer it to a separate bank account within 5 working days, and it must be paid to the concerned shareholder within 30 days from the date of declaration. That logic is applicable even for interim dividend as well. Fine. So one important point, dividend is not a liability for the company unless declared by the shareholders at a validly constituted general meeting by passing an ordinary resolution. For declaring dividend, which resolution is enough? Ordinary resolution. Simple majority. Number of votes cast in favor should be more than number of votes cast against. Okay, 51% majority we call it as. So at the rates recommended by board or such lower rates as may be decided. Whatever the rate at which board of directors decided, at that rate. Suppose I told you, when there is an inadequacy of profit or if there is a loss during the year and you want to declare interim dividend, it shall not exceed past 3 years average rate of dividend. So in such case, that lower rate concept applicable. Otherwise, whatever rate of dividend board of directors decided, that rate will be applicable. So dividend is recommended by board and will be approved by shareholders at AGM. And the company in general meeting may declare dividend, but no dividend shall exceed recommendation by the board. Whatever board recommended, only that shareholders can approve. Shareholders cannot increase the dividend. Suppose board of directors recommended 10% dividend. Shareholders cannot increase it to 20%. Sir, by the way, dividend 10%, 20%, 100%, 200%. How this dividend is calculated? Dividend is calculated as a proportion to nominal value, which is also called as face value. Suppose if a company declared 10% dividends, if the company said dividend rate is 10%, 10% means, suppose face value is 10 rupees, 10% means 1 rupee. So we have even given examples here. So I hope you are using this material. If at all you are using this material, I'm telling you, you understand very easily the concepts. Okay, so we have even given the examples here. Next. So then write about the concept of interim dividend and final dividend. Nothing but here the dividend provision we are going to discuss. What is an interim dividend? It's a dividend declared by board of directors at any time during the period from the closure of the financial year till the AGM. Simply speaking, not on the AGM you're declaring. You're not declaring dividend on the date of AGM. You're declaring at some other date. Interim dividend can be declared from the following sources. You may declare it from surplus in profit and loss account, or you may declare it from the profit of the current financial year in which dividend sought to be declared. Profit of that financial year means current year. Profit generated in the financial year till the quarter preceding the date of declaration of interim dividend. All these three are talking about mostly same. First point, surplus in P&L. It is something like accumulated profits. It is something like accumulated profits. If a company is having accumulated profits, you can declare interim dividend from that. You can declare interim dividend from the profit of this financial year. You can declare interim dividend in the profits of the previous quarter. Suppose we are somewhere in the November 2021. Let us assume November 2021 is a quarter 3. So you can declare dividend from quarter 1 plus quarter 2 profits. So profits generated in the financial year till the quarter preceding the date of declaration of dividend. Now, once interim dividend is declared, it shall be ratified by members at AGM. Now, you may get it out, sir. What if members, what if members don't ratify? Obviously, they will ratify, man. Why? Already received by members. So this is very important. Declaration of dividend when there are losses to the company. Suppose if the company incurred loss during the current financial year up to end of the quarter immediately preceding the date of declaration of dividend. So what do you mean by loss? Tell me, generally I'm talking about listed companies. Listed companies give financial statements on quarterly basis. Listed companies give financial statements on quarterly basis. So there are 4 quarters in a year. For every quarter, listed companies will file with SEBI quarterly financial statements. So what is quarterly financial statements? Don't worry, not required for you. You know what? Relating to this, a new section has been added called 129A. 129A, there is a new section added which is applicable for the first time for May attempt student. 129A, we are going to discuss it from accounts of the company's chapter. We will be discussing this in the accounts of the company's chapter. Periodical filing of periodical results, periodical financial results. So that is nothing but quarterly financial statements being filed by listed companies, similar to. Now you see, quarter 1 company has made a loss of 20 crore. Quarter 2, company made a profit of 40 crore. Quarter 3, company made a loss of 10 crore. Okay, quarter 4 not yet come, but what happened is in quarter 4, company want to declare some dividend. Not on the AGM. That is not about AGM dividend. It is about quarter 4 dividend. They want to pay dividend in quarter 4. What is it called as? Interim dividend. Now look at this particular sentence once again. If the company incurred loss during the financial year up to the end of the quarter. Now you see here we are declaring in quarter 4, right? As on quarter 4. Cumulatively, what is the profit or loss? That we need to see. You cannot say, sir, first quarter we have a loss, sir, third quarter also we have a loss, so loss provision is applicable. No, don't calculate like that. Cumulatively, how much? First quarter 20 crore loss, second quarter 40 crore profit, third quarter 10 crore loss. Put together, net amount is how much till now? 10 crore surplus only is there. How much is there? 10 crore. How much already is there? 10 crore. So in case of losses, that provision do not apply. When the concept of in case of losses will come into picture. Today I want to declare interim dividend. I will see from 1st April to today, this financial year. Totally what is the profit or loss? It is profit only. This provision do not apply. Totally you have to see, not quarter wise. Getting it? Totally. Suppose cumulatively, if maybe quarter 1 profit, quarter 2 loss, quarter 3 loss, total if you combine it, all are losses only. Totally as a whole. On the date when I am declaring interim dividend, if I look at my current financial year profit or loss, it's actually loss. In that case, this provision will apply. Okay, sir. What is this point says? Interim dividend generally can be declared at any rate by board of directors. However, if there is a loss during the current financial year up to the quarter preceding the declaration of interim dividend, before I declare the dividend by board of directors, if there is a loss in the current year cumulatively, then interim dividend shall not be declared. Interim dividend shall not be declared at a rate higher than average of dividend declared by the company during the immediately 3 preceding financial years. Okay, suppose I am right now in, let us assume 21-22. Until quarter 3, I am declaring dividend in quarter 4. So what I need to check, quarter 1, quarter 2, quarter 3 put together, what is the profit or loss I need to see? I need to see profit or loss. Simply speaking, before I declare dividend, what is the cumulative profit or loss as per our books of accounts? Because today it is electronic books of accounts. You can see profit on any day. You can check for profit on any day. So cumulatively, if there is a profit, this provision do not apply. Straight away you go with. If it is a loss, what is applicable? If it is a loss, you have to check. Okay, so previous 3 years means what? 2021, 1920, 1819. So 3 years, 10%, 12%, 14%, plus by 3. Average amount only you have to declare. So what is the average dividend? 12% in this example. That's it. If a company declare dividend at a rate of 16% during the immediate preceding 3 years, in all the 3 years 16 only they declared, then in that case, if the company incurred loss in the current year, it is permitted to declare interim dividend at a rate which is not higher than 16%. That's it. Further, the amount of dividend once declared shall be deposited in a separate account within 5 days. I spoke about this in the overview part. That's it. Whatever provisions that are applicable with respect to payment of dividend, they shall apply even for interim dividend. So whatever, like we have seen, no unpaid dividend account, investor education protection fund, 7 years concept, all this in the overview, they all applicable for interim dividend as well. 90 days, whoever have not claimed the dividend, within 90 days company has to show in the website, everything is applicable here. So what is the difference between interim dividend and final dividend? So we have given a diagram here. So you can have a look at this diagram. Maybe this kind of question also can come. They may ask you for 4 marks question. What is the difference between interim and final? Interim dividend is declared and paid during this accounting year before finalization of accounts. Whereas final dividend is recommended by board and approved by shareholders at general meeting. Announcement, board of directors. Whereas the recommendation is by board, but announcement and approval is by shareholder. Before preparation of financials, it is after preparation of financials. It can be revoked with the consent of all the shareholders. Yeah, very important point. Interim dividend can be revoked, whereas final dividend cannot be revoked. Interim dividend declared can be revoked with the consent of all the shareholders. Whereas final dividend, once declared, it's a liability for the company. Accrued liability cannot be revoked. And interim dividend can be declared only when articles specifically permit. Articles shall have interim dividend clause. Only then it can be declared. You know, by default, when a company we newly incorporate, the model articles we copy paste. At the time of incorporation, we copy paste model articles. By default, interim dividend concept will be there as part of articles of association unless company delete that. Okay. Whereas for final dividend, it does not require provision in articles, but still in all the cases, in all the companies that you see in the market, articles of association contains provisions for both final dividend and interim dividend both. Now write about classification of shares based on manner of payment of dividend. You know, you might have learned this in foundation or intermediate itself. Foundation probably cumulative preference shares, non-cumulative preference shares, that concept. So this is very easy. So I'm not giving an idea about it. See, if it is a regular course, if you are my subscription student or my law class student, I'll be giving detailed explanation. In fact, this chapter will be explained for 7 hours approximately. Whereas in marathon, I hardly can cover it for 1.5 hours maximum. So what are the provisions regarding declaration and payment of dividend? Yes. So what are the provisions regarding declaration and payment of dividend? First of all, we must understand from which sources we can declare. In the overview, I clearly explained dividend can be declared out of profits of the current year. In the current year, you're having profits, happily you declare. If you do not have profits in the current year, you can declare out of profits of any financial year or years, which means this is what I call it as accumulated profits, which is what we call it as accumulated. Or out of both above A and B, you can declare dividend partly from current year profits and partly from previous year profits. Suppose current year your total net profit is 10 lakhs. Suppose you want to declare a dividend of 20 lakhs. You see accumulated profits, you are having some 40 lakhs. So out of 20, 10 lakhs you declare from current year, remaining 10 you declare from accumulated profits. Okay. And remember, accumulated profits means what? Only free reserves, and no other reserve shall be used for declaration of dividend. Revaluation reserve cannot be used. Any write back of depreciation or impairment loss cannot be used. Only realistic profits, only real profit, realized profit, that too we call it as free reserves. Security premium cannot be used. Section 52, security premium can be used only for few purposes. Okay, so a dividend can be declared only out of free reserves which are absolutely available for distribution. Suppose you don't have current year profits, you don't have past year profits, and you know, while incorporating your company, for all the shareholders, government has given a guarantee. They are shareholders, don't worry. You buy shares of this company, we will give guarantee. If the company do not have profits, we will pay dividend. In that case, money provided by central government or state government for payment of dividend by the company because of a guarantee given by the government. If at all government gave a guarantee, government stood as a guarantee for all the shareholders. Okay, if the company do not give dividend, in that case, government will give money to the company. Company will declare it as a dividend. Very rare scenario. Very rare scenario. If you look at the act, you know, it only has 2 clauses. Sources means only 2 clauses. 123 subsection will have only 2 clauses, A and B. One is profits of the year or previous years. Another one is amount given by the government out of a guarantee. That's it. But we split it into 4 parts. Now, and there is very important note as per the 4th proviso of 123. Before you declare any dividend, whatever previous losses, whatever depreciation that is not provided shall be set off against profit of the company for the current year. Remember, here unnecessarily students will do lots of interpretation. To declare dividend, first depreciation shall be provided. Whether you declare dividend or not doesn't matter. Today, not just today, the moment accounting standards evolved, the moment gap has evolved, for all the companies, they mandatorily provide depreciation as per accounting standards for sure. They mandatorily provide. No doubt about it. It's because dividend calculation is an accounting standard requirement. And every company shall prepare books of accounts and financial statements as per accounting standards. It may be normal accounting standard or Ind AS. So providing depreciation is no doubt it is there. Only first I provide depreciation, then I will declare. No need to have a specific discussion like that. Without providing depreciation, you cannot, see, if you don't provide depreciation, what happens? Auditors will qualify. Auditors will give adverse opinion. Getting it? So without depreciation, it is not possible to prepare financial statements itself, first of all. It's a violation of fundamental principles of accounting, general principles of accounting. So if, like, of course, since it is covered in the provision we are discussing, so without calculating depreciation, without providing correct depreciation in the books of accounts, you don't declare dividend. That's a precautionary measure in the provision. But in reality, we always provide depreciation whether we declare or not about the dividend. So before you declare dividend, maybe from the current year profits or from the accumulated profits, whatever, first see all the accumulated losses has been set off. Indirectly, what are they trying to tell you? See, you have three sources, right? One is current year profit or accumulated profit or amount given by government. Let us keep this aside. Amount given by government, keep this aside. I'm not talking about that issue. Suppose these two together, nothing but current year profit and loss account and accumulated profits I'm combining. If I have a negative figure, if I still have a negative figure, how can I declare? Only if I have a positive figure I can declare. Only then it's a source. If it is a negative figure, how can I declare? I cannot declare dividend. Now you will get it out. Sir, can I declare dividend out of capital profit, or can I declare dividend out of share capital? Can I declare dividend from the capital? I withdraw some amount of share capital and then give it as a dividend? Prohibited. Capital profits are not same as distributable profits. They are not earned in the normal course of business and therefore not available for dividend distribution. Dividend cannot be declared out of capital. It is not possible, not permitted. Dividend sources is very clear. Profits of the current year, profits of the previous years. Before you declare, any accumulated losses were there previously. Depreciation, if at all not provided, that also reduce it. Still you have a positive figure, then declare the dividend. So that's what they're saying here. That's what they're indirectly telling you. So what do you mean by free reserves? Means that reserves which as per latest audited balance sheet of the company available for distribution of dividend. Free reserves excludes revaluation reserve, any fair value adjustments. Fair value adjustments are as per Ind AS, okay? That is not required at CA Inter. Then there is another question. What is the need of providing depreciation out of the profits before providing dividend? So that is not relevant from exam point of view. Not that important. Give a single reading to this question. Not that important. Now, sir, before declaring dividend, a company must transfer a certain percentage of profit to reserves. Is it true? Once upon a time, it is true. In World Companies Act 1956, there is a compulsory provision for transfer to reserves before declaration of dividend. But now that provision has been eliminated. Whether you are having profits, whether you are having losses, whether you are declaring dividend from current year profit or whether you are declaring dividend from accumulated profits, now there is no restriction, there is no provision which says percentage of profits has to be transferred to a reserve. So no, the transfer of profits to reserve for any financial year, it is completely left to the discretion of the company. Therefore, a company is free to transfer any portion of profits to any reserve, whatever they want to create it for, as it may deem fit. It may also decide not to transfer. They may decide not to transfer also. Nothing wrong, because this provision itself is not there. We have seen in the overview class. Is there any such provision like this? No. So examples we have given, just give single reading of these examples more. Now finally, what are the conditions for declaration of dividend in case of inadequacy or absence of profit? So what is the condition if you want to declare dividend in spite you do not have inadequate profit, or absence means you do not have profit at all, you're having losses, you are running in losses, or you don't have enough profit. Maybe your profit is hardly 10 lakhs in the current year, but you want to declare 20 lakhs dividend. So inadequate. Maybe in current year you're having 20 lakhs loss totally. Still you want to declare some 20 lakhs dividend. How can you? You can declare it from accumulated profits. Nothing but you can declare it from free reserves. If at all you're having accumulated profits, you can declare. provided there are three conditions. You remember the overview session, three conditions I told. So what are the three conditions? Condition one, first one, in the current year having loss, yes. You want to declare the dividend from accumulated profits, yes. First, to do one thing, check what is the, at what rate you want to give the dividend. The rate of dividend shall not exceed average of rates of dividend declared by the company in the immediate 3 years. In the last 3 years, when you are having profit, you are declaring 15%, 16% like that. Today, this year, you are having loss. How can you declare more than that? In a situation of profit, you declared 15% dividend. Example, today you want to declare 20%. That too, you are having losses in current year. See, if you have profits in current year, I don't have any problem. But you're having losses in current year. In that case, how can you declare higher amount of dividend when in the last 3 years, though you are having profit, you declared a lower rate? On that logic, this condition has been added. Very simple. Last 3 years, you're having profits. Example, in those years, you declared some 15, 16, 20 like that. This year you're having loss and you want to declare 25%. How fair it is? So when you're having a loss, look at the last 3 years, take average rate, declare maximum that much only. The maximum rate of dividend in the year in which loss is there. In the current year you want to declare dividend. Okay, it may be interim or final, whatever. You want to declare some dividend in the current year, and you are in the current year there is a loss figure. What is the maximum rate at which you can give dividend? Average of last 3 financial years rate of dividend. That's it. However, this condition shall not apply if the company did not declare dividend in the last 3. So obviously, if at all there is no dividend for the first time, I'm declaring, choice is yours. Okay. So for new companies, this condition 1 do not apply. Or for a company which is declaring dividend for the first time, this concept do not apply. Then condition 2. Okay. So in current year having loss, right? From where you will draw money and then give dividend? Hey, 123 subsection 1 says I can draw from previous year profits, accumulated profits. Okay, very good. How much accumulated profits you're having? I'm having 45 lakhs accumulated profits. Can you declare entire that accumulated profits? No. Look at the total amount to be drawn from accumulated profit shall not exceed 10% of the paid up share capital and free reserves as appearing in the latest audited balance sheet. Indirectly, what are they saying? Dear mister, you're having current year loss, no? Don't do overaction. Okay? Don't give build up. Give dividend give dividend in such a way it is less than or equal to 10% of your paid up capital plus free reserves. Sir, 10% of paid up capital and free reserves comes to 20 lakhs, sir, because my paid up capital is 1 crore, my free reserves is 1 crore, totally 2 crore. 10% is 20 lakh. So I'm having accumulated profits of 60 lakhs. I want to declare 40 lakhs dividend. Hey, shut up. This year you're already having loss. When will you set off this loss? You need to first set off the loss, no? You have accumulated profit 60 lakhs, but this year 30 lakhs loss is there. First set off. See what is the amount available? Very less. So don't do build up. Getting it? So don't give dividend. If at all you are withdrawing, if at all you are having a thought to declare dividend out of accumulated profits, don't declare more than 10% of paid up capital and reserves. At the same time, condition 1, don't declare more than average rate declared in the last 3 years. So I hope you are able to understand the logic behind these provisions. So total amount that can be drawn from accumulated profit shall be less than or equal to 10%. And first it must be utilized to set off of the financial year. Only balance amount available can be used for dividend. Correct? No? Suppose current year I have 10 lakhs loss, but I'm having accumulated profits of 60 lakhs. My paid up capital and reserves is 2 crores. In this 10% is 20 lakhs. So how much I can declare? Can I declare entire 20? There is a condition. Fourth provision. What it says, before declaring any losses of the current year or any accumulated losses, first set off. Okay, 20 lakhs minus 10 lakhs. So maximum I can declare only 10 lakhs money as a dividend. What is the rate? Calculate. Then you declare at that rate, provided that rate shall not exceed average last year 3 rates. Then condition 3. Now you are withdrawing money from accumulated profits. Ensure that after withdrawing, it shall not fall below 15% of the paid up share capital only. It shall not be less than 15% of the paid up share capital. Ensure that after you withdraw whatever money you want to declare, ultimately after you withdraw, check what is your reserves balance available and see that it is at least 15% of the paid up capital of the company. It is not less than 15% of the paid up capital. Sir, how to, can you give a very clear example of this? Yes. By the way, if it is a 100% government owned company, remember, I'm not saying simply a government company, I'm saying 100% owned government company. What is 100% owned government company? Suppose Telangana State Power Distribution Corporation Limited, Telangana State Power Distribution and Corporation Limited. In this, 100% of the share capital is held by state government of Telangana. It's a 100% government owned company. Suppose State Bank of India Limited. In State Bank of India Limited, 55% is only held by Government of India. Remaining 45% is held by others, private entities. So State Bank of India is not a 100% owned government company. State Bank of India is only a simple government company because majority, more than 51% of the voting power is held by central government. Only by satisfying government company definition it became a government, but it is not 100% government company. So what rule 3 says? The conditions prescribed in rule 3, three conditions, condition 1, condition 2, condition 3. What is condition 1? The rate of dividend shall not exceed average of last 3 years rate. Condition 2, maximum dividend that will be drawn from accumulated profits, maximum amount that can be drawn shall not exceed 10% of the paid up capital and free reserves. After withdrawing, okay, the balance reserves available shall not be less than 15% of the paid up capital. So that condition will not apply for a government company which is 100% government company owned by central or state or combination of central and state. So we have given an example. Capricorn Industries Limited has a paid up capital of 200 lakhs and reserves of 240. So paid up capital plus reserves are how much? 440 lakhs. 10% is how much? 44 lakhs. Just keep it aside. Calculation. Loss for the year ended 31st March 2020 is 30 lakhs. So I think this might be current year. Current year loss is how much? 30 lakhs. Okay. Dividend declared in the last 3 years is as below: 9, 10, 12. 10 plus 10, 22 plus 9, 31. 31 by 3, 10.3 percentage. What is it? 10.3 percentage. First condition, as per condition 1, you cannot declare beyond 31% of, 10.3% of the rate. Once. Sorry. So what is the maximum rate as per condition 1? 10.3. Condition 2. Condition 2. How much you can draw for the purpose of declaring dividend? How much you can draw? By the way, first let us calculate amount. 10.3 of how much paid up capital? 200 lakhs. Means face value means paid up capital 200 lakhs only, no? So paid up capital 200 lakhs multiplied by 10.3 percentage. How much? Approximately some 21 lakh rupees will come. How much dividend you can declare? Maximum sum 21 lakh. 21 lakh you can declare because 200 lakhs into 10.3 percentage or 23 lakh probably. Not 23.3 means 1% means 2 lakhs, 0.3 means 60. Some, okay, 21 lakh round off. Okay, 0.3 ignore. So 21 lakh you can declare, approximately 21 or 22 lakh you can declare. So 10.3% means, okay, fine. Condition 2, how much you can draw from the accumulated profits? First of all, for the purpose of declaring dividend, I have accumulated profits of 240 lakhs, accumulated reserves. From that 10%, paid up capital is how much? 200 lakhs. So how much I can draw from accumulated profits? You can draw from accumulated profits an amount equal to maximum 10% of PUC plus accumulated profits. That is 44 lakhs I withdraw. Okay, first I draw. Can I declare entire 44? No. What condition? Before you declare, your accumulated profits should be set off, no? 30 lakhs. So how much is available as per accumulated? Condition 2, how much amount is available? Only 14 lakhs is available. Oh my god. As per condition 1, average raise concept, you can declare more than 20 lakhs. But as per condition 2, you can declare only 14. Let us see condition 3. Is it satisfied or not? Condition 3. Okay. You know how much is the accumulated profits? 240. Out of that, how much you are withdrawing for dividend? 14. How much is balance available? 226. How much is balance available? 226. So is it less than 15% of paid up capital? No, obviously more. So condition 3 satisfied. Okay, condition 3 satisfied. As per condition 2, you can declare only 14 lakhs. As per condition 1, you can declare 10% approximately, which is equal to 20 lakhs. All the 3 conditions shall be satisfied. So maximum how much dividend I can declare? 14 lakhs. 14 lakhs means 14 by 200 lakhs paid up capital. What is the rate? Approximately 7% is the rate at which you can declare. So you see the computation has been given below. The computation has been given below. So maximum rate a company can declare is 14 lakhs. That's it. Next. So we have given even another example also. So how to write the answer, that is also explained clearly. So another example is given for your practice. Please solve this. Whether you are Shrestha student or other student, please, this entire material, whatever I'm giving you, remember this is very beautiful material. Please read this thoroughly. After listening to this marathon, read this material thoroughly. Then finally, okay, so in the overview class, I clearly told once dividend is declared, what we need to do? Company shall transfer it to another bank account, dividend declared bank account within 5 days from the date of declaration. However, if it is a 100% government company, this condition do not apply. 5 days transfer, this condition do not apply. If it is a 100% government company, not normal government company, then once you transfer to a separate bank account, you need to pay to the shareholder. Yes or no? So dividend shall be payable only to a registered shareholder. Suppose if a person is a shareholder but not a member, because the shares transfer just happened, not yet membership records were not yet updated. In that case, okay, in that case we need to wait. Okay, a purchaser of shares whose name is not entered cannot claim payment of dividend, though he might have made full payment for seller of the shares. So in this case, dividend will be kept in pending abeyance until registration of transfer, unless the shareholder original authorized the company to pay the dividend to the purchaser. So example also given here. So please read these examples, very simple. Sir, can we declare dividend on partly paid shares? Yes, in proportion to the partly paid up amount. Suppose you are declaring face value 10 rupee, you are declaring 20% dividend. Generally 2 rupees. Suppose paid up capital is only 5 rupees, means only 50% is paid up. Out of 20%, 50%, 5 rupees only you can, 1 rupee only you can pay dividend. Sir, can I pay dividend in kind, non-monetarily? No, dividend must be payable only in cash. You see, in dividends that are payable to shareholders may be paid by check or electronic transfer, whatever. As per 127 section specifically talks about payment of dividend. So it says any dividend declared must be paid to shareholder within 30 days from the date of declaration. Originally within 5 days, transfer to separate bank. From that bank, transfer to all the shareholders' bank account. Suppose if the company issued dividend warrant, now dividend warrant concept is not there, it is deleted. So I'm not reading warrant concept. Once upon a time, dividend warrants will be there. Okay, such warrant must be posted to the registered address within the prescribed time. Once posted, it is immaterial whether shareholder was paid within 30 days or not, all that. So, but this warrant concept is not relevant at all from exam point of view. So exception also not required. See, 127 we have a separate question. Payment of dividend, we have a separate question later. So there we will be discussing. Next. In case of Nidhi companies, should I pay within 30 days to the member directly? No need. You can just credit to his outstanding. In Nidhi company, what is a Nidhi company? You all members joined with my company as a shareholder and also a member. What Nidhi company will do is it collects funds from all the members and gives it as loan to that member who needs it. Getting it? So once I collect a fund from you, in my books of accounts, in company books of accounts, your account is a liability to me. So I am already owing to you so much of money. And if I declare any dividend, if I credit to your account, that is also enough. This subsection shall apply to Nidhi, subject to modification that any dividend payable in cash may be paid by crediting the same to the account of the member, if at all he has not claimed within 30 days. If a Nidhi company member did not receive the dividend, did not claim the dividend, first of all, forget about receiving it, he did not claim at all, company can pay them by just crediting their account. Okay, that's it. But actually claiming and all is also not required. Today what is happening, AGM or somewhere they'll declare, you get the money within the time limit mentioned in your bank account directly, because today we are having shares in demat form. Demat bank account is linked, that entire details are available with the company. Once company declare, you will get the money into your bank account. That's it. Sir, do I need to claim? I don't claim at all. I'm a shareholder in many companies. I receive directly without any procedure for claiming. That's it. So when a company is prohibited for declaration of dividend, if a company defaulted with section 73 and 74 deposits provisions, if a company is defaulted with these provisions, it is prohibited. Further, section 8 companies prohibited to declare dividend, because Section 8 companies are formed for charitable purpose, not for the purpose of claiming dividend. And one of the condition for getting Section 8 license is what? It shall not declare a dividend. Then write about the concept of unpaid dividend account, section 124. What is this unpaid dividend account? Within 5 days, first a company shall transfer to dividend declaration account. From that account, company shall pay within 30 days from the date of original declaration to the shareholder. Shareholder, it is not paid within 30 days. Within 31st day, from 31st day, count 7 days. Within 7 days, whatever dividend declared, not paid to shareholder within 30 days, from the expiry of 30 days, within 7 days, transfer to unpaid dividend account. So where a dividend has been declared by the company but not paid or claimed within 30 days, the company shall within 7 days from the expiry of the said period transfer total amount of unpaid dividend or unclaimed dividend to a special account called unpaid dividend account. Suppose if there is a default. Here there are two types of default. I told you very clearly in the overview lecture also when I'm explaining through diagram. Default in transfer to unpaid dividend, default in payment of dividend. For default in payment of dividend to the shareholder, 18% interest. Default delay in transfer of dividend from bank account to unpaid dividend account. For that delay, more than 7 days delay, 12% interest. Both shall be paid to ultimately shareholder in the proportion to dividend. And further, company shall prepare statement of unpaid or unclaimed dividend and shall publish within 90 days on the website of the company. These are the shareholders who didn't receive dividend, who didn't claim the dividend. Then write about transfer of unpaid dividend to IEPF, Investor Education Protection Fund. Suppose if a dividend remains same unpaid, unclaimed for 7 years from the date of transfer to the unpaid dividend account, and whatever interest accrued on that, it shall be transferred to Investor Education Protection Fund. And not only dividend, even then the shares value company shall transfer to Investor Education Protection Fund. Within the 7 years, if any shareholder claimed the dividend or shares, then that shall not be transferred to IEPF. Once you transferred, inform Investor Education Protection Fund by filing a statement. Now you know the original owner of the shares. After 7 years, he opened ISA. Okay, so he can go to Investor Education Protection Fund and then reclaim transferred shares along with dividend. So punishment for contravention is given. Penalty has been modified, not required from exam point of view. So write about Investor Education Protection Fund. For what purpose Investor Education Protection Fund can be used? That is important. How Investor Education Protection Fund can be utilized? It can be utilized for repayment of unclaimed dividend, repayment of mature deposit, repayment of mature debentures, repayment of application money due for refund. These are all originally transferred to Investor Education Protection Fund because of 7 years they were not claimed. After 7 years, shareholder or his legal heir came to the IEPF and asked, sir, my parents' money or my money, hard earned money, I forgot, I was in coma, please give me back the money. Investor Education Protection Fund shall refund that money. And Investor Education Protection Fund can be utilized for promotion of investor education awareness, a distribution of any disgorged amount means cheated money. So somebody has cheated and got some money, and the some enforcement directorate or whatever, they caught them, recovered that money, and that recovered money will be given back to Investor Education Protection Fund, and that recovered money is called as disgorged amount. So that disgorged amount can be given for those persons who suffered losses. And not only for that, reimbursement of legal expenses because of any class action suit. I think you might have learned this in prospectus chapter. So what is the process? The person who is claiming unpaid dividend, the person who is claiming the shares, whatever, he has to make an application to Investor Education Protection Fund. And other provisions are there that is not required from exam point of view. Look, don't think that I'm covering, I'm explaining at a faster speed. This is a marathon class. Almost only on dividend chapter we are spending close to 2 hours, close to 1.5 to 2 hours. And question number 13 is regarding section 126. What this says: if the ownership is in dispute, don't declare dividend. I mean, declare dividend but don't pay to him. Simple. And what is the punishment for failure to distribute dividend? This is also an important question. Punishment for failure to distribute the dividend. A dividend declared shall be paid within 30 days from the date of declaration. If at all it is not paid within 30 days, first, company shall pay interest at 18% per annum during the period until it is paid back to the shareholder, and every director of the company shall be punishable for an imprisonment up to 2 years if he is knowingly a party to the default, and he is liable to pay a fine of 1000 rupees every day during the default continues. From 31st day, every director of the company shall pay 1000 rupees penalty, plus they are liable for 2 years imprisonment if at all it is intentionally done. Knowingly a party for the default. He knows that dividend declared but not paid. If you don't declare dividend, that is not a problem. But you declared, you must pay within 30 days. If you don't pay, 2 years imprisonment. And company, what is the punishment for the company? They have to pay 18% interest to the shareholder. So who are exempted from punishment? What are the cases exempted? This itself can be asked as a 4 marks question. A company declared dividend but could not pay within 30 days, defaulted, but there are certain cases where company is not liable for section 127 punishment. What are the cases? Because of operation of law. The company declared dividend, immediately lockdown was announced. Example. So entire banking operations, everything were halted. In that case, permitted, exempted. Punishment will not be there. Specific direction could not be complied, where a shareholder has given direction to the company regarding payment of dividend and those directions cannot be complied and the same has been communicated. Shareholder told, hey, my bank account is this, but my bank account is not working, transfer to this bank account. So shareholder told to the company, but company has some doubts. So they replied to the shareholder. Somehow shareholder has not replied. They communicated finally, shareholder, your bank account is not authorized, so we can't transfer. Sorry. Communicated by the company. Shareholder requested. Still it was kept pending. In that case also it is okay. Or ownership is in dispute. Who is the right shareholder, right member? It is in dispute. Or suppose the shareholder has to pay call money. It can be adjusted against due. I declare dividend, he has to pay some call money, calls in arrears, I will adjust. Or default in process. Maybe banking channel has, there is a default with the depository, some account details were not updated or shareholder account was blocked. So because of that, though we declared, it could not be paid because of technical issues out of the control of the company, not mistake of the company or the directors. In that case also, there is no punishment. So these exceptions, who are all exempted from punishment? What are the circumstances exempted from punishment? Which is important question under section 127 that can be asked for 4 marks. That's it. With this, dividend declaration concept has been completely discussed. And for Nidhi companies, 127 says if the amount declared dividend is 100 rupees or less than that. For a particular member, if it is less than 100 or 100, no need to pay. It is enough if you just advertise who are all eligible for dividend for less than 100 rupees. If you just give an advertisement circulation, that's enough. You just give a circulation that the declaration is dividend is declared and displayed in the notice of the Nidhi company for 3 days notice board. Website, if you have a website, display, that's enough. If it is 100 rupees or less than 100, no need to pay. Simply speaking, this entire provision meaning is if a Nidhi company declare dividend and a member is eligible to receive 100 rupees or less than 100 rupees, the Nidhi company need not transfer. If the Nidhi company just give the declaration and put it on the website, that's enough. With this, dividend concept has been completely discussed. Almost 1.5 hours we discussed. See, this is not my a regular class. In a regular class, I will be explaining in very much detail. In fact, I will be showing AGM notices, how dividend received, how all that voting happens, all that I'll be discussing in the regular class. But in a marathon, that and all cannot be done, and I hope it is not required also. At last moment, you should not learn something newly. You should revise whatever you learned. I hope with this dividend chapter I gave you some clarity. Have a nice time. Okay, by the way, not yet complete. Accounts of the companies is going to start. Accounts of the companies will continue. Okay, just take some 5 to 10 minutes break and then come back and watch accounts of companies, continuation to this video. That's it. So the continuation, I hope the previous part, I hope you completed a dividend concept thoroughly. Before you proceed with this, if possible, try reading from this material the dividend topic whatever we covered. Okay, now let's discuss about the next topic, that is accounts of companies, which is actually the lengthiest chapter in the entire company law. This is the lengthiest chapter and the weightage is up to 10 marks. I can confidently say minimum 10 marks. Yeah, I can confidently say minimum 8 to 10 marks is for sure. Sometimes If luck favors, 12 marks also may come. 12 to 14 marks also may come. Very important chapter, accounts of company. Now, this accounts of companies, we have section 128 to 138. 128 and 129, they deal with books of accounts and financial statements. There are so many subsections. And you know what? Very recently, 129A, a new section has been added, which is very important. It's an addition, nothing but it's part of amendment. Every one of you, please make a note. 129 subsection a new section has been added, which is very important. I'll talk about that. Then you have two sections called 130, 131. Both deal with reopening of accounts or revision of financial statements and board report. Nothing but, revision of financial statements. Nothing but. I'll come there and then discuss. Then 130 to 133 section, it talks purely about National Financial Reporting Authority, NFRA, what are its functions, what are its duties, and when it is constituted, what companies are covered within the purview of NFRA, all that. Then 134 talks about authentication of financial statements and board of directors report and director's responsibility statement. And then most important thing, another topic in our CA Inter, this chapter is CSR. 135, such a big section and big topic. In this entire chapter, lengthiest topic is actually section 135, CSR, corporate social responsibility. And you know what, how we are going to discuss the order? First we will be discussing 129A, then I'll be discussing 130, 131, then I'll be discussing 135 CSR. Then after we'll discuss about filing of the financials, 129 and 128. Then I'll be discussing 132, 133, NFRA, all that depending upon the necessity. But most importantly, what are the sections that you must not skip? 129A, 130, 131, 135. These sections are very important. Even I can say 137, filing of the financial statements, is also one of the important section. Then why late? Let's enter into 129A. Periodical financial statements, periodical financial results. Periodical financial results. Just a minute. So in my material, it is question number 7. So explain the provisions relating to periodical financial results under 129A of the Companies Act. So like first, I need to give you a very background idea for this. See, this is a revision class, not a regular class. Just keep a note. Yeah. Listed companies, they list in stock exchanges, right? And we know that every day stocks will be traded, correct or not? Every day shares will be traded. Now tell me, generally, whether a company is performing well or not, how we know? Based on the financial statements. Agreed? What is the periodicity of preparation of financial statements generally? What is the duration? 1 year, yearly once we prepare. That's what we know. But last year company prepared financials. Almost 11 to 12 months it's been. I am trading in that share. Whether the company has performed well in the last 11 or 12 months, I don't know. It's very risky, yes or no? Correct or not? I want to know the real-time information. I want to know the latest information. Last year company may be excellent, but this year we don't know. Until March 2020, the company is performing excellent 1920. But 2021 was completely locked down. Now in that lockdown, what is the exact sales? How do we know? That's why for listed companies, SEBI made mandatory to prepare quarterly financial statements. For listed companies, as per SEBI regulations, they have to prepare quarterly results, nothing but quarterly financial statements. Every listed company shall prepare quarterly financial statements and shall file with SEBI and shall intimate to stock exchanges, and that information shall be published. Now tell me, every quarter I'll get what is the performance of the company during that quarter. So I know very well the latest information of this quarter I know. So by end of every quarter I'll get latest information. Same way. What about unlisted companies? Filing of quarterly results or filing preparation of quarterly financial statements, this provision is not there in the Companies Act. It is a provision as per SEBI regulations. Now company law has brought a new provision, that is section 129A, where they call it as periodical financial results, where they named it as periodical financial results. So what this section says, the central government may require such class of unlisted companies. Their main focus is on what? Unlisted companies. It may be a private company or it may be a public limited company, not clearly specified. Central government may give by order which unlisted company is liable for this. They may give some limits, 100 crore capital, 200 crore turnover, 500 crore some borrowings or 50 crore borrowings. Some limits they'll describe, and they will make some companies liable under this. But that right now that limits were not yet prescribed. This section was added in 2021 only. So central government may by order, for certain unlisted companies, they should prepare financial results of that company on periodical basis and in such form as may be prescribed. See, 129 what it says, every company shall prepare financial statements every year. That's what it says. Now what is this? They are asking you to, prepare financial results. They want to talk, they want to know profit or loss. They want to know the overall performance of the company and position of the company periodically. Okay, periodical basis. What is periodical basis? It may be quarterly or it may be half yearly. Depends. We don't know unless the government gives notification. We don't know. But when government can give notification, only when authority is given to the government in the act. Now Act 129A section brought and gave authority to the government. Now MCA release notification. Quarterly should be prepared. Yeah, we will prepare. All unlisted companies like us, we prepare quarterly results just like listed companies. So 129A section has been added. So every unlisted company, whoever is covered within the government order, shall prepare financial results on such periodical basis. It may be half yearly or quarterly, in the form whatever is given by the government. Now not only that, the company shall obtain approval of board of directors and complete audit or limited review of that periodical results. Remember, quarterly financials, just like that we don't release. We will conduct audit or we will conduct a limited review. As per SEBI regulations, listed companies, quarterly financials, they must be reviewed. They must be reviewed by statutory auditors under a limited review engagement. Sir, what is limited review? What is review? What is audit? What is the difference between review and audit? That much in-depth knowledge is not required at CA interlevel. Ignore. There is a concept called review. It is not as superb as audit, but it is not useless as well. It's medium. Auditor saw everything. There is nothing wrong. Fine. Okay, so don't discuss much about review now. Okay, don't think about it. So the government may also put a condition that the periodical results must be reviewed by auditors, or audit might be conducted. Either audit or review might be conducted as the manner in the manner whatever prescribed. Okay, so once quarter results prepared, review report or audit report of the auditor obtained, what you have to do? File the copy with the registrar within a period of 30 days from the completion of the relevant period. If it is a quarter, from the end of the quarter, 30 days. If it is half year, from the end of the half year, it is 30 days. If it is 120 days, from the end of 120th day, 30 days. Once in 4 months, they need to prepare periodical results. We don't know. Once government gives the order, then only this is applicable. So that is section 129A, filing of periodical results by unlisted companies prescribed by central government. So that class of unlisted companies which are covered under the order of the central government shall prepare periodical results on such basis using such format as may be prescribed by central government. And these unlisted, these financial results, periodical financial results, must be audited or reviewed by any person or auditor as per the order, and these must be filed with ROC within 30 days from the end of the period, whatever is mentioned. 30 days, this is important. MCQ might come. That's it. So that's about 129A. Then coming to next two more sections, what that is 130 and 131. What is 130? 130 is called as reopening of accounts, whereas 131 is about revision of financial statements. In fact, I call it as voluntary revision of financial statements or board of directors report. Voluntary revision of financial statements and board report. 131. Whereas 130, reopening of accounts by By whom? Reopening of accounts. Reopening of accounts by generally tribunal or court. Either the court or tribunal will reopen. So, sir, what is this reopening of accounts at a glance? Simply, suppose my company doing business, every year I'm preparing financial statements, audit is being conducted, every year I'm filing with ROC, everything is going fine. Suddenly one day, income tax department conducted raid. They opened and checked my past 3-4 years financial statements and books of accounts. They discovered so many frauds. Our company management committed so many frauds. Now the income tax department discovered these frauds. Array, so many frauds were there. So much of under disclosure of turnover. So much of understatement of profit. Tax has been evaded. GST is also evaded. This company is completely cheating entire government, public, shareholders, everybody. Now income tax department, what they did, they put order on us. They added all that income, they collected income tax, everything. But not with that they didn't stop. They intimated to GST department. They intimated most importantly to NCLT. They filed a complaint with the court, competent reason jurisdictionary court. So they went and filed a complaint with the court that this company is cheating. Okay, so now income tax department filed a petition, filed a complaint, filed an application to the tribunal or court that our company is fraudulently preparing the financial statements for so and so years. Now what that court or tribunal can do? They can reopen the accounts. Hey dear ABC Limited, you prepared false accounts. I am reopening your accounts for these financial years. Okay, we will investigate. These are all the mistakes we identified. Modify the accounts like this. So that is called order for reopening of accounts. Now, for how many years or with respect to what period the court or tribunal can reopen the accounts? Maximum 8 years preceding the year. So let's see what is covered. A company shall not reopen books of accounts, shall not recast. A company shall not reopen, shall not retotal unless an application is made by central government or income tax authority or SEBI. Actually central government includes income tax authority, but since still they gave separate specific point, or any other regulatory body or any person concerned, aggrieved person. If anybody else aggrieved by the company fraudulent financials, he can file a complaint, and if that complaint is received by the tribunal and they convinced, they may pass an order. To whom you will make an application? A court, a court of competent jurisdiction. The company, where the company is located, in which city, that related court or the tribunal. Now what court or tribunal will do? The court or tribunal may pass an order to revise the accounts, to retotal the financial statements of the company if they satisfied, they got a proof the earlier accounts were prepared in a fraudulent manner, the affairs of the company were mismanaged during past 3 years, casting a doubt on the reliability of the financial statements. If the court understood that, yeah, company financial statements were fraudulently prepared, the affairs of the company were mismanaged, somebody wrongly managed this company, in that case, what court can do, what court or tribunal can do? They may pass an order, to revise the accounts and retotal the financial statements of the company. Two reasons: relevant earlier accounts were prepared in fraudulent manner, the affairs of the company were mismanaged during the relevant period, which because of which there is a doubt on the reliability of the financials which are already filed with ROC. The court shall give notice to the applicant, shall take into consideration the representations if any made by them before passing the order. So before you pass the order of revision, whoever applicant is there, hey applicant, income tax department, these are the changes I am passing an order, are they okay or do you have any objection? I will once again take the representation before passing the final order. And the accounts are so revised, after finally revising the accounts, after finally retotaling the entire financials, they shall be final and that cannot be revised later on. Mandatory revision. This is mandatory revision by the tribunal or court, because they received an application from either the government or departments or statutory authorities or any other person concerned. When they will pass an order, if they convince that books of accounts were, financials were prepared on fraudulent manner, the company affairs were mismanaged during the period. Now, no order. There is a, sir, for how, what period? Sir, 10 years back company, fraudulently prepared balance sheet P&L, sir. Can we reopen? No. No order shall be made for reopening books of accounts related to a period earlier than 8 years immediately preceding the current year. Suppose you are in the current year 21-22. Before 21-22, 8 years. In 21-22, court will pass 130 order pertaining to last 8 years excluding 21-22. Suppose if the company is maintaining books of accounts for more than 8 years because of a government order, because some investigation is going on, company retained books of accounts for more than 8 years. In fact, right now company is having past 10 years records. In that case, you can reopen any of the past 10 years record. Generally, for how many years company will maintain books of accounts? 8 years. So you have to keep, you have to, you can pass order only with respect to any of the past 8 years. That's it. That's about reopening. Now revision. What is revision? Here, who will request, who will revise? Company itself will put a request. If it appears to the directors of the company, if the directors of the company feel financial statements of the company, board report do not comply with the provisions of relevant sections. 129 talks about financial statements preparation. 134 talks about board of directors report preparation. If the directors of the company felt that, sir, our financial statements in the last 3 years, 1 year financials, they were not prepared as per 129, sir. Some accounting standards we did not follow, sir. We prepared board reports, sir. Some points we did not follow, sir. If board of directors felt that, if board of directors discovered some mistakes in the financial statements and board report of the past 3 years, not 8 years, reopening of accounts is 8 years, this one revision of financials voluntarily by the company is only 3 years, understand? So they do not comply with 129 or 134, they may prepare revised financial statement, revised board of report in respect of any of the 3 preceding financial years. Suppose right now I am in 21-22. Right now I am in 21-22. Suppose I am in April month 2022. April 2022 comes in which financial year? 22-23. Now I discovered some error in my books of accounts, some error in my financials. Are same error is repeated in board of directors report also? Some financial highlights is there in board report, financial highlights are there. Financial statements were wrong. The same information is given in board of directors report. Are both are wrong? Now I want to revise. Okay, which year accounts board report you want to revise? 16-17 financial year. Are 16-17 financial year is more than 3 years. You are in 22-23, right? Now you are putting application, no? Before 22-23, 3 years means what? 21-22, 20-21, 19-20. If you are in 22-23, now if you want to revise, you can revise financial statements or board of report belonging to any 3 years. Any of these 3 or all of these 3, anything, whatever it is. So you can revise only relating to past 3 years. You can't revise more than 3 years. So now, okay, sir, can company directly revise and file again? No, first before revision, the revision can be made only after getting approval of the tribunal, NCLT, after making an application. You make an application to the tribunal. First file an application, then revise. Only after getting approval. And once you got the approval, you will get an approval by an order. Tribunal will give an order. Okay, your application is approved. That order, whatever passed by tribunal, first inform to ROC. Hey ROC, I filed financial statements with you. No, I am revising. See, tribunal permission I have. Tribunal shall serve notice. Tribunal has one duty. Tribunal approved. No, along with me, tribunal will also tell to income tax department, GST department, ROC. Hey, so and so company requested for revision of financial statements for so and so reasons. Look at all these reasons. You also go and check whether companies are paying you tax properly or not. They already paid tax, I know, but check once again because they're revising the accounts. The tribunal shall give notice to the government and the tax authorities and shall take into account whatever their words, representations, if any, made by government before passing any order under this section. And remember, once the financial statements and board report is revised, once again revision is not permitted. Only one time it is permitted. Suppose right now I am in financial year 22-23. Preceding 3 years means what? 21-22, 20-21, 19-20. Now I discovered mistake in 1920. I went and filed application with NCLT. They permitted. Revised. I revised. I refiled with ROC, everything revised. Again I discovered one more mistake in 2021. No, you can't do that. Only one time. See, in other words, from this, when a company has revised financial statements or board report pertaining to any of the three preceding years, then such revised statements shall not be revised again for the period it has been so revised. You already revised for 2021, you can't revise once again. So revision for a particular year financial statements and board report can only be done only once. And not only that, now you revise 22-23. Now 22-23, after it is over, you give financial statements for current year, you give board report for current year. No, in that board report tell that 2021 related financials revised during the year, the detailed reasons for revision of the financials and board report whatever shall be disclosed in the current year board report in the relevant year in which revision is made. We made revision in 22-23. In this year board report you shall mention about 2021 financials which are revised. And remember, you can only revise where copies of the financial statements or board report has been given to members, delivered to ROC, laid before the company. The revision must be confined to correction with respect to previous financial statements or report. Only if there is a non-compliance with these two and consequential alteration. This point is not required. You can revise only for one reason. Why? You either contravened 129 or 134. Only these two reasons only you can revise the accounts. You can't revise accounts for any other reason. Sir, section 129 schedule 3 division 1 format is given, sir. For me division 2 is applicable, sir. Ind AS is applicable, sir. But I filed financial statements with normal accounting standard. Now I want to revise. Revise because 129 says schedule 3 shall be followed. Division 2 if applicable, division 2 shall be followed. Sir, some other reason I have. I want to, sir, some incomes and expenses I did not recognize in the last year, sir. Prior period items are there. Can I revise? No, it's not a 129 item. Prior period item is not a 120. Prior period item is covered in accounting standard and you can recognize in current year as a prior period item. That's it. Only if you fail with 129, some technical things, 134, some technical things, then only you can revise voluntarily by making application. This H point is not required. How this revision shall be made, central government made, what is the manner of revision, that is not required. So that's it with respect to reopening of accounts and revision of financial statements. I hope you understood thoroughly. 129A periodical results, 130 reopening of accounts, 131 and revision of accounts by revision of financial statements or board report by board of directors. I hope you're clear. Listen once again the past 20-25 minutes. Very important, these three provisions, 129A, 130, 131 from exam point of view. Okay, yes. We'll continue now with NFRA, then I will continue with CSR, then remaining provisions of this chapter I will check it out. I hope you are understanding well. Okay, let's continue. Yes, continuation. So just we completed 129A, 130 and 131. And now we are discussing another important provision of this particular chapter, that is 132. NFRA, National Financial Reporting Authority. You know, from in 2018 NFRA was constituted. In 2019 NFRA was given full powers. The moment NFRA was given so many powers, one of the power which is given for NFRA is investigate chartered accountants. Investigate chartered accountants and audits conducted by them. This created a lot of mess in the CA fraternity. Institute has opposed. So there are various reasons why ICI has opposed NFRA with respect to the power to investigate audit firms. Okay, so there's so many reasons. One of the reason is because NFRA is a government department. NFRA officials or government people who are not chartered accountants, they may unnecessarily screw chartered accountants and get rob money from them. So many reasons. Bribe, so many reasons for there why ICI has opposed, but nevertheless, irrespective of opposition by ICI, finally, just a minute. Finally, NFRA has been implemented. Now, with respect to section 132, what are the important things from exam point of view? There are three provisions that are important. First of all, what are all the companies that are covered under NFRA purview? Not every company is covered under NFRA. Only few categories of companies are covered. 5 categories of companies are covered under NFRA. 5 categories of companies. Okay, like listed entities, all listed companies are covered under NFRA, comma, and all unlisted public companies, only public, remember, unlisted public companies subject to satisfaction of any one criteria. They have given 3 criteria: capital criteria, turnover criteria, borrowings criteria. 3 criteria we have given. Any one criteria, if it is satisfied, even that unlisted public company is covered within the scope of NFRA. Third category of company that is covered is special entities like insurance companies, banking companies, special entities, electricity entities. These companies are also covered within the scope of NFRA. Fourth category of company, if central government requested NFRA to review, investigate about a particular company, that company is not covered in any of these 3. That is not covered in any of these 3. Central government selected one company. What is central government? Some income tax department or GST department. Somebody have detected some fraud in some private company or in some public company, which does not come under category 2, which does not come under category 1, which does not come under category 3. But some severe fraud is there. They want to investigate. So who is already available experts in investigation? NFRA. So income tax department requested NFRA. NFRA, please investigate into accounts of this company. Please investigate into audit. So on a special request received from central government and its department, NFRA will investigate that company. Okay, so special request companies. And fifth category, material subsidiary company or associate company of these 4. Material associate company, material subsidiary company of these 4 companies. So if these 4 companies are covered under NFRA purview, right? Naturally, automatically, material subsidiary company, material associate, remember, only material subsidiary companies, material associate companies are covered. Only material associate companies and subsidiary companies are covered. Not all subsidiary companies, only material. So what is a material subsidiary? If that subsidiary income or that subsidiary net worth is 20% of the total group net worth, then in consolidated financials, that subsidiary company share is 20%. Then it's a material subsidiary. State Bank of Reliance Industries Limited is having 270 plus subsidiary companies. But do you think all 274 companies are material subsidiaries? No, maybe hardly 5 or 10. Not even 5 or 10. Hardly some 2 or 3 you will find material subsidiaries. For a company, material subsidiaries will be 1 or 2 only, in spite of having hundreds of companies. Fine, don't worry, I'll come to that once again while reading it. Okay, so what are the functions of NFRA? First of all, one of the most important function is they make recommendations on formulation and laying down of accounting and auditing policies and standards. Until before this provision came, who is recommending accounting standards and auditing standards to central government? Who is participating in the designing of standards? Institute of Chartered Accountants of India. And now NFRA is taking over that power, taking over that role. Of course, now institute is also participating in recommendation. Even NFRA is also participating in the recommendation. NFRA is an authority constituted under Companies Act. Under Companies Act it is constituted, authority constituted under Companies Act. Institute of Chartered Accountants of India is a regulatory body constituted by a separate act of parliament. That's it. Now, so NFRA make recommendations. What are the functions of NFRA? 4 functions. They can make recommendations to the central government with respect to designing of auditing and accounting policies and standard. NFRA can monitor, they can enforce compliance with standards and auditing standards. How? Okay, I recommend standards. Are these standards followed by people, chartered accountants? I will see. Are the accounting standards implemented by companies? I will monitor. Okay, and I will check, oversee quality of service of professions associated for compliance with such standard and suggest measures required for improvement in quality of service. Oversee the quality of services by professionals, nothing but oversee the quality of services means what? Investigation of chartered accountant firms. perform such other functions under clause ABC as may be prescribed. Whatever given under above, incidental to any other function is required, that function. So three main functions: recommending central government regarding accounting and auditing standards, designing all that, monitoring and enforcing compliance with these standards, oversee the quality of professionals, example chartered accountants. Next, so now they have these many functions, right? When these many functions were there, to execute these functions, NFRA should be given some powers. Yes or no? So what are the powers of the NFRA? They have the power to investigate on their own, suo motu, or on a reference made to it by central government. What do you mean by central government? Central government means the central government and all its department, income tax department, GST department, finance department. These are all various departments of central government. Either on my own or by receiving a request from a central government department, I have investigation power of such class of body, corporates or persons, into the matters of professional or other misconduct committed by any firm or firm of chartered accountants. So I can investigate into affairs of a company or person into the matters of professional or other misconduct committed by any member. So if any member of the chartered accountant, if any institute, CA, did he commit any professional misconduct? Did he commit any other misconduct? I have power to investigate and check. Once NFRA proceedings started, no other institute, no other body shall initiate or continue any existing proceedings. Okay, where NFRA initiated. Once NFRA take up the case of a particular chartered accountant, on him, whatever cases going on under ICI or under some other panel, everything will discontinue. NFRA will investigate straight away. Then what are the powers of the NFRA? Second power. So the first power, they can investigate any person or class of companies. Okay, and they can investigate into any misconduct conducted by chartered accountant firms. Okay, and while investigating, they have all the powers which are given for a civil court. What kind of powers that are there for civil court while they are carrying investigation? Same powers were also given for NFRA. So NFRA can demand production of books of accounts and other documents at any place decided by NFRA. They can call, summon and enforce the attendance of person. They can inspect any books, registers, other documents of any person referred in class B, that is members of ICI. They can refer any books of members of, they can issue commissions for examination of witness or document. They can issue orders to call that person, call this person. So they have all the powers that a civil court is having. And they can investigate, they can call and investigate. Now, if professional or other misconduct is proved, suppose if the misconduct is proved, sir, what do you mean by professional misconduct? What do you mean by other misconduct? CA Act has a two schedules, Schedule 1, Schedule 2. You will get this in CA Final. CA Final, Advanced Auditing Paper 3. I only deal with Advanced Auditing Paper 3 at CA Final. In that, we have a chapter called Professional Ethics, which is 12 to 14 marks chapter for CA Final. Inside that, we will be discussing CA Act, what is professional misconduct, what is other misconduct, all that. If that misconduct is proved, NFRA voluntarily or based on a complaint investigated, they called persons, checked books of accounts, all that, accounts, records, various things, documents, audit working papers, all that they saw, and they discovered CA is grossly negligent. Some professional misconduct is discovered. They can impose a penalty. How much? Minimum 1 lakh. Or it may extend depending upon the severity 5 times if the auditor is individual. Suppose if the auditor is a partnership firm, minimum 5 lakhs fine, which may extend to 10 times. Not only that, they will impose penalty, and NFRA can debar the member from being appointed as an auditor or internal or undertaking any audit in respect of financial statements, central auditor, any body corporate. They can debar the member from taking audit assignments. Okay, and minimum how many months they can debar? 6 months. Maximum how many years they can debar? 10 years. NFRA, if a chartered accountant like you and me, if we were proved as guilty, NFRA will impose penalty minimum 1 lakh or 5 times of the fee, or in case of firm 5 lakh rupee minimum, 10 times of the fee, whichever is whatever, it may extend. There is no such concept of whichever is lower, whichever is higher. There is no such concept. Minimum 5 lakhs. If the negligence, if the misconduct, if the mistake is so big, 10 times of this. In case of firm, individual 1 lakh or 5 times of this maximum. Now, not only penalty, okay, I'll pay. They will debar me.
they will debar me for minimum 6 months to 10 years. Okay, I am prohibited to do valuation. I am prohibited to do audit. Not only stat audit, internal audit also I am prohibited to do. So these are the powers of NFRA. NFRA has power to investigate. NFRA has same powers like a civil court. If once a misconduct is proved, NFRA will levy penalty and NFRA will debar a member from taking up audits, stat, internal or valuation works, minimum 6 months or maximum 10 years. These are the powers of NFRA. Now, suppose NFRA passed an order on a chartered accountant and he is not at all ready to accept that allegation by NFRA, that order. He can go to NECLAT, National Company Law Appellate Tribunal. National Company Law Appellate Tribunal. So he will go to the NECLAT. We call it as NCLT, not NCLT. NCLT above there is an authority called NECLAT, NCLAT, National Company Law Appellate Tribunal. That's it. So you can go and file a case on the NFRA. Finally, NECLAT will decide. Suppose if NECLAT also failed, go to High Court. If that is also failed, go to Supreme Court. And once Supreme Court decides, that is final. That's it. Now, composition of NFRA. This concept is not required from exam point of view. Meetings of NFRA, all this not required. Now, question number 12. This is important. What are the companies that are covered under NFRA purview? I told you 5 categories of companies. What are they? What are they? Listed companies. Companies whose securities are listed in any stock exchange. It may be in India or outside India. And not only that, unlisted public company, which means private limited companies are not covered within the scope of NFRA. Remember, MCQ may come. So any unlisted public company satisfying 3 conditions given, any one enough. If any one condition is satisfied, NFRA is covered. Okay, see, paid up capital minimum 500 crores, turnover minimum 1000 crores, aggregate loans, debentures, deposits minimum 500 crores as on 31st March of the last year. Suppose my paid up capital 100 crores only, sir. Okay, condition 1 failed. Check condition 2. Turnover, is it 1000 crores? No, sir. Check borrowings criteria, borrowings, deposit, all the debentures all together. Is it minimum 500? 550 crores. NFRA applicable for you. Sir, I'm an unlisted. One condition satisfied, na? NFRA is applicable for you. Not only that, if you are coming under special entity, insurance, banking, companies engaged in electricity, or any companies governed by any special act, body corporates incorporated by any act, all body corporates, NFRA can even investigate into ICI affairs because it's a body corporate incorporated by an act. NFRA can investigate into LIC affairs. NFRA can investigate into General Insurance Corporation. NFRA can investigate into Food Corporation of India because they're all body corporates. So these are entities. Then, so 3 categories. One is listed, unlisted public company subject to some criteria, and special entities, and any body corporate, any company, any class of body corporates are government on a reference made to NFRA by central government. Suppose the central government in public interest requested NFRA, look into this company case. Sir, that company is not covered in the above 3 list. It's okay, look into. Then also that company is liable under NFRA. And then not only them, a body corporate incorporated registered outside India, which is a subsidiary or associate company of any company body corporate referred in the A to D above. In the above 4, no, you have above 4, right? These 4. For any of these 4 companies, if there is any material subsidiary, material associate company, that is also covered within the NFRA company. What is a material subsidiary? If the income or net worth exceeds 20% of the consolidated income or 20% of the consolidated net worth, any one criteria, that's enough. They are also covered within the NFRA purview. So that's enough. Second point. Sir, I'm an unlisted company, sir. Last year, borrowings 500 crore crossed. Okay, NFRA applicable, sir. This year applied. Sir, but this year, as on 31st March, all limits are satisfied, sir. I mean, paid up capital not satisfied, turnover not satisfied, borrowing not satisfied. Am I exempted from NFRA next year? A body corporate or company shall continue to be governed by NFRA minimum 3 years after it ceases to be listed, after its paid up capital, turnover all falls within the below the limits. Suppose, sir, I'm a originally listed company, sir. Turnover and all 10 crores, all very less, sir, but still listed. NFRA applied. Okay, now I delisted, sir. I don't come under any of the 5 categories. I will not fall, sir, now. Now is NFRA exempted? When you delisted this year only. From this year, 3 years, NFRA still applies for you. After 3 years, then you are exempted. Suppose within 3 years, if any of the above 5 categories you fall under once again NFRA applies. Okay, so a company shall continue to be governed by NFRA for minimum 3 years, even after it ceases to be a category company. Minimum 3 years. Once you come out of any of these 5 category, once you come out of all the 5 categories, 3 years still NFRA apply. 3 years nothing. You didn't come under, you didn't touch any of the above 5 categories. Enough. You're exempted from NFRA applicability. So that's about NFRA applicability. So question number 13 is not an important question, that is not required. Question number 13 is not required. Then so now what we will discuss is same as per our order. So 129A, 130, 131, 132, and now 135, which is important. So once we'll discuss 135, then I'll come to 134 board report, 128, 129, all that. Okay, yes. So we'll go with 135. What is 135? Corporate social responsibility. What is 135? Corporate social responsibility. Yes, question number 17. Come to question number 17 in this material. If at all you're following some other material, in that material you can follow, no issue at all. But this material we did cover comprehensively everything. That's it. Okay, so continue watching for CSR. Yeah, so let's continue. So just we completed NFRA, and now the most important topic, that is 135, corporate social responsibility expenditure. You know, this 135 is such a lengthy concept. Actually, it has 9 subsections. Most importantly, any book that you're reading, or maybe ICA material you're reading, this topic is spread over approximately 5 pages around. And many students, with respect to this topic, they're having lots of confusion. Now listen carefully, approximately some 25 to 30 minutes, this topic alone we will be spending. You will get a clarity like never before with respect to CSR. Okay, we'll start. First of all, you can also take notes along with me for this concept. Okay, or else do one thing, first listen to whatever I'm saying, then you copy. So first of all, which companies has to spend CSR expenditure? What is first of all corporate social responsibility? I'll explain little detailed, not like a pure marathon, little bit detailed, but not at the same time like a regular course. Okay, yeah. So first of all, which companies are liable to spend CSR, and what is CSR? Corporate social responsibility. One of the Mahatma Gandhi principle, whatever you are earning is coming from the society. So today companies are creating empires. So lots of companies are growing like anything. How are they getting it? Of course, their idea, their business, okay, fine. But ultimately, who is paying you that money? The people around you, the general public. So you are getting that growth, money, net worth, wealth, everything from the society. Give back to the society. So on that principle, every company, social responsibility is not just an individual responsibility. Even companies will have social responsibility. Companies must spend for social responsibility. This is not a business expenditure. Whatever a company, suppose if a company is spending under 135 because it's statutory requirement, you cannot claim it as a deduction under income tax, PGBP. You don't get CSR expenditure as a deduction. You can't claim it under 80 series, chapter 60 also. Just you have to spend it. That's it. So, okay, fine, understood at a glance. Now, which companies are liable for incurring CSR expenditure? Every company, sir, listed, unlisted, no such variation. Every company, it may be listed, unlisted, private, public, government, non-government, whatever. Every even foreign companies, every company, including foreign company, satisfying any of the 3 criterias: net worth 500 crore or more, okay, turnover 1000 crore or more, net profit 5 crore or more. Sir, all the criterias? No, any one. Suppose my net worth is already 500 crore, enough, that's it, you are liable for CSR expenditure. No, not exceeding. Look at your turnover, is it 1000 crores? No, not exceeding. Still one more criteria, profit. Do you have 5 crores or more than that? Yes sir. You are liable for CSR. Sir, I did not comply with the 2 criteria. It's okay, man. Any one satisfied, that's enough. You want a proof? I'll open the proof directly. You see, this is the bare act. So every company, look at this, every company having net worth. What do you mean by net worth? The definition is also given. It is not required from exam point of view. Every company having net worth of 500 crores or more, or the word used is or. If turnover net worth criteria not satisfied, check turnover. Turnover of rupees 1,000 crores or more, not satisfied. Check the third criteria. Net profit 5 crore or more. During which year? Current year? No, no, no. In the immediately preceding financial year. Suppose right now I am in 22-23 financial year. Right now I'm in 22. Sir, in this year, should I spend money on CSR? What is last year? 21-22. For 21-22, check these limits. Satisfied, sir. One limit satisfied. In 22-23, you must spend CSR expenditure. You must incur CSR expenditure. Next. Next. So CSR. So in the immediately preceding, they shall constitute a CSR committee of board of directors consisting 3 or more directors, out of which one must be at least one independent director. So what is the provision? Every company which is satisfying any one criteria, what they need to do? They must constitute a CSR committee. CSR committee means who will be part of this committee? Minimum 3 directors should participate in this committee. Out of these 3, one at least must be independent director. Sir, mine is a private company, sir. Independent director question do not apply. Moreover, I'm having only 2 directors, sir. Okay, if you do not have independent director, if you are having only 2 directors, then with 2 directors only form CSR committee. With 2 directors only form CSR committee. Now, with respect to CSR committee, they have given one exemption. Which companies are not required to have a CSR committee? Subsection 9 says, suppose if the company amount to be spent, if the amount to be spent does not exceed 50 lakhs, then CSR committee shall not apply. No need to put a separate committee. Whatever functions of the committee, they can be discharged by board of directors. A separate committee not required. Directors itself discharge. When separate committee is required, any of the one criteria satisfied, expenditure is 50 lakhs or more. Okay, then CSR committee shall be constituted. There must be a separate committee. Board of directors cannot handle everything. They have so many works to do. Put a separate committee. They will look exclusively into CSR activities. Like how audit committee looks into audit related activities, CSR committee will look into CSR related activities. Put a separate committee. They only focus on CSR related things. Who will be the part of this committee? Directors only. So CSR committee, so a director will have a director capacity, board of director, and he's also a member of CSR committee. That's it. Now, next. Okay, sir, understood slightly. Every company which satisfies any one criteria, they must have a CSR committee, and through CSR committee, they must execute 135, conditions. Okay, sir, fine. Okay, sir, committee constitute. What we have to do? Nothing. You have to spend money. You have to spend money for what? Social activities. What activities? Schedule 7. There is a schedule under Companies Act that is called Schedule 7. They described so many issues. For all these activities, you can spend money. Then only we will call it as CSR expenditure. Okay, sir, Schedule 7 funds are there. So many activities are covered. Education, rural upliftment, so many, disaster management, so many were covered. Okay, we will spend. How much we should spend, sir? You must spend minimum. How much CSR expenditure? Minimum 2% of average net profits of 3 preceding financial years. Last 3 years, how much is your profits? Total it. Last 3 years. Sir, right now you are in 22-23. No, I ignore this. 21-22, 20-21, 19-20. Total it by 3. How much average profit? That much. On that apply 2%. How much amount came? That much you should spend in this year. In this year you have to spend. Sir, should I spend entire 2% money? Sir, my company is a Reliance Industries Limited, sir. Last year I have 1000 crore. That, last year I have 30,000 crore. That last year I have 40,000 crore profit. That last year I'm having 20,000 crore. So total it by 3 is equal to 30,000 crore profit I have, sir. Average profit is 30,000 crore. into 2% means 600 crore. Sir, 600 crore should I conduct on social activities in 1 year only? Sir, I want to, I wanted to, develop one village, sir. That village development takes 3 years, sir. That village development takes 2 years, sir. I can't spend entire money within 1 year. What is the, remedy in this case? I want to develop village. That is covered in Schedule 7, sir. Development of rural areas is covered. It will take 2-3 years, sir. But you are saying entire money shall be spent in the current year. Can I spend this 2% over some number of years? Logically speaking, entire 2% must be spent in the same financial year. You must spend, means money should go out. Sir, I am trying, sir, 600 crores I want to spend and develop some villages, sir. But it will take multiple years, sir. So this year I only spent 300 crores, sir. Still 300 crore left with me. What should I do? You know what is this called as 300 crore? This 300 crore is called as unspent money. This 300 crores is called as what? Unspent money. Okay, what we should do? Unspent money. Now, by the way, you are spending now already. Is it an ongoing project? Oh, yes, sir, it's an ongoing project. What is an ongoing project? Ongoing project is a multi-year project. What is a multi-year project? Logically, CSR expenditure must be spent in the same year. Yes or no? But if at all directors and CSR committee decided to spend it over 2 or 3 years, multiple years, can they spend in the multiple years? Yes, there are some conditions. Normally you should spend entirely in the same year, but there are some conditions. Suppose you want to spend on a particular project which will not complete within 1 year, but it will take few multiple years. It's a multi-year project. Then only we call it as an ongoing project. Okay, you unspent some 300 crore. No, it's an unspent money. No, is it relating to ongoing project? Yes, sir, it is ongoing project. You can't spend entirely 1 year. No, sir, we can't spend. Do you really have intention to spend? Yes, I'm having really intention. That money is there already ready. I'm ready to spend. But the problem is time. I can't spend immediately. Not possible. Only once road is constructed, we can construct some water tanks and all. Road itself is taking 1 year. When will I construct water tank? I have money ready to spend. The problem is time taken for incurring expenditure. Okay, fine. Don't spend entirely within 1 year. Try to spend within 1 year. Not possible, no? Don't worry. So if it is something ongoing project, the project you are spending on a project and that project is going more than 1 year, multiple year project. Okay, if it is ongoing project, do one thing. Okay, I want that money to be safely spent. You can't cheat me. I'm a Ministry of Corporate. You should not cheat me. What condition? Suppose 300 crore you spent. That's okay. 300 crore unspent. No, that unspent is relating to ongoing project. No, that you are telling. What you need to do? This 300 crore transfer to separate bank account called unspent CSR expenditure account. What is it called as? Unspent CSR account or simply unspent CSR account. Transfer to that bank account. When should I transfer, sir? Year will complete, no? Suppose right now you are in 22-23. Year will complete on 31st March 2023. From 31st March 2023, within 30 days, 30 days from the end of the financial year, within 30 days from the end of the financial year, put this 300 crore in a bank account. Which bank account? Unspent CSR activity bank account, unspent CSR expenditure bank account. Put separate bank account, deposit there. Show me proof. Okay, fine. You have money, you are ready to spend. Only thing is some technical difficulties are there. Okay, fine. Now, sir, unspent bank, I transfer, sir. Now, within what time that money kept in bank account shall be spent? Can I have infinite time? No. You have only 3 years of time. You have only 3 years of time. From when? From 30 days after? No. From on which date you transferred? Sir, somewhere on 10th April I transferred, sir. From 10th April, within 3 years, entire 300 crore must be spent. Entire 300 crore must be spent. Actually, entire 600 crore you should spend in 22-23 only. But the problem is, it's not possible to spend for you. So I am allowing you to spend over multiple number of years. How many years maximum I will allow? 3 years. I will only wait maximum next to 3 years. If you can't spend entire money within this year and you already started the project, it is in between, it is in progress, ongoing project. You already started the project. Remember, the condition is it's ongoing project. You already started the project. As on 31st March, the project is not yet complete. You already spent partial some amount, some partial amount is pending. That is already 2% of your net profit totally. You kept aside. Partially you spent 2% of net profit 600 crore, 300 crore you spent, 300 crore still pending. Transfer within 30 days from the end of the financial year to unspent CSR activity account. From that account, withdraw and spend on this project. Finish this project within 3 years from the date of transfer. Sir, I couldn't, sir, within 3 years, no, 280 crore I spent, sir. Within 3 years, I spent 280 crore. Still 20 crore is lying, sir. What should I do? What will I do? Transfer that 20 crore to, transfer that 20 crore to Schedule 7 fund. What is it? Transfer that account to Schedule 7 fund. What is Schedule 7? In Schedule 7, there are some funds called Prime Minister National Relief Fund, Scientific Research Development Fund, some government funds are there. Transfer to that fund. Donate to that fund. It's simply like donation. You fail to spend, no, 20 crores, give it as donation to government, Prime Minister National Relief Fund, Prime Minister Cares Fund. Donate, that's enough. Over. Sir, suppose I spend 300 crores on some projects that are already over in the current year. Still 300 crore remained, sir. We couldn't spend. Have you started the project or no, sir? We couldn't start any project. The 300 crore is just lying. Now only we should plan how to spend all that. Okay, you don't have any excuse. Within 6 months of the end of the financial year, within 6 months of the end of the financial year, 31st March 2023 came, within 6 months, transfer it to Schedule 7. Transfer it to Schedule 7 funds directly. No more excuse. No unspent account. No 3 years time limit. 3 years time limit when I will give? You already started the project. It is in between. Money is there. Project is going on. 3 years I will wait. You didn't start project itself. That clearly shows you don't have any interest on spending. Just for namesake, you kept side money. You want to cheat later on. No, 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 I will not allow. Within 6 months, a transfer to government funds. We will take care. So that is the condition. So what is the condition? See, I will show you here. I will show you. I hope you're able to reconnect. I hope you're able to connect with me. Put a reply under the comments. How you understand, how far you understood these provisions. You know, mention your reply. So 2%, no? See, what if you are failed to spend minimum amount? First, disclose the reason why you couldn't spend. Out of 600 crore, only 300 crore spent. 300 you didn't spend. Why? Mention the reason. Sir, you mention because of ongoing project, 300 crores we kept aside. Suppose if the unspent amount is other than ongoing, no ongoing project, no more excuse. Transfer entire that amount to a fund specified under Schedule 7 within 6 months from the end of the financial year. Sir, I already started the project, sir. Rural development example. It will take 2-3 years for developing the village. How come you insist on me? How come you compel me to spend entire 600? Should I throw on road? Suppose you take up some big project, multi-year project, and because of that, that money was idle. Okay, 600 crore, 300 crore, you spent 300 crore, still is there. Any amount remaining unspent because of any ongoing project shall be transferred by the company within 30 days from the end of the financial year to a special account which shall be opened on behalf of the company, you know, which is called as unspent CSR account, unspent CSR account, and that amount shall be spent for that obligation toward CSR policy within 3 years from the date of that transfer. Within 3 financial years you have to transfer. Failing which, suppose you failed at the end of 3rd year, still 20 crore lying, whatever amount left shall be transferred to again Schedule 7 fund within 30 days from the date of completion of 3rd year. Once 3rd year over, within 30 days whatever amount lied in that special account transferred to government authority. Sir, what are Schedule 7 funds? Can you give us one idea about what are the Schedule 7 funds? I'll show you right now. What are Schedule 7 funds? Contribution funds. Contribution to PM Relief Fund, PM Citizen Assistant Relief in Emergency, PM Cares Fund, nothing but any other fund set up by central government for socio-economic development, all that. Okay, contribution to incubators, research development projects, which are, you would have all seen this in PGBP, all that. So all these funds you donate. Okay, especially this one, PM fund, Prime Minister National Fund, Prime Minister Cares Fund, any other fund set up by central government or state government, so transfer to that fund. if you could not spend. If at all you could not spend, no project, transfer within 6 months. There is a project, within 30 days, transfer to unspent CSR account. From that account within 3 years use it. Couldn't use within 3 years, whatever amount lying pending, transfer within next 30 days to these fund. That's it. Sir, for what activities I can spend CSR? For basic needs like hunger, poverty, malnutrition, all this elimination, education and training, for gender equality, empowering women, all that. Okay, so many, setting up old age homes, all that. For environmental purpose, ecology purpose, for heritage, protection of heritage, culture, and for armed forces you can use, for sports, you can use. Sir, what are all not covered within CSR purview, sir? Which expenditure do not qualify for CSR? My employees were there, sir. I am constructing houses and giving it to all my employees, sir. I am constructing my house and giving it to all my employees. Can I claim this as CSR expenditure? No. The following expenditure cannot be taken as CSR. Any activities which are taken in pursuance of normal course of the business. Like generally company to promote their brand name, okay, free samples they are distributing. That free samples whatever distributed by company, no, you cannot call it as a a CSR expenditure. Suppose companies researching for a particular drug development. My company is a pharma company, we are developing a particular drug for a particular disease, research and development. A normal pharma company research and development is a regular activity. You don't call it a CSR, spend for something else. Pharma companies, they have given one special exemption, research and development activity related to vaccine development of COVID-19 for the financial years 2021, 21, 22, 22, 23, subject to that particular research is carried in collaboration with some institutes, and that activity is disclosed separately in the annual report. In that case, though you are a research and development organization, if you research on COVID related thing, we will call it a CSR. Only with respect to COVID, we will call it a CSR. Okay, so normally in normal course of business, you are a research and development company, you are researching on something, you don't call it a CSR. In normal course of business, for some marketing or some reason you are distributing samples, don't call it a CSR. Just because you are giving it free, don't call it as corporate social responsibility. Don't link it with the CSR. If it is something like normal course of activity, so don't call it a CSR. Or any activity you are undertaking outside India, anything that you spend outside India, no, we don't call it a CSR expenditure. That is not covered under CSR expenditure. That we will not take into account in 2%, except training of Indian sports person representing any state or union territory at national or international. Only for training sports person outside India you can spend money. For any purpose outside India you can't spend money. There is so much of poverty, hunger, education needs in India. Spend in India, that's enough. Don't spend outside India. Sir, I spent in Somalia. Sir, I donated in Sri Lanka. No, that is not permitted. Donation to political party is not considered as a CSR expenditure. Activities benefiting employees of the company, okay, that is not a CSR expenditure. You constructed houses and gave to employees. You are benefiting your organization. Where you are benefiting to the society. We want benefit to the society, not your organization. Employee benefit is not covered under CSR. Suppose you gave sponsorship for deriving marketing benefits. Some Paralympics, like Paralympics is happening to promote paralyzed people getting it. You are sponsoring and advertising and getting so much brand name. Don't call it a CSR. It's a marketing expenditure. And you are spending because of some statutory obligation. There is compulsory, you incorporated a factory in a backward area. As part of the license condition, you are supposed to spend some money every year in that backward area. That's a condition under law. Don't call it a CSR. Then what is CSR expenditure? That is something which you have to additionally spend because of section 135 requirement. So how should we spend? We board of directors are so busy. Don't worry. Create a committee. Keep some directors in that committee. They only look into CSR activities. Now, sir, okay, fine, sir. We have formulated a committee. What we have to do? Committee shall formulate a CSR policy. Policy means what? See, there are so many activities which companies, there are so many social activities that are there. Education, rural development, disaster management. There's so many activities covered. Which activities company will take up? What is the policy of the company? So that is what covered in CSR policy. Please read this on your own, single reading, not required from exam point of view. Whatever is required from exam point of view, I will be covering it full. So corporate social responsibility means activities undertaken by the company which shall not include, okay, in pursuance of section 135, which shall not include normal course of business activities, any activity carried outside India except for training sports persons, okay, for playing on behalf of state or nation in a national or international games, donation, employee benefits, sponsorship, and statutory obligations. And the remaining points are not required in this question. So which companies are liable to constitute CSR committee? Every company, even foreign company, private company, public company, government company, non-government, listed, unlisted, any company satisfying any of these, net worth 500 crore or more, turnover 1000 crore or more, net profit 5 crore or more, when immediately preceding last year you need to check, okay, shall constitute CSR committee from board of directors, at least 3 or more, out of which at least 1 director shall be independent director. Suppose if there is no independent director, or if your directors are only 2, then with 2 directors you can constitute. This point is not required, ma. The second point, holding company, foreign company, all that. Sir, mine is a foreign company, sir. In that case, net worth, turnover, net profit, if it's a foreign company, we will calculate as per section 381. Sir, what is 381 section? What is foreign company regulations? That is not covered in CA into. You are having in CA final paper 4 law, you will be getting. I don't deal paper 4, I deal only paper 3 advanced auditing. Fine. Next. See, this is a marathon. Don't think that I am rushing up. I'm giving you lot of clarity. Again, I will connect to totally. So what is net worth? Net worth definition is not required. Okay. So here some examples were given. Here some examples were given. So please go through that. Now, sir, like suppose example, sir. Last year I came within those 3 limits. Fine. Covered under CSR. I will spend money, sir. But what happened, no, sir? This year I didn't cover under CSR, sir. Now, am I exempted from CSR expenditure 2%, sir? Last year I covered, this year I spent. This year I didn't satisfy any limit. My capital is less than 500 crores or net worth. My turnover is less than 1000. My profit is less than 5. You see here. Exclusion of companies. Every company which ceases to be a company under 135(1) for 3 consecutive years shall not be required to constitute CSR committee, shall not be required to comply with these criteria for 3 years. See, one time you cover under any of the limit, next 3 years CSR expenditure you must spend. Next 3 years these limits not at all came into picture. Continuously 3 years you didn't satisfy net worth criteria, turnover criteria, profit criteria, continuously 3 years, none of these 3 you satisfied, then exempted. 4th year onwards you are not liable, but once satisfied 3 years you are liable to spend. Within these 3 years, in all the 3 years, all the limits are not satisfied, 4th year you are exempted. In these 3 years, any 1 year again satisfied, again 3 years it will continue, which means one time if a limit satisfied, 3 years it will apply. In every year we will see. Next year, suppose 2021, I saw net worth, turnover and profit. Okay, this is not satisfied, but profit satisfied. 21, 22, 22, 23, 23, 24, you have to comply. 21, sir, I didn't satisfy. 22, I didn't satisfy. 23, 20, again next 3 years it will continue. Simple logic. So CSR committee shall have what? Minimum 3 directors or more than that, and at least 1 director must be independent. Suppose if a company do not have independent director, the company is not liable for independent director. In that case, 2 or more directors shall form CSR committee. So composition of CSR committee, this itself can be asked as a question. Write about composition of CSR committee for 3 marks. Which company is liable to constitute CSR committee? They may ask you. So in that case, you need to write this first point. So in the 18th question, first point is important. 4th point is important. 5th point is important, composition. Now, when CSR committee is not required, see, you are liable for CSR. 135 subsection 1. 500 crore, 1000 crore, 5 crore, something satisfied, but still committee not required. With the board of directors you can manage. When? If the expenditure, if the amount to be spent does not exceed 50 lakh rupees, you calculated 2% of average net profit, that amount is less than or equal to 50 lakhs. If it is more than 50, committee is compulsory. If it is less than or equal to 50, committee not required. You board of directors can go. Sir, still I want to form committee, sir. My expenditure is 45 lakh, but still I want to form committee. Okay, form it. We gave exemption. If you don't want to use this exemption, it's okay. This is a new amendment. Now, sir, okay, sir, committee form letter. Why this committee, sir? The committee shall recommend a policy. They should design and recommend to board what are the activities under Schedule 7 our company can take up. Remember, CSR, one condition is what, proviso says. One of the proviso says, company must give attention to local areas. Okay, where the company is situated, local areas they should develop. You don't come to South India or North India and develop something remote location. Go, no, first give priority to local areas. And so first develop the policy, recommend what is the amount to be incurred for activities, monitor how the policy is being executed, and give action plan every year. CSR committee, directors don't know how to spend all that. They need to release money. What are all the activities we are going to do in this year? Okay, we know 600 crore money is there. What is the action plan for this 600 crore? Give action plan. What are the projects we should take up? What are the programs we should take up? How should we execute? How we should utilize the funds? Okay, how we should monitor so that funds will not be leaked, people will not cheat. How we should report, and do impact assessment. What is impact assessment? You are spending money, is it really benefiting to that people, other people? You are developing the rural area, is it really benefiting the people in that particular rural village? Do impact assessment. So give an annual action plan. Now, what projects or programs, how we should execute, how we should spend the money, how to monitor and report, how to do impact assessment. Give an annual action plan. That is also your responsibility. So what are the duties of CSR committee? This itself can be asked as a 4 marks or 6 marks question. What are the duties of CSR committee? Now, okay, CSR committee understood. Now, what is the board of directors duty with respect to CSR? They formed a separate committee. They recommended policy, approve the policy. Being a director, approve. Ultimate decision is with you only. Approve the policy. See that activities are, included as part of the CSR. And what are all the activities you are taking? Display on your website. Being a director, display. So what are the duties of board of director in relation to CSR? So this can be asked as a 3 marks or 4 marks question. And how much amount you have to spend? I already 2% of average net profits. What is average net profits? Average of last 3 years. Sir, my company incorporated last year only, sir. Then last year profit itself is average profit. 2 years only your company is existing, then 2 year average. If the company is existing for 3 or more than 3, take 3 years average. Otherwise, 1 or 2 years average. That's it. And if you fail to spend, I already explained. Now, sir, as you said, sir, we are spending some CSR projects, sir. We are spending projects, self-help groups we created, women empowerment related, some activities we created. We created some small business ventures for rural women, sir. When that business venture is carried on, they got some profit. What should we do? Left back into the same project. Put back that profit into in course of CSR project, if you get any profit accidentally or incidentally, put it back into that. Don't take it into your P&L account. Okay, the board shall ensure, any surplus arising out of CSR shall not form part of business profit of the company, and it shall be put back into the same project. It shall be transferred to unspent CSR account. Okay, if there is no CSR, in pursuance of CSR annual action plan, unspent CSR account, if it is ongoing project. Suppose if it is not a B point ongoing project. Suppose no ongoing project. From a particular project you got surplus suddenly, that is not an ongoing project. Over that surplus, what you should do? Transfer to Schedule 7 fund within 6 months from the expiry. If it is related to ongoing project, transfer to unspent and spend from them. Spend from that. Put back into the same project, spend in the same year. Whatever surplus you got, spend in the same year. Couldn't spend, ongoing project, transfer to unspent CSR activity account and then use it within 3 years. Not ongoing project, transfer to Schedule 7 fund within 6 months. Simple. And sir, understood, sir. CSR means what you are telling is entire money 600 crore we must spend on rural development only, sir. But for spending all this, we need to recruit staff, we need to recruit some people, stationery, all that. So much of administrative expenses we will incur. Can we, out of that 600, can we use something for administration? Yes, you can use. How much? Maximum 5% of the total expenditure. Administrative overheads shall not exceed 5%. See, you kept 600 crore aside for CSR, out of which 5% means 30 crore. Maximum administration overhead, how much? 30 crore. Remaining 570 crore must go for welfare of the people. Sir, in this year, no, I spent 750 crores, sir. I'm actually liable to spend only 600, but 750 I spent extra, no. Will I have any benefit for the extra? Yes, you can carry forward and spend over next 3 years. Set off over next. Where a company spends an amount in excess of requirement, that excess amount will be set off against requirement to spend up to 3 succeeding years. That excess amount shall not include surplus in the project. You got surplus in the project, don't keep that in the excess amount. So that you left back. If you spend any excess amount, don't set off that surplus. No. Surplus is different. The excess amount is different. Any byproduct or profit you got in the project, that keep for that project. Excess amount spent means what? Total amount 600 plus 150 you spent extra. That is excess amount. The board shall pass a resolution for that effect. Pass a resolution that within next 3 years we are going to set off. If you do not pass resolution, you can't. So this itself, what if an excess amount is spent? That excess amount, whatever is spent, can be used to set off against a amount to be spent. Suppose this year 600 crore you are supposed to spend, 750 you spend, 150 you spend extra. Next year 500 only you have to spend. Set up 150. Only 350 you spend. That facility is there. That's it. Sir, as part of CSR, no, I bought one big mission, sir. Okay, can I buy a capital asset like this, fixed asset? Or entire expenditure should be revenue? You can have a capital asset also, provided it must be in the name of the company established under section 8 for the purpose of CSR. See, actually, there is a question called manner of implementation of CSR policy. Sir, how company should spend money? Can company spend directly? Yes, company can directly spend CSR, or through a company established. Form section 8 company separately. Okay, your company has formed another company. Suppose Reliance formed Reliance Foundation, Tata Group formed a Tata Foundation. Getting it? Okay, so there are some foundations. So form some section 8 company, transfer 600 crore to that section 8 company, and then spend through that company. All conditions apply. Or you can spend through another company which is established by government, or you can spend through any entity which is established by parliament, or you can spend through any company which is established, which is a section 8 company, which is registered society, registered under income tax law also, and which is already having established track record of 3 years. So with that company you spend. You create your own company, transfer to government owned company, transfer to parliament statute special entity, or transfer to another company which is already in existence for 3 years. So or spend in your name directly. Anyway you can spend. And suppose, sir, okay, I don't want to spend in my name, sir. I want to form section 8 company. What is the procedure? This is newly added 2021. Every entity which is intended to undertake CSR activity shall register itself with the central government by filing CSR1 electronically with effect from 1st April. Suppose, sir, I want to spend money in my name only, sir. You register for CSR registration. No, not in your name. Another section 8 company name. Some section 8 company you formed. Register that. Yeah, registration is compulsory for the company itself as well as for another company through which this company is spending money. CSR1 shall be signed and submitted electronically by the company, shall be verified by a chartered accountant. On submission of this form, unique registration number like corporate identification number, CSR registration number shall be generated. A company may engage into international, this is not required, and a company may also collaborate with other companies for undertaking projects, programs, or CSR activities, provided they need to report separately on the projects and programs. Like two companies, Infosys, Wipro together, developing some villages, locality, nearby villages, they can do together, they can do, provided they should maintain separate records for each of the expenditure spent. That's it. So manner of implementation of CSR policy. This itself can be asked as a 4 marks question. How a company can implement a CSR policy directly on its name, or through section 8 company incorporated by this company, or through or the company can spend through a company which is owned by government, or a body corporate or entity established by parliament, or a company which is already in existence for at least 3 years. Okay, and whether you spend directly on your own or through another company, all of them should have CSR unique registration number. What is the procedure? They should file CSR1 electronically. It should be signed and submitted electronically by the entity and certified by chartered accountant or company secretary or cost accountant or somebody. That's it. And write about CSR reporting. Okay, finally, fine, sir. We are liable for CSR expenditure. we formulated committee, we developed a policy, board of directors approved it and showed it on website. We spent 2% money, some money is unspent, we transferred as per the rules to unspent account, or some amount we directly transferred. If it is not ongoing project, we directly transfer to schedule 7. So much we did know with respect to CSR. Should we report all this in the financial statements? No. Put a separate report called CSR report. What is it called as? CSR report. There is a concept called CSR report. The board of directors report of a company shall include an annual report on CSR. So prepare an annual report on CSR. Okay. Suppose if it is a foreign company, whatever CSR report is there, please attach it to the financial statements. Please attach it to the financial statements. Further, okay, if a company is having CSR obligation of 10 crore or more in the three previous years, 10 crore or more, you are having CSR, you spent 10 crore or more. In that case, do impact assessment of every project where 1 crore or more is involved. In the last 3 years, you spent 10 crore or more approximately for CSR. Now you are having so many projects, no? 1 crore or more, whatever projects were there, no? Do impact assessment, whether the project is giving yield or not. Impact assessment report shall be placed before the board of directors and shall be attached with CSR report. A company undertaking impact assessment may book expenditure towards that, okay, which shall not exceed 5% of the. So impact assessment related expenditure, whatever is that can also be booked under CSR expenditure, which shall not exceed 5% of the total expenditure. I don't think impact assessment is also important, so not important from exam point of view. What are the activities covered under schedule 7? That is also not important from exam point of view. I think one of the attempts that they have asked it, but actually it is not important. I think in CMA or somewhere I remember, not in CA, okay, but it's not important at all. If possible, give single reading. What are the activities covered under schedule 7? And some important clarifications were given by MCA, that is not required. Out of that, 2 clarifications are important. Suppose if a company is carrying like events such as marathons, 10-kilometer marathon, award functions, charitable contribution, advertisement, sponsorship, they don't come under CSR. Sir, mine is a company, sir. It's an Indian company, but I have a foreign holding company. That company came to India and spent so much money, sir. Can I claim that money as a CSR expenditure of mine? Yes, sir. Expenditure incurred by foreign holding company for CSR activity in India will qualify as CSR for Indian subsidiary if that expenditure are routed through Indian subsidiary and if the Indian subsidiary is required to do so as per 135. If Indian subsidiary is liable for 135 and foreign company gave me the money and I spent that money for CSR activity, it is treated as I spent CSR. That's it. So these are the 2 points which are important. So remaining points are not that important. Okay, these are the 2 clarifications which are important. And with respect to COVID, they gave some clarifications, not required from exam point of view. It is not required at all. So with this CSR also we have completed close to 40 minutes. We discussed only on CSR. If possible, shall I just a small request, give once again, just listen whatever I told, then read these questions, then give a single reading of all these questions. Question number 17, 18. Yes, question number 17, 18, and 19. Duties of board, amount to be spent, and what is the manner of implementing the policy, how the company should spend, and after spending what they should report, and what activities company can spend upon, and clarifications given by MCA. Totally 17th question to 25th question is completely single section 135, one of the most complicated provision in this chapter. So we completed. I hope you thoroughly enjoyed until now CSR. So with this, CSR expenditure is also completed. So now again I'll come back to this one, our initial diagram. I'll come back to diagram. I hope our Sreshta students are also watching. Our Sreshta students are also watching this classes. So please read. So what are all we have completed? So 130 we completed, 131 we completed, 132 we completed, 135 we completed, 129 we completed. Now only small provisions are pending. 128, 129, 134, 136, 137, 138. Very small provisions. Okay, so we'll continue. So with this 135 is done. Remaining are actually Even if you read on your own, you can understand remaining provisions. Main important crux provisions I explained. That's it. Yeah, so let's continue. Section 135 is done, 132 is done, 130, 131, 129A is also done. So now let's discuss 136 and 137. Okay, these are also important from MCQ point of view, or they may ask a straight question. So what is section 136? So sending of the financial statements to members, nothing but right of members to copies of audited financial statements. How this will be circulated? First of all, what is the manner in which the financial statements first shall be circulated? How the financial statements shall be circulated? Okay, first I will, 136 talks about every member of a company have right to receive the financial statements. Okay, fine, I agree. How a company shall circulate? By electronic mode, where the shareholding is in demat format and mail IDs are registered with the depository. Suppose if you are holding shares in with a demat account, you will get electronically the financials. Suppose where the shareholding is held otherwise, not in demat form. Nowadays it is not possible. Only in private companies this might be there. Okay, so to such members who positively consented in writing for receiving by electronic mode. Suppose if at all he gave a consent that, oh, okay, I'm eligible, I'm ready to receive electronic mode to the company. Consent he has given. In that case, he can get electronically. If he has not given consent and shares are not in demat format, then you must dispatch physical copies through any recognized mode of delivery. So if a shareholder shares are not in demat format, you must dispatch them. Physical financial statements, audit report, board report, annual report shall be dispatched. By the way, to which companies this provision apply? Manner of circulation. It is applicable for all listed companies and public companies having net worth of 1 crore and turnover of 10 crore rupees. Public company having 1 crore and net worth of 10 crore. For them it is applicable and all listed. So what about private companies? Private companies no need to circulate the financial statements. It is enough if they keep the financial statements at the registered office, members can come and inspect. That's it. So that is a manner of circulation. So this itself can be asked as a straight question for 3 marks. Please keep a note. Now, first of all, okay, we understood how a company circulates the financial statements. Now, to whom a company shall circulate, when they shall circulate. Every company, Section 136 provides that a copy of the financial statements, including consolidated financials if applicable. Section 129 subsection 3 talks about consolidated financials. I'll come to that later, little while. So, an auditor's report and every other document, whatever is important required, they shall be laid before a company in the general meeting. Whatever is liable to be, kept in general meeting shall be sent to the following persons at least 21 days before. To whom? Every member, every trustee of the debenture holder, to all other persons, whoever is so entitled, whoever is eligible, nothing but simply whoever is eligible to receive notice of AGM. Notice of AGM, to all of them you must send the financial statements plus consolidated financials plus auditor's report plus board report and all the documents whatever is liable. Sir, can I send these financial statements for a period less than 21 days? I don't have time, sir. It's already financials are prepared late. We are conducting AGM little earlier. Notice also given at a short period. So the financials has to be sent for less than 21 days. I can't send more than 21 days before. Can I? Yes, provided 95% of the shareholders agree. 95% of the shareholders, 95% voting power related shareholders. Suppose if it is having share capital, not having share capital. No share capital, 95% of the voting power. Having share capital, who represent 95% of the paid up capital. Nothing but in both the cases, 95% voting power. If they give consent, okay, less than 21 days. If the copies of documents are sent less than 21 days before the date of meeting, it is valid only if shareholders given consent having 95% of the paid up capital. So if the company is not having paid up capital, share capital, then voting power 95%. This is not required. Now, further, for listed companies, there is additional condition. For listed companies, they have additional conditions. Sending 21 days before to members, that alone is not. They have additional conditions. What? The copies of the documents, they must be available for inspection at the registered office of the company during working hours for 21 days before the date of meeting. Before you conduct general meeting, 21 days before, keep all the financials at registered office. If anybody want to come and inspect, they can inspect. And a statement containing silent features, important features of the documents, okay, shall be sent to every member of the company and every trustee, okay, not less than 21 days before the meeting, unless shareholder asks for full financial statements. So in case of listed company, important features of the financials shall be sent to members, and entire set of the financials and documents can be kept at the registered office, shall be kept at the registered office for inspection. Further, not only that, listed companies, they shall publish on the website. Every listed company shall place the financials, consolidated financials, all the documents on the website. Further, if a company is having subsidiary, place a separate audited accounts in respect of each subsidiary on the listed company website. Provide a copy of audited, separate, audited or unaudited financials in respect of subsidiary to any member who asks for it. If a member is asking for subsidiary company's financial statements, whether they are audited or unaudited, doesn't matter, send him. Okay, so your financial statements and consolidated your standalone financials, consolidated financials, both place it on your website. And if any you have subsidiaries, subsidiary financial statements, place it on website. Some member is asking the financial statements to send him physically, send him. Take money from him, it's okay. Suppose, sir, I have a foreign subsidiary, sir, I'm a listed company Indian, but I'm having a foreign subsidiary, and that foreign subsidiary, it is preparing financial statements. That foreign subsidiary related financial statements also, should I put it on my website? Yes. Sir, they were unaudited, still put it on the website. Sir, they were in some other language, translate into English and then put it on the website. Sir, they were prepared in something different format, make it convert into your Indian format and then put it on the website. Simple. See, where a foreign subsidiary is required to prepare consolidated financials under the law of that country, the requirement of this provision shall be met. This provision, we assume it is okay if the consolidated financials is placed on the website of the company. Simple. Foreign subsidiary, their financials, keep it on your website. Their consolidated financial statements also, keep it on the website. That foreign company, holding company, will prepare some consolidated financials. Okay, that foreign subsidiary might have some subsidiary. Foreign company is having some subsidiary, so it is preparing consolidated financials, keep that also on the website. If the foreign company, nothing but, see, you are an Indian company, you are having a subsidiary company, this is situated in foreign, this is having subsidiary company, let us assume. So foreign company is preparing two sets of financials, standalone financials of foreign company, consolidated financials of foreign plus its subsidiary. Both you should keep on your website. Where some foreign company is not required to get the financial statements audit. Suppose there is no audit requirement in that country for that foreign company, and does not get the financial statements audited, then our Indian company may place unaudited financial statements on the website, and suppose if it is in other than English, translated copy of financials in English shall be mentioned. Sir, you are having a foreign subsidiary, it is preparing consolidated financial standalone, both keep it on the website. Sir, you are having a foreign subsidiary, it is not liable for audit at all. Audit, okay, keep that unaudited accounts. Sir, they are in other than English, translate them into English. Further, format of accounts of foreign subsidiary should be in accordance with the requirements under Companies Act. So in case if it is not possible, why it is not possible, just mention. If the foreign company accounts are very different, complete new terminology, different terminology, even if we mention in our Indian website, our shareholders may not understand. Convert them into our Indian GAAP and then publish. So generally what companies do, original foreign company financials they will give, and translated version both will be kept. That's it. You see here example, this is important. This itself can be asked as a 4 marks question. Reliance Industry Limited, a company incorporated under Companies Act, has its shares listed on a stock exchange. One of the subsidiary of Reliance is a foreign company incorporated outside. Okay, foreign subsidiary. In the AGM of the company, Reliance has placed its audited financial statements, including consolidated financials, on the website. Correct, no? In the AGM it is placed, even on the website it is placed. Reliance Industries has also placed on its website separate accounts of all its subsidiary located in India except one subsidiary, which is foreign company. Okay, all subsidiary company audited financials they mentioned in the website, but one foreign subsidiary they didn't put on the website, which is located outside India. Why? On the grounds that foreign company is not required to get it. What they are saying, one foreign company related financial statements, separate unaudited financial statements, they didn't put on the website. What are they claiming? Hey, they were not audited, so we didn't put that. Okay, so you are required to examine whether Reliance has complied, not complied. What is the duty? Website where foreign subsidiary is not required to get financials audited under any other law. The Indian company shall place the unaudited financials on the website, and where if it is in other than language, translated copy must be kept. See here. No, Reliance Industry not complied with the provision because it is required to place unaudited financials of foreign subsidiary if they were not audited, even if it is not required to get audit. That's it. So this and all is not required. Nidhi company point not required from exam point of view. So with this we understood manner of circulation and right to receive for the members. Okay, so it is not just sending the financials. So placing on the website is important. Keeping it for inspection is also important. Financial statement shall be kept for inspection at the registered office of the company at least 21 days before. And you must send copies to all the shareholders, members, debenture trustee, all the at least 21 days before. How? What mode? Electronic mode, demat shares. Suppose if it is not possible to send within 21 days, I mean at least 21 days time. Earlier you can't send. Less than that. Okay, send at least 14 days before. Send at least 10 days before. Get 95% shareholders approval. Then only you can do that. Then next. Okay, you sent financials, everything over. Members came to the AGM. Members came to the AGM. Okay, now once members, first of all, AGM might be conducted or AGM might not be conducted. Sir, AGM is not conducted, sir, but financial statements, everything is there. We didn't conduct AGM. What is the last date for the AGM? Identify. Yes, sir, identified, sir. 30th September. We identified as 30th September. Just a minute. We identified as 30th September. Just a minute. So, whatever financials were there, file them with registrar. Right now we are discussing section 137. 136 is over. 137 we are discussing. Filing of the financial statements with the registrar. Okay, you prepared financials, you sent to member, you kept it on website. What about ROC? You need to file the financial statements with ROC also. What is the time limit? Within what time I should file? I have not conducted AGM. Suppose identify what is the last date for conducting AGM. From the last date, within 30 days, file with the ROC. Sir, suppose I held AGM, sir. AGM conducted, sir. AGM conducted, sir. Then two situations. Are the financial statements adopted? Adopted means approved by the members. If the answer is yes, are the financial statements not adopted? Are the financial statements not adopted? Suppose, sir, the financial statements were not adopted by members, sir. Members did not approve the financials in the AGM. Where the financial statements are not adopted at AGM or adjourned AGM, such unadopted financials shall be filed with ROC within 30 days of that AGM. Okay, it's okay. They were not adopted. File it with ROC. The ROC shall take them as provisional financials till the financial statements filed after adoption. Once again, company will adjourn, make shareholders sit, adopt it, and then file once again. Until filing the adopted financials, unadopted financial statements will be taken as provisional. So if the financial statements are finally adopted in the adjourned AGMs, they shall be filed with ROC within 30 days of the adjourned AGM date with the fees, additional fee, whatever applicable. So very simple, sir. In AGM, their financials were not adopted, sir. Okay, within 30 days, file with ROC that they are not adopted. Keep it as provisional. Dear ROC, I urgent AGM. Once again, I will call shareholders. All of them will come, will approve the financials. Within 30 days, once again, I will file. Until then, take them as provisional. They are final. That's it. So this itself can be asked as a 4 marks question. Write about filing of the financial statements with ROC if the financial statements were not adopted at AGM. This itself can be asked as a 4 marks question. Write about filing of the financial statements if AGM is not held. Whatever we discussed, E point, this is B. E point can also be asked as a straight question. Hope you're able to understand. Accounts of companies is so lengthy chapter, I told no. Revision itself is taking this much time. Imagine the regular session. It will take at least 10 hours, regular class. Now, filing of the financials. Suppose financials are adopted. Generally, this is the most practical scenario. Financial statements not adopted, AGM not held, very rare cases. Now, financials are adopted. In that case, a copy of the financial statements, including consolidated financial statements, along with all the documents which are required to be attached to financials like audit report, board report, all that, shall be filed with registrar within 30 days of the date of AGM. Once AGM is complete, within 30 days. Now, every NBFC shall file financial statements with registrar and consolidated financial statements with registrar in some other format. Okay, so this actually second point is not required. First point is only important. And not only filing financial statements in particular format, AOC4 form, XBRL is also required for the following companies. The following companies shall file financial statements in XBRL format. What is XBRL format? You will understand in EIS subject group 2. So which companies they should file XBRL financials? All listed companies. And companies having paid up capital 5 crores or above, even though it is unlisted, 5 crores paid up capital is there, XBRL applicable. Sir, 5 crores not there, sir. I'm not a listed company, sir. Turnover 100 crore is there? Yes, sir. Applicable. Sir, turnover also not there, sir. But are you preparing Ind AS financial statements using Ind AS accounting standard? Yes, sir. Then also it is applicable. So this itself can be asked as a side question for 3 marks. What are the classes of companies that are liable to file financial statements in XBRL format, extended, extensible business reporting language format? Which companies shall file their financials using XBRL AOC 4? 4 categories of companies: listed companies, or companies with paid up capital 5 crore or more, or companies with turnover 100 crore or more, or companies which are liable to prepare financial statements using Ind AS rules. They're all liable to file XBRL. Which companies are exempted from XBRL rules? NBFC is exempted, housing finance company is exempted, company engaged in banking and insurance sector is exempted. So banking, insurance sector, they're all exempted. Next. And once filing of the financial statement is applicable, it is applicable forever. It is applicable forever. Even if the XBRL once applicable, it is applicable forever. A point is not required, B point you remember. The companies which filed financial statements under XBRL rules shall continue to file the financial statements under subrule 1, though they do not fall under. Once you filed XBRL, forever applicable. Later you unlisted, less than 5 crore, less than 100 crore, no Ind AS, that and all does not apply. So look at this example, read this example. So, sir, what about 1% company? Financials which are adopted by members with all the documents shall be filed within 180 days from the closure of the financial year. You shall file 1% company, not 30 days from AGM. 180 days from the closure of the financial year. Very important. MCQ. 1% company. What is the time limit for filing of the financial statement? 30 days from the end of the AGM. False. 180 days from the closure of the financial year. Very important observation. Now, sir, what about subsidiary companies' financials? Should we file them also? Yes. A company, along with its financial statements, attach accounts of the subsidiary which were incorporated even outside India, which do not have place of business in India. With respect to foreign subsidiary also, you have to file. Where foreign subsidiary is not required to audit. Okay, the holding in a company shall file unaudited accounts along with the declaration to the effect that they were translated. Even foreign subsidiary related accounts must be filed with ROC, even though they were unaudited. Further, format of accounts of foreign subsidiaries shall be as per the requirements of Companies Act. So here they have given a very clear example. Please solve this example. Please solve this example. Even at the end of this chapter, there are some practical questions. Please solve them. So what is a penalty for failure to comply with 137? We didn't file within 30 days. What is a penalty? So all that, that penalty related provision is also covered here. That's it. So I didn't take that much in-depth. 138 internal audit, that I will cover in the next chapter, audit and auditors. It is very easy. My internal audit question is very easy. 138 is very easy. Then I'll come to books of accounts, section 128 and 129. If we complete these two, this chapter is completed. 134 board report, director responsibility statement, authentication of board report, that is not that much important. Okay, 134. If possible, I will try to cover 134 also. So first of all, books of accounts. What are the provisions related to books of accounts? They should be maintained on accrual basis. They should be maintained under double entry system. What do you mean by books of accounts? What books of accounts definition include? This can be asked for 2 marks or 4 marks or 3 marks. For any weightage they can ask. What is the place at which books of accounts shall be kept? This is important from exam point of view. Books of accounts, every company shall prepare and keep books of accounts at registered office only. Sir, I know I want to keep at corporate office, sir. Our registered office is a very small, small, flat. But we took a very big corporate office. That is not registered office. This is registered office is this one. That is corporate office. Can I keep there? Yes, sir. Provided all or any of the books of accounts may be kept at such other place in India only if board of directors decide. Where such a decision is taken by board, the company shall within 7 days file with registrar giving full address of that place. If books of accounts are kept at some other place, inform ROC within 7 days. Simple. Sir, what about branch related books of accounts? Keep at branch itself. That's okay. Need not bring to registered office. Sir, what about foreign branches? Suppose, okay, if any books of accounts are maintained outside India, they shall be sent to registered office at a quarterly interval. Foreign branches related books summary shall be obtained. The summarized returns of the books of accounts of the company kept and maintained outside India, that is foreign branches, shall be sent to registered office on a quarterly interval, which shall be kept and maintained at the register of the company, and it is open for inspection. Okay, sir. Understood about keeping books of accounts. Sir, these books of accounts can be inspected by any director? Yes, during business hours. Sir, what about subsidiary company books of accounts? Can they be inspected by board of directors? Yes, a person can inspect subsidiary related company books of accounts provided board of directors resolution shall be necessary. Now, this point is not required. Sir, a director want to get some financial information, sir, but that information is there outside India, sir. How should he get? Where any other financial information which is maintained outside India is required by any director. A director requires some information, but that information is available outside India. The director first file a request with the company. What are the details of information you want? For which period related information you want? First file a application with the company. The company shall give that information to the director within 15 days of the receipt. The director can get information only personally, individually. He can go and ask personally. I cannot send my agent to go and ask for foreign information. Not by attorney, holder, agent or representative with respect to financial information maintained outside the country. So if the company is maintaining some financial information outside India, a director can request that information by putting a specific application and mentioning what details you want, which period related information you want, and company shall send that information to the director within 15 days. Director shall make this request personally, not through agent. This itself can be asked as a 3 marks question. Write about financial information maintained outside India being requested by a director. 3 marks question they can ask. So this is the answer. Sir, for how many years books of accounts shall be kept? 8 years, sir. Okay, the books of accounts together, vouchers, whatever it is, it shall be preserved for at least not less than 8 years immediately preceding the previous year. So right now we are in 22-23. As on today, how many years books of accounts will be there? 21-22 and before 7 years. So okay, so 22-23 before 8 years means what? 21-22, 20-21, 19-20, 18-19, 17-18, 16-17, 15-16, 14-15. These books of accounts I should compulsorily keep even in 22-23. Suppose if any investigation is ordered, government passed an order that you should keep for more than 8 years, don't discard. Okay, you should not dismantle or discard books. If at all, you have to maintain for more than 8 years. And who are the persons liable for maintaining the books of accounts? These are the persons. These are the persons. And what is the penalty for contravention is given here. Sir, can a company maintain books of accounts in electronic format? Yes, absolutely. Books and papers can be maintained in electronic format, shall be accessible in India and usable for later reference. Compulsory. These are the guidelines. Okay, further, the books of accounts which are maintained in electronic format shall have an audit trial feature with effect from 1st April 2022. What is audit trial feature? See, suppose audit trial means it shall have a log. It shall have a log record. Today you entered one transaction. Later you opened this transaction and changed something, narration or something. In audit trial log, it will record original transaction, second version, third version, fourth version, like that every version will be recorded. So that is called audit trail. So the electronic software should provide audit trail feature. Further, entire books of accounts must be kept in original format only. No change, vouchers, everything, they should be kept as it is. Whatever information that you are receiving from branches, don't alter. Original information, keep it as it is. Further, whatever information you are keeping in electronic form should be displayed in legible format. Further, there should be a storage retrieval display, print out all electronic record, whatever as audit committee, board of directors, whatever they want. And suppose if at all the electronic information, books of accounts are kept outside India server, compulsorily, periodically, they must be brought back to India and keep it in a server located in India. And inform the ROC who is the service provider, SAP, Italy, what is the IP address, where he is located, and what are the books that are maintained on cloud. So all that you need to file with ROC. Then write about definition and concept of financial statements under Companies Act. This you can definitely read on your own. In this entire thing, no, exemption from preparation of consolidated financial statements is an important question. Which companies are exempted from preparing consolidated financial statements? This is important. Remaining are not that important. Question number 5. Second point is not required. Question number 5. First point is important. First point is important. Or even second point also you can keep. First and second point. Question number 5. Write about concept of financial year under Companies Act. This is very easy, ma. That's why I'm not repeating. And every company shall prepare financial statements. Financial statements include balance sheet, P&L, cash flow, statement of changes in equity, and notes. One-person company, small company, and a private company if it is a startup, they are exempted from cash flow statement. One person, small company, private company if it is a startup. What is a startup company? It's a company in accordance with Commerce and Industry Board. It is recognized as startup, that is exempted. And see, this exemption from cash flow is available only when the exception, modification, whatever is applicable to private company, only if it is not committed in default in filing 137 or annual return under 92. Only if that private company did not default under 92, did not default under 137, only then this exemption is applicable. That's it. Now financial statements shall be prepared as per Schedule 3 accounting standard, and they shall be true and fair view. Companies engaged in defense production, they are exempted from segment reporting. So that's it. So with this 128, 129 is also completed. Only thing what we kept is 134, authentication of financial statements by board of directors. Authentication of financial statements by board of directors. It's very easy, ma. Just you can have a look. Authentication of financial statements by board of directors. Give single reading of question number 14. Single reading. Question number 14. Authentication of financial statements. Actually, first we have given snapshot, not that important. So what are they saying here? Let me just give at a glance. The financial statements, including consolidated, shall be approved by board of directors before they signed on behalf of the board. Okay, so who shall approve? At least chairperson of the company if is authorized by the board, or two directors, out of which one must be managing director if available, and CEO must signed, must sign it, CFO must sign it, and secretary must sign it. What if it is a one-person company, only one director, he shall sign it. Audit report shall be attached to every financial statement. A signed copy of the financial statements and consolidated shall be circulated, published along with notes, audit report, board report. I told you 136 manner of circulation, all that. So they have given an example, so please go through that. Write about board of directors report and contents therein. For all companies, board report format is rule 8. For one person company, the board report format is rule 8A. For one person company, the format of board report is rule 8A. That's it. 8A is applicable. Okay. Abridged board report. So abridged board report is applicable for one person company and a small company. So what are the contents of the board of directors report? What are the contents of the board of directors? There are so many points were there. Any 5 points you can remember. Any 5 points. Contents of board report. And board report shall contain responsibility statement. Board report shall contain responsibility statement. That is question number 16. This is also asked once in company law. Director responsibility statement. Write about director responsibility statement. 4 marks question can come. This question number 16 is also important. What is the direct responsibility for preparation and presentation of financial statements on going concern basis, for maintaining accounting policies consistently? See, in preparation of annual accounts, applicable standards have been followed, and director selected and applied accounting policies consistently, and accounting estimates are reasonable, and they give true and fair view. This is completely auditing terminology. The director had taken proper care for maintenance of accounting records. The director prepared annual accounts on a going concern basis. The director, in case of listed company, has laid internal financial controls for ensuring these. Okay, actually, the directors had laid down IFC to be followed by the company, and they are adequately followed and operating effectively. This is enough. Actually, this point is not required. And finally, the director put proper system to ensure compliance with laws and regulations. Totally 6 points. Actually, these 6 points are covered in internal control objectives in auditing. Management is responsible for preparation of financial statements on going concern basis. Management is responsible for preparation of financial statements in compliance with accounting standards. Management is responsible for, this one. For management is responsible to lay down internal financial controls. Management is responsible to comply with laws and regulations. This is completely audit related stuff. So with this 134, everything has been discussed. Mainly in this chapter, what I told you, 129A, 130, 131, 132, 135, 136, 137. These are important provisions. 128, 129, 134, jujube, not that important. Dividend we discussed thoroughly. Accounts of companies we discussed thoroughly. Approximately both these two chapters together, 12 to 15 marks weightage in company law. And you know what? The next chapter that we are going to discuss is audit and auditors. Just a minute. The next chapter that we are going to discuss is audit and auditors. You know what? Audit and auditors. Actually, I did one marathon in last year, May 2021, revision. CA Inter Audit. You know, many students at Group 1 company law, they ignore this chapter. December 21 attempt and July paper attempt, 4 to 6 marks question came from this chapter 2 times. Even last attempt also not even 4, I think 8 marks question came from this chapter. Every attempt minimum 4 marks will come pakka from this chapter, and most of the students of company law ignore this chapter. Please don't ignore. So I'm giving you my audit marathon related recording for this. In audit we call it as company audit, so that recording we are giving. Now that recording which I'm giving, in that 2 points there is an amendment now. There is an amendment now for 2 points. Okay, one point is when it come there, just make a note right now. Resignation of auditor, the resignation of auditor, there is an amendment. The maximum penalty for resignation of auditor is 2 lakhs. In that particular revision, no, continuation, you're watching continuation, no, audit, company audit chapter, nothing but audit and auditors. There, I might have told 5 lakhs maximum penalty. Now it is only 2 lakhs. That's the only amendment, major amendment. Okay, so watch the continuation revision, which I did for CA Inter Audit. Okay, so company audit, so that revision I'm merging along with this. Anyhow, you're seeing, another 2 hours is there, another 2.5 hours video is there. Okay, so that 2 hours video is company audit inter recording. Please watch it for sure, don't miss it. That's it.
The next topic of revision is share capital and debentures. A very lengthy chapter, very big chapter. You can expect some 8 to 12 marks from this chapter. So share capital and debentures. As you all know, company can mobilize funds through issue of securities. Primarily under this chapter, I am going to categorize those securities into 2 types, shares and debentures. So debenture related provisions we will study under section 71, and then with respect to share capital we are going to cover from section 43 to section 70. So from this topic you can expect a question from either from buyback or bonus issue, or issue of preference shares, issue of issue of equity shares with the differential rights. Prima facie, these four topics are very important. So buyback, every 3 attempts you can see 2 times buyback question will be there. Next one, bonus issue. Next one, preference shares, as well as equity shares with the differential rights. Sometimes securities premium question was asked, and then rights issue. There was a question on rights issue. Okay, let's start the discussion. First one is types of share capital. First of all, you all know share means share in the share capital of the company, and it includes stock. So stock is nothing but bundle of shares. A transferability point of view, stock is preferable, but at present in the demat form of securities you can't see this stock. In olden days stock concept is very popular. So transferability point of view, you can transfer 0.1 stock, 0.2 stock, that means stock can be transferred in fractions, whereas shares will be transferred only on lot system, lot basis. Fine. So share means share in the share capital of the company. We had 2 types of share capital, not 3, only 2. One is equity, the other one is preference. So equity share capital means share capital which is not preference share capital. And coming to preference share capital, earlier we had only one definition, but we had 2 definitions for preference share capital. One is any share capital which carry preferential rights with respect to payment of dividend and with respect to repayment of capital. So when compared to equity share capital, any share capital which is carrying preferential rights with respect to one, payment of dividend, the other one is with respect to repayment of capital in the event of liquidation. So these benefits, these preferential rights, if any share capital is having, that share capital is preference share capital. And the latest one, recently added point, that is, even though these 2 benefits are not there, even though these 2 priorities, 2 preferences, suppose payment of dividend, repayment of capital, preference is not there, but still if any share capital which is having participatory rights along with equity shareholders. So preference share capital means any share capital which carry 2 preferential rights. One is payment of dividend, and the second one is repayment of capital compared to equity share capital. And then any share capital with participation rights, participation with respect to distribution of surplus or dividends and distribution of surplus in the event of liquidation, that share capital is also treated as preference share capital. Now next one, yes, write about equity shares with differential rights. Equity shares with differential rights. Here, these differential rights are of 2 types: superior voting rights and then fractional voting rights. So what is meant by differential rights? Generally, one share can give you 1 vote and equal priority with respect to dividend, equal dividend simply. So each and every share will give you equal voting. So 1 lakh shares are there, 1 lakh votes will be there. If all these 1 lakh shares are fully paid up, and repeat, if they are fully paid up, then each and every share will carry 1 vote. But if one share is having more than 1 vote, they are nothing but superior voting rights. Or if one share is having less than 1 vote, for example 10 shares can give you 1 vote, 10 shares can give you 1 vote, such kind of shares are fractional voting rights. So if one share is not giving you 1 vote, that is nothing but differential. They are not equal, they are not equal, they are differential in nature. So differential rights are of 2 types: superior voting rights, fractional voting rights. Now the point is, for issue of equity shares with the differential rights, what are the conditions to be satisfied? What are the conditions to be satisfied? So conditions for issue of equity shares with the differential rights. For this, the first condition, AOA authorization. Check whether articles permit issue of differential rights or not. If articles permit, then you can offer equity shares with differential rights, or else amend the AOA. Simply alter the AOA under section 14 by passing special resolution. File the altered AOA with ROC. ROC shall register the same and issue the certificate. Next one, ordinary resolution from members. Ordinary resolution from members. So if equity shares were listed on a recognized stock exchange, then this ordinary resolution shall be passed through postal ballot. This is one mode of conducting a voting. Fine. So once you get members approval, you can proceed. But there are some more conditions you need to satisfy. That is maximum limit. Maximum limit. You can issue differential rights subject to a limit. What is that limit, sir? The voting power from differential rights. I repeat, voting power from differential right. It should not exceed 74% of total voting power. Total voting power post issue of differential rights. Post issue of differential rights. So out of total voting power of the company, maximum 74%, differential rights can present. So voting power from differential rights shall not exceed 74% of total voting power of the company. So these are normal conditions. And next one, conversion is not possible. Conversion of normal rights to differential rights, differential rights to normal rights is not possible. And you need to maintain a separate register. You need to highlight them, or you need to differentiate the members in registers which you maintain under section 88. So you need to differentiate, the persons who are holding differential rights, you need to differentiate them. Next one, they will carry same privileges. That means whatever normal right holders are getting, dividends or bonus shares or right shares, these people will also get, but subject to their rights. And one more important point, that is, default. Very important to remember, almost some 16-17 defaults were prescribed. The company should not possess following defaults. That means only a company which is regular in complying Companies Act 2013, which is simply active complaint. Only a company which is complying all the applicable provisions, only that company can offer equity shares with differential rights. So the company should not have following defaults. For better understanding as well as for remembering these defaults, I categorize these defaults into two types. Subsisting defaults. The company should not have these defaults at the time of issue of equity shares with differential rights. So no subsisting defaults. The other one is no defaults, but I categorize them as time, with respect to time. So you should not have the following defaults, time defaults. Under subsisting defaults, I categorize 4 defaults. One is failure to redeem preference share capital and dividend thereon. Failure to redeem, simply default in redemption of debentures and interest thereon. Failure to repay deposits and failure to pay interest on deposits. Then failure to pay dividends to equity shareholders, declared dividends, failure to pay declared dividends. Understood? Next one, following, company should not have following time defaults. Here I categorize these time defaults into two types. 3 years. Last 3 years, company should not have, last 3 years, company should not default in the following aspects. One is with respect to ROC filings. Every year company has to file 2 forms with ROC. One is, financial statements AOC 4, annual returns MGT 7. So last 3 years company should not commit any default with respect to ROC filings. And last 3 years company should not be penalized. Under regulatory sectors. Like RBI, FEMA, SEBI, and Securities Contract Regulation Act and other regulatory sectors as may be prescribed. So the company should not be penalized under regulatory sectors during the last 3 years. Now coming to one more topic, that is 5 years cooling period. 5 years cooling period. So if company commit any of the default with respect to following areas, after rectification, company should wait for 5 years. After rectification, ignore that year and wait for 5 years. That means after rectification, you can't issue equity shares with the differential rights during the next 5 years. Understood? So what are those defaults, sir? What are those defaults? Term loan which you borrow from banks or financial institutions. So term loan, repayment of term loan and interest thereon. Next up, failure to pay preference dividend. Failure to pay preference dividend and failure to transfer monies to investor education and protection fund. Failure to transfer monies to money or shares, whatever it might be, to investor education and protection fund. So subsisting default means at the time of issue of equity shares, you should not possess these defaults. 3 years means last 3 years company should not possess these defaults. 5 years concept means once default happened, you rectify them. After rectification, wait for 5 years and then you can issue equity shares with differential rights. So very important to remember these defaults, ma'am. Already it's there in material also. So AOA approval is must. Unlisted companies, okay, ordinary resolution. Listed company, same ordinary resolution, but postal ballot concept is applicable. Max 74% of voting power, and it should be regular filer with ROC. That's what I told you. It has not defaulted in filing ROC returns, last 3 financial years, and no defaults with respect to deposits, preference capital, debenture, interest, dividends, term loans, and employee statutory dues, IEPF dues. If you are writing the notes, at this point also, employee statutory dues. So upon rectification, wait for 5 years. That is last point. This is last category. Whereas these points, last 3 years don't possess these defaults. Subsisting default means okay, default is there, no problem. You rectify them and immediately you can offer equity shares with differential rights. Understood? Now if default is made good, wait for 5 years. That is applicable only with respect to term loans, preference dividend, employee statutory dues, and then IEPF dues. Only to those 4 points, 5 years concept is there. And it should not be penalized under the regulatory sectors, already gave in the notes. Next one, conversion is not possible, and they had all rights similar to normal rights. They carry same privileges when compared with equity shares with normal rights, but the only difference is voting or dividend. Maybe they will get high voting with less dividend or low voting with high dividend. That is the only differentiation factor. Remaining rest of the things are same. Okay, that means equity shareholders with normal rights, they will get bonus shares. These people will also get bonus shares. Right shares, but similar shares. If I'm holding normal share, I'll get normal share under bonus or rights. If you are holding differential rights, then under bonus share or under rights issue, you will get same security. You will get similar security. Next, disclosures in the register of members, disclosures in the board report. Very simple concept, ma'am. Even though it is lengthy, you can remember quickly and you can revise it quickly. So I think hardly I took some 8 minutes to explain this topic, right? Okay. Next one, section 46, share certificate to be a proof of shares held. So share certificate, this is all about share certificate. At present, due to latest amendments, all unlisted companies, unlisted public companies, already listed companies, their securities are in demat form. Coming to unlisted public company, there is a rule that they should convert all their physical securities, all their material securities into demat form of securities. So only private companies are left with, holding shares in material form. For them, this section is applicable. So what about this section? Issue of share certificate. The moment you become member of the company, you'll get share certificate within 2 months, within 2 months of allotment, or within 2 months of incorporation. In case of transfer transmission case, within 1 month from the submission of documents with the company. So now the point is, allottee or transferee will get share certificate. That share certificate is valid only if it contains certain points. What are those points? Are it should be distinctively numbered, as it is already there. It should be distinctively numbered. So next one, it should be under common seal of the company. If common seal is there, common seal, you need to affix common seal. If there is no common seal, then it should be signed by 2 directors. In case company having secretary, then 1 director and 1 secretary. I'm telling you, if common seal is there, you need to fix common seal and director signature continued. If there is no common seal, then 2 directors. If company is having secretary, 1 director plus 1 secretary should sign the share certificate, or else that share certificate is invalid. It is simply document showing title. Understood? So whose name appears on the share certificate and the number of shares appeared on the share certificate, yes, that fellow is owner with respect to that many shares. Suppose if original share certificate is lost, you can apply for duplicate share certificate. For that, you need to submit prescribed documents. But remember, whatever the provisions under section 46 are there, they are not applicable to the shares which were held in demat form. For example, in demat form of security, you can't see signatures of the directors, you can't see common seal, and you can't see distinctive number. For example, I'm having 2000 rupees. I can show you. On that, you can see a serial number, a distinctive serial number. Right? On that, you can see RBI governor signature. But if the same 2000 rupees is there in my bank account, can I tell you the denomination? Can I tell you the serial number of currency? Can I tell you whether the signature of RBI governor is present or not? No. So these norms are not applicable when money was held in bank account. Similarly, when shares are held in demat account, the provisions of signing, the provisions of distinctive numbering are not applicable. But remember, my dear students, in case company makes fraud with respect to issue of duplicate share certificate, without proper application, without proper documents, if company issue duplicate share certificate, then officer in default is going to get punished under section 447. Officer in default is going to get punishment under section 447. But company, the punishment to company, understand clearly, minimum 5 times of the face value of shares involved in the duplicate certificate, but it may extend to 10 times or 10 crores, whichever is higher. Don't get confused with 3 limits. I'll write here minimum punishment in case of defraud. Minimum 5 times of face value of securities involved. Face value of shares involved. Okay, face value of shares involved in the duplicate. Maximum 10 times of face value or 10 crores, whichever is higher. For example, the shares involved in duplicate issue, and where company issued them with an intent to defraud is some around 50 lakhs. Imagine 50 lakhs. Then minimum punishment is 5 times of 50 lakhs. That means 2.5 crore. Maximum how much ma? 10 times of 50 lakhs. 10 times of 50 lakhs, that is 5 crores or 10 crores, whichever is higher, that is 10 crores. So minimum 2.5 crore, maximum 10 crores. The frequency is the length, the punishment is minimum 2.5 crore, maximum 10 crores. Officer in default is already punished, he is already liable under section 447. Next one, 47, it is all about voting rights. See ma, nowadays, a person will take shares because of only 2 things. Either dividend income, simply, gain he is getting from investment, or voting point of view. So promoters always concentrate on voting, whereas, small investors will always concentrate on the profits of the company, right? But, each and every shareholder is entitled to have voting rights. If you are holding equity share, if you are holding a equity share, you will carry that equity share capital will carry voting rights, and you will automatically get voting rights. Sir, how much voting rights, sir? It depends upon the proportionate of paid up share capital. What is the total paid up share capital? In that total paid up share capital, how much you are holding? What is the percentage of your holding in the total paid up share capital? Sir, total paid up share capital 100 crores, sir. In that I am holding 25 crores, sir. That means your voting power is 25%. Sir, I am holding only 1 crore, sir. My voting percentage is 1 crore. Understood? So in total paid up share capital, how much you are holding, how much paid up share capital you are holding, how much paid up share capital you are holding, that is your voting power. Understood, my dear students? So this is with respect to poll. Modes of voting, there is a poll concept, postal ballot concept, show of hands concept, electronic voting concept. These four types of voting you can study under management and administration chapter. But the point is, in case of poll, proportionate voting power is given. Whereas show of hands, each and every member is entitled to one vote, irrespective of holding number of shares. Suppose under show of hands, I'm holding 1 million shares, you are holding 1 share. I'll be given 1 vote, you'll be given 1 vote. So each and every person will have 1 vote under show of hands. Whereas under poll, person will have voting rights proportion to the total paid up share capital. His holding in the total paid up share capital. That proportionate, he will have voting power. And there is a point, for Nidhi companies, special point for Nidhi companies, to eliminate a dominant position. Suppose if you are holding 20% of paid up share capital, you will get only 5% voting power. You won't get 20% voting power. This is simply to avoid concentration of power with few people. Next one, preference share capital. Sir, preference share capital holders, will they get voting power? With respect to general meeting, no, ma. With respect to general meeting, no. But they have voting power with respect to the matters affecting their rights. With respect to the matters affecting their rights. Suppose initially I offered 10% preference shares, 10% preference share capital. Now company want to decrease this 10% to 9%. Now whose right is getting affected? Preference shareholders. Now preference shareholders consent is required. I repeat, preference shareholders consent is required for reducing the dividend from 10% to 9%. Next one, any resolution for winding up of the company. Next one, for reduction of share capital. So with respect to these 3 matters, preference shareholders will get voting rights. And there is an exceptional circumstance, that is 2 or more years. Consecutive 2 or more years, if preference dividend is not paid. I repeat, if preference dividend remains unpaid for a period 2 or more years, then they will also get voting rights in addition to equity shareholders. That means they are also entitled to attend general meeting. In that general meeting, along with equity shareholders, preference shareholders will also get voting power. How much voting power, sir? Proportion of total paid up share capital. Suppose my equity share capital is 10 crores. Preference share capital is 5 crores. So total paid up share capital 15 crores. Suppose Mr. X is holding 1.5 crore, 3 crores. Mr. X is holding 3 crores equity share capital. 3 crores equity share capital. Suppose if preference dividends were paid on timely basis, now Mr. X will get 30% voting power. How much? 30%. How, sir? 3 out of 10. 3 crores by 10 crores, X will get 30% voting power. Understood? Whereas, just if preference dividend remain unpaid, preference dividends are not paid, then X voting power is not 30%, it is 20%. How? 3 out of 15 crores. Total paid up share capital, including preference share capital, you need to take basis. You need to take it as basis, and you're holding in the total capital, you'll get a voting power. Understood, ma? Only if equity shareholders are having voting power, then X voting power is 30%. Preference shareholders also got voting power because of non-payment of dividend. Then X voting power is 20%, 3 by 15. Next one, section 47 applicability in case of private company, it is different. Private company, you need to see AOA, Articles of Association of the company. If AOA is silent, then section 47 is applicable. But if AOA of a private company provides something else, like, in any case, preference shareholders won't get voting rights. In any case, preference shareholders are not going to get any voting rights. In that case, preference shareholders won't get any dividend even if their dividend remains unpaid for 10 years, 15 years, 20 years, 25 years. Getting my point, students? But this privilege is available to private company only if they are regular in filing financial statements, annual returns with ROC. If they are regular with filing annual returns and financial statements with ROC, then such private company can take these privileges. Next one, variation of rights of shareholders under section 48 of the Companies Act 2013. I'll take one small example to explain this concept. So this section 48 is available only if company had issued different classes of shares. If company issued only one class of share, then this section is not applicable. Because for variation of one class, this section is not applicable. The general meeting is sufficient. Annual general meeting is sufficient. So here, we are going to conduct class meeting. In that class meeting, the persons who are holding particular class of shares, they will attend and they need to give approval. Suppose company issued equity shares with normal rights, company issued equity shares with differential rights, company issued preference shares. Two or more class of shares were involved. Now, if company wants to change, rights of one particular class, if company wants to change rights of one particular class, then only this section is applicable. Understood, ma? For the time being, company issued 10% preference shares, 10% preference share capital, rupees 60 crores. That means every year, at the end of the year, company should pay dividend of how much, ma? 6 crores. 6 crores. Now company wants to reduce this 10% to 8% because of COVID pandemic. Company is not in a position to generate adequate profits. They want to cut the profits from 10%. Sorry, they want to cut the dividend from 10% to 8%. Is it possible, sir? Yes. But for this, a class meeting should be called for. And then out of the 60 crores, 3/4 people, 3/4 of the, it's not 3/4 of the people, 3/4 of 60 crores, that means how much? 45 crores. If you are passing, resolution through postal ballot, then holders, persons holding 45 crore paid up share capital should give consent in favor of variation. No, sir, I can call meeting, sir. In that case, special resolution is sufficient. If you are able to call meeting, special resolution is sufficient. Or if you want to take consent through postal ballot, then 3/4 consent is required, 3/4 of the issued clause. But before conducting meeting or before conducting voting, you need to check whether your constitutional documents allow such change or not, whether MOA AOA permits the variation or not. If MOA AOA is silent, then check the issue terms. For getting this money, for issuing these shares, you might have offered prospectus or you might have offered private placement document. Open the document, check whether variation is prohibited or not prohibited. Suppose variation is not prohibited. Now you can proceed with variation. First one, check MOA AOA. If MOA AOA is providing, if it is giving power of variation, then vary the terms. If it is not providing variation, in that case, check issue terms. If issue terms, no variation is not prohibited, then proceed. How to proceed, sir? Simply take consent of 3/4 of the class of shareholders. 3/4 of the class capital shareholders. And one more point, my dear students, if change of one particular class, changing the rights of one particular class is having effect on other class of shareholders. I want to change rights of equity shareholders with differential rights. Because of this, if normal right holders getting affected, if the other class shareholders are getting affected, then you need to take consent from both the classes. So you need to take consent from two classes of shareholders. Okay, if you get consent, then you can proceed with variation. However, there is a right to the dissenting shareholders. Sir, who are the dissenting shareholders? Dissenting shareholders are one who cast vote against to the variation. Suppose we don't want that variation, sir. We need 10% dividend. We are not okay with 8%. So we call them as dissenting shareholders. So dissenting shareholders are having a power to file a petition with NCLT provided two conditions to be satisfied. One is they should be minimum 10% of the class capital. That means these dissenting shareholders should hold at least 6 crores. Out of 60 crores, 10% means 6 crores. 6 crores capital they should hold, first one. Second one, they should file a petition with NCLT within 21 days. How many days? 21 days from the date of consent. Now now the ball is in the court of NCLT. So NCLT can declare whether to approve the variation. Suppose if that variation is prejudicial, if it is having negative impact, they will reverse the variation, or else they may allow the variation. Whatever NCLT is giving, whatever the order NCLT is giving, company has to file that NCLT order with ROC within 30 days. So file a copy of NCLT order with ROC within 30 days. If you make any default, then following punishment is applicable. And you need to check amendments with respect to punishments. So those all part you can find under separate video. So you can get all those points under separate video. But variation, only 5 points are very important. So whether constitutional documents permit or not, whether issue terms permit or not. Next, consent, how much consent is required, powers of dissenting shareholders, and then NCLT order is final, filing NCLT order with ROC. These 5 points, if you remember, you can answer this question easily. Next one, very, very small topics, section 49 to 54. 49 is all about, calls on shares. So who is having power to make calls on shares? Board of directors. So if a single director, say for suppose managing director issuing notice calling for making for calls on shares. No, is making calls on shares. Single director issuing notice, that is null and void, simply void ab initio. Board resolution is important, and that board resolution should cover 2 points, call amount, and then next one, time limit for payment of call amount. Under SEBI regulations, for listed companies, so they need to convert partly paid up into fully paid up by making calls on shares within 12 months from the date of issue. Of course, that is not part of our syllabus. Just ignore. For your academic knowledge, I'm telling you. So within 12 months, or every listed company, within 12 months from date of issue, they need to convert into fully paid up by making calls on shares. So normally, for getting funds, board of directors can make calls on shares. That call amount should be on uniform basis. That means, with respect to particular class, that call amount should be equal. You can't fix, 2 rupees from 10 shareholders, and 1 rupee from 5 shareholders, half rupee from 50 shareholders. You can't fix like this. Uniform basis, fixed amount. It should be same for all the members holding that particular class. Understood? Next one, calls in advance. If any member want if he want to pay something extra, then call money. Can company accept that amount or not? Suppose if a member is ready to deposit extra amount, more than call amount, can he deposit, sir? Can company accept it, sir? The only condition is articles of association. Check whether AOA permits or not. If your AOA is permitting calls in advance, then accept the calls in advance. But for calls in advance, company has to pay interest on the calls in advance subject to AOA provisions. Understood? And this calls in advance, this is not a part of capital. This will be shown under liabilities. This will form part of capital only when company make calls on shares subsequently. So since this is not a capital, this is a liability to the company, here you won't get any extra voting rights. Here you won't get any extra dividends. Understood? No extra voting rights with respect to calls in advance, because just now I told you, voting depends upon total paid up share capital. So calls in advance is not part of paid up share capital. Are you all getting my point, students? So you won't get any extra voting rights with respect to calls in advance. And then proportionate dividend. Here you understand this word, subject to AOA. Subject to AOA. Generally, whenever you see the news, company Reliance Industry declared 60% dividend, 70% dividend. Sir, that 70%, 60% on what, sir? On face value. On face value. Forget about whether it is partly paid up or fully paid up. So whenever you heard about 70% dividend, 80% dividend, that percentage you need to apply on face value. But if company wants to pay, if company wants to apply that percent on paid up capital, 70% on paid up value, not on face value, that point should be disclosed in AOA. If company is authorized by AOA, then only company can pay dividend on paid up capital. Understood, ma? Understood. So if AOA is silent, then you will get dividend on face value. That means both on paid up value as well as calls in advance. Sometimes if there is no calls in advance, then also you will get dividends. I'll tell you one example. Suppose face value 10 rupee, paid up value 6 rupee. Paid up value 6 rupee. If AOA permits, then company will pay dividend on paid up value. If AOA is silent, then company has to pay dividend on face value. That is the only point. Next one. Write about issue of shares at premium under section 52. Students, remember that there is no condition in Companies Act with respect to issue of shares at premium. There is no condition on the company to issue shares at a premium. So it is completely at the discretion of company. So company can issue shares at premium or at par. How much premium? There is no that restriction also. You can't find restriction in Companies Act. Premium should be 200% of face value. Premium should be 300% of face value. There is no such restriction. Company is free to fix premium. And even if AOA is silent, company can fix premium amount. But section 52 is placing only conditions with respect to utilization of securities premium. Utilization of security premium. So how you are going to utilize securities premium? That's the only condition kept under section 52. So all companies can utilize security premium for 5 purposes. One is bonus shares, bonus for issue of bonus shares, or writing of preliminary expenses, issue related expenses, which might be commission or discount, whatever it might be, and premium payable on redemption, as well as buyback of shares. You can utilize security premium for 5 purposes. But if you are a company where you are following accounting standards in presentation of financial statements, so for preparation of financial statements, if you are following accounting standards, then you can utilize security premium only for 3 purposes. One is buyback, next one issue related expenses, next one bonus shares, bonus issue. That means writing of preliminary expenses, premium payable on redemption, these two are not available for the companies which prepare financial statements based on accounting standards. Suppose if you utilize security premium for a purpose other than stated purpose, other than permitted purpose, in that case you can't reduce the amount of security premium. You need to reduce share capital amount. In that case, reduction of share capital provisions will apply. I repeat, reduction of share capital provisions will apply. Understood? Next one. So with this, section 52, issue of shares at premium also completed. 53, issue of shares at discount. So can a company issue shares at discount? Obviously no. If company issues shares at discount, it is void. Company has to return the money and company has to take back these shares. In addition to that, company need to pay interest on that money it received under issue of shares at discount. Plus company has to pay penalty also. Penalty, how much, sir? Amount involved in the issue of shares at discount or 5 lakhs, whichever is less. Issue at discount amount involved in the issue, or rupees 5 lakhs, whichever is less. And I told you need to refund all the money along with interest at the rate of 12% per annum. Understood, my dear students? But there are two exceptions to this general rule. General rule, you can't issue shares at discount. Exceptions, exception case, you can issue shares at discount. You can issue shares at discount. Sir, what are those cases, sir? Those cases are sweat equity shares, where company will offer shares to its employees, directors. And second one, issue of shares under debt restructuring scheme or any statutory resolution plan which was prepared according to the RBI norms. Okay, under DRS, debt restructuring scheme or statutory resolution plan, company is allowed to issue shares at discount. Simply, internal reconstruction. In accounts, you might have prepared this chapter, internal reconstruction, where creditors agree to forfeit some amount. For remaining amount, they will accept shares. In that case, according to the resolution plan or debt restructuring scheme which was approved, under that scheme you can offer equity shares at discount basis. And this speaks about shares only, right? This speaks about shares. So you can offer debentures at discount. That is completely outside this section 53. So section 53 speaks about only shares. And coming to the last topic of this part 2 is sweat equity shares. So sweat equity shares. So this is a motivation, financial motivation to the employees. So under this concept, company can offer sweat equity shares either at a discount, that means less than face value, or for a consideration other than cash. That means here company is not going to get any money. In fact, company is going to get some intellectual property rights from the employees. So here, company can give these shares only to the permanent employees, not temporary employees. Those employees or directors, they might work in our company or our holding company or our subsidiary company. Simply in a group holding subsidiary, yes, that employee can be in our company or our holding company or subsidiary company. But that employee should be permanent. He might work either in India or outside India. It is irrelevant. The only relevant condition is permanent employee. And previously we had a condition that that employee should complete 1 year of service in our company, but right now there is no such condition. Even a newly joined employee is also eligible to take share under sweat equity. Is it clear? Okay, employee stock option, same point ma. Employee stock option, employee definition is very same. Sorry. Employee definition under ESOP, employee definition under sweat equity share, there is no change. But sweat equity, we offer shares at discount or for consideration other than cash. Whereas ESOP, here we are going to get cash, but here we offer discount to the market value. Suppose face value 10 rupee, market value 100 rupee. Sweat equity share, I may offer it for less than or equal to 10. Less than or equal to 10 or less than 10, simply discount, right? Less than 10. But coming to employee stock option, here I will offer shares at a price more than face value, greater than or equal to face value, but less than market value. So employee stock option is different, sweat equity share is different. Don't get confused. So at a predetermined price, we will give offer to them. So on the predetermined date, so on the date, whatever date we tell, on the date we will offer options to the employee. Next one, conditions for issue of sweat equity shares. As you all know, special resolution is compulsory from the members, because there arises a dilution of control, right? So equity shareholders will have voting rights. Under section 47 we studied the same. Now issue of sweat equity shares, certain percentage of ownership is getting diluted to the employees. So that's why you need to take approval from members, and that approval is valid for a period of 12 months. For getting approval, you need to issue notice calling for general meeting. In that notice, you need to disclose the number of shares offered under sweat equity, what is the current market price, And what is the benefit? What are the class or class of shares offered to the class or class of directors or employees? What type of shares you are offering and to whom you are making offer? For listed companies, in addition to Companies Act, they need to comply SEBI norms. In prospectus chapter, I think section 24, I made it very clear. I made a very clear statement. Listed company issue and transfer of securities are subject to SEBI guidelines. Other than listed companies, they're subject to company rules, company share capital and debenture rules. Next one, sweat equity shareholders will carry same rights. They will also get voting rights in the general meeting. They will also get dividend rights. They will also get same rights, limitations, restrictions. That means they are, when compared to other equity shareholders, they are also same. Next, important conditions with respect to amounts. In a single year, I can offer sweat equity shares, maximum 15%. Suppose my paid up share capital, excluding sweat equity, is 100 crores. In a year, maximum I can offer 15% sweat equity, that is 15 crores or 5 crores, whichever is higher. But overall, during the lifetime of the company, it should not exceed 25%. Suppose if I increase this amount, to 200 crores, then these amounts will also automatically get increased. But out of, total paid up share capital, sweat equity shall not exceed 25% overall. Excluding sweat equity, how much capital is there? On that, maximum 25. In a year, 15% or 5 crores, whichever is higher. Throughout the lifetime of the company, 25%. But for startup companies, we gave a privilege because the startup companies can grow only with the work of employees. If employees work smart, if employees work hard, then definitely the startup companies will they will grow. Yes or no? So for startup companies, it's not 15, 25. They will be given flat 50% of capital. So they can issue sweat equity shares up to 50%. And there is a lock-in period, sweat equity shares. Today, if I give share to the employee, so they can't transfer such shares up to 3 years from the date of allotment. So lock-in period, how many years? 3 years. Next one, what is the value of the share? What is the value of intellectual property rights? These valuation should be done by a registered valuer. So under Insolvency and Bankruptcy Board of India, IBBI, there is a course called registered valuer for security financial assets. Person holding such qualification, such license, can value the shares as well as intellectual property rights. Next one, that person will value the shares issued under sweat equity and assets which we got, intellectual properties which we got from the employees, because these intangibles are subjected to amortization every year. So if that is for indefinite time period, we can enjoy these intellectual property rights for unlimited number of years. Then every year you need to check for impairment, or there may be life. Suppose we can use this intellectual property rights for 10 years. Then over a period of 10 years, you need to amortize. Are you all getting my point, students? Next one, you need to disclose the same in Board of Directors report. So this year we issued equity shares under sweat equity scheme. So these many shares were offered, and there should be identified in a members register also. So maintain separate register for sweat equity shares. With respect to non-cash consideration, the treatment, as I already told you, if I am getting any asset, then it is subject to the amortization. So the written down value will be carried in the balance sheet. You can see written down value in the balance sheet. If I am getting nothing, so no asset I am getting, just as a matter of motivation, I offered sweat equity shares beginning only. In that case, the amount specified by the registered valuer, suppose the value of share is 90 rupees and I offered 1 lakh shares. 1 lakh into 90 lakh rupees, I should straight away transfer to the profit and loss account. So expenditure, employee benefit expenses, staff expenditure. So employee, under employee welfare expenditure or employee benefit expenses, I need to charge to profit and loss account. Suppose asset is 50 lakhs, asset value is 50 lakhs, shares I issued is 90 lakhs. Now you do one thing, 50 lakhs, take it to balance sheet. 90 lakhs minus 50, the difference 40 lakhs, charge to profit and loss account under employee benefit expense. Suppose if these shares are issued to the directors, then this amount of 40 lakhs, 40 lakhs will be deducted from their managerial remuneration under section 197, calculation of managerial remuneration. Okay, fine. So employee definition, already I told you that he should be permanent, whether working in India or outside India, whether in our company or our subsidiary company or holding company. And coming to the director, whether whole time or not, but they should be in employment category, right? So with this, part 2 also completed, ma. The next section is section 55, issue and redemption of preference shares. So this single section covers both two aspects. One is issue of preference shares and the second one is redemption of preference shares. So section 55, preference shares. Just follow the points, ma. The conditions with respect to issue is, first one, articles of association authorization. If your articles permit you to issue preference shares, then you can offer preference shares, or else amend AOA under section 14 of the Companies Act, by passing special resolution, file the documents with ROC, and you will get a certificate with respect to that. Now you can issue preference shares. Second point, members approval. What kind of approvals are? Special resolution. The reason is very simple. Compared to equity share capital, preference share capital carry two priorities. One is payment of dividend, the other one is repayment of capital. So now equity shareholders' interest is getting affected because of these two priorities. That's why you need to take consent from members of the company. And for getting approval, you need to give notice calling for general meeting. In that notice, you need to attach explanatory statement. There you should provide all the details of how much of preference share capital, what is the tenure, and then what are the specialities of these preference shares. Are they convertible or non-convertible, cumulative or non-cumulative, participative or non-participative? Everything you need to communicate with a member. Then only you can obtain consent from the member. Next one, at the time of issue, the company should not have subsisting default. That means these defaults should not be in existence at the time of issue of preference shares. So what are those defaults, sir? Failure to pay dividends, pay preference dividend, failure to pay preference dividend, failure to redeem preference share capital. So at the time of issue, these two defaults, either of these defaults should not be there. So if these defaults are there, first rectify them. The next minute you can issue preference shares. Sir, can I issue preference shares, irredeemable preference shares? No, ma. You can issue only redeemable preference shares. Irredeemable preference shares concept is not there. Then, sir, can I fix tenure for 50 years, sir? No, the maximum tenure is 20 years, max 20 years. But if you're a company engaged in infrastructure projects which were notified under Schedule 6 of the Companies Act, Schedule 6 of the Companies Act 2013, then so for such companies the maximum tenure is 30 years, provided from 21st year onwards 10% redemption. 10%, every year you need to redeem 10% of the preference share capital. So 10 years you are going to redeem preference share capital completely. So at the end of the 30th year you will find 0% preference share capital, right? So because everything got redeemed from 21st year onwards, right? Next one, so these are the conditions with respect to issue. These are the conditions with respect to issue. With respect to redemption, what are the conditions we need to satisfy, sir? What type of shares I can redeem, sir? Remember, only fully paid up shares. Only fully paid up shares can be redeemed. If they are partly paid up, convert them into fully paid up. Either simply make calls on shares, convert them into fully paid up, then you can redeem. Next one, source of funds. Source of funds, sir. From which funds I can utilize for redemption? So here the redemption value, it will be of two parts. One is face value, the other one is premium on redemption. Premium on redemption. Suppose face value is 100 rupee and you agree to redeem at 120. That extra 20 is premium on redemption. So with respect to 100 rupees, I can utilize either divisible profits of the company, profits that are available for distribution and payments of dividend, distribution and payment of dividend. Either you can utilize divisible profits or you can utilize fresh issue proceeds. So proceeds of fresh issue. Proceeds of fresh issue. But the point is, when you select divisible profits, then the nominal value of preference shares so redeemed, that amount you need to transfer to CRR account, capital redemption reserve account. So only the nominal value, the face value of shares which you are redeeming, so that amount you need to transfer from reserves to CRR account. If you select proceeds of fresh issue, then no need of such transfer because there is no effect on capital base. There is no effect on capital base. Next, with respect to premium on redemption, you can utilize either same, divisible profits or securities premium. But the point is, if you are a company which follow accounting standards in preparation of financial statements, accounting standards notified under section 133. So section 133, companies which prepare financial statements according to schedule 3, they need to follow accounting standards. Such companies can use only divisible profits, whereas all other companies can utilize securities premium or divisible profits for premium on redemption of preference shares. Once redemption is completed, simply communicate the matter with ROC. Company should communicate the same matter with ROC in form number SH7 within 30 days of redemption. Within 30 days of redemption, company should communicate the same with ROC. So this is the major part of the section, and there is one more small point in this section which was recently tested, in the previous attempt. I think May 2022, there is a question on this simple concept, that is, deemed redemption. I should not call it as deemed redemption, but listen carefully. When company is unable to redeem its preference shares, because of its financial position, because of its worst financial position, in that case it can go with this concept, redemption of unredeemed preference shares. Redemption of unredeemed preference shares. So here, what company can do, with the consent of 3/4 of preference share capital holders. Capital is important word. 3/4 of value holders. If you need to take consent and then take NCLT approval with respect to this redemption. Once you get NCLT, NCLT will give you approval only if dissenting shareholders are repaid. Dissenting shareholders are repaid. So first of all, what about this deemed redemption? So here we are not going to give cash. Here we are not going to pay cash. Here we are going to issue new shares in the place of old shares. So we'll take old shares and we'll give them new shares. Now that new shares also of tenure maximum 20 years. New shares, that concept is also maximum tenure is 20 years. They are also redeemable preference shares. But for doing that, you need to take consent from preference shareholders. Next, you need to file application with NCLT for getting NCLT approval. NCLT will give you approval only when the dissenting shareholders were paid off. Finally, here the new preference shares which you are issuing, they should cover not only old preference share capital but also dividends which are in arrears. So the dividends which are in arrears, you need to cover that amount also. And one more point, because of such deemed redemption, reduction of capital or increase in capital provisions are not going to get affected. So no need to comply those provisions. Simply communicate the matter with ROC. So this time we redeemed preference shares by issuing new preference shares. Understood, my dear students? So on this point, there is a question in May 2022. You can check it. Fine. So this is all about section 55 of the Companies Act, redemption of issue and redemption of preference shares. So I'll highlight the point here also. Just go through it. So this is the point, tested in the recent exams. Just go through this point. 3/4 in value is important word. Next one, transfer and transmission of securities. If you go through section 45 of the Companies Act, what is the nature of a share or debenture? Nature of security, it is movable property. It is movable in nature. And if you read the definition of goods under Sale of Goods Act, so goods includes securities. So shares or debentures simply securities. They are movable in nature. That means you can transfer them. But the transfer is subject to AOA, Articles of Association, because when you read private company articles, they contain 3 conditions, restrictions on transfer of shares. If you read public company AOA, you can't find that restriction. So that means, securities are freely transferable, right? So now finally, securities are transferable. How, sir? How? So what are the prerequisites for transfer and transmission? First of all, is transfer and transmission both same or different? See, transfer and transmission both are different. Transfer is a voluntary act where buyer and seller will come to the market. There is no compulsion on them. Seller want to exit from the company, seller want money. Buyer want to become member of the company and buyer want to purchase the shares. Now buyer will come to seller. If terms are matching, now buyer will pay the money and buyer will take the shares. So this is voluntary act. There is no compulsion on them. But coming to the transmission, it happened due to operation of law. That means if a person gets deceased, if a person is deceased, now there's due to succession concept, the legal heirs of the deceased person will become members of the company. That means the shares get transmitted from deceased person to legal heir. Or if that person become insolvent, now through court order, official assignee will become member of the company. The shares automatically gets transmitted in the name of official assignee under court order. That is all about transmission. Getting my point, students? So there is a difference between transfer and transmission. Now let's take the concept of transfer. What can be transferred, sir? Very simple, either security or interest in a company. If you are a company with share capital, then securities are transferable. Sir, I'm a company without share capital, sir. Then there is no concept of security. So here, what happens? Here, the interest of a member which he get because of memorandum of association, that will be transferred. For that, what are the prerequisites? Remember, my dear students, the transferor, one who transfers shares, transferee, they need to execute an agreement in writing. So oral transfer is invalid. In writing, they need to execute an instrument, that is SH4. We call it as transfer deed. So both the parties should execute this deed. Along with this, if transferor is having original share certificate, then he will attach original share certificate. So transferor recently became member under allotment process. He is having only letter of allotment, sir. He is not having share certificate. Then attach letter of allotment. Now these two documents, transfer deed and original share certificate, or transfer deed and letter of allotment, should be submitted to company by transferor or transferee within 60 days of execution. Within 60 days of execution, on transfer deed, you can find the date. From the date onwards, within 60 days, submit the document to company. Suppose, if shares are fully paid up, then, company will register the shares in the name of transferee. Company will incorporate the details of transferee in the registers maintained under section 88. Suppose if the shares are partly paid up, and such execution was done by transferor. Listen carefully. Execution of transfer deed was done by transferor. Shares were partly paid up. In that case, company will register the shares only after getting approval from the transferee. I should not use the word approval, but company can register, or company is not allowed to register such transfer without giving intimation to transferee. So here 2 weeks intimation, once company receive, application for transfer of shares, those transfer of shares is with respect to partly paid up partly paid up. And next one, it was executed by transfer or alone. In that case, company cannot or company shall not register the transfer or shall not register the transfer without intimating transferee. Company should intimate transferee. Transferee, the shares are partly paid up. In future, when we make calls on shares, you are liable. In future, if company goes into liquidation and if company assets are not in a position to meet its liability, then you are liable to pay contribution amount. Like that, company should give intimation. If there is approval from transferee, come on, proceed with registration of transfer. If there is no response from transferee, then consider it as deemed approval, register the transfer. But that care should be taken only if two conditions are satisfied. One is partly paid up shares and application was executed by transferor alone. Understood, ma? Everyone. But whatever the procedure I told you, transfer deed, submission of these documents, and it should be properly stamped. You need to pay stamp duty according to Indian Stamp Act 1899. All these points are not applicable to or not applicable in two cases. One is when securities are held in demat form. No need to execute transfer deed. And when the securities are held by government, government company. Do you remember government company? So shares will be in the name of President of India in case of central government company, governor of state in case of state government company. So for transferring these kind of securities, the procedure is different. It was specified in Indian Constitution. You need to introduce bill in the Parliament or Assembly. After approval of that bill, when House gives approval to that bill, then President or governor signing that bill, then only such securities can be transferred. So for that, the procedure specified under section 56 is not going to apply. So these exceptions you need to remember. Bonds issued by government company. So here simply transferee shall give intimation to company along with bond certificate. That's it. Intimation is sufficient. And securities held by nominees of the government. So government company will enjoy these privileges only if it is regular in filing financial statements as well as annual returns with ROC. Understood, my dear students? Next one, ma. Suppose, ma, transferee was negligent and he lost the instrument of transfer. He lost the instrument of transfer. Now, sir, can transfer be registered? Actually, no. But if he submit indemnity bond, now company may register the transfer. Understood? So partly paid shares, already told you, consent of transferee is required. 2 weeks intimation we need to provide. 2 weeks intimation means, so today if we are giving intimation, the transferee should respond within 2 weeks. Transferee should respond within 2 weeks. And I told you, instrument of transfer is not required in case of transmission, because transferor should execute transfer deed. However, transferor, either he got deceased or he become insolvent. In both the cases, he lose contractual capacity. How he can sign instrument deed? Understood, ma? Next one, time limit for issue of share certificate. What is the time limit for issue of securities? Suppose company got incorporated. Now all the subscribers should get share certificate within 2 months from the date of incorporation. If it is allotment case, then within 2 months from the date of allotment. If it is transfer case, secondary market, issue is covered under primary market, so company will get money. Transfers will happen in secondary market. So in case of transfer or transmission, when you deposited all the documents with company, from that date onwards, within 1 month, company should issue security certificate. But if it is with respect to debentures, 6 months from date of allotment, because debentures, we need to appoint debenture trustee, execution of debenture trust deed, and then creation of charge. So there is a lengthy procedure. So that's the reason under debentures, 6 months time period is given. But with respect to shares, remember 2. And with respect to transfer or transmission, forget about whether it is a share or forget about whether it is a debenture. The concept of 1 month is applicable. Understood? So these two speaks about share This point speaks about security, that means both share and debenture. This point speaks about only debenture. Identify the difference, ma. Next one. Suppose, sir, Mr. M is a member of a company C Limited. He got deceased. And Mr. N is the legal heir of M. The moment M get deceased, N under transmission, he will become member of the company. Right? He will become a shareholder. But here N is having two options. Option 1, to get registered shares in his own name, to get enrollment in the register of members. So yes, registering shares in his own name, or he can transfer shares to other persons, outsiders. So N, either he can become himself as a member of the company, or even without becoming member, N can execute transfer deed in favor of other person. Now, when company receives this transfer deed, company should not object. Company should register the transfer in the name of outsider, provided N should submit original share certificate plus death certificate of the deceased person plus succession certificate. So I am the only legal heir. I'll get all the rights with respect to Mr. M. So succession certificate and then transfer deed SH4. So SH4 should be duly stamped. Suppose if he opt to become member, to get registered in his own name. In that case, no need to execute transfer deed, no need to pay stamp duty, no need of signature of transferor and transferee. All these particulars are not applicable. Understood? So legal heir is having two options: either to get register himself as a member, that means to declare himself as a member by filing documents under transmission, or transfer shares to the outsiders. So if company makes any default with respect to 56, suppose delay in issue of share certificate, within 2 months they need to issue share certificate. If it commit delay, or even if instrument deed is incomplete but still company allows the registration, in those cases company is going to get punishment of 50,000, penalty of 50,000. And the other persons, depository, company as well as officer in default 50,000. If shares are held in demat form, and if depository or depository participant is making mistake, to defraud a person, then section 447 punishment will apply. Section 447 punishment will apply. Next one, forged transfer. What is meant by forged transfer? Sir, in forged transfer, the signature of transferor will be forged. That means imitating signature of transferor. If someone is signing the document on behalf of transferor without his permission, it is nothing but forged transfer. Here, just listen to the example. O is the original member of the company. From O, F looted the security. F looted security from O, and he executed transfer deed, which was forged. F signed. F, a fraud person, simply F, a fraud person, signed as if pretending himself as O, and executed transfer deed in favor of F. Company should object such transfer. Company should not register the transfer. Suppose if company registered the transfer, that means company is in default. Okay, fine. And F, suppose F transferred the shares to innocent person, innocent purchaser. So now you can see here total how many parties are there, ma? 3 parties. O is the original member, F is the fraud person, I is the innocent purchaser. In this situation, whenever O comes to know about this fact and O goes to the company, suppose O went to the company and O is asking what happened. So sir, this is a forged transfer. Sir, how you registered forged transfer? Now what are the duties of company? Company should remove the name of I from the register of members, and company should incorporate the details of O. That means O name should be restored. Whatever dividends paid during this period, company should pay all the amounts to O. And then sir, then what about I, sir? I will suffer loss. No sir. Yes, definitely I will suffer loss. But who is responsible for such loss? Company. Why? Company should not register this transfer. However, company registered transfer negligently. Company is at default, right? So company should compensate I. Company should compensate I. Now, if you observe, who is at loss? Company is at loss because company gave shares to original member. Company restored the name of O, and company paid amount to I. So that is a loss to company. In this case, company will get reimbursement from F. So F has to indemnify company. Once again, I'm telling you, in the entire case, why company is taking a risky position, sir, because company should not register forged transfer. It failed, it negligently registered forged transfer case. So company is liable to original member. Company is liable to original member, and company is also liable to I because I purchased shares because of he's thinking that F is a member of the company, because share certificate is the proof document showing title. I told you, document showing title. So seeing that share certificate, I purchased shares, so now I is at loss, so company should reimburse I. And finally, whatever loss company suffered, that loss company is going to get reimbursement from F because he is the party at fraud. So that is the total concept of forged transfer. You just read one time. This here, the third party buyer is Mr. I. Simply, third party buyer is Mr. I. Now you read this entire concept, you will get to know. Remedy to the company. Company will get indemnity from the first transferee. Here the first transferee is Mr. F. Under the forged instrument, under forged instrument, who is the transferee? Mr. F. Understood? So just read the point, ma. Next one, punishment for personation of shareholder. What is this punishment concept, sir? What is this personation? Sorry, personation. If someone pretends himself as a owner of the company, if someone pretends himself as a owner of this particular security, so why he is making such a personation, sir? So I told you, personation means pretending myself as owner of the security. Simply changing the identity. I'm changing my identity in order to tell that I'm the owner of particular security, I'm the owner of the company. So why personation? Why he will do personations are very simple. In order to get some securities or gains on security. So gain on the security. So whenever a person attempts to personate himself in order to get security, already he obtained security, or he is attempting to obtain security, or received the amount, or attempting to receive the amount. In that case, the person who is doing such personation is punishable. He is going to get punishment. The punishment is both imprisonment and fine. Imprisonment 1 year to 3 years, fine 1 lakh to 5 lakh. Simply, you should not pretend yourself as a owner of the security. That's it. If you do it with an intention to obtain security, with an intention to obtain money from the transfer of security, then you'll get punishment. Next, section 58, very small concept. Refusal to register the shares. Refusal to register the transfer. Sorry, refusal to register the transfer. You can observe here, transfer or transferee. Both executed transfer deed and they submitted transfer deed to company. Now company, within 1 month, they need to issue share certificate in the name of transferring, or 1 month issue share certificate, issue security certificate. Okay, issue certificate, security certificate, or within 30 days, issue notice of refusal. Notice of refusal. So because of these reasons, we are not going to register the transfer. Suppose they are partly paid up and transferee is not financially capable person to repay call amounts in future, or this is a private company, we had some restrictions on transfer of shares, stating the reasons, issue notice of refusal. Issue notice of refusal. Suppose transferee is getting notice of refusal, he is getting notice of refusal, sir. Or suppose company failed to issue notice of refusal. Company failed to issue notice of refusal. That means no notice of refusal issued. Understood? So I divide. So total 2 branches. Received notice of refusal. No notice of refusal. No notice of refusal. Listen carefully. if the shares are related to private company or public company. So here also two concepts: private company, public company. So let's start the point. Let's begin the each and every case. Sir, transferee received notice of refusal and the shares are related to private company. Then within 30 days of refusal, transferee can file a petition with NCLT. Sir, these are not valid grounds. Private company rejected my transfer, sir. These are not valid grounds. Like that, he can file an application with NCLT. If it is a public company, then within 60 days of refusal, so this concept is when you receive notice of refusal. Suppose, sir, no notice of refusal. I didn't receive any notice of refusal. Then if you're a private company, if securities are involved, if securities are related to private company, then within 60 days of delivery of documents for transfer, delivery of documents for registration of transfer, that means here the time limit is from the date of delivery of documents, 60 days. In case of public company, within 90 days of delivery of transfer documents, So these are the time limits for making a petition with NCLT. Are you getting my point, students? So just listen, just see carefully. So I received notice of refusal. Securities related to private company. Then within 30 days of receipt of notice of refusal. Public company within 60 days of notice of refusal. Sir, I didn't receive any refusal notice, sir. Then you delivered documents, right, with private company. Already 30 completed, you didn't receive security. You didn't receive notice of refusal. So additional 30. So simply 30 plus 30, you are having 60 days. So 60 days from delivery of transferred documents for registration in case of private company. In case of public company, 90 days of delivery of transferred documents. You are having a time to file an application with NCLT. Now NCLT is having two options. Either dismiss the appeal. Okay, the reasons, the justification of company is correct. So this transfer is not allowed. Dismiss. Or order company to register transfer and issue certificate within 10 days. From the order. And reimburse transferee all legal expenses. All the expenses he incurred in bringing the suit. So this is the power of NCLT. So this is all about section 58, ma. This is all about section 58. Section 59 is rectification of register of members. Suppose I am the member of company, but my name was wrongly omitted from the register. Or I am not a member, but my name is wrongly entered in the register. In these cases, yes, an aggrieved party can file a petition with NCLT. If you are an Indian member, if you are Indian, that means if your stay is in India, then you can file an application with NCLT for rectification. First, I'll write a letter to the company. Sir, I'm not a member, but my name is included. Or I'm a member, but my name is excluded. Like that, I'll write a letter to company. If company rectify, no problem. Or else I'll file petition with NCLT. There is no time limit, ma. You can file petition with NCLT within reasonable time. Suppose, if mistake happened in foreign register. Now, foreigner, there is no obligation on foreigner to come to India to file petition with NCLT. So, foreigner, outsider can easily, so he can file an application with a competent court specified by central government. So, central government will specify the court in that area. So, you can file petition in that court. Now this person, NCLT or competent court, after hearing to both the parties, so they will order company to rectify the register. They may dismiss the appeal or they will order company to rectify the register. So and compensate the plaintiff. the person who filed suit, compensate the person. That is all about 59. So 58 is refusal of registration and appeal against such refusal. And 59 is all about rectification of register of members. So 2 points I covered, just go through it, you'll get to know the points. So with this, part 3 of share capital completed. Next one, part 4 of share capital. So this is as per stress term material. Okay, fine. So next concept is different ways of alteration of share capital. So in how many ways I can alter share capital, sir? In 5 ways. Either increase or decrease, consolidate, subdivide, conversion of shares into stock, reconversion of stock into shares. So in 5 ways I can alter the share capital. Once again I'll tell you. So increase in capital, decrease in capital. Consolidation means, suppose I issued shares of face value 10 rupee. Now I'll consolidate all the shares into one share. I will divide them into shares of higher amounts. Suppose 100 rupees. Before consolidation, share value is 10, face value is 10. After consolidation, face value may be 100. Understood? Next one, because of consolidation, if there is change in voting percentage, if there is change in members voting, if there is change in members holdings, then they need to take approval of NCLT. In my regular class, I told this point in a very clear, with a clear example. So since this is a revision, I can't provide such examples. We need to complete the topic within the limited time. So, okay, fine. So because of consolidation, I repeat, because of consolidation, if members holding is getting disturbed, members holding is getting changed, then they need to take approval of NCLT. So that's what the point is here. See, change of voting powers of shareholders, then a prior approval of tribunal is required. Next one, conversion of shares into stock, reconversion of shares into stock into shares. So transferability point of view, I told you stock is better concept. Right now, such concept is not in existence. Next is split, subdivide. Suppose, face value 10 rupee. I'm dividing each share into 5 parts. Face value would be 2 rupees. Recently, IRCTC happened, this one only. Next one, cancel of shares, that is nothing but decrease of capital. So the moment you alter share capital, you need to file it with ROC. But remember students, for alteration of capital, 3 conditions are very much important. One is ordinary resolution from members. The second one is AOA authorization. Actually, this is the first one and this is the second one. Check whether AOA permits the alteration or not. Once AOA permits the alteration, then by taking ordinary resolution, alter the MOA capital clause. And last condition, filing with ROC in SH7, filing with ROC within 30 days of alteration. That means, within 30 days of alteration, file this information with ROC. So 3 conditions, and how many ways of alteration? 5 ways of alteration. In that, consolidation, if it is affecting voting percentage, of the members, then NCLT prior approval is required. Clear ma? Next, section 62, further issue of shares. So here, issue of shares will take place 2 times. One is at the time of incorporation, directors should issue shares to the subscribers. That is initial issue. And any issue other than initial issue, we call it as further issue. Any issue other than initial issue is further issue. So further issue of shares. So under section 62, that further issue of shares can be done in 3 ways. One is to the existing members, preemptive rights or rights issue, proportionate offer of shares to the existing members. That is one way. The other way is employees, under employee stock option plan or stock option scheme. The last one is to the others, simply other than existing members and employees. So last category, if you take last category, others, it might be either of public offer or an offer to the identified persons. If it is a public offer, prospectus is required. If it is an offer to identified persons up to 200, then private placement section 42 is going to apply. So depending upon the case, you need to comply chapter 3 of Companies Act 2013, prospectus and allotment of securities. So here section 62 speaks about further issue of shares to the members. So whenever company make further issue of shares to the existing members, they need to issue a document called letter of offer. What is the name of the document? Letter of offer. So this should be given at least 3 days before opening of a rights issue, and that rights offer period should be minimum 15, maximum 30. The range would be 15 to 30 days. Offer period should be minimum 15 days, max 30 days. But if you are a private company, I repeat, if you are a private company, after taking consent from 90% of members, 90% of the members, you can reduce this 3 days, you can reduce this 15 days. So 15 days, 3 days is subject to reduction only in case of private company, not in all companies. And you need to take consent from the members. 90% of members should agree for shorter notice, 90% of members should agree for shorter period. Then only it is possible. I know here we offer shares, and if you see the contents of the letter of offer, the ratio in which you are offering a share. Suppose for every 10 shares you are holding, one additional share will be given at so and so price, like that. All the contents should be incorporated. And if your AOA is silent, renunciation is permitted, and that point is also to be specified in AOA. That means you can allow any person to become member of the company to subscribe that additional share. Are you all getting my point, students? Next one. So the notice of offer shall contain explicit statement. That's what I told you. So contents of the letter of offer, this point should be there. If you are not willing to subscribe the additional share, you can transfer such right to the known people. Next one, on expiry date, the offer period completed, but we didn't receive any application from the member, and we didn't receive any rejection letter from the member. In that case, board of directors may dispose the shares in a manner not disadvantageous to the company. Suppose the value of share is 60 rupees. You offered the share at 58 to the member, because he is our existing owner. That's why you offered the share to the member. Now, members didn't took the such shares. Suppose if members failed to file application, then you can dispose the residual shares in a manner not disadvantageous to the company. That means you can't issue such shares less than 58 rupees. Because if you offer such shares less than 58, it is a loss to the company. Company is going to miss some funds. So loss to the company is nothing but indirect loss to the members. Understood? Everyone. So these are the conditions to be satisfied, but listen carefully. For making rights offer, no need to take consent of members, because we are offering shares to the owners only. Because of this, there would be no dilution of control. There is no dilution of control. Existing members shares, number of shares getting increased, yes or no? And you can't find dilution of control, because before issue, after issue, there is no change in voting percentage. Next priority, you can go with employees, and that employees are in the internal part of the organization. They know about our company, so no need of advertisement, no need to issue prospectus, no need to issue private placement, simply offering options to the employees. So here the conditions to be remember is AOA permission. Obviously you need to check AOA permission. Next one, members approval is very much required. What kind of approval, sir? All cases special resolution, but if you are a private company and regular in filing ROC returns, then ordinary resolution is sufficient. Understood? And sir, I'm a listed company, sir. Myself listed company, sir. Then you need to follow SEBI regulations also. So these are the primary conditions. Next one, For getting approval, you need to issue notice calling for general meeting. Along with that notice, you need to give explanatory statement. In explanatory statement, we will give complete information with respect to how many options we are giving to employees, to whom we are offering shares, what is the exercise price, what is the vesting period. Everything will disclose. All material information will provide in the explanatory statement. And remember that vesting period, that means time gap between grant of options and exercise of options should be minimum 1 year. And yes, company is having complete freedom to fix lock-in period with respect to exercise of options. So in sweat equity, with respect to unlisted companies, 3 years lock-in period is there, right? And until employee become member of the company, simply he's having option, right? So we can pay dividend to them, those options can be transferred, those options can be placed, is completely wrong. Until he become member, he can't get dividend, his options are not transferable, and he can't pledge the options. If he do that, it is null and void. Suppose if employee got deceased before exercising the option, now legal heir can exercise the option. Understood? Next one, so definition of employee. So who is eligible to get shares under ESOP? Permanent employee, whether working in India or outside India, whether in our company or holding company or subsidiary company. But two people are specifically excluded. Who are they? Promoter working as an employee in the company. And the next one is director holding more than 10% equity in that company. Director holding more than 10% equity in that company. These two people are prohibited from employee stock options. Very, very important to remember these points, because there is a chance of asking practical question. So company is planning to allot shares under employee stock option scheme to the promoter of the company. So do you agree? And it obtains special resolution from the members of company. So do you agree with the decision of the company? The answer is no. Understood? But what would be your answer if it is a startup company? So the answer is again different. So the above conditions are not applicable up to 10 years from the date of incorporation of a startup company. So care should be taken on exceptional cases. So if you're reading main provision one time, read exceptions twice, thrice. Next one, any other persons, chapter number 3, conditions to be satisfied. But since you're offering shares to the outsiders, members interest is getting affected, their voting percentage will come down. How? Previously 1 lakh share capital, 1 lakh held by the existing members, they are having 100% capital. Now company is offering additional 1 lakh shares to the outsiders. As a result, total share capital would be 2 lakhs. Existing members voting percentage will come to 50%. So in that manner, their voting percentage is getting affected. Understood? Next one, ma. So summary of this section 62 subsection 1 is further issue to existing members to employees. In this case, special resolution is must. Of course, private company which is regular in filing ROC returns, ordinary resolutions. To the outsiders, to the others, simply others, outsiders or others, in that case special resolution is required, plus valuation report, registered valuer report with respect to fixation of price. You can see that point here, valuation report of a registered valuer, plus chapter number 3 rules and regulations. You need to comply. So this is the summary of section 62 subsection 1, right? Members, employees with special resolution, others with special resolution. But this concept is not going to apply in the following cases. Sir, what are the following cases, sir? Following cases are, I issued convertible debentures. Some 10 years back, I issued convertible debentures or convertible preference shares. So today I need to convert them. So under conversion process, I'll take existing securities and I'll give equity shares. So what law is telling, whenever you are issuing equity shares, further issue to the others, you need to take special resolution, you need to take registered value report, and you need to comply chapter number 3 rules. But here, no need to apply, because 10 years back, when I offered convertible shares, convertible securities, I should take special resolution at that point of time only. So that means when I'm offering convertible securities, first I need to take approval from existing members. Already I took existing members approval at the time of issue of convertible securities. So no need of one more approval at the time of conversion. So no need to take approval from the members at the time of conversion. Straight away you can issue preference shares. Sorry, you can issue equity shares. Next, this is a normal point. And this is a special point, special point. Listen carefully. Company took some loan from government. Company took loan from government, or company issued debentures to the government. At the time of maturity, company was not in a position to repay, unable to repay because of its financial condition. Financial condition is worse, so it is not in a position to repay. In that case, government, considering public interest, considering financial affairs of the company, issued terms, considering all these factors, government may order company to convert these loans or debentures into equity shares. So when government is ordering company to convert them into equity, now also no need to take special resolution from members. No need to take valuation report, no need to comply chapter number 3 rules. But if company is not okay with the decision of the government, company can go to NCLT within 60 days of government order. NCLT will fix the deal, whether to allow or not to allow. NCLT will fix the deal. But the point is, so in these two cases, one is convertible securities, the other one is government order to convert their loans or debentures into equity shares. In these two cases, the aforesaid provisions won't apply. And finally, whatever the thing happened, communicate the same with ROC. Fine. Coming to the next concept, issue of bonus shares. Issue of bonus shares. So bonus shares, the shares which are given at free of cost. No need to pay money. The shares will be given at free of cost. The other name to this concept is capitalization of profits. So when you see the financial statements of a company, you might have accumulated reserves and surplus. And those accumulated reserves and surplus, you can't find them under cash. So that some portion of reserves and surplus may be available in fixed assets. That means it is not available in cash. So if members request company, come on, pay dividends, or you are having more and more profits, more and more surplus. But the point is, I already invested that portion of reserves, some portion of reserves in fixed assets. They're not available in the form of current assets. How can I pay dividend? So for better capital structure, for presenting financial statements in a better manner, you can capitalize some profits. Capitalize, that means issue shares. Here the entry would be like this, reserves and surplus, free reserves account debit, securities premium account debit, CRR account debit to equity share capital. Now I'm capitalizing these reserves. So capitalization of reserves concept will be there. So the conditions for issue of bonus shares is first AOA, important thing, AOA permits or not. Next, approval from members. Ordinary resolution is to be taken. Why? Because we are capitalizing the profits. Capitalization of profit is taking place. So you need to take approval from members. Ordinary resolution. And at the time of issue of bonus shares, company should not commit some defaults like repayment of deposits, payment of interest on deposits, employee statutory dues, debentures, debt related part. Company should not commit any default. And with respect to sources, you can utilize only 3 sources: free reserves, securities premium account, CRR account for issuing bonus shares. Remember, my dear students, bonus is allowed in 3 parts. Bonus is available in 3 parts. One is converting partly paid up to fully paid up. partly paid up to fully paid up. This is converting. Second one is issue of fully paid up bonus shares. Fully paid up bonus shares, extra share, new share. The third one is combination. Understood? So bonus, you can provide bonus in these three ways, right? Next one, coming to the sources, you can utilize only these three sources. In reserves and surplus, if you find revaluation reserve, it is not permitted to utilize revaluation reserve for the concept of bonus issue. And coming to the conditions, AOA, first board will recommend and members has to approve ordinary resolution. And company should not possess the following defaults, debt related instruments and then statutory dues of employees. So partly paid up shares should be converted into fully paid up before issuing bonus shares. Understood? So by making calls on shares or by providing bonus element. And finally, remember this point, you can't substitute dividend with bonus. So declaring dividend. So suppose, I declare dividend, instead of paying it in cash, I can't give them bonus shares. Or in the place of dividend, I can't issue bonus shares. Dividend is a separate aspect, bonus is a separate aspect. Getting my point, students? So you can't replace both. You can't replace dividend with bonus shares. Next one, very small section 64, that is intimation to ROC. What all about this, sir? What about this intimation? Very simple, whenever you alter capital, whenever you redeem preference shares, whenever you had a direction from the government with respect to conversion of debentures into equity, conversion of loans into equity, in all these cases, company should communicate that matter with ROC. What is the time limit, sir? 30 days. Form number SH7, I already told you. In case of default, if delay happened, then punishment to the company is 500 for each day delay. But this is subject to maximum penalty of 5 lakhs in case of company, 1 lakh in case of officer in default. So 30 days you need to file. You took 60 days for filing. Additional how many days? 30 days you violated. So 30 days into 500, that means 15,000 rupees to company, 15,000 rupees to each and every officer in default. But this is restricted to 5 lakhs and 2 lakhs as the case may be. Understood, ma? Everyone? And the final part of this share capital and debenture is section 66 to 71. Reduction of capital under section 66 of the Companies Act 2013. If you take any share, it will have face value. Say for suppose face value 10 rupee. Paid up value, in one case it is 10 rupee. In another case, it was suppose 8 rupees. Now the point is, under reduction of capital, I may reduce this face value or I may reduce this paid up value. Either of the things will happen. I may reduce face value, I may reduce paid up value. Suppose, if you take this case, reducing face value 10 to 8, this is also reduction of capital. As a result, member liability becomes 0. That is nothing but extinguishment of members liability. If I reduce this 10 to 9, 9 minus 8, member liability is 1. Originally member liability is 2, but now it was reduced to 1. That is nothing but reduction. See, my intention is not reducing the liability of members, but as I am reducing share capital, the final impact is on liability of the members. And the next one is either with or without extinguishing or either with or without reducing the liability of any of its shares with respect to cancel any paid up share capital. So in this case, I am changing this paid up value figures. I am reducing this paid up value figures. Next one, pay off any paid up share capital which is in excess of wants of the company. So this is different, buyback is different. Under buyback, company will take shares and company will repay money. Company will pay money, company will take shares. Whereas here, company won't take any share from the member. Company won't take any share from the member and company straight away will pay some portion of paid up value. Because of this three reasons members liability may be reduced or members liability may be extinguished. This first part you already you are very familiar with first part under internal reconstruction chapter. In internal reconstruction chapter you have already done many problems on this aspect. So reduction of capital, where certain portion of paid up capital you will transfer it to capital reduction, and all the assets, miscellaneous assets, goodwill, will be transferred to capital reduction, where you will have final impact. That means total this reduction of capital may take place in three circumstances. One is cancellation of uncalled capital, first point. Second one, cancellation of paid up capital. Third one, pay off paid up share capital, which is in excess of wants of the company. So in these three ways, reduction of capital provisions will get affected. But the procedure, what is the procedure, sir? See, first of all, this concept is applicable only to the company having share capital and limited liability. So listen carefully. Two companies will follow this concept. Company with share capital, company limited by shares. Next one, company limited by guarantee and having share capital. Only to these two companies, section 66 is applicable. Now coming to the procedure. First point, AOA authorization is must for reduction of capital. Next, take members approval, that is special resolution. What kind of approval? Special resolution is required for reducing the capital. Next one, the company should not have the following defaults. No defaults at the time of reduction. One is with respect to deposits, and the next one is interest on deposits. Company should not commit any default in repayment of deposits and payment of interest on deposits. Once these three conditions are satisfied, now obtain a certificate from chartered accountant, certificate from company auditor, simply company auditor who is chartered accountant in practice. So with respect to financial statements, preparation of financial statements. So the financial statements and this capital reduction had effect according to the accounting standards. Now once this is ready, now file an application with NCLT. That means without NCLT approval, capital reduction won't happen. So for reduction of capital, NCLT approval is must. So now here starts the procedure. Company has to file application with NCLT with respect to reduction of capital. Immediately NCLT will forward the application to four people, central government, ROC. If your company is listed company, then SEBI, and finally all the creditors. So yes, creditors consent is also required. So NCLT will forward this application to the four people, and it will give 3 months time period. So if you have any objection, so CG, ROC, SEBI, creditors, if you have any objection, file your objections within 3 months from the receipt of this notice. So NCLT will fix the deadline. So within 3 months, if any objection was received by NCLT will ask company to remove those objections, simply to settle them. Suppose some creditors are objecting capital reduction, come on company, pay them. If no objection is received from these people, then NCLT, subject to auditor certificate with respect to accounting treatment in books of accounts regarding capital reduction, and subject to creditors consent, so NCLT will give approval of capital reduction to the company. So capital reduction approval, finally NCLT will give you. The moment you get NCLT order, company should file the same with ROC for the purpose of registration. So ROC will register the same and issue the certificate. From that date onwards, the capital reduction is said to be effective. So tell me students, when capital reduction is said to be effective, from which date onwards capital reduction is said to be effective? Sir, from the date of filing with ROC, from the date ROC register capital reduction, from that date onwards capital reduction is said to be effective. In this case, the members will be liable for the balance uncalled or unpaid amount. Suppose original face value is 10 rupee, original paid up value is 10 rupee. Company is thinking that we had excess funds, so let's pay some funds and reduce the face value and paid up value. So company planned to reduce face value to 8, paid up value to 6. For example, they paid 4 rupees per share. For example, company paid 4 rupees per share to the member. So paid up value got reduced to 6 and company decided to reduce face value to the 8. Now 8 minus 6, so 2 rupees is the maximum liability of the members. 2 rupees is the maximum liability of the members. But remember students, if company did this practice in order to cheat creditors, how sir? NCLT will forward the application to the creditors. Which creditors? Company creditors. So who are the creditors of the company? Do you think NCLT know who are the creditors of the company? No, sir. So company will provide a list of creditors to NCLT. Sir, these people are my creditors, sir. These people are my creditors. Originally, there are 100 creditors. Each and every one liability, each and every person, company is liable, for example, 1 crore. The total liability is 100 crores. However, company concealed some 60 creditors details. Company concealed some 60 creditor details. They filed only 40 creditor details with NCLT. NCLT gave application to 40 creditors. 40 creditors gave no objection. And finally, NCLT approved this reduction. And NCLT, it will definitely ask a company to publish NCLT order in 2 newspapers. Publish NCLT order in 2 newspapers. So after seeing that advertisement, after seeing that publication, the 60 creditors came to NCLT. Sir, my details are not there in the register, sir, or my details are not provided to you, sir. That's why I didn't raise any objection. So I am the creditor to company. These are the details. Like that, if any creditor comes forward subsequent to the reduction of capital, that is nothing but fraud. That is nothing but cheating. So company cheated its creditors. Now what NCLT will do? NCLT will simply take back this NCLT order. So it will simply cancel this NCLT order. The moment NCLT order gets cancelled, what happens? Members liability, what is the original liability? That original liability will continue. Suppose, face value is 10 rupee, original face value 10 rupee. Paid up value, original paid up value 10, but they were paid 4 rupees, right? So 10 minus 4, 6. So original face value 10 and paid up value is 6. So the balance amount 4 rupees. So members, persons who are members as on date of reduction, as on date of capital reduction, they are liable to contribute 4 rupees to all those creditors. 4 rupees per share, 4 rupees per share they need to contribute. That means if capital reduction happened fraudulently, in that case, the officers of the company who are in default, they are going to get punishment under section 447 and members are going to get punishment. Sir, members, what kind of punishment, sir? Their original liability gets retrieved. So they are not liable for the reduced portion. They are liable for original amounts. So their maximum liability is original liability. Understood, ma? Everyone. And who will be held liable, ma? The persons who were members at the time of reduction of capital. So that is all about section 66. Very simple section. Think 1 year back this question came in the exam. So procedure for reduction of capital, probability 5 marks. 5 marks question, ma. So you can see here all the points I covered. So NCLT is subject to the approval of creditors and subject to the auditor certificate with respect to accounting treatment. It will give order. Once company get that order, company should register that order with ROC and company should publish that order in 2 newspapers. So that any creditor details were omitted, that creditor can file an application with NCLT. Now NCLT will lift it order. That means it will scrap the order. Now members liability, original liability will be continued, and the officers in default, they are going to get punishment under section 447. Understood? So very simple topic, small concept. Next one, section 67. A company is restricted to purchase its own shares. Comment. Obviously, yes, ma. Buyback is different. Purchase of its securities is different. I repeat, don't get confused with buyback and section 67 and section 68. Under 68, under buyback, the moment company take its shares, the company purchase shares from the members, it will cancel all those shares. But section 67 is like this, purchase of shares means their intention is to hold the shares. The intention of company under section 67 is to hold the shares. Tell me, is it logical? Will you buy your own assets? I'm asking you, suppose you had a bike, it's your bike, it was registered in your name only. Will you purchase it? Will you purchase it? No, sir, no. So similarly, how a company is allowed to purchase its own shares, ma? So no company is permitted to purchase its own shares directly. Indirectly, company is not allowed to finance anyone, either it's employee or any outsider. So public company is prohibited from financing anyone to purchase its own share. Are you getting my point? But this section is not applicable to two companies, Nidhi company and private specified IFSC public companies. Of course, private company should satisfy all these conditions to get the privilege. These conditions we already discussed under deposits concept. No other body corporate has invested money in this private company. And the borrowings of this private company should be, twice of its paid up share capital or 50 crores, whichever is less. And there should be no default in repayment of such borrowings. Any private company fulfilling these conditions, section 67 is not applicable. Logically speaking, that means public interest in such company is zero. So that company can do anything. So that company can purchase shares from its members. Okay. Nidhi company, Nidhi rules will apply. So don't worry. Next point. No public company can finance any person to purchase its own share, directly or indirectly. But to this general rule, we had three exceptions. Suppose if you take banking company, their business is lending. What is the business? Their business is lending. So yes, they're giving money based on the security, and they're not bothered with that money which which borrower is having. So borrower, whatever he do with borrowed funds, it is none of the business of banking company. Based on security, they will grant some loans. Are you getting my point? Now, borrower buying a bank company shares, it is immaterial. But the only point is such loan should be done in ordinary course of business. Suppose, that fellow provided security worth 1 crore. As per banking norms, I can give finance up to 80%. I should give finance of 80 lakhs only. Imagine, bank gave 8 crores finance with respect to security of 1 crore. Now, this is not ordinary course of business. In that case, this general rule is once again applicable. So, this general rule, no public company shall finance anyone directly or indirectly. Indirectly means, giving guarantee, providing some security, some other financial assistance. So, you should not provide any financial assistance to anyone to purchase your company shares, your holding company shares. This is general rule. But exceptions are more important than general rule. First one, banking companies, simply lending business. Second one, we are providing benefits to the employees under a scheme. So we want our employees should get some perpetual gains. So throughout their life, they should get some gains. It is possible only in the form of dividends. If company is regular in paying dividends, definitely its members will get amounts, perpetuity. Throughout their life, throughout the life of the company, yes, it will pay some money. So members only will get dividends. Chalo, let's make employees as members of the company. We'll form a trust. In that, this trust is only for the benefit of employees. Now, company can finance this trust to purchase shares of the company. Of course, three conditions are to be satisfied. For forming the trust, special resolution, members' approval is required. First thing, members' approval is required. Second thing, this trust should be for the benefit of employees. And third thing, the trust should acquire only fully paid up shares. They should subscribe fully paid up shares. If these conditions are satisfied, then definitely it will be covered under exception. So general rule is not going to apply. And the third exception is employee loans. So instead of forming a trust, if you had hundreds of employees, then form a trust. But you had very less employees, very few employees, and one of them are interested to become member of the company, but they are not having that much financial assistance. Now, on the request of that person, you can grant loan to that person, provided that loan amount should not exceed 6 months pay. It's 6 months salary, maximum 6 months salary. You can help him. You can provide financial assistance. And with that amount, he should acquire, he should subscribe or he should purchase fully paid up shares, not partly paid up. And moreover, employee should not be KMP. Employee should not be director. So if those three conditions are satisfied, then so loan given to the employee to purchase the company shares is not treated as a offense because it is already covered under exceptions. And you need to disclose all the points in the board report, that is as usual. And penalty for contravention, if you violate the provisions of section 67, then company 1 lakh to 25 lakhs, minimum 1 lakh, maximum 25 lakhs. Officer in default, imprisonment and fine. Imprisonment up to 3 years, fine minimum 1 lakh to maximum 25 lakhs. So this is all about section 67. Very simple, my dear students. Two general rules. No company is allowed to purchase its own shares. To this general rule, we had two exceptions: private IFSC private company, IFSC public company, and then Nidhi company. Second general rule: no public company should provide financial assistance either directly or indirectly to any of its employees or outsiders in order to acquire shares of the company or its holding company. But we had three exceptions. What are those three exceptions? Lending business. Next one, money lent to a trust for the benefit of employees, after taking special resolution only, and the trust is taking only fully paid up shares. Next one, third exception is loans to the employee, but employee excludes directors and key managerial person. Maximum loan you can provide 6 months salary, and then with that loan amount he can purchase only fully paid up shares. Understood? Next point, buyback of shares. Buyback of shares. So section 68 to 70, it speaks about only buyback. First of all, for making buyback, sources of funds. Sir, from where they will get money, sir? From where they will get money? They had three sources. One is issue proceeds. They can issue equity shares. With that money, they can make buyback. But the point is, shares involved in issue, shares involved in buyback should not be same category. They should not belong to same class. Understood? So, issue proceeds of other class of shares, first one. Second one, free reserves. Third one, securities premium. They can utilize these three amounts for the purpose of buyback. Repeat: free reserves, security premium, issue proceeds. But issue proceeds of the shares should not belong to the shares involved in buyback, and the shares involved in issue should not be same. Next one, when you select reserves concept, other than issue proceeds, then you need to create CRR, capital redemption reserve account, and CRR shall be utilized only for the purpose of issuing fully paid up bonus shares, which we discussed under section 63 of the Companies Act. Clear? So with this sources completed, this point was asked I think 3 times. In last 10 attempts, this point was asked for 3 times. Next one, conditions for buyback. First, AOA authorization compulsory. So you blindly remember the point, company to do any activity, it should get permission from AOA. And this is a general permission. Yes, company can make buyback of securities, but how much? To what extent it can make buyback? For that, secondary approval is required. It depends upon the percentage of buyback. Suppose, if the amount involved in buyback is 10% of paid up equity share capital plus free reserves plus securities premium, then board resolution is sufficient. Board resolution is sufficient if the amount involved in buyback, I repeat, amount involved in buyback, that means amount to be invested in buyback, amount involved in buyback, if it is up to 10% of paid up equity share capital plus free reserves plus security premium, board resolution is sufficient. But with special resolution, maximum you can go up to 25% of paid up share capital plus free reserves plus securities premium. Here you need to identify the difference. Here I am writing the word equity share capital, but whereas here I wrote the word paid up share capital. In a single financial year, in a single financial year, a buyback is permitted up to 25% of paid up equity share capital. This is with respect to number of shares. Number of shares. This is with respect to amount in buyback. As I already told you, amount involved in the buyback, the amount which we can invest in buyback is the first point. Number of shares which we can buy back per year, maximum 25% of paid up equity share capital. Understood? The limit should be very clear, ma. Next, amount completed, number of shares completed. There is one more condition, that is debt equity ratio. Debt equity ratio post buyback. After completion of buyback, the debt equity ratio should not fall below 2:1. Sorry, should not fall above, should not cross 2:1. That means for every 1 rupee equity, max 2 rupees debt. It should not go beyond 2. It should not go beyond 2. So in debt equity ratio, what components we can consider? Long-term debts, either secured or unsecured. Debt equity ratio will consider only long-term debt, either secured or unsecured. In coming to the equity, simply capital, reserves, and surplus. So these three conditions, as you all know, because you might have done some 20-25 problems in buyback chapter. So only based on these three conditions, you use it to complete buyback problems, right? So these three conditions are important. Next one, the shares should be fully paid up. The shares involved in the buyback should be fully paid up. And then coming to the rules and regulations. If you are a listed company, you need to follow SEBI guidelines. Sir, unlisted company, sir, company share capital and debenture rules are sufficient. Next one, time gap between two buybacks. Sir, maximum, in a year, how many buyback I can do, sir? In a year, how many times I can do buyback? Only one time. And moreover, the time gap between two buybacks should not fall less than 1 year. I repeat, the 1 year gap is between closure of earlier buyback and opening of next buyback. The time gap is not, date of commencement of buybacks. You should not check 1 year from date of commencement of previous buyback to date of commencement of next buyback. It is not like that. Previous buyback when completed, from that date onwards, up to 1 year, you are not permitted to make one more buyback. Understood, everyone? So that's what lock-in period. Next, procedure for making buyback. Conditions I fulfilled. Procedure. So board resolution is sufficient if amount involved is up to 10%. Beyond 10%, definitely members approval is required. For that, you need to call them for general meeting. So you need to issue notice calling for general meeting. Along with notice, you need to give explanatory statement since it is a special business. So you all know what is an ordinary business, what is a special business, or else read once management and administration chapter. There you will come to know. So all the decisions taken by members in a company general meeting are classified into two types. One is ordinary, the other one is special. And for all special businesses, explanatory statement is compulsory. So in explanatory statement, you need to disclose all the points, necessity of buyback, class of shares, amount to be invested, time limit for completion of buyback. You need to disclose all the points. And one more point, the board resolution or special resolution which you took is valid for a period of 12 months. That means within 12 months, you need to complete buyback. Sir, unfortunately, 12 months completed, but we didn't complete buyback, sir. Take approval one more time. And then from whom we can make buyback, sir? That means, from whom we can take shares. You are given three options. One is, all the existing members on proportionate basis. So for every 10 shares held by you, company will take 1 share and company will pay you sufficient money. Or some from open market, go to the stock market, stock exchange, who are willing to sell at that point of time, take the shares. Or next one, purchase of specified securities. That means previously you have offered some shares under sweat equity or under employee stock option. Now take those shares, pay the money. And important point, you need to select one option and you should complete buyback only in that option. Changing of options is not permitted. Okay. And during the buyback, yes, the directors, minimum two directors should file a declaration stating that company position is good. So company is in solvent position only. It is not in insolvency. So next 1 year, company will not be liquidated, or company will not be resulted into insolvency. So the logic of this concept is simply only solvent companies are permitted to make buyback. So next 1 year, why 1 year, sir? Because generally, going concern concept is only for 1 year. Going concern means company will do business for the next 1 year. So standing on 31st March 2022, if I am able to do business till 31st March 2023, that means going concern is appropriate, or else there is no concept of going concern. Now board of directors should file this declaration that, sir, next 1 year we will do the business. Company will not be regarded as insolvent. Even if a company went into liquidation, even if company goes into liquidation, the assets are in a position to meet its liabilities. So no worry with respect to creditors. Like that, declaration should be signed by 2 directors. One should be managing director. And once buyback completed, within 7 days, cancel all those securities. If they are in physical form, simply scrap them. If they are in demat form, reduce the number, extinguish the demat securities. And finally, ma'am, cooling period. Once buyback is completed, the next 6 months you are not permitted to issue same class of shares to anyone. 6 months you need to wait. After 6 months, you can issue same class of shares. Understood? So because of buyback, my paid up share capital will come down, but my authorized capital is same. I can issue, unissued shares, or, unsubscribed shares I can offer. But the point is, shares involved in buyback, that class of shares should not be offered for a period of 6 months. Of course, to this general rule, we have exceptions. You can offer shares under bonus issue, or you can offer same shares under, to the persons holding convertible preference shares, convertible debentures, or, we had an obligation to allot shares under employee stock option or under sweat equity. Then you can offer same shares. So in these cases, general rule is not applicable, because these are genuine cases. There arises an obligation because of past events. In past they made a promise that your preference shares will be converted, your debentures will be converted, you are going to get shares under ESOP, like that. In past I made promise. So fulfilling those promises, you can issue same class of shares which you bought back recently. So for that 6 months time period is not applicable. And you need to maintain register of buyback. In register, you need to update all the particulars. Finally, when buyback is completed, file the returns with ROC. That is the last point. Once buyback is completed, file returns with ROC, return of buyback. And any provision, if you violate, you are going to get punishment under section 68 subsection 11. So punishment, how much, sir? Company 1 lakh to 3 lakhs, officer in default 1 lakh to 3 lakhs. Simple punishment. CRR, I already told you, when you select option of buyback out of divisible profits or security premium, the nominal value of shares which you bought back shall be transferred to CRR. CRR shall be utilized only for issuing fully paid bonus shares. And section 70, in 2019, I guess there is a question on this section 70. So list down the circumstances where buyback is prohibited. List out the circumstances where buyback is prohibited. Simply, if you remember, equity shares with differential rights, disqualifications, defaults under equity shares with the differential rights, you simply write those points sufficient. That means, listen carefully. If I am having following defaults, then I am prohibited from making buyback up to 5 years, up to 3 years after rectification. So what are those defaults, sir? Failure to pay dividend, failure to repay preference capital, failure to pay preference dividend, failure to pay debentures, failure to pay interest on deposits, failure to repay deposits, failure to repay term loans, failure to repay interest on term loans. Simply, write down the sources of finance. Write down the sources of finance. In the sources of finance where you commit mistake, you are prohibited from buyback. So dividend on equity or preference, preference share capital, preference dividend, debentures, only debentures. Next, interest on deposits, term loans, interest on term loans. If you make default, first rectify them. First make the defaults good. After that, wait for 3 years. Next year, you can make buyback. And then if you commit any default under section 92, filing of annual returns, 123, declaration of dividend, 127, failure to pay declared dividend under 127, and then 129, financial statements, preparation of financial statements. If you had these defaults, then also you are not allowed to make buyback. So simply a solvent company which is regular in filing returns with ROC, which is regular in paying monies to the creditors, and then preference shareholders, only those companies are permitted to make buyback. Understood? Then last part of this chapter, that is debentures. So debentures. So here section 71, only section 71 is important. With respect to debentures, all the conditions you will find under section 71. Of course, for debentures, there is only one section, that is 71. So I'll tell from first point onwards. So, sir, company can issue convertible debentures, non-convertible debentures, no problem. But if company decides to issue convertible debentures, special resolution from members is required. Under section 62 also I told you, at the time of issue of convertible debentures only, company should obtain special resolution from the members. In case of non-convertible debentures, you need to check whether proposed loan plus outstanding loan, that means loan balance as on date plus new loans, if they are within the limits of 100% of paid up share capital plus free reserves plus security premium, then for non-convertible debentures, board resolution is sufficient. But if they exceed the limit, suppose if they exceed the limit, in that case for non-convertible debentures, members approval is required. One time special resolution is required. If they are convertible debentures, forget within the limits or outside the limits, forget about the limit. If they are convertible, one special resolution is required. Understood? So members approval when required, sir. Convertible debentures required. Non-convertible debentures, but they are within the limits, sir. Outstanding loans plus proposed loans, so altogether they are within the limit of 100% of paid up share capital plus free reserves plus securities premium, then board resolution is sufficient, or else take special resolution. Next one, voting rights prohibited, because debenture holder is a creditor, he is an outsider, he won't get any voting rights. You can offer secured debentures, you can offer unsecured debentures, but if you are offering secured debentures, if you are issuing secured debentures, then you must create charge on asset. That asset market value should cover both principal amount as well as interest amount, and this charge should be registered under section 77 of the Companies Act with ROC within 30 days. Or else they are not treated as secured debentures, they are treated as unsecured. And the maximum tenure of debentures is 10 years. But if you are a company engaged in doing infra business or doing infra finance or infra debt fund company, so simply engaged in infra, then for you the redemption period is up to 30 years. General tenure 10 years, whereas infra companies 30 years. So creation of charge, security, appointment of debenture trustee, all these points are as usual. But remember, my dear students, if you're offering debentures to more than 500 members, or if you're offering debentures to public at a large, then debenture trustee appointment is compulsory. Of course, a person whoever having requisite qualifications and not having disqualifications is eligible to act as a debenture trustee. Company will appoint one person as a trustee. Company will publish debenture trustee details in the offer document. Next one, limit on borrowings from debentures. That's what I told you. Section 180 subsection 1 clause C is all about 100% of, you can see here, 100% of paid up share capital, free reserves and security premium. So this point already I covered. Next one, debenture trustee. Just now I told you, if you're offering debentures to members, more than 500, or if you're offering debentures to the public at large, then appointment of trustee is compulsory. So before appointment, you need to take consent letter from the debenture trustee, proposed candidate. However, he should not possess following disqualifications. So once read this point carefully. Debenture trustee may be member of the company, but he should not have beneficial membership. Not holding shares beneficially, not holding shares in beneficial interest beneficially. So beneficial interest, he should not have beneficial interest. That means he may hold shares on behalf of someone. He should not have beneficial interest in the shares of the company. And he should not be promoter, director, KMP, or any officer of the group companies, our company, our associate company, our subsidiary, our holding company. And he should not be relative to these two persons. He should not be relative to all these persons. And he should not be creditor to the company. He should not be debtor to the group companies. He should not be debtor. He should not be creditor. He should not be surety with respect to debentures. With respect to debentures payment, he should not be surety. That means he should not provide any guarantee. And he should not have any pecuniary relationship with the company during the last 2 financial years as well as current financial year. So pecuniary relationship means how much amounts are, 2% of the gross turnover, or total income, total service income, or rupees 50 lakhs. Out of all these amounts, whichever is less, you need to take it as standard amount and compare the amount of transactions you had with company. So amount of transactions, amount involved in the transactions, if it is higher than this amount, if it is equal to or higher than the standard amount, then you are said to have this pecuniary relationship. Once you had pecuniary relationship, you are said to be disqualified. Next one. In case of casual vacancy of trustee, trustee vacancy may be of two types. One is, resignation. The other one is other than resignation. In case of other than resignation, board of directors will fill the vacancy. But in case of resignation, board will fill, but for that majority of debenture holders consent is required. Next one. Yes, removal of trustee. If debenture holders want to remove the trustee, by passing a special resolution, simply 3/4 in value of the debentures. So total debentures rupees 50 crores. Now 3/4 means 37.5 crores. So people holding 37.5 crores, one person or two persons or 10 persons put together holding 37.5 crores, their consent is required for removal of the trustee. So the role of debenture trustee, he will simply act as a whistleblower. He will act as a whistleblower. He will take all the steps to protect the interest of the debenture holders. He may conduct meetings on suo motu, or he may conduct meeting once he receive any requisition from the holders holding not less than 1/10 of the value of debentures. Next one, if debenture trustee is negligent, then he is 100% liable. Even any clause avoiding debenture trustee from liability, any clause in the trust deed protecting debenture trustee from any liability, such clauses will be treated as void. So he is 100% liable, but he can be protected with the consent of 3/4 total value of debentures of such clause. If 3/4 total value of debentures of such clause give approval, then his liability will become 0, or else he is liable in all the negligent cases. Next one, company is liable to pay interest periodically, and company should repay debenture amount as it promised. Suppose if company is not in a position to pay the amounts, if it is not in a position to pay the amounts, maturity date, it is after 1 year, but right now company is losing its solvency position, company is becoming insolvent, then trustee can file a petition with NCLT. It's like an anticipatory breach. Today it didn't commit any breach, but after 1 year it may commit breach, sir, definitely. So trustee can file a petition with the tribunal stating that, sir, please stop company from incurring new liabilities. Now NCLT will order company, yes, stop incurring new liabilities. After repayment of these debentures, you can incur new liabilities. Next one, suppose on maturity date itself, if company made default, on maturity date company made default, then any debenture holder can file petition with NCLT. NCLT will order company to pay interest, to pay principal portion to the debenture holder. The difference between ninth point and D point is only simple. Ninth point is like anticipatory breach. As of now, it is not maturity, it is not at maturity, before maturity, but company may commit default, whereas D point, company is already at a default. So in ninth point, trustee will file a petition, because debenture holder don't know the position of company, only trustee will know the position. Trustee will file a petition with the tribunal. Here debenture holder or trustee can file a petition. Now with respect to security of debentures, debenture trust date, and then inspection of debenture trust date, debenture certificate, debenture redemption reserve, all other matters, any matter, central government is having superior power to frame rules. It is having a power to frame the rules. So the parliament is giving power to central government to frame rules with respect to these points. And next one, debenture redemption reserve. Debenture redemption reserve, this is one more crucial point. So how much, sir? It is 10%, 10%. So 10% of outstanding debentures, they need to create a reserve account. They need to create reserve. So with respect to the debenture redemption reserve, you just have this chart, you just have this chart. All India financial institutions no need to create any debenture redemption reserve with respect to both public issue and private placement. And next one, NBFCs, with respect to public issue, they need to create DRR of just 10% of outstanding value. Now, listed companies are also not required to create any DRR. And coming to the unlisted, other companies, other than companies which were prescribed above, for them, 10% of value, both, public issue as well as 10% of value under private placement, all these, they need to create a debenture redemption reserve. So just go through this question one time. And after maintenance of DRR of 10%, 15% that is maturing the year, 15% maturing during the year, you need to maintain that balance on liquid assets. Similar to the deposits, you need to create deposit repayment reserve and you need to invest that money on liquid assets. Here also, you need to maintain 10% reserve, but 15% on liquid assets. I know they need to reduce it, but okay, fine. 10% provision, 10% provision. And whatever the funds you kept aside under a provision, that money, you need to keep it on liquid assets. But percentage to be maintained on liquid assets is 15% of debentures maturing during this year. Clear? So if they are convertible debentures, then no need to maintain DRR, no need to invest on liquid assets. If they are partly convertible debentures, so non-convertible portion, on that only you need to maintain DRR. On that amount only you need to maintain liquid assets. Is it clear? So with this, share capital and debentures chapter marathon completed. The next topic of revision is registration of charges. So section 77 to 87, already 2 sections were omitted from this syllabus. So 9 sections and you can expect 5 marks from this topic, very small topic and scoring topic. Let's begin the discussion. So what is a charge? Charge means, for getting a financial assistance, if borrower is providing his properties or assets as a security to the lender, it is nothing but charge. So charge is nothing but providing properties as security. So from Companies Act point of view, charge means interest or lien created on property or assets of a company or any of its undertakings or both as security, and it includes mortgage. So yes, company here in this chapter, company stands in the position of borrower. For getting financial assistance, it may provide its properties or assets or any of its undertakings. Undertakings means group of assets engaged in a project. So to run a project, what are all the assets are required? That group as a whole, I can call it as undertaking. Or undertaking and property or assets of a company both as a security. So if I am creating some interest on the asset, and if I am transferring that interest in favor of a lender, it is nothing but charge. And charge includes mortgage. That means whatever the provisions that are applicable to charge are equally applicable to mortgage. So charge will comes into picture only whenever company borrows some money providing assets as a security. So here, yes, what kind of properties can company provide as a security, or what kind of properties will be involved in the charge? Only tangible or intangible, sir? So both tangible and intangible, movable and immovable, so all are covered. But if company is providing movable property as a security, where the possession of movable goods lies with lender, in that case registration of charge is not applicable, not mandatory. But where the company is allowed to use the goods, that means hypothecation. So company is having possession of the goods, company can deal with the goods. In that case, registration of charge is mandatory. So charge can be created on both tangible properties and intangible properties. Charge can be created on movable property as well as immovable property. Sir, where the property should be situated? Either in India or outside India. So listen carefully. Charge can be created on any property, whether it is situated in India or outside India. And we had two types of charges. One is fixed charge, the other one is floating charge. Fixed charge, floating charge. Sir, how can we differentiate, sir? Very simple. Answer these two questions. Answer these two questions. What kind of property? So is it identified property? Yes, sir. Identified property. So charge was created on the identified property, sir. Fixed in nature, sir. Then it is fixed charge. Sir, unidentifiable, sir. For example, closing stock, inventory, debtors, we can't identify them. They're fluctuating in nature. Their nature is fluctuating. So balances keep on increasing, balances remain constant, or balances may come down, sir. So in that case, the charge is floating charge. So this is first question. So what kind of property is involved? So at the time of creation of charge, if assets are identified, if assets are in identifiable condition, then it is fixed charge. Whereas if assets are in fluctuating nature, then it is called floating charge. Next one, dealing in the assets. Dealing in the assets. Is company allowed to sell the charged property or not? If answer is no, sir, company is not allowed to sell the charged property, sir. It is fixed charge. Say for suppose I provided my immovable property as a charge. I created charge on immovable property. Now I can use that property, whereas I can't sell the property without consent of a money lender. In that case, it is fixed charge. Whereas if you take inventory without consent of banker, without consent of lender, I can freely sell them. I can freely deal with such a charged property. Then it is a floating charge. So what kind of property is engaged? And next one, is borrower allowed to deal with the assets or not? So these two questions will answer you whether it is a fixed charge or floating charge. And next one, my dear students, it is crystallization of charge. Crystallization. What is meant by crystallization, sir? Crystallization word is applicable only to the floating charge. So upon crystallization, the floating charge automatically gets converted into fixed charge. So it is no more a floating charge. It will be treated as fixed charge. That means the borrower is not entitled to deal with such a charged property. So the charged property will be 100% under the control of a lender. Are you getting my point, students? So crystallization will happen based on some events. Suppose if company is if company defaults in payment of interest, if company defaults in repayment of principal portion, or if company stop doing business, or if company going into the position, going into liquidation position, in those cases, yes, the charge holder, sir, first of all, who is the charge holder? In charge concept, you can find two persons. One is borrower, the second one is lender. So in Companies Act, the charge holder is nothing but lender. That means in favor of whom you are creating charge. In favor of whom you are creating charge, that person is charge holder. And company stands in the position of borrower. Are you getting my point? So now the point is the charge holder will come forward and he will crystallize the floating charge upon happening of few events specified in the agreement. Are you getting my point, students? So floating charge, as long as the charge is floating as long as charge remains as a floating charge, company is free to deal with the charged property, company can sell it. But the point is, upon crystallization, I repeat, upon crystallization, so it becomes fixed charge and charge holder will get control over the charged property. So that's it. This is all about basics of the charge. Next one, registration of charge. Here begins the first section, that is 77. So whenever company provide any asset as a security in favor of lender, it is the duty of company to register the charge with ROC. It is immaterial whether the property was located within India or it is located outside India. It is immaterial, but company should register the charge. So registration with ROC. For that, company need to file CHG1 or CHG9, whatever the case may be. They need to fill these forms and they need to file these forms with ROC. ROC, upon verification, it will register the same and issue registration of charge certificate. Understood? So now the point is, who will sign this CHG form, sir? So CHG form should be signed by two parties, borrower and lender. Borrower means company, lender means charge holder. On behalf of company, any director can sign it. KMP, key managerial person, can sign it. On behalf of charge holder, authorized person will sign the same. So what is the time limit, sir? What is the time limit for registration of charges? You can see here, when your charge was created. Sir, my charge was created before 2nd November 2018. So on 2nd November 2018, we got an ordinance, Company Amendment Ordinance 2018. So on the date, what happened, sir? So till that date, whatever charges created, for them, the original time limit is 30 days. Within 30 days of creation, that means the moment you created charge, how can we know, sir? You might have executed mortgage deed. So company and lender might have executed mortgage deed, right? So from the date of execution, within 30 days, register charge with ROC. If not, you'll be given additional 270 days. That means total how many days? 300 days. So within 300 days of creation, by paying additional fees, register the charge with ROC. Sir, I failed to register within 300 days of creation, sir. So on 2nd November 2018, the lawmaker gave you 6 months transition period. So even 300 days completed, no problem. You are given 6 months time period, comply all the provisions. So simply, register, file all the documents with ROC for the purpose of registration of charge. But whatever charges created on or after 2nd November 2018, they reduced the time limit. Original time limit 30 days is as usual, but extra time limit, extra 270 days, they reduced. How they reduced it, sir? So if you register charge within 30 days, normal fees is sufficient. Payment of normal fees, 600 rupees, say for suppose 600 rupees is sufficient. But if you fail to register within 30 days, you'll be given additional 30 days. That means total 60 days. But for this, you need to pay additional fees and you need to take consent of ROC. Sir, I failed to register within 60 days, sir. No problem. Lawmaker is giving you additional time limit of 60 days. So MCA, Ministry of Corporate Affairs, so the government of India is giving you additional 60 days. But for this, you need to pay normal fees as well as ad valorem fees, value-based fees. Of course, ROC approval is must and should. So here you can find total how many days, sir? So 120 days. 120 days is the time limit for registration of charge. Previously it is 300 days. Now it is 120 days. So remember, original time limit 30 days. Additional time limit 30 with the consent of ROC and on payment of additional fees. But if still you fail to register within 60 days, additional period of 60 days were provided. So who will register the charge? First obligation is on the company. Remember, first obligation is on the company. But if company fails to register the charge, then charge holder can file an application. charge holder can file an application with ROC. The moment ROC receives application from charge holder, it straight away won't register the charge. It will intimate, it will give notice to the company, 14 days notice. 14 days notice means the company has to give response within 14 days. So now, company is having three options. Either company may register that charge on its own, or company may give response, company may give reply, sir, we entered into the loan contract but it was failed, we withdraw our application because of so and so reasons. Like that, company can file a response with ROC. Third one, company remaining silent, company remains silent. So in first case, ROC will register the charge on application of the company. Second case, ROC will intimate the same to charge holder. Third case, if there is no response from the company, if there is no reply from the company, now ROC will register the charge according to the data submitted by charge holder. Now for getting registration of charge, whatever normal fees or additional fees paid by the charge holder is entitled to get reimbursement from company, because it is the duty of company to register the charge. Since company failed to register the charge holder will pay that amount and charge holder will get reimbursement from the company. So first whose duty to register the charge? Company. Second, who can register the charge holder. And third one, purchaser. Suppose company entered into a loan contract with SBI. Company created charge on one immovable property and it got registered with ROC. Later, one person purchased this property. For example, Mrs. P Limited acquired that property. Now P Limited is treated as purchaser. So now it is the duty of P Limited to register the charge with ROC. If P Limited settles that loan amount, then no need to register the charge. Suppose if P Limited took both property as well as it took loan takeover happened. Now it is the duty of a purchaser to register the charge with ROC. How to register? I already told you. There are forms CHG1, CHG9, depending on if it is a normal loan, one form. If it is a debentures, if it is involved in debentures, then another form you need to file. What is the time limit? Just now I told you, original time limit 30 days. Extended period, according to the amendment latest, in the year 2022, the additional 30 days will be given, and then additional period of 60 days also given. So total time limit is 120 days. But for 120 days, you need to pay normal fees, additional fees, ad valorem fees. And ROC consent is also very much required. So verification of instrument of charge, that means signing of the charge instrument. So who will sign? On behalf of company, director, secretary, or any authorized person, a person having interest in the charge, and on behalf of charge holder, any authorized representative can sign the charge document. So extension of time limit already completed. Next one, issue of certificate of registration. Once once ROC receives the information either from company or charge holder or from purchaser, based on these details, ROC will register the charge and it will issue certificate of registration of charge to both borrower as well as lender. Once certificate is issued, it will be treated as conclusive evidence. That means all the applicable provisions, rules have been complied. Next one, subsequent registration not to prejudice rights of the charge holder. Suppose it is the duty of company to register charge within 30 days. However, company failed to register charge within 30 days. It somehow filed all the documents on 90th day. So delay of 60 days happened. Now in this case, on behalf of company, the director should file a declaration stating that, sir, due to delay in registration, due to subsequent registration, there is no prejudicial impact on the subsequent creditors, on the subsequent debts. Due to late registration, there is no adverse impact on the creditors, sir. So we are in a solvent position only. We can discharge all the debts which we borrowed during this time period. And finally, my dear students, so what happen if registration of charge is not done? What happen if registration of charge is not done? Actually, whenever you are providing immovable property as a security, under Transfer of Property Act, right? Under Transfer of Property Act, you need to register that mortgage with local registrar, with a in registrar office. So this registrar is different. He is not ROC. So yes, property registrar. You need to register mortgage under Transfer of Property Act. But our Companies Act is telling that even if you register that mortgage under Transfer of Property Act, but if you fail to register the charge with ROC, I will treat that registration as null and void. That means whatever mortgage you created, whatever charge you created, if you fail to furnish the information with ROC, if you fail to register the charge, then the creation, the charge which you created will be treated as null and void. That means subsequently if company goes into liquidation and liquidator came forward to take all the properties of company to pay the loans, selling the property and whatever money is getting in order to pay the loans, at that point of time he will arrange all the creditors in a line, like secured creditors, unsecured creditors, preference shareholders, equity shareholders. But if your charge is registered, if your charge is registered with ROC, you will be treated as secured creditor, or else you will be kept under unsecured creditors. Accordingly, you will get the money. That means you won't get any right on the mortgaged property. So now who will be in the risk, sir? Obviously charge holder. Are you getting my point? So charge holder should take care that whether charge was registered or not, or else the mortgage which was created under Transfer of Property Act or under any other law will be treated as null and void. Yes, Companies Act is having that power to make to invalidate, simply to make that mortgage invalid. Are you getting my point, students? So next one, so registration of charge is compulsory. So next one, application for registration of charge by charge holder under section 78. I told you, if company fails to register charge within 30 days, then charge holder can directly file application with ROC. ROC will give 14 days intimation to the company with respect to registration of charge. If company registered the charge, no problem, or else ROC, if no response from the company, if there is no response from the company, then ROC will register charge in favor of charge holder and he will issue certificate of registration of charge, and charge holder is going to get the money which he paid to ROC from company, as we already discussed. Next one, write about company acquiring property already subject to the charge. So this is all about purchaser concept. So if company is acquiring charged property, then it is the duty of a purchasing company to register the same with ROC, or else that mortgage will become void. That's it. Next one, modification of charge. Modification or amendment, alteration, one and the same. So at the time of entering into the loan transaction, borrower, simply company, borrower, and lender, simply banker or any person, they might have entered into a contract which will contain terms and condition. So amount, loan amount, rate of interest, and tenure. So if there is any change in the terms and conditions of the contract, it is nothing but modification. So any modification happened to the charge, then once again section 77 is applicable. So it is the duty of company to register that modification, same as like creation of the charge. So what is the effect of modification, ma? The company should register such modification with ROC, same like creation of charge, or else modification will be treated as null and void. Originally I took loan of 60 lakhs. Later, due to my repayment history, due to my payment history, or due to increase in assets, the banker agreed to give extra finance So he increased my finance to 90 lakhs. So originally I registered charge with 60 lakhs. Now I got extra 30 lakhs. Now I need to register this modification, or else 90 lakhs rupees charge will be treated as void, 60 lakhs rupees charge will be treated as valid. So and then if floating charge is getting converted into fixed charge, such kind of modifications also you need to register with ROC. Are you getting my point, students? So simply, very simple, section 79 modification is similar to section 77 registration of charge. At the time of creation of charge, whatever provisions are applicable, same provisions are equally applicable when you modify the charge. Next one. Of course, upon filing the documents, ROC will register the same and ROC will issue certificate. That certificate will be treated as conclusive evidence. Next one, section 80. This is all about doctrine of constructive notice. I told you constructive, deemed, notice, intimation. In incorporation chapter also I told the same point. When you file a piece of paper with ROC, it becomes public information. It becomes public information. So when you are registering charge with ROC, when you are filing all the documents with respect to charge with ROC, it becomes public information. Now any person dealing with charged property, the court, the ROC, everyone assumes that he had knowledge of charge. So later he can't deny that, sir, I don't know, sir. I don't know. I thought that this property is free property. This is not charge hold property. I thought that this is a freehold property. That's why I purchased it. So I won't pay you loan. Like that, the purchaser is denied from making such statements. So rule of estoppel will apply. This is all because of section 80, that is deemed notice of the charge. Next one, write about reporting of satisfaction of charge. Once we register the charge and companies start paying the loan amounts, EMI. So companies started paying the loan amounts. So the tenure is, for example, say for suppose 7 years. 7 years. 7 years completed, company repaid the loan. That means the purpose of creation of charge is satisfied. Why you created charge? So for getting loan, I provided some property as a security. Now when you repay that loan, that security, whatever you provided as a security, it is said to be satisfied. So similarly, the charge is satisfied. Now you need to register the satisfaction of charge with ROC. Same like, whenever you created charge, you need to file it with ROC. Similarly, whenever you discharge loan amount or whenever you sell that property to someone else, and finally you came out of that obligation, you had no that loan obligation. In such cases, it is the duty of company to file satisfaction of charge with ROC. What is the time limit, sir? Original 30 days. First time limit 30 days. But if you fail to register within 30 days, no problem. You will be given additional 270 days. That means total 300 days. But for this, you need to pay additional fees. On payment of additional fees, you can file this form within 300 days of payment or satisfaction on payment. Discharge of loan, discharge of obligation. From that date, within 300 days, you can file, provided you need to pay additional fees. So once here, company, charge holder. Now company is filing satisfaction of charge with ROC. Listen carefully. Company is filing satisfaction of charge with ROC. ROC won't register that satisfaction until he get a consent from the charge holder. So here ROC will give intimation to charge holder. 14 days intimation is given to the charge holder. Within 14 days, if charge holder gives no objection, then ROC shall register the satisfaction of charge. Suppose if there is no reply from charge holder, then also ROC will presume that yes, the charge has been discharged. The charge has been discharged. Accordingly, ROC will issue certificate of registration of satisfaction of charge. Here ROC will give memorandum of satisfaction of charge to the company. But this intimation of 14 days is not required when charge holder furnish no objection certificate to company, and company furnished the same no objection certificate to the ROC. That means if charge holder give NOC to company, come on, get your charge, get your satisfaction of charge registered with ROC. So this is our no objection. Like that, if charge holder furnish that information to company, and if company file the same with ROC, then this 14 days intimation is not required, or else ROC can't register the satisfaction of charge without giving notice to charge holder. Is it clear, my dear students? So company's duty to file satisfaction of charge with ROC. What is the time limit? 30 days. Normal fees. 30 days completed, sir. Additional 270. That means total 300 days. But you need to pay additional fees. However, if company failed to furnish this information, suppose 300 days also completed, company failed to file this information. Now ROC on suo moto, that means on its own motion, can register the satisfaction of charge. What it means, sir? How ROC know about satisfaction of charge? Very simple. I took loan for 7 years. 8 years completed or 9 years completed, but still there is no response from the company. Now ROC, through its authorized sources, it may conduct inquiry, it may conduct investigation. So upon the information what it receives, suppose the charge is already discharged, sir. Now ROC, recording the same facts in the register, it will issue certificate of registration of satisfaction of charge. So this is ROC suo moto power. Just go through this box, you'll come to know each and every point. So this point, powers of ROC, right? So once you file these documents, ROC will issue certificate of satisfaction. Once company receives certificate of satisfaction, now the property is freehold property. Company can mortgage that property with a new lender. So now section 83 also I completed, ROC upon preliminary investigation, if it comes to know that the charge has been discharged, the charge has been released, the properties has been released from the charge. Now on suo moto, it will issue certificate of satisfaction of charge, and it will furnish information to the affected parties. Finally, it will issue the certificate. Understood? And 2-3 small points are pending, that is section 84. See, in this section 84, suppose, imagine company as well as charge holder, they might have entered into an agreement stating that if company fails to pay 2 months installment consecutively, terms and conditions, I'm telling you terms and conditions. If company fails to pay 2 installments consecutively, then charge holder can appoint a receiver who can take right on the property, who can take possession of the property, and he can collect the revenue of the property, whatever amount, whatever income earned by the property, the receiver can collect it, and he will appropriate that amount against loan. Simply he will take charge on the property, he will take control over the property. So the moment company fails to pay installment consecutively 2 months, then charge holder can appoint receiver. Like that, you can place conditions in the charge document, you can place conditions in the contract. And suppose company really it failed to pay installments 3 months consecutively. As per this agreement, charge holder is having power to appoint receiver, and charge holder appointed receiver. So this receiver will take control over the property. Whatever rental incomes, company is getting from the property, the receiver will take the amount, and receiver will adjust that amount against loan. And the moment, company start paying the loan, the role of receiver will come to an end. Now section 84 is levying a responsibility on the charge holder. It is levying responsibility on the company. So what responsibility, sir? What responsibility? The moment such receiver was appointed, within 30 days, so they need to communicate with ROC with respect to appointment. And the moment the role of receiver comes to an end, again you need to file information with the ROC. Are you getting my point? Now ROC shall register the same. So appointment of receiver, removal of receiver, everything ROC will record the same. Are you getting my point, students? So if any person, charge holder appoints such receiver or person under any power contained in any instrument, he shall give notice of such appointment to the company and the ROC along with the copy of order or instrument within 30 days from passing the order or making the appointment. Understood, ma? So responsibility, simply section 84 is whenever official receiver is appointed or whenever official receiver was terminated, so the charge holder should give notice to both company as well as ROC. ROC will record the same and he will issue the certificate. Next one, write about punishment for contravention with provisions of registration, modification or satisfaction of charge. Simply, whenever a violation happened under this chapter, chapter number 5, it's not 5, chapter number 6, registration of charges. So violation under registration of charges, chapter 6, the punishment under section 86 gets attracted. What is the punishment, sir? No, company is liable with penalty of 5 lakh rupee and officer who is in default shall be liable to a penalty of 50,000. And if they do fraud, that means, modifying the documents. Already I provided one property as a security in favor of SBI. Now morphing the documents, providing same documents to the Axis Bank or to some other person. Simply, if my intention is to fraud the public, to fraud the lenders, then I'll be punished under section 447. Section 447 punishment, everyone is aware of the section 447 punishment. So depends upon, public interest. If public interest is affected, then fine would be minimum, fine would be amount involved in the fraud, maximum 3 times of the amount involved in the fraud. What is the punishment under section 447? Fine, minimum amount involved in the fraud, maximum 3 times of the amount involved in the fraud. And imprisonment, minimum 3 years, maximum 10 years. Minimum 3 years, maximum 10 years. So public interest is safe, sir. Public interest not affected. In that case, you need to check whether it is a greater magnitude or lesser magnitude. That means amount involved in the fraud, you need to compare it with rupees 10 lakhs or 1% of turnover, whichever is less. So just compare amount involved in the fraud with 10 lakhs or 1% of turnover, whichever is less. If it is less than this limit, then it is lesser magnitude. The punishment is very simple: imprisonment up to 5 years or fine up to 50 lakhs or both. I'm not writing in detail, just I'm just telling you, this is a revision class. I'm not writing in detail, just follow my words. Imprisonment up to 5 years, fine up to 50 lakhs or both. But if it is a greater magnitude, that means, greater than or equal to 10 lakhs or 1% of turnover, whichever is less, then same punishment, instead of 3 years imprisonment, it is 6 months imprisonment. Minimum 6 months imprisonment, maximum 10 years imprisonment. With respect to fine, minimum amount involved in the fraud, maximum 3 times of the amount involved in the fraud. Next one, powers of central government. This is like a residual section. So it's almost like, revision of income tax return. I furnished an income tax return. I found some mistakes in my income tax return. Now what I'll do, I can revise it. For that, government approval is not required. Within the time limit, I can revise income tax return as many number of times I can. But here, if you file any information with ROC and if you find any mistake in such forms, then with the approval of government, you can revise them, you can modify them. So any misstatement or any omission in the particulars of the charge, previously made to the register, so with the approval of central government, you can modify them. And moreover, when the time limit is over, suppose within 300 days I need to register satisfaction of charge. Suppose 300 days completed. 300 days completed. Now file an application with CG. With CG approval, you can file satisfaction of charge with ROC. So central government power in two cases. One is delay in filing satisfaction of charge, and the second one is omission or any misstatements in the charge documents which were already filed with ROC. So this is all about government powers. So with this registration of charges revision completed. Very simple, section 77 company duty. You need to remember time limit. Section 78 charge holder right to register the charge. Section 79 acquirer, purchaser has to register the charge. 80 it is all about doctrine of constructive notice. And then we saw satisfaction of charge and then appointment of official receiver. Finally, punishment for violation of this chapter and powers of central government. Very simple chapter. Don't neglect. Read twice. Next topic, acceptance of deposits. So section 73 to 76A. You can expect 5 marks from this topic. Very small topic, and you can score maximum in this topic. So let's begin the topic of deposits. So this entire chapter, chapter number 5, deposits and company rules, company acceptance of deposit rules. This particular chapter and these rules are not applicable to, remember this point, there is a chance of getting a practical question. These are not applicable to NBFC companies, banking companies, housing finance companies, and companies specified by CG in consultation with RBI. So beginning of chapter only I'm telling you this point. They may ask a practical question. A company engaged in NBFC want to accept deposits from public. So how much percentage of paid up share capital and reserves and surplus, so they can accept deposits. I mean, simply to what extent they can accept deposits, or what are the procedural formalities, they may ask you. You ignoring this word, NBFC, banking company, housing finance company, if you ignore this word and if you write detailed procedure, you'll get 0 marks. You're going to get 0 marks. So this entire chapter is not applicable to 4 companies: NBFC, housing finance companies, banking companies, and then companies specified by central government in consultation with RBI. And deposit, obviously it is one source of finance. To meet their very short-term requirements or short-term requirements, yes, company will accept deposits from the public as well as from the members. So which company will accept deposit from public, which company can accept deposit from members, all these points and procedure for acceptance of deposits we are going to cover in this marathon. So first of all, what is meant by deposit? Any receipt of money by way of deposit or loan, or in any other form, it is called deposit. So the definition is very clear: any receipt of money in the form of, that receipt is not because of sales, because of providing services. It should be in the form of deposit or loan, or in any other form, we call it as a deposit. But deposit excludes certain categories of amounts were excluded from the definition of deposit. That means this chapter and company acceptance of deposit rules 2014 are not applicable to the exempted deposits. So it is very important to remember the exempted deposits. Let's begin the exempted deposits. Here I am going to give you notes. You need to remember. No need to reproduce them in the exam, but there is a chance of getting a true or false question or a multiple choice question. So that's the need. So you need to remember, and I'm going to write it on the notepad so you can copy it. So exempted or exclusions, you can remember in this manner. So if you accept any money from the following institutions, namely government, local authority, statutory authority. Government means central government, state government, both, and then local authority, statutory authority. Any loan you receive from them, any receipt of money from them is not a deposit. Next one, foreign government and foreign bank, foreign multinational multilateral financial institutions according to FEMA guidelines. So foreign multilateral financial institutions subject to FEMA regulations. And then next one, from public financial institutions, PFI, public financial institutions. Next, from banks. And next, from other companies, simply, intercompany borrowings. Intercompany borrowings. So from holding company or from subsidiary company, from other companies. So if you receive any amounts from these institutions, they are not categorized as deposit. So remember these five names. And the next one is from instruments point of view. Institution completed from instruments point of view. So if you collect money by issuing these instruments, they are also not treated as a deposit. First one, commercial papers. They serve as short-term borrowings, ma. So to meet the liquidity crunch, companies, banking companies, financial institutions are allowed to issue commercial papers. So they are short-term promissory notes, and they are also not categorized as a deposit. And then subscription money with respect to any kind of security. Subscription money, if you make allotment of securities, then it is not a deposit. If you fail to make allotment, then you need to refund within 60 days. Sorry, you need to make allotment within 60 days of receipt of money. Within 60 days of receipt of money, if you are making allotment, then it is not treated as a deposit. Or else a refund within 15 days from the expiry of 60 days. Refund within 15 days from the expiry of 60 days, then also it will not be treated as deposit, or else it will be treated as deposit. Next one, secured bonds, secured debentures. I repeat the word, secured debentures are also not treated as deposit. Sir, convertible debentures, but that conversion should happen within 10 years from the issue. 10 years. So even though if they are unsecured, but if they are convertible, then also they are not treated as deposits. Next one, listed debentures. Listed debentures are also not treated as deposits. So that means, unsecured, non-convertible, unlisted debentures, straight away they will be called as deposit. It was not there, but we can understand. So secured, not a deposit. Convertible debentures, not a deposit. Listed debentures, not a deposit. So these are the instruments. Next, from person's point of view, if you receive money from the following persons, then also it is not treated as deposit. So who are they? First one, directors of the company. In case of private company, relatives of directors, relatives of director. In case of private company, in public company, relatives are not covered. And the next one is unsecured loan from promoters. Unsecured loan from promoters. So straight away I won't tell that they are not deposits, but some conditions are there. Suppose when you receive money, when you receive loan from directors should furnish a declaration. They need to give a declaration stating that this money belonging to us. They are not the money which we are lending to the company, it is not out of borrowed funds, it is from our own funds. Like that, they need to furnish declaration, then only it is not treated as deposit. Even in case of unsecured loans also, this unsecured loan should be given because of stipulation kept by a bank. Any bank or financial institution, they put a condition that yes, we can grant loan to the company provided promoters should contribute some unsecured loan to the company. And this unsecured loan is not treated as deposit till company repay loan to bank or financial institutions. Once company repay complete loan to the bank, from that point onwards, this unsecured loan from promoter will be treated as deposit. So how long unsecured loan from promoter is not treated as deposit? Till the company repay loan amount to the bank or financial institutions. And then employees. Next one, employee security deposit. Employee security deposits. Employee security deposit, but here we had two conditions. Condition one, maximum 12 months salary. Maximum 12 months salary. And next one, non-interest bearing security deposit. Non-interest bearing security deposit. If these two conditions are satisfied, then any deposit received from the employee in the form of security deposit, any amount received from employee in the form of security deposit is not treated as deposit. So if it is more than 12 months salary, then it is a deposit. Sir, less than 12 months, sir, but company is paying interest on the deposit, sir. Now also we call it as deposit under this chapter. Next one, from business point of view. All trade advances, that means whatever amount you receive from the debtors is not treated as a deposit. And interest advance received in the form of trust, no, advance, it's not advance. Amount deposited with company, and company is like a trustee. So company having fund in the position of trustee, company holding fund in the position of trustee, and company is not paying any interest. So non-interest bearing amount held by company in the position of trustee, so this is also not treated as deposit. And finally we are left with one category, that is companies. Following companies, even they receive amounts in the form of loan or in the form of advance or in the form of deposit, those amounts are also excluded from the deposit. So what are those companies, sir? So Nidhi company, you all know, for cultivating the habit of savings among the among the members in the rural areas. So we had a concept called Nidhi company. And then next, chit fund company, even if they receive money from their customers, clients, it is not treated as a deposit. Next, startup company. There is interesting point in startup company here. Under single tranche, so single transaction, company should get 25 lakhs or more, and this would be convertible note. By issuing a convertible note, which should be converted within 10 years. Recent amendment is there. Previously it is 5 years, but now it got increased to 10 years. We can go through it. And then collective investment schemes, companies conducting these kind of schemes. Next one, mutual funds, alternate investment schemes, mutual funds, venture funds, real estate venture funds, real estate investment trust, etc. Alternate investment scheme, mutual funds, real estate investment trust, etc. So all these amounts received by them is treated as exempted deposits. So now I hope everyone can easily remember these exclusions. Government amounts received from government, local authority, statutory authority, amounts received from foreign government, foreign bank, foreign multilateral financial institutions, then public financial institution, loans received from banks, borrowings from intercorporate, simply intercorporate loans, and amount received by issuing commercial papers, subscription money up to 60 days of receipt of money is not a deposit. And if you make allotment, it is not a deposit. Or else if you need to refund within 15 days, then also it is not a deposit. But if you fail to refund within 15 days after expiry of 60 days, then it will be treated as a deposit. So all secured debentures, not a deposit. Convertible debentures, which should be converted within 10 years from issue, not a deposit. And then listed debentures, listed on any one of the recognized stock exchange. And then amounts received from the following persons, amounts received from in the form of because of doing business, and amounts received by the following companies. All these are not at all considered as deposits. So you can easily highlight these points in a material. When you're going through the material, you can easily identify them. So these all are institution, governments, foreign governments. In that manner only our material has been drafted, you can see here public financial institutions, and then commercial papers, intercorporate loans. So I kept 6 point ahead of 5th point, and remaining you can see these all are the securities only. Just give one time reading, very important. And then loan from directors, persons, I categorize them as persons. Bonds and debentures I categorized as instrument. So for simple remembering the points, I gave that notes. You can follow our material. It is sufficient. Convertible debentures, non-convertible, but if they are listed on a recognized stock exchange, then also not a deposit. And then, from trust and from employees, two conditions to be remembered. One is security deposit, 12 months salary, and non-interest bearing security deposit. Advances from the commercial transactions, business advances. Here you need to remember, it should be adjusted within a period of 365 days. Sometimes you can get advance for immovable property. They are also not treated as deposit. Security deposit for goods or services. Advances for long-term projects. Advance for AMC contracts. And then sectorial permitted advances, you can see in prospectus chapter also. Advance for subscription, right? And then deemed deposits, we discussed this point also. Advance for subscriptions, any advance for subscription towards publication in any media against receipt of such publications, it will be treated as revenue to those companies. Understood? Next one, loan from the promoters. I told that conditions. So bank or financial institution should put a stipulation. Because of that condition only, they should lend some money to the company. And as long as they repay loan to the bank or financial institution, loan from unsecured loan from promoters are not treated as deposits. Nidhi company, chit fund company, collective investment schemes, startup companies, and then REIT, IFIT. So I covered each and every point, my dear students. Very, very important to remember these points, because every 2 attempts out of 3, 2 out of 3, there is a question on exempted deposits. So that's what, very important. So I took almost 12 minutes to explain the same. Next one, explain the meaning of depositor under rule 1D of the acceptance of deposit. So who is a depositor? The person who makes deposit, he is called a depositor. But here you need to understand from eligible company point of view. What is eligible company, sir? It should satisfy 3 conditions. One is public company, and next one, it's net worth 100 crores or more, and its turnover 500 crores or more. So if any public company satisfying these 2 conditions, then we call it as an eligible company. Eligible company can accept deposits from both members as well as public. I repeat, eligible company can accept deposits from both members as well as public. So from eligible company point of view, who can be the depositor, sir? Either member or public. Other companies, other than eligible company, for other companies, only member can act as a depositor. Only member can act as a depositor, because other companies can accept deposits only from the members. Eligible company can accept deposits from both members as well as public. Next one, write about prohibitive provisions and companies that are exempt from the prohibitive provision for acceptance of public deposits. Already told you at the beginning of this chapter, any banking company, NBFC, housing finance company, and company specified by CG in consultation with Reserve Bank of India. Next one, write about provisions relating to acceptance of deposits from members. This is applicable to all the companies. Companies which are accepting deposits from members, they need to satisfy these conditions. First one, as usual, you need to take approval from the members. Ordinary resolution is sufficient. So why? Why? Because company, part of profits company is paying as interest to the deposit holders. Actually, this money is belonging to the equity shareholders. So money belonging to shareholders, out of that money, you are paying some money to the deposit holders. That means whose interest is getting diluted? Equity shareholders. So members' consent is necessary. Next one, you need to prepare a statement called circular. So when you make public offer, prospectus will come into picture. When you make offer to the identified persons up to 200, then private placement will come into picture. If we are making offer of shares to the existing members, then there comes rights issue, there comes letter of offer under rights issue. And whenever you want to accept deposits, here you need to make a statement, you need to circulate a statement. We call such statement as circular. So in that circular, the statement should be there with respect to position of the company, financial position, credit rating. It depends upon the performance of the company. It depends upon the company payment capacity. So capacity of company in meeting the uh, liabilities simply on due date, are they capable to repay or not? So what is the past track record, what is the position of the company, how the company can generate revenue, how the company can generate profits. Depending on all these factors, credit rating agencies will give credit score to the companies. It depends on, it's like triple A plus triple A and double A plus double A plus A, like that, certain rating will be provided. That rating should be circulated, and outstanding amount of deposits and total number of depositors as on the date of circular. Next one, such other particulars as may be prescribed. So all these points should be there in circular. This circular should be first filed with ROC, at least 30 days before circulation among the members. Next thing, you can give it to the members. So yes, you are asking, so simply you're making an invitation to offer. So whoever interested, the members whoever interested, they will deposit their savings in the company. And mode of sending this circular, you already know, section 20, speed post, electronic mode, in any format, but there should be a proof of delivery. Yes, we delivered this copy. There should be some kind of proof. Advertisement in newspaper, and finally CA certificate with respect to no defaults. CA certificate with respect to no defaults. So only a company which is regular in repaying deposits principal and regular in paying interest on deposits, only those companies are permitted to accept deposits. So a default company is not allowed to accept deposits. So regular in paying interest, regular in repaying principal. So only such companies are allowed to accept deposits. But the point is, even if default happened, upon rectification, wait for 5 years. So after completion of 5 years, you are allowed to accept a new deposits. So now CA will give a certificate that company had never committed default, or company committed default but 5 years completed. Last 5 years company didn't commit any default. Like that, CA has to give a certificate. Chartered accountant in practice should give a certificate, and you need to circulate this certificate along with circular. And finally, such circular shall be issued on the authority and in the name of board of directors. So simply, a single director giving circular is void. That circular should be issued under the authority of board of directors. Simply, board resolution is must and should. That means first ordinary resolution allowing company to accept deposits. Now preparation of those documents, and these documents require approval of board of directors, board resolution. And whatever you're making advertisement or whatever circular you're giving, it will have a validity period. The validity period is 6 months from the closure of financial year, or actual date of AGM, or due date of AGM, whichever is earliest. Whichever is earliest. So most probably, companies used to conduct general meeting on 30th September only. That means, 6 months from the closure of financial year only. Majority of the cases, I'm not telling all the cases, I'm telling you majority of the cases, these 3 dates look like 30th September of every year. But the point is, the circular which you issued, the advertisement which you made is having a validity of 6 months from the closure of financial year, actual date of AGM, due date of AGM, whichever is earliest. And the prospectus is valid for a period of 90 days. Shelf prospectus is valid for a period of 1 year. So similarly, circular is valid for a period of 6 months from the closure of financial year, due date of AGM, actual date of AGM, whichever is earliest. And then for every financial year, we need to issue fresh circular. And the circular is valid till so and so date, just now we discussed. So before giving circular to members, we need to file it with the ROC. Next one, deposit repayment reserve account. So this is like a provision. So every year, out of divisible profits, the profits which are available for the distribution and payment of dividend, out of the profit you need to reserve some funds. How much, sir? 20% of amount of deposits maturing the financial year. So my deposits, I'm going to repay some 100 crores deposits in the current year. Now 100 crores into 20%, 20 crores. 20 crores. I need to keep a reserve. I need to reserve them. Listen carefully, ma. So with respect to the upcoming financial year, the amounts which were maturing in the upcoming financial year, on that 20% you need to keep a provision. Keeping provision only not sufficient. You need to invest that fund in a highly liquid securities. That means which you can, by selling those securities, you can easily mobilize money. So transfer of the security should be very high. That means, highly liquid assets. In fact, highly liquid assets. So invest 20% of amount of deposits maturing during the financial year on liquid assets. So once again, I'm telling you, you can identify the difference. Provision with respect to next financial year, whereas deposit is with respect to current financial year. So we are in the financial year 2022-23, right? So amount of outstanding deposit, 20% of outstanding deposit maturing current year, you need to invest that money in separate securities where you can easily sell them and you can easily get money to meet the liquidity crunch, in repaying the deposits. But whereas, with respect to provision, keeping aside, that should be with respect to upcoming financial year. That means, financial year 23-24. With respect to provision next year, with respect to deposit in liquid assets current year. Next one, certification as to no default in repayment declaration. I told you that yes, CA certificate is required and this should be circulated along with the circular. Next one, provision of security. If you are accepting secured deposits, I repeat, if you are accepting secured deposits, then you need to provide adequate security. So amount covering both principal and interest amount, you should provide security. Sir, we are not accepting security deposits, sir. We are accepting unsecured deposits. Then clear disclosure of unsecured deposits should be there in circular. You need to give a circular disclosing, yes, we are accepting only unsecured deposits. But if you are accepting secured deposits, whatever assets you are providing as a charge, you need to register the charge with ROC according to chapter number 6. Next one, relaxation for private companies. So far we discussed conditions, ordinary resolution, preparation of circular, right? Next one, contents of circular, no default by a CA, deposit repayment reserve account, and then maintenance of liquid assets, no default certificate by CA, I already told you, ROC filing. All these conditions you need to follow for accepting deposits from members. But out of these conditions, certain conditions were exempted to the following companies. What are those conditions? Issue of circular, ROC filing, deposit repayment reserve account, and no default certificate by company. These are not applicable to whom, sir? Private company accepting deposits up to 100% of paid up capital and free resource and securities premium account. So if you're accepting deposits up to 100% of paid up share capital plus free reserves plus security premium, no need of these conditions. So I'm going beyond 100%, sir. Then you need to follow these conditions. Startup companies for doing ease of business, for easy doing of business, these conditions were eliminated up to 5 years from incorporation. And other private company, but that other private company should satisfy 3 conditions. It should be neither associate nor subsidiary to other company. And the loans, the borrowings from banks, financial institutions, or any other body corporate is less than 2 times of paid up share capital or 50 crores, whichever is lower. And with respect to these borrowings, there should be no default. So these kind of private companies can accept deposits more than 100% without complying the aforesaid conditions. Now, to claim these privileges, these companies should file DPT3 form with ROC in a specified manner, in a prescribed manner, and within the prescribed time limit. Understood, ma? And specified IFSC companies also had this kind of privileges. The only reason is ease of doing business. That's it. Next one, repayment of deposit. Deposits you accepted. Now you are at maturity period. Now what you should do? You need to repay deposit amount. You need to pay interest on deposit. So whatever promise you made, fulfill the promise, or else aggrieved party can file a petition with NCLT. Now NCLT will order you to pay the amounts. Understood? So the amount which you kept aside as a provision under deposit repayment reserve, you should not use that amount for any purpose other than repayment of deposits. So these are special purpose funds. The fund should meet that special purpose only. You can't pay dividends from that fund. You can't use that fund for any other purpose. Next one, tenure for deposits. Minimum, remember minimum 6 months, maximum 36 months. So no company is allowed to accept deposits for a period less than 6 months, for a period more than 36 months. But sir, my requirement is very short term, sir. I need funds only for 4 months, sir, not for 6 months. In that case, you had an advantage. You can accept deposits up to 100% of paid up share capital plus free reserves plus securities premium. But this money you should accept for minimum 3 months. Minimum 3 months. This is the maximum amount you can accept a deposit for a shorter tenure of 3 months. 3 months. Understood? So actual general rule 6 months to 36 months. But exceptional cases, you can accept deposits for a period less than 6, but it should be more than 3. With respect to limit on amount, it should not exceed 10% of paid up share capital plus free reserves plus securities premium. Next one, coming to the maximum amount of deposits, I'll give you a single chart where you can remember each and every point, ma. I'll give you a chart on this. So maximum amount of deposits. So here I'll write, section 73, which can accept deposit only from members. Section 76, an eligible company. 76 is all about eligible company. And here, others. So now, who can be depositor? Who can be depositor? Only a member. Here, member as well as public. Now maximum amount of deposit which you can accept for 36 months is 35% of paid up share capital plus free reserves plus securities premium. 35% of paid up capital plus security premium plus free reserves. Whereas for private companies, IFSC public company, IFSC public, as well as all private companies, including IFSC, all private companies, they can go up to 100% of paid up share capital plus free reserves plus securities premium. Understood? But they are required to file a prescribed form with ROC. Now coming to the eligible company, from members, they can accept up to 10% of paid up share capital plus free reserves plus security premium. Whereas from non-members, simply public non-members, it is 25% of paid up share capital plus free reserves plus securities premium. Interchange not possible. That means from members I'll go with 35%, 25%, sir. From non-members 10%, sir. It is not possible. It is not at all possible. But when you take government company, 35% overall limit, 35% overall limit from public as well as members. Overall limit is 35% of paid up share capital plus free reserves plus securities premium. That means they can accept 35% from public, they can accept 35% from members, or 25-10 or 20-15 or 15-20. Permutations and combination is possible in government company, whereas that is not possible in eligible companies, which are other than government companies. So this is the maximum amount of deposits which a company can accept from the eligible depositors. Understood, my dear students? But as usual, private company which is a startup up to 5 years of incorporation, and a private company which fulfill those three conditions, it is neither associate nor subsidiary to other entities, and which has borrowings less than twice of the paid up share capital or 50 crores, whichever is less, and no default with respect to those borrowings. So these kind of companies can accept deposits without any limit. Means, so 1000% of paid up share capital plus free reserves plus securities premium, or 10,000% or 1 lakh percentage, there is no limit. Unlimited amounts they can accept. So you can see in the material 35% concept, 100%, and there is no limit to the two companies. So after exempted deposits, it is very important to note the limits of deposits. Conditions you can easily remember, circular, members approval, board approval, ROC filing, no default certificate from CA, and then deposit repayment reserve account 20%. You can easily remember, but the limits and exempted deposits are very, very important. And finally, appointment of trustee for depositors. So being an outsider, deposit holders, outsiders, they don't know about internal affairs. So to protect their interests, a company must have depositor trustee. So qualifications of depositor trustee is almost similar to the qualifications of debenture trustee. You can have an overview. Next one, filing of application by the depositor. So for making deposits, they need to file application. So in writing, so simply they can't transfer funds as they like, so they need to file an application. And yes, company can issue deposit certificate in joint names but not exceeding 3. Remember, 3, maximum 3. In case of joint deposit holders, the number should not exceed 3. Maximum 1 certificate can be held by 3 people jointly. And then they can have a nominee. And then issue of deposit receipt. So company should issue deposit receipt within 21 days from the receipt of money or realization of check or application for renewal. So remember this time limit also, 21 days. In case of share certificate, the time limits is like 2 months, 1 month, 6 months for debentures. Did you remember? But for deposit receipt, max 21 days. Within 21 days, company should issue deposit receipt. 21 days from when? Receipt of money. In case of check, realization of money. If it is for renewal, then when they filed an application for renewal, you need to remember. Next one, a register of deposits. So company has to maintain a register with respect to their deposit holders. So yes, date of acceptance, date of payment of interest, date of maturity, all those particulars they need to maintain. Premature payment is also permissible, but 1% will be deducted. If agreed interest, from agreed interest 1% will be reduced. That concept also you can find in the material. And filing of returns of deposits with the ROC. So every company accepting deposits, they need to file DPT3 with ROC. So once you accept deposit terms, you are not allowed to modify the terms of circular without consent of deposit holders. Understood? And then if you fail to repay deposits within the prescribed time, then you need to pay penal interest of 18%. Finally, when you override any of the aforesaid provisions, then this is the punishment. Company and every officer, first 5,000 rupees maximum penalty. And still, if you are not rectifying it, if you're still not making any rectification, and if that contravention is continuing in nature, then 500 for every day during which such contravention continues. Failing to send deposit receipt, example, failing to send deposit receipt within 21 days. So within 21 days, if company failed to send deposit receipt, first punishment, it would be up to 5,000. and you made a delay of 10 days. For 10 days, 10 into 500, extra 5,000. So that is the total punishment on company as well as officer who is in default. Officer who is in default. Next one, this point already we covered in the above question. This question you can see, fifth question, you can find these points, but a separate question. We framed it as a separate question. Next one, eligible public companies. So this one also I covered. So which company comes under eligible company? Public company, net worth 100 crores or more, or turnover 500 crores or more. So let me correct the point which I told you. I told that eligible company means, just wait just listen. Eligible company, here I didn't mention. So yes, previously I told you eligible company means public company. That public company should satisfy any of these conditions: net worth 100 crores or more, turnover 500 crores or more. So let me rectify that point. Initially I told you that net worth and turnover, but it's not and turnover. Net worth or turnover, any one limit satisfied, then we call it as eligible company. So it should obtain approval from the members in the form of special resolution. But remember carefully, many students had a doubt at this point. So ordinary resolution is sufficient in a note point, whereas special resolution is required. What is the difference, sir? My total debts means debentures, maybe loan from banks, maybe deposits. If all these amounts outstanding plus proposed, if they are within the limit of section 180 subsection 1 clause C, that means up to 100% of paid up share capital plus free reserves plus securities premium. Which one? Debts proposed plus outstanding. Proposed plus outstanding. So these proposed debts plus outstanding debts, if they are within 100% of paid up share capital plus free reserves plus security premium, then special resolution is not required. If they exceed 100%, then special resolution is must. Are you all getting my point? So my outstanding amounts plus proposed deposit, if it is exceeding 100%, then special resolution is required, or else ordinary resolution is sufficient. Don't get confused. When you read, read it independently. General rule, if it is within the limits, OR is sufficient. Exceeding the limits, special resolution is required. And for public, eligible company, same whatever we read under section 73 subsection 2, same conditions will apply, but additional condition is they need to obtain credit rating from credit rating agencies every year. As long as they had deposits, as long as they show deposits in their financial statements, they should get credit rating every year, and they should advertise it, they should publish it into newspapers. So this is the only additional condition you can get here. So remaining all the points, we covered it. We covered all the points. So deposits in joint name, nomination, deposit receipt, everything we covered under section 73 subsection 2. And finally, section 76A. Whenever you violate provisions of 73 subsection 2 and 76, then punishment will be imposed on 76A. For example, you accepted deposits but you are not paying them. You are not returning money to the deposit holders. You are not paying interest on deposits. In those cases, punishment will be attracted. So what is the punishment, sir? For company, 1 crore rupees or twice 1 crore or 2 times of deposit accepted, whichever is lower. 1 crore or 2 times of deposit accepted, whichever is lower. This is the minimum fine, minimum punishment. Maximum 10 crores. So don't get confused with 3 limits. There we had only 2 limits. One is 1 crore or twice the amount of deposit accepted, whichever is lower. This is the minimum penalty. Coming to the maximum penalty, 10 crores. This is the frequency. Suppose I accepted deposits of 10 lakhs and I made default with respect to 10 lakhs. Now my minimum punishment is 1 crore or twice the 10 lakhs. That means 20 lakhs. 1 crore or 20 lakhs, whichever is less, means 20 lakhs. So minimum 20 lakhs, maximum 10 crores. Minimum 20 lakhs, maximum 10 crores. Suppose I accepted deposits of 100 crores. I made a default of deposit of 100 crores. Now my minimum punishment is 1 crore or 2 times of 100 crores, whichever is less, means 1 crore, maximum 10 crores. And with respect to officer in default, imprisonment plus fine. Imprisonment up to 7 years, fine, minimum 25 lakhs, maximum 2 crores. But if you are making, if you want to default any person like income tax department, so you received you received service income, you received amount under sales, but you're canceling the sale service income, putting them under deposits, showing them under deposits, so that you can avoid tax. Or some long-term loans you are putting under deposits to attract more loans from the banks. So simply, if your intention is to make fraud, then you will be punished under section 447. So with this, my dear students, deposits completed. So let me recap you quickly. So here we categorize companies into two types: eligible company, other than eligible company. In eligible company, you can see they can accept deposits to the extent of 10% from members, 25% from non-members. Other companies, they can accept 35% from members only. For startup companies and companies where there is no private company, private company, IFSC public company, they can go up to 100% of capital plus reserves plus securities premium. And then we discussed one more point. So there is no limit to the certain companies, like a startup company up to 5 years of incorporation. Next, a private company which is neither associate nor subsidiary to another body corporate, and total borrowings is less than 2 times of the paid up share capital or 50 crores, whichever is less, and no default with respect to repayment of those borrowings. So these two companies can accept deposits without any limit. And then we had discussion on procedure for acceptance of deposits. So simple conditions you need to remember: members approval, circular, board resolution, ROC filing, CS certificate, deposit repayment reserve account, depositor trustee, and then payment of interest on timely basis, repayment of money within the specified time. We covered all these points. And then we discussed exempted deposits. Finally, we completed punishment in case of violation of 73 subsection 2 and section 76.